Sir, very happy evening to all. Sir, we are going to start the revision series of the financial management, my dear lovable students. With regard to FM, the subject as a whole is 50 mark for examination, right, sir? This subject is having, FM is having objectives to achieve. There are three objectives to achieve for this subject as a whole. Number one, we have to take financing decision. What decision? Then we have to take investment decision. What decision? And we have to take the dividend decisions. We have to take the, with regard to financing decision, what are the sources of fund? What are its cost of capital? And capital structure theories is what the financing decision is all about. From where and all we can raise the fund. Generally, my dear lovable students, if you see the balance sheet, the liability side of the balance sheet will show the sources of fund. Will show the, and asset side of the balance sheet will show the application of the fund. There are various sources of fund to the business, such as equity share capital, such as preference share capital, such as debt, and you are having reserves and surplus. If you are raising the fund through equity share capital, the return what you are paying to the equity shareholders is called as equity dividend. Sir, if you are raising fund through preference share capital, what you are paying to the preference shareholders is what preference dividend. And if you are raising fund through debt, you will be paying interest. And to the reserves and surplus, since it belongs to the equity shareholders, again you have to pay the equity dividend. So as a financial manager, first decision what you are supposed to take is from where you have to raise the fund. If I raise the fund from the various sources, my dear lovable students, what will be the cost to the respective fund? That's what the chapter called as cost of capital. What of capital? In that, the objective of the chapter cost of capital is to learn how to find out the cost of debt. How to find out the, that is called as KD. That is called as how to find out the cost of equity. That is called as KE. That is called as how to find out the cost of preference shares. That is called as KP. That is called as how to find out the cost of retained earnings. That is called as KR. That is called as. Then, my dear lovable students, KD plus KE plus KP plus KR is equal to KO. Like this, you should not think. Because this is just the addition of the KD, KE, KP and KR. How much proportion of each element of cost matters a lot. That means I have to make the combination of the cost, not only the combination of the cost, and I have to do the weight of each source of finance. Weight of, that is called as weighted average cost of capital. Weighted average. So in this chapter, cost of capital, I'm going in the same order. Number one, we will be dealing with the financing decision. Okay, sir? In that financing decision, what are the sources of fund? Debt is a source of fund. Preference shares is a source of fund. Equity is a source of fund. Retained earnings is a source of fund. If I add all the four, I will get the WACC. But it should not be simple average. It should be weighted average. Sir, what do you mean by cost of capital? Generally, you have to understand that there are two parties are there. Number one is the company and the fund providers. Fund providers such as equity shareholders, fund providers such as preference shareholders, fund providers such as debt holders, and fund providers such as equity shareholders by way of retained earnings. If these people provide fund to the company, they will be expecting something in return. Sir, for the provider of the fund, it is the return, and for the people, the company who are paying its cost. So, cost of capital. Tell me, which is nothing but the return expected by the providers of capital. We know that there are various providers of capital are there, which may be shareholders, which may be lenders, and the debenture holders. That means these people will give money to the company. Once these people gives money to the company, they will be expecting something in return. That is their return, and it is cost to the company. That is called as what of capital. cost of capital. Sir, why we are learning? Why are we learning the chapter cost of capital? Because of three reasons. Because of number one, evaluation of the investment option. Sir, after this, we will be studying a chapter called as investment decision, which is nothing but capital budgeting and working capital management. Capital budgeting, and in that capital budgeting, we have to find out the NPV. We have to find out the IRR. My dear lovable students, sir, I have to discount the future cash flows. We all know that net present value is equal to present value of the cash inflow minus present value of the cash out. So I have to convert the future value into present value by doing a process called as discounting. By doing a process called as, I will do this discounting by using the word KO. For that purpose only, we are finding out the cost of capital. So number one, evaluation of the what option? Investment option. Number two, I know that various sources of finance are there, such as KE is there, such as KD is there, such as KP is there, such as KR is there. If I am going to do a particular project, I need fund. So by which way or which term I have to raise the fund? Whether it's better to go with all equity, or whether it is better to go with only debt, or mix of debt and equity. So that financing decision I have to take. If I know the individual cost of capital and if I know the overall cost of capital, then only I can compare. Then only I can compare the sources of fund and I can take the decision. That decision is called as financing decision. And number two, designing of optimum what policy? Credit policy. Because, sir, this is a working capital management decision. After I raising the fund, my dear lovable students, I will be doing the business, correct? When I do the business, I will be selling the goods. When I sell the goods to the debtor, I will say that, debtor, please pay me cash within next 30 days. Debtor, please pay me cash within next 60 days. This is called as debtor's collection period. Debtors, I will set the debtor's collection period based upon my cost of capital. Because if my debtor is giving me money very late, then I will not be able to pay interest to the debt holders. Automatically, KD will get affected. I can't pay equity shares and preference shares, the preference dividend and the equity dividend, then they will get disturbed. Are you all really with me? So, based upon my cost of capital, if my cost of capital is less, my dear lovable students, then I can have liberal credit policy. If my cost of capital is high, I can't wait, sir, to get the money very late from the debtors. You may get a theory question from this. What is the significance of what of capital? There are three significances are there. Sir, why are we studying this chapter? To evaluate the investment option. Number one, to evaluate the, sir, to take financing decision, to take and to designing of the optimum what policy? Credit policy. Okay, sir. So we understood that this chapter is very important, cost of capital. How to determine the cost of capital? Determination of the what of capital? How you will? Sir, cost is not the amount which the company plans to pay or actually pay. Rather, it is the expectation of the stakeholders. Even though the word is cost of capital, and this is technically applicable to the company, my dear lovable students. Sir, generally cost means, for example, if I am traveling from one place to another, I have traveled in an auto rickshaw. How much I paid to that auto rickshaw is what my cost. Sir, even though this is paid by the company, how much they are paying or how much they are willing to pay is not the cost of capital. The providers of fund are there. They are having certain expectations, right, sir? How much their expectation, it is the cost of the company. So to calculate what cost, step number one, identify the various cash flows. Identify the various cash flows in the sense means, if I raise the debt, if I issue the debenture, what will be the cash inflow from that? What will be the, how much is the interest I am supposed to pay on an year-to-year basis? If I pay interest, that interest will be debited to the P&L account, right, sir? Because of debiting that interest to the what account? P&L account. I am having certain tax benefit. I am having certain, what are the tax benefit I am having? And at the time of redemption, my dear lovable students, I have to repay the debt. So that is called as terminal cash flows. Terminal. So the ideal way to find out the cost of capital is to estimate the various cash flows. You will be having cash flows at 3 point of time. Number one, initial cash flow. Number one. Number two, my dear lovable students, is the interim cash flows. And the last one is the terminal cash flows. Last one is the like inflow of amount received at the beginning. At the Y0, what are the cash inflow? Because providers of various source of finance is providing fund to the company. Correct, sir? It will be an inflow to the company. And for that, company have to pay the returns like equity dividend, like preference dividend, like interest. So you have to find out the outflow of payment of interest, dividend, redemption of amount, etc. Are you able to appreciate? And inflow of what benefit? Tax benefit. That tax benefit will only be there for interest. Only be there for, or outflow of payment of dividend tax. Now, we don't have dividend distribution tax. That has been abolished in India. So because of that, while you are calculating the cost of capital, please don't consider the dividend distribution tax. Can I proceed? Thereafter, once you finalize the cash inflow, terminal cash flow, in between cash flow, use the trial and error method to arrive at a rate where the present value of the outflow is equal to present value of the inflow, which is basically IRR. Which is basically, that IRR should be taken as the cost. IRR should be taken as the cost. That means generally how you have to calculate the what of capital, cost of capital, is you have to estimate the cash flow from that particular financial instrument. How much cash inflow is coming to the company? How much company have to pay during the life of that instrument? How much the company have to return at the end of the life? Comfortable? So present value of the cash inflow should be equal to present value of cash outflow. That rate is called as IRR. That rate, IRR, should be adopted as the cost. In that, number one, sir, first source of finance may be long-term debt. What debt? Sir, for the long-term debt, we are liable to pay interest. Am I right? The cost of debt is represented by KD. Is represented by, sir, what is long-term debt, sir? It do not confer ownership to the providers of the finance. You may have a doubt that, sir, equity share capital are there, preference share capital are there. They are also long-term. But for equity shareholders and preference shareholders, they are having ownership rights. Whereas long-term debt people does not have the what right? Ownership right. Debt providers do not participate in the what of the company? Affairs of the company. On the day-to-day affairs, on the long-term affairs, on the decision making, on the minutes of the meeting, they will not be participate. They will just provide us the fund. And they will expect, sir, from us some return. That return is what? Interest. They get charged on the profit. What on the profit? That means whatever return, that is interest we are paying to the debt holders, will be debited to P&L account. Will be debited to? If you are debiting that to the P&L account, my dear lovable students, we used to call it as charge against profit. Charge against. Once you find out the charge against profit, you will be getting net profit, my dear lovable students. This net profit will go and sit in the profit and loss appropriation account. Profit and loss. That means when you prepare the profit and loss account, my dear lovable students, you will be debiting the interest on debt in the P&L account. Comfortable? So, after that only you will pay what? Tax. After that only you will pay what? You will get what? PAT. That is profit after tax. Since I am paying tax, after debiting the interest to the P&L account, this KD, I can call it as it's a charge against the profit. And from this part only, I will pay the preference dividend and also the equity dividend in the same order. So this is an appropriation of profit. What of profit? Whereas debiting interest to the P&L account is a charge against the profit. What against the profit? So they get charge on profit before tax in the form of interest. Comfortable? So we are going to find out the cost of long-term debt. There are two types of long-term debt are there. Number one, cost of irredeemable debt. Cost of redeemable debt. My dear lovable students, sir, I am starting a company and there are debt holders. Debt holders are saying that company has started for an infinite period. You are having going concern. So till you close the company, this fund you can keep. Every month, every quarter, every half year, based upon the terms of agreement, you just provide us the return. That is called as irredeemable debt. What debt? If the debt is a irredeemable debt, there is no question of redemption value at all. There is no question of. That means irredeemable debt are only it is having one side of a coin and other side is absent. That means, sir, if I am putting like this, the debt is having a life. That means opening value is there and closing value is there. Are you really with me? Whereas with regard to what debt? Irredeemable debt, only the net proceeds will be there. What will be there? And redemption value will not be there. Redemption value. Since redemption value is absent in case of what debt? Irredeemable debt. Sir, there is no concept of average liability. There is no concept of. Hence, sir, with regard to the KD means what of debt? Cost of debt is equal to I into 1 minus T is equal to divided by NP into 100. Divided by basically any source of fund. Now we are talking about long-term fund, my dear lovable students. With regard to the long-term fund, we understood that there are two types of long-term fund are there. Number one, irredeemable debt and redeemable debt, right? Sir, for the debt holders, we are going to pay interest. Are you all really with me? This interest will be debited in the what account? Profit and loss account. Because of debiting the interest in the profit and loss account, my net profit reduces. Are you all really with me? That is why this interest is called as charge against the profit. Clarity. So because of debiting the interest, my net profit reduces. I will give you a quick example. If the interest is 30,000, my dear lovable students, hello, and my net profit is 70,000, if I have not debited the interest, assume, what will be my net profit? 1 lakh. That means, sir, the net profit after debiting interest is 70,000. Right, sir? Sir, my net profit without debiting interest will be 1 lakh. Able to appreciate? If my net profit is 70,000, I am liable to pay a tax of 30,000. 70,000 into 30%, 21,000. If my net profit is 1 lakh, that means I am not debiting the interest to the P&L account. Then 1 lakh into 30% comes to 30,000. That means if no interest has been debited to the P&L account, I am liable to pay a tax of 30,000. If I am debiting the interest of 30,000 to the P&L account, I am liable to pay a tax of 21,000. So there is a tax saving. Am I right? There is a tax saving to the extent of 9,000, which is nothing but DT. Tell me, DT, which is nothing but interest amount into tax rate. Interest amount into what is the interest you have debited to P&L. So for this 30,000, sir, 30% tax savings are there. Am I right? So 30,000 into 30% comes to 9,000 is the tax benefit. 9,000 is the, so when I am calculating the cost of debt, my dear lovable students, which is I into what minus T? 1 minus T. Even though I am debiting 30,000 rupees interest to my P&L account, hello sir, I am having a tax benefit. I am having a, that means 9,000 rupees is my inflow. So 30,000 minus 9,000, net interest is 21,000. Net interest is, that's what we are calculating as I is 30,000. Comfortable? Into 1 means 100% minus tax rate of 30%. Can I proceed? That means 30,000 into 0.7 comes to 21,000. This is what happening in the I into 1 minus T. I into, sir, we are calculating what of capital? Cost of capital. Cost of capital is equal to cost divided by capital. Cost divided by, sir, it is not cost divided by capital. It is net cost divided by net capital. Net cost divided by, don't take gross cost, take the net cost. That's why in numerator I have calculated I into what minus T? 1 minus T. I into 1 minus T. That means in numerator I have not taken gross cost. I have taken, since I have taken net cost, my dear lovable students, in denominator I can't take the gross cost. I have to take the, so don't take gross proceeds, take the net proceeds. Take the net proceeds in the sense means gross proceeds minus flotation cost. Gross proceeds minus, my dear lovable students, we are talking about debt. Debt means debentures. Generally, this subject is not a Apagopa subject. This subject is an international subject. Hello, sir. That means if you are a debt holder, if you want to invest in my company, my dear lovable students, my company should be a listed company. My company should be a, sir, we are not calculating, sir, cost of capital for the private companies. We are calculating the cost of capital for the listed company, right? Listed companies in the sense means it should be listed either in recognized stock exchange or it should be listed in the Bombay Stock Exchange. Are you all really with me? So my dear lovable students, you are going to Marina Beach, you are going to, sir, some other beaches, and I just want to ask you one question. If you put a piece of thermocol, if you put a bottle, water bottle after you drink, you are just throwing onto the sea, what will happen to that bottle? It will be float on the water, right? Sir, in the recognized stock exchange, thousands of companies are there. Thousands of companies has been listed in the recognized stock exchange. Who said that my debenture, my shares are there in that stock exchange? So recognized stock exchange would have pop up my security to you. Out of lot of securities, my security should be floated in the recognized what exchange? For that, the recognized stock exchange will collect some charges from me. That is called as flotation cost. In order to float my security in the recognized stock exchange, I am liable to pay certain cost. I am liable to pay certain cost. That means you as a shareholder, my dear lovable students, will be investing the current market price. Will be investing the, for example, 100 rupees is the current market price. As a company, I can't enjoy 100 rupees. I can't enjoy 100 rupees because out of that 100 rupees, being the mediator, the stock exchange, for the flotation purpose, they will be charging what cost? Flotation cost, which will be either 2%, 3% or 5% of the issue price. Of the what price? That means if they are charging 5 rupees as flotation cost, balance only 95 rupees a company will be able to enjoy. I am not calculating the cost of capital for the investor. That is return on investment. I am calculating cost of capital for the company. That's why in the denominator, I am taking net proceeds. What proceeds? Which is nothing but gross proceeds minus flotation cost. Gross proceeds minus. So you tell me how you have to find out the KD. KD for a irredeemable debt is equal to KD is equal to I into 1 minus T divided by NP into 100. Comfortable? I stands for interest, annual interest payment. And KD is the cost of debt after tax. Cost of debt after tax. When I say KD, it is cost of debt after tax. That's why it is 1 minus T. That's why it is always the cost of capital will be after tax. Cost of capital will never be before tax. Cost of capital will never be before tax, and cost of capital means it is cost after tax, because I will be adjusting the tax element. Sir, what is I? Annual what payment? Interest payment. Generally, net proceeds means gross proceeds minus what cost? Flotation cost. Gross proceeds minus flotation cost. Comfortable? Sir, if nothing has been given in the question, how to find out the net proceeds, then sir, you can take the current market price. You can take the of the existing debentures of the, and T stands for tax rate. We all know, sir, net proceeds means issue price less issue expenses or the what cost? Flotation cost. So this is the first type of security a company will be raising to get the fund, my dear lovable students, which is, sir, cost of what debt? Irredeemable debt. Cost of irredeemable debt. That means KD is equal to I into 1 minus T divided by NP into 100. Are you settled with this? I'm moving to the next one, a beautiful discussion called as cost of redeemable debt. Cost of, generally 90% of the debt holders will be like that. Today they will give fund to the company and they will ask from the company that you can use my fund for next 10 years. Next, for this 10 years, please pay me interest, my dear lovable students. After 10 years, you have to repay my principal. So today, they will give us gross proceeds. They will give us, from that gross proceeds, we are supposed to incur the what cost? Flotation cost. So gross proceeds minus flotation cost will be the net proceeds. Will be the, comfortable? And every year, we are supposed to make them pay interest. Because of paying interest, we are having what benefit? Tax benefit, my dear lovable students. Comfortable? So your net cash outflow will be interest into 1 minus T. Because interest is a cash outflow and 1 minus T is a cash inflow. Comfortable? If you knock off cash outflow minus cash inflow, you will get the net cash outflow. You will get the net cash. Comfortable? Since the debentures are redeemable debentures, you have to pay redemption value at the end. You have to pay redemption value at the end. So, if the type of debentures are redeemable debentures, we have to redeem after certain point of time. That means there will be starting point and there will be ending point. Comfortable? Since there is starting point and ending point, I will not take the starting liability. I will not take the ending liability. I will be taking the average liability. I will be taking the, that means, sir, KD is equal to, am I calculating KD? What is KD? Cost of debt after tax. That word is very important. Cost of debt. What is the cost as a company you are going to incur interest? Is the interest cash inflow or cash outflow for the company? Cash outflow. But because of incurring this cash outflow, company is having a cash inflow, which is nothing but 1 minus tax. 1 minus, this is the net cash outflow. Plus, tell me, plus RV minus NP. Tell me, RV minus NP divided by N. Divided by, whole divided by, tell me, whole divided by RV plus NP divided by 2 into 100. RV plus NP divided by What this formula is saying that, have you issued a debt today? Yes, sir. Will you redeem the debt after 10 years? Yes, sir. You will be incurring two type of cost. You will be incurring, one is revenue expenditure and other is capital expenditure. One is revenue expenditure and other is, my dear lovable students, every year you are supposed to pay interest. You are supposed to pay. Sir, every year if something is happening, it is revenue in nature. It is revenue in nature. That's why KD is equal to I into 1 minus T. I into, actually my cash outflow is only I. But because of that cash outflow, I am having a tax inflow. So because of that, my cash outflow reduces. I will not take cost. I will take the net cost. That's why I into 1 minus T. Comfortable? Plus, that means I have taken care of the revenue expenditure, my dear lovable students. Now I am going to take care of the capital expenditure. Can I take care of capital expenditure? Today, a debt holder has given only 100, but after 10 years, I am liable to pay 120. That means 120 minus 100 means there is extra payment of how much? 20. This 20 extra payment, I am not paying for 1 year. I am paying for 10 years. That means I have to amortize this 20. I have to, over the period of 10 years, that is N. That is a logic of RV minus NP. What is RV? Redemption value, which is how much? 120. Minus ENP 100. That means extra you are paying 20. Is it for 1 year or life? That's why N. That's why N. Right, sir? So there are two costs you are supposed to pay. Cost number one is the revenue expenditure. Cost number two is the capital expenditure. What is revenue expenditure? Sir, KD is equal to I into 1 minus T plus RV minus NP divided by N. In this I into 1 minus T is the revenue expenditure, and RV minus NP divided by N is the capital expenditure. Comfortable? Sir, you look at the start of the project, man. When you look at the start of the project, sir, I am having 100 rupees. I am having 100 rupees. But at the end, the investment grown, and it has grown to 120 rupees. So my opening liability is only 100, whereas my closing liability is 120. 120. Correct? Sir, can I say that in the mid of the project, sir, my liability is 110? Because 100 would have grown to 110. At the end of 10th year, my project would have grown to 120. Correct? That means I am paying this much cost. Which much cost? Sir, I into 1 minus T every year. And RV minus NP divided by N for 10 years. Not for the start of the debt. Not for the mid of the debt. Not for the end of the debt. To enjoy the entire 10 years. Correct? So I will not take opening liability. I will not take closing liability. I have to take average liability. What liability? That's why, sir, RV plus NP divided by 2. What is RV? Redemption value. That is at the value at the end. That is at the value at the, tell me, what is NP? Net proceeds. That is at the value at the start, which is nothing but closing liability plus opening liability divided by 2 is what my average. That means I am paying this revenue expenditure and I am paying this capital expenditure to enjoy the average liability. So my dash of capital, cost of capital is equal to cost by capital. Correct? Which is net cost. Which is what cost? Net cost divided by, sir, net capital, which is equal to average capital. Can I proceed? Here in this, my dear lovable students, what is I? I stands for what payment? Interest payment. what is NP? Net proceeds. Net proceeds. Sir, either net proceeds you can take or you can take the current market price if nothing. Sir, in question, examination question, you will be getting two types of KD. Sometimes the company may be a new company and they may be issuing KD for the first time. Then in examination solving question, take the NP as the new price. Sometimes the company may be an existing company and they will ask you to find out the what of capital, cost of capital. Sir, you have to take the what market price, current market price, because that debt already issued. That debt, then I can't take the issue price. Then I have to take the current market price as the NP. Comfortable? RV stands for what value? Redemption value. T stands for what? Tax rate. N stands for remaining life of debenture. Don't say life of debenture. Sometimes the N may be 5 years in question because they will say that 10 years is the total life. Out of 10 years, already 5 years over, balance 5 years are also only there. Then, my dear lovable students, if you have to calculate the KD, you have to take the denominator as the 5 years. That is balance life of the debt. Balance, brilliant, my dear lovable students. Sir, this formula is used for only when interest on debt is what deductible? Tax deductible. Sometimes debt are issued at a discount and redeemed at a what? Premium. In such case, discount on issue and premium on redemption are also what deductible? Tax deductible. Then the following formula can be used. I will tell you why they are what they are saying. Sir, if question saying that only interest are tax deductible, then this formula should be used in exam. Or if they are saying that there is tax effect for the capital expenditure also, that is, you are having loss on redemption of debentures, correct? If you are having loss on redemption of debenture, can you say how much loss? 20. Because redemption value 120, issue price 100, 120 minus 100, 20 is the loss on. Sir, every year divided by 10, 2 rupees can be debited to P&L account. Can be debited to. If that is allowed under the Income Tax Act, then there will be one more tax benefit from the capital expenditure. Am I right? Then, my dear lovable students, don't take I into what minus T. Take just I plus RV minus NP divided by N. For both of this cost, apply 1 minus T. For both of this cost, apply. Sir, here I am applying the tax benefit only for the revenue expenditure, not for the capital expenditure. It depends upon question. 99.99% in exam, we are using only this formula. Only this formula. Only this formula. Are you able to live with me? But I can't say that this formula is not there in the syllabus because this is the document issued by ICI Board of Studies. Hello, sir. So, like this also, a scenario may be tested in examination. Comfortable? Then there will be a change in formula. The formula will be I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Aduk badila. I plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 1 minus T. That means on the entire numerator, you apply 1 minus T. Comfortable? Both on revenue expenditure and on capital expenditure, enjoy the tax benefit. These two formulas are called as approximation method. What method? Because there is a big defect in this formula. I will tell you what is the defect. It's a blunder. This formula is a blunder. I will tell you why. Because KD is equal to, sir, I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. You know this formula? My dear lovable students, RV means what? Redemption value. That you will be paying at the end of the life of the debt. That means it's a future value. It's a Whereas NP means net proceeds. That means present value. Present value. You are reducing future value minus present value. That means this formula does not consider the time value of money. Does not consider the time value of money. Right? Sir, if the debt is a irredeemable debt, it is a irredeemable debt, then KD is equal to I into 1 minus T divided by NP into 100. I means interest. I mean interest. Correct? Yes, sir. Sir, into 1 minus T. T means tax rate. NP means net proceeds. Generally, this NP will be in Y0 and this interest will be in Y1 and tax will be in Y1. Yes, even this formula does not consider what value of money. But much difference will not be there because only there will be a time difference of 1 year. So only general, normal, inflation difference will be there for this formula. Whereas for this formula, 10 years time value of money will be there. That is why, or that is the logic, only for the redeemable debt, you are having YTM approach. You are having YTM approach is not possible or irrelevant, my dear lovable students, for a irredeemable debt. For irredeemable debt, the main formula itself serves the purpose. If you find out as per YTM also, maybe decimal difference may be there, but the major difference won't be there. Appreciating? So using present value method, what method? Or yield to maturity approach. Yield to, which is nothing, YTM is equal to IRR. YTM is equal to, the main defect in the approximation method is it does not consider the time value of money. Correct? That means, my dear lovable students, what cost of capital is saying that I am borrowing the technique of the capital budgeting. I am borrowing the technique of the capital budgeting. Can we? Yes, sir. So YTM is IRR at which current price of a debt equals to the present value of the cash flows. That means this is a cash flow game. This is a YTM. What's the full form? Yield to maturity. YTM. Hence, it's a 3-step approach. Are you all really with me? Step number 1, identify the cash flows. What are the cash inflow? What are the cash outflow? Cash flow at the start, cash flow at the end, everything you find out. Are you really with me? Step number 2, calculate NPV of cash flows. What of cash flow? NPV stands for net present value. NPV stands for as identify above using 2 discount rate. 2. So calculate NPV at 10%. Calculate NPV at 15%. Sometimes your NPV at 10% may be positive and NPV at 15% may be negative. You have to interpolate. Step number 3 is calculate what? Yeah. What are the cash flows associated with the redeemable debt? The relevant cash flows are in Y0, year 0, net proceeds in case of new issue. Net proceeds. Company will get the money. That will be a cash inflow. Am I right? Yes, sir. 1 to nth year, I into 1 minus T. I into 1 minus T will be a cash outflow from the angle of the company and cash inflow from the angle of the investor. Am I right? And N stands for redemption value. N stands for. So there are 3 cash flows are there. Simple. Cash flow at the start. Cash flow at the end. Are you all really with me? And you are having interim cash flows. What cash flows? Interim cash flows. Only 3 cash flows will be there. Once you know the cash flows, sir, by using some guess rate, generally we will guess at 10%. Correct? Calculate the NPV of cash flows. What is NPV? Net present value. Net present value in the sense means discounted cash inflow minus discounted cash outflow by using 2 different discount rate. I will discount at 10% and I will discount at to get each a positive NPV and also what NPV? Negative NPV. I need one positive NPV and I need one negative NPV. Comfortable? Once I get that, I can do the interpolation. What polation? My IRR is equal to L plus. L stands for the lowest percentage. If I am going from lowest, I have to add. If I am going from highest, I have to minus. That I will do at the time of solving sums. Plus NPVL, that is the lowest NPV, divided by NPVL minus NPVH, that is highest NPV. The difference into H minus L. I will not use this formula when I am solving. I will use the interpolation method that I will say to you. Sometimes at this time, this formula you won't understand. Leave it, wait for me. Right, sir. One example I'm going to solve. This is an ICA example, sir, that I will be solving. Right, sir? A company issued 10,000 10% debentures of 100 each on 1/4/2021 to be matured on 1/4/2026. Upper 21 means 26. What is the life gap? 5 years. So the debt is a dash debt, redeemable debt. Only for redeemable debt, YTM approach will be applicable. Right, sir? The company wants to know the current cost of its existing debt, that is KD. If the market price of the debenture is 80, considering 35% tax rate. Right, sir? Think from the angle YTM is equal to IRR, internal rate of return. Internal return is for the company or for the shareholders. Before I start this show itself, I said that how much company is paying to the shareholder is not cost of capital. How much the fund providers are expecting is the what? Cost of capital. Correct? So my dear lovable students, in year number 0, current market price 80 rupees will go out of their pocket. That is from the investor's pocket. So 80 rupees will be a cash outflow. Cash? Sir, for the company it is cash inflow, sir. Under YTM approach, it is yield to maturity is the dash RR. IRR full form, internal rate of return. For whom it is return? Investor. That means company is calculating from the angle of investors. Hello? So my dear lovable students, for an investor, they will invest 80 rupees today. They will invest 80 rupees today. That means, my dear lovable students, value of an asset today is equal to present value of its future cash flows. Present value of its future cash flows. Clarity? Sir, from 1 to 5, interest net of tax. That is what I into what minus T? 1 minus T. You tell me what is the face value of the debenture? 100. For that 100, every year, company is liable to pay 10%. 100 into 10% comes to 10 rupees. For that, so 10 rupees will be the cash outflow to the company. Correct? Yes, sir. My dear lovable students, sir, if this 10 rupees has been debited in the P&L account, company will be having tax savings. Company will be having tax savings. Company will save a tax of 35%. That will be tax inflow. So minus 3.5 because 10 into 35%. So the net will be 6.5. Sir, but the shareholder, but the debt holder, he'll be receiving 10 rupees. No, sir. Now only you said that you have to take the cash flow from the angle of the investor. Then why are you taking the cash flow of the company? If this 10 rupees has been received by the investor, that will be an income to him, which will be taxable under IFOS. Then he is liable to pay personal tax. For an investor, is the personal tax is an inflow or an outflow? Outflow. If since nothing, no information has been given in the question, I have to assume that this tax rate is applicable for the investor also. Otherwise, you just think, who is finding? Company. How many debt holder? 1 crore. Will you go and to every person, what is your basic assumption limit? What is your basic assumption limit? What is your basic assumption limit? Is it practically possible? No, sir. So we are assuming that company's outflow is equal to investor's inflow. Comfortable? Yes, man. In the 5th year, we will be paying redemption value. They specifically said that, sir, nothing has been said to be matured on 1/4/2026. Am I right? Then if nothing has not been mentioned, we will be assuming that we will redeem at par. So these are the cash flow, man. I have finalized the cash flow. I'm going to calculate the NPV. Enjoy the NPV calculation. In year number 0, what is the cash flow? For Y0, the present value factor will be 1. The present value factor will be 1. The cash outflow 80, because this is from the angle of investor. Sir, for that present value is 1. I'm calculating. Hello, sir. I'm not doing for the next one. Let me complete this. For 1 to 5 years, the cash inflow from the angle of the investor is 6.5. Comfortable? So first year, second year, third year, fourth year, fifth year. Take your calculator, sir. 1 divided by 1.1 is equal to, put in some calculator, you have to put into is equal to, if the is equal to is not working. Second year, then again third year equal to, fourth year and fifth year, GT will give you 3.791. This is called as cumulative present value factor. This is called as. So my dear lovable students, 6.5 into 3.791 comes to 24.64 is the cumulative present value factor. Present value of the cash inflow. Present value of the cash inflow. Comfortable? And at the end of the fifth year, the debenture holder will get 100 rupees. For that, don't take cumulative, because this is not repeated cash flow. Correct? My dear lovable students, calculator 1 divided by 1.1. First year, into. Second year, third year, fourth year, fifth year. Then you will be getting 0.621. Are you getting? So 100 into 0.621 comes to 62.1. 62.1. That means this is the discounted cash inflow. Discounted cash inflow for the investor. And this is the discounted cash outflow for the investors. Right? My theory, my ideology is, sir, 80 rupees should be equal to 80. My ideology is 80 rupees should be equal to Abdina, the present value of the cash inflow. That is value of an asset today. Value of an asset today should be equal to present value of the future cash inflows. Sir, if I discount the future cash flow at some rate, that should be exactly equal to 80. Let me ask you a question. Here I am having cash outflow and here I am having cash inflow. As an investor, how much you invested today? 80. But you are getting two cash inflows. Number 1, interest. Number 2, redemption value. What is the present value of interest, my dear lovable students? 24.64. What is the present value of redemption value? 62.10. Calculator. 24.64 plus 62.10 comes to 86.74. 86. That means this 80 rupees 80, if it is growing at some X percentage, it will become 86.74 after how many years? 5 years. I don't want 86.74. I want exactly 80. That's my theory. Because at IRR, my discounted cash inflow should be equal to discounted cash outflow. That means I can say that my IRR is not equal to 10%. Not equal to. You can take this as NPV, net present value. Are you getting positive NPV? Positive NPV can be equated as profit. You are having profit. Do you have profit or do you want zero? Zero. So you should not have profit. If you don't have profit, you have to increase the cost. Increase the. That's why after 10%, I am discounting at 15%. I'm discounting at 15% because at 10% I'm getting positive NPV. Correct? I don't want positive NPV. At IRR, my ideology is discounted cash inflow should be equal to discounted cash outflow. Clear? Comfortable? That means, my dear lovable students, sir, the same question I am discounting at how much percent? 15%. 15. So calculator, what is the present value of 80 today? 1. Sir, 1 divided by 1.15 is equal to, you will be getting 0.869. For second year, 0.756. For third year, 0.657. Fourth year, 0.571. 0.497 is for fifth year. GT comes to 3.352. This is the cumulative present value factor at 15% for 5 years. So 6.5 into 3.352 comes to 21.79 is the present value of the future cash inflows. For an investor, only this cash flow, he is having another cash flow to the extent of 100 that he will be getting at the end of. If the discounting factor is 15%, calculator 1 divided by 1.15 is equal to second year, third year, fourth year, fifth year. What is the applicable present value factor? 0.497. So calculator, man, 100 into 0.497 comes to 49.7. This is the discounted cash inflow. Discounted cash inflow. Correct. Sir, in future, that means in future, I am going to get 6.5 into 5. Am I right? 6.5 into 5 comes to 32.5. In future, I am going to get a redemption value as 100. That means I will be getting 132.5 totally. And I am going to invest only 80. Correct? If I discount this 132.5 to the present value at the rate of how much percent? 15%, it comes to 21.79 plus 49.7, which comes to 71.49. Oh my God. It should not be 71.49. It should be exactly equal to, that means my NPV is negative. My NPV is, that means if I am discounting at 10%, I am getting positive NPV. If I am discounting at 15%, I am getting negative NPV. Are you all really with me? Then I understood that my IRR is between 10 and 15%. Can we interpolate? My dear lovable students, how to interpolate at 15% and at 10%. At 15%, my dear lovable students, your NPV was negative of 8.51. At 10%, your NPV was 6.74 positive. I don't want negative NPV. I don't want positive NPV. I want NPV to be 0. Comfortable. That means from negative to 0, I have to travel 8.51. But I totally travel 8.51 plus 6.74. And the total miles I have traveled is 15 to 10, which is 5. Are you able to appreciate? Which is 8.51 plus 6.74 comes to 15.25 upon 8.51 into 5. So 8.51 divided by 15.25 into 5 comes to 2.79%. I should reduce. I should. From what I have started, 15%. So 15 minus 2.79% comes to 12.21%. If I am discounting my cash flow at 12.21%, my present value of cash inflow will be equal to present value of cash outflow. This is called as YTM. This is called as YTM approach. This is applicable only for dash type of debt, redeemable debt, and will not be applicable for the irredeemable debt. I'm going to amortization of bond, the next concept from this area. My dear lovable students, a bond may be amortized every year. In the sense means, I will say that today I am going to issue a bond of rupees 1 lakh. Instead of paying the entire 1 lakh at the end of 10th year, you do one thing. First year end, get 5,000. Second year end, get 5,000. Third year end, get 5,000. Fourth year end, get 5,000. 5,000 or 10,000, whatever it may be. If I am paying every year end 10,000, 10,000 into 10 comes to 1 lakh. Why companies are doing like this? To reduce the tension of the redemption value. Otherwise, after 10 years, if company have to pay a bulk amount of 1 lakh, their working capital will get affected. They have to go for another loan. So if they are paying 10,000, 10,000, 10,000, interest burden also will reduce. And also the principal burden will also reduce at the end. So a bond may be amortized every year. That is, principal is repaid every year rather than at what? Maturity. Instead of paying the entire redemption value on maturity, company will be paying some amount at equal intervals. Are you really with me? In such a situation, principal will go down. Yes. Because if the principal is how much lakh? 1 lakh. And if you repay 10,000, balance 90,000 will only be there. Then only on that 90,000, the company is liable to pay interest. Then a company is having a responsibility of repayment of only 90,000 with annual payment, and interest will be computed on the what amount? Outstanding amount. Only on this 90,000, you have to calculate the interest. Am I right, sir? And cash flows will be uneven because every year principal repayment will be same. That will be cash outflow for the company. But since you are calculating interest on the outstanding amount, the interest will come down, come down, come down, come down. Comfortable. So the total cash outflow on every year from the angle of the company will be principal repayment plus the actual interest what they are paying. Are you all really with me? So you have to calculate the value of the bond. What of the bond? The value of the bond today, which is nothing but value of a bond today, is equal to present value of its future cash flows. Present value of its. For example, if company is saying that the company will repay every year some cash flow, every year some, for example, 10,000 rupees company will be repay for next 5 years. In addition to that, company will be paying what also? Interest also. Interest also. So 10,000 plus interest will be the cash outflow from the angle of the company in year number 1. The present value of this cash flow, I have to discount it because this is Y1 at Y1 because at the end of year number 1, am I right? To bring that, I have to do, sir, 1 plus KD raised to 1. 1 plus KD means cost of debt. Cost of, sir, why are you putting raised to 1? Because this is a cash flow at year number 1. I have to discount it to bring to year number 0. So one time discounting is enough. One time. Plus, for this bond, even in year number 2 also cash flow will be there. Am I right? So for that, my dear lovable students, 10,000 again plus what? Interest. But that interest will not be equal to this interest. It will be less than the year number 1 interest. Are you able to match? Then 1 plus KD raised to 2. 1 plus KD raised to 2. Because this cash flow is at the end of year number 2. First of all, I have to bring that to end of year number 1. And then I have to bring to year number 0. So I have to do 2 time discounting. Comfortable? And the last one, sir, 10,000 plus interest, sir, divided by 1 plus KD raised to 3. Raised to, and so on. It will go, sir, 10,000 plus interest divided by 1 plus KD raised to N. I don't know. If the life of the bond is 10 years, I will be doing at N. So when you, sir, see this formula, value of a bond means, sir, the present value. Value of any asset today is the present value of its future cash flows. If you invest in a bond, you will get back the principal, you will get back the interest. Are you all really with me? if you discount it by using the appropriate discount rate, which is nothing but KD. Because for a debt, the relevant rate is what? KD. Are you able to appreciate? We are having one more quick concept from debentures. Debentures may be convertible debentures. What debenture? Convertible debenture in the sense means, my dear lovable students, sometimes I would have invested in debentures of the company. Sometimes company will say that in future we will give back you cash. Listen, there will be an option to get, either get the debenture redeemed into what? Cash. Either you get it as cash. Till now we dealt such a situation. Or get specified number of company shares. I invested in the dash of the company, debentures of the company. But in future, I may get cash. If I get cash, RV, redemption value, will be in cash. Sometimes company may say that I will give you shares. I will give you shares. Then the redemption value will not be in cash. Redemption value in kind. Redemption value in. So while determining the what value? Redemption value. It is assumed that all the debenture holder will choose the option which has the dash value, higher value, which is dash to the holder. For example, today if a company is going to issue debt, company will say that after 10 years, either you can get the face value of the debenture as return, or you will get 2 equity shares, based upon the market price after 10 years. Sometimes after 10 years, for one share, the market price may be 65. For one debenture, how much equity share I will get? So 65 into 2 comes to 130 will be the redemption value if I adopt conversion. I am saying that I don't want conversion. Please give me cash. Then you will get only face value of how much? 100. When we are calculating the KD, cost of debt, and if the debenture is a convertible debenture or redeemable debenture, rather, are you really with me? My dear lovable students, sir, I into what minus T? 1 minus T plus RV minus NP divided by N, whole divided by RV plus NP divided by 2 into 100. This RV, we will assume that either 130 or 100, whichever is higher. Every debenture holder will choose highest value. You may have a doubt or ask me a question. Why, sir, company is stupid to issue or give 130 rupees instead of? Because 130, there is no cash outflow in the hands of the company. Yes, sir, they are giving only shares. But if they are giving cash, my dear lovable students, they have to pay 100 rupees. So company is feeling that let them get the shares rather than cash. Are you really with me? Yes, sir. These are the discussion from the KD. So whatever we are talking till now, I'm consolidating for the time being, my dear lovable students. Cost of capital. We started talking about cost of capital. Why? Because the subject flow is like that. We have to take 3 decisions, my dear lovable students. Right, sir? Number 1, financing decision. Financing decision means from where I have to raise the fund. So there are so many sources of fund, like equity, like debt, like preference, like retained earnings. For every sources of fund, it is cost associated. Right, sir? So we started finding out what is cost of capital. Cost of capital means it is not the amount paid by the company, it is a return expected by the providers of capital, right? What is the significance of cost of capital? Why are we learning this chapter? To understand 3 things. Number 1, evaluation of the investment option. Number 2, to take the financing decision and designment of the optimum credit policy. Comfortable? Sir, how to determine the cost of capital? The ideal way of determining the cost of capital is analyzing the cash flows. That means as a person, you should know how much cash inflow at the start, outflow at the start, how much during the mid and at the terminal cash flows. Comfortable? The debt may be long-term debt. It will be represented as KD. That debt may be redeemable debt or if the debt is a irredeemable debt, lifelong, there is no need of repayment. RV concept will not be applicable. Then KD is equal to I into 1 minus T divided by NP into 100. Comfortable? But if the debt is a redeemable debt, you have to repay after a certain point of time. Right, sir? Then KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Are you really with me? Sometimes in question, they may say that not only the capital expenditure is tax deductible, but also not only the revenue expenditure is tax deductible, but also the capital expenditure is tax deductible. Then you have to alter the formula in such a way that I plus RV minus NP divided by N whole into 1 minus T divided by RV plus NP divided by 2 into 100. Right? This formula is a blunder. That's why this formula is called as approximation method. Because this formula is comparing future value with the present value. I can't minus monkey with donkey. So this formula is baseless. That's why we are using the YTM approach. The basic ideology of the YTM approach is present value of a cash flow today. Value of an asset today is the present value of its future cash inflows. Present value of its future. That's what YTM is all about. How to compute the YTM. First of all, identify the cash flows. Then calculate NPV, net present value, by using trial and error method and find out one positive NPV and one negative NPV. You can fix that. The IRR is between that. And you have to interpolate and you have to calculate the IRR. Can I proceed? Sir, there is a concept called as what of bond? Amortization of bond. Amortization in the sense means instead of today issuing the net proceeds and fully paying redemption value at the end, what I will do is, my dear lovable students, I will be redeeming the debt in the over the tenure of the life. That means the investor will get cash flow at year number 1, which is principal repayment plus interest. Year number 2, which is principal repayment plus interest. Year number 3, year number 4, year number 5, year number X, which is principal plus interest. That I have to discount by using the discounting factor called as KD. For first year, I will use 1 plus KD raised to 1. For second year, I will use 1 plus KD raised to 2. For third year, I will use 1 plus KD raised to 3. And for nth year, I will use 1 plus KD raised to n. Sometimes in question, they will be calculating, asking you to calculate the conversion. The debt may be convertible debt. If it is convertible debt, if the question is silent regarding the redemption value, please assume that either the cash redemption portion or the kind redemption portion, whichever is higher, will only the every debenture holder will choose. That's what nyayam. So that's it. With regard to the first cost of capital, first element of capital called as KD. In the coming slot, we will be talking about cost of what share capital? Preference share capital. That is KP. Are you all really with me? Which comprises of, again, redeemable preference shares. Then we will move into the real cost of capital, that is KE, by using dividend price approach, earnings price approach, growth approach, realized yield approach, and capital asset pricing model. Sir, what is dividend price approach? What is the logic of the formula? What is earnings price approach? What is the logic of the formula? What is growth approach or Gordon's approach? G has been found out by Gordon. That's why GG Parle G. Come on, sir, what is the formula and what is the logic? Then, my dear lovable students, he has propagated various type of growth. If it is average growth, how to find out? If it is, sir, Gordon's growth model, how to find out? Are you all really with me? Then Gordon's growth model, which is G is equal to B into R. Then you are having realized yield approach, which is nothing but YTM. Yield to maturity, how to find out that? Then capital asset pricing model, that is RF plus beta into RM minus RF. Hello, sir? Then we can calculate the KR and how to find out the KR at different. Then we will be moving into the WACC, that is weighted average cost of capital. While calculating the WACC, what is the relevance for the book value and also for the market value? That's it. And we'll be solving one question from the WACC, my dear lovable students. That's it. We will be done with the chapter of the what of capital. cost of capital. What you are supposed to do is take a breathing space of 15 to 20 minutes, revise whatever we have done and come back. We'll be completing the next part. Are you comfortable? Sir, very happy afternoon to all. So we started our revision of the chapter cost of capital. Chapter cost of capital means finding out the KO. That is the objective. We are having various sources of finance such as KD, KP, KE, KR and the KO called as overall cost of capital. Right, sir? It is not simple average of KD, KE, KP and KR. It is weighted average. So what is cost of capital? Yesterday we understood that cost of capital means the return expected by the providers of the fund. Like what is the return expected by the equity shareholders, return expected by the preference shareholders, return expected by the debenture holders and return expected by the equity shareholders for the retained earnings. Why are we learning this chapter? To evaluate the investment opportunities, to take the financing decision and to design the optimum what structure? Capital structure. Generally, every company, in order to evaluate or find out the cost of capital, they have to analyze the cash flows. There are three cash flows will be there. Cash flows at the start, cash flows during the tenure of the instruments and cash flows at the end. Are you really with me? So that is called as various cash flow. Cash inflow will be there at the start. Cash outflow will be there such as returns for interest, equity dividend, preference dividend. And for this cash outflow, there will be tax benefit and you will be having the redemption or the terminal cash flows will be there. Sir, we have started talking about cost of long-term debt, which is called as KD. There are two types of debt will be there, irredeemable debt and the redeemable debt. Irredeemable debt means, sir, I will not repay the debt at all. That means KD is equal to I into 1 minus T divided by NP into 100. Whereas if the debt is a redeemable debt, sir, I will be repay after certain point of time. That means life will be there for the redeemable debt. So you can use either approximation method or YTM method. In that approximation method also, you have to check in the question that for the capital expenditure, is tax benefit available, not available? If the tax benefit is available for the capital expenditure, sir, not available for the capital expenditure, then KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Whereas if tax benefit are available even for the capital expenditure, then KD is equal to I plus RV minus NP divided by N whole into 1 minus T divided by RV plus NP divided by 2 into 100. My dear lovable students, if the debt is a redeemable debt, then surely redemption value will be there. That means a definite period of life will be there. Then we can follow YTM approach. YTM is equal to IRR. It is the rate at which discounted cash inflow will be equal to discounted cash. It's generally a three-step approach. First, we have to analyze the cash flow. Then we have to find out the NPV, one positive NPV and another negative NPV. And we have to find out the IRR by using the interpolation method. Are you really with me? Yes, sir. Then we are having a concept called as amortization of bond. Certain company will decide that if I am issuing bond at 1 lakh and if I am repaying 1 lakh after 10 years, that will be a burden for me. So instead of giving back 1 lakh in one shot, let me pay 10,000, 10,000, 10,000, 10,000 every year. So automatically what will happen? The interest also will come down and the principal repayment burden will also reduce. So what is the value of the bond today? Value of the bond today is equal to present value of its future cash flow. That means how much money you are going to get at the end of the first year. That you have to discount to bring into today value. So value of bond is equal to cash flow, what you are going to receive at the end of the first year, divided by 1 plus KD raised to 1 plus cash flow at the end of the second year divided by 1 plus KD raised to 2. Sir, like that it go on. And sir, cash flow at the end of the nth year divided by 1 plus KD raised to N. This is what? sometimes convertible. The debentures may be convertible debentures. Then when we solve the convertible debenture question, we have to take the redemption value as either the cash portion or the kind portion, whichever is higher. That's what the basic normal logic we will be taking. And I'm moving into the second source of finance called as cost of preference share capital. For the preference share capital, my dear lovable students, we will pay dividend at a specified rate on face value. How we are paying interest for the debt, the same way for the preference share capital also, we will be paying what dividend? Preference dividend. This preference dividend will also be fixed percentage, like 12% preference share capital, 11% preference share capital, and the dividend will be treated as approximation of the profit. That is, there are two things are there: charge against the profit and approximation of, right, sir? Sir, this is, sir, appropriation, sir, because we will be preparing the profit and loss in account, appropriation account. That means after paying the tax, that is PAT, profit after tax. From that only we will pay the preference dividend. That means of after tax profit. That means we will be having earnings before interest and tax. From the earnings before interest and tax, we will pay the interest. We will get the earnings before tax. Earnings before tax. From that, we will pay the tax. We will get the PAT. From that PAT only, we will pay the preference dividend. Are you really with me? So, does not reduce the what liability of the company? Tax. This is the difference between the KD and the KP. Sir, we are having tax benefit for KD, whereas we don't have tax benefit for KP. Are you really with me? So, my dear lovable students, since the KD is having what benefit? Tax benefit, and KP is not having what benefit? Generally, KD will be cheaper than KP. KD will be cheaper than KP. Sir, how you are to calculate the cost of preference share capital? Preference shares may be irredeemable preference shares or redeemable preference shares. Right, sir? If the preference shares are irredeemable preference shares, my dear lovable students, till the company is going to, sir, close it, we will not pay to the preference shareholders. How, sir? Sir, Companies Act 2013 specifically saying that the maximum life of the preference shares is only 20 years. Have you heard about it? Then how we can have a irredeemable preference shares? Because this subject, financial management, is not Indian subject. This is international subject. Are you really with me? Such provisions are not there in Australia. Such provisions are not there outside India. So, my dear lovable students, sir, cost of preference, KP, is equal to, for the debt holders, we are supposed to pay interest, right, sir? The same way, we will be paying preference dividend. What dividend? Preference dividend. What dividend? So, that is a cost the company is going to bear, divided by net proceeds, divided by. That's what P0, my dear lovable students. So, PD means annual what dividend? Preference dividend. It will be specifically expressed by the preference shareholders. It will be specifically expressed by the preference shareholders. And P0 means net proceeds from the issue of what? Preference shares. That means either gross proceeds minus flotation cost will give you the what proceeds? Net proceeds. So, net proceeds means issue price minus issue expenses, or what cost? Flotation cost. But if the preference shares are redeemable preference shares, today I will issue the preference shares. After a certain point of time, I have to repay the money, right, sir? Then you will be having what proceeds? Net proceeds. And you will be having what value? Redemption value. Redemption. But the preference dividend, what I am paying every year, is not tax deductible, because it is not a charge against the profit. It is a appropriation of the profit. It is a, hence when you are calculating the KP, 1 minus T will be absent. But when you are calculating KD, 1 minus T will be present. Are you really with me? So, my dear lovable students, PD plus what plus? This is a revenue expenditure, my dear lovable students, because every year we are supposed to pay the preference dividend. Am I right, sir? plus RV minus NP. Tell me, RV minus NP. If the RV per preference shares is 120 and the NP is just how much? 100. 20 rupees is what extra you are going to pay. 20 rupees is what extra you are going to pay. This extra is not for the start of the preference shares. This extra is not for the end of the preference shares. It is for the life of the preference shares. So this capital expenditure has to be, sir, written off, depreciate, amortize over the period of the life of the preference shares. Right, sir? That's why divided by N. What is the RV? 120. Minus what is NP? 100. That means what is the difference? 20. Divided by life. Assume 10. Comes to 2 rupees. Every year there is a loss. There is a premium on redemption of preference shares. Comes to 2. Are you ready with me? My dear lovable students, divided by RV plus NP divided by 2. Because redemption value may be 120 and NP is how much? 100. I will not take the opening liability. I will not take the closing liability. I will take the, or I have to take the average liability. Comfortable? That means 120 plus 100 divided by 2 comes to 110 is what? The average liability. In order to enjoy that 110, only I am yearly paying preference dividend. In order to enjoy that 110, only I am incurring capital expenditure of 2 rupees per share. Are you really with me? So what is the preference dividend? Annual preference dividend. PD stands for annual preference dividend. It will be already expressed by the preference shareholders. And RV means what value? Redemption value. NP means what proceed? N stands for remaining life of the preference shares. Remaining life of the, my dear lovable students, when you are calculating the KO, that is overall cost of capital, the first one we have talked about KD. The KD of various types, which may be long-term, redeemable or irredeemable, or amortization of bond, or convertible debenture, that with IRR and YTM, all those terminologies we have discussed. Are you comfortable? The next one is the KP, my dear lovable students. The speciality of KD and KP are expressive. They will say that I need 12% interest. KP will say that I need 11% preference dividend. Whereas the next group is there, which is KE, cost of equity. They won't explicitly say that this is my expectation. So it is little difficult to find out the expectation of the equity shareholders. Are you really with me? So equity share capital, it is the expectation of the what shareholder. So KD is the expectation of the debenture holders, debt holders. Sir, KP is the expectation of the preference shareholders. KE is the expectation of the value of performance divided by expectations. Sir, value is performance divided by expectations. Sir, how I have to calculate, man? What is my performance? Residual earnings. What is my residual earnings? Performance means the amount paid by the company to investor. Like for the debenture holders, we are paying interest. For the preference shareholders, we are paying dividend. For the equity shareholders, we are paying dividend. And redemption price, which is uncertain in case of equity. This is the main problem with regard to finding out the KE, because for all other people, I know how much is the fixed interest I am supposed to pay. For the preference shareholders, I know how much is the preference dividend I am supposed to pay. For the debenture holders and the preference shareholders, which may be redeemable or irredeemable. If it is redeemable, redemption value is certain. But equity shareholders are the real owners of the company. Are the real? There is no classification of redeemable equity share and irredeemable equity share. Is there any concept like that? No, sir. So, you don't know how much interest to pay, how much dividend to pay, at what price it has to be redeemed. Nothing you should not know, but you are supposed to calculate the KE of a company, right, sir? So, it is not easy to find out the KE. Hence, we are having 6 ideologies are there to find out the KE. One is number 1, dividend price approach. Number 1. Number 2, earnings price approach. Number 2, Number 3, growth approach. In that growth approach, you are having dividend price plus growth approach and earnings price plus growth approach. Are you really with me? And realized yield approach. Next one. And capital asset pricing model. Tell me, capital asset. Repeat once again. Dividend price approach, earning price approach, growth approach, realized yield approach, capital asset pricing model. These are the various 5 model ideologies in which you can find out the K. My dear lovable students, number 1 is dividend price approach. What approach? Sir, this approach assumes that dividend per share is expected to remain constant forever. This is the first assumption of this model. My dear lovable students, are you going to be equity shareholder in my company? Without any expectation, will you be an equity shareholder? No. You will be having expectation. You are expecting dividend. Your expectation is not earnings. Your expectation is what? Dividend. And the speciality of that particular dividend is every year you will get the same dividend. Every year you will get the first year, sir, 2 rupees dividend. Second year, 2 rupees dividend. Third year, 2 rupees dividend. Fourth year, 2 rupees dividend. Infinite year, 2 rupees dividend. That means, my dear lovable students, you are going to get a cash flow, the same cash flow for infinite period. Means the value of the future cash flow, value of the future cash flow is equal to cash flow divided by R. Cash flow divided by, have you heard about this? That means if you are going to get a cash flow, if that cash flow is lifelong remain to be same, then the present value of that cash flow is cash flow divided by R. For as per dividend price approach, what is the cash flow you are going to get? Dividend. Sir, will the dividend be same or different dividend? This is the basic assumption of the dividend price approach. This is the basic assumption of the, based on that assumption only, they have created this approach. That means, sir, the KE is equal to what? KE is equal to, KE is equal to, sir, DPS1. Tell me. It may be DPS1, it may be DPS0, because DPS0 is equal to DPS1. DPS1 is equal to DPS5. DPS5 is equal to DPS25. As per what approach? Dividend price approach. Divided by MPS0. Divided by into 100. Into. So as per the first approach, what is the first approach? Dividend price approach. Sir, the KE is equal to DPS1 divided by MPS0 into 100. Basically, my dear lovable students, KE is the cost of equity. KE is the cost of equity. Are you really with me? Sir, cost of equity is equal to cost divided by capital. Am I right? According to the company, if the approach is a dividend price approach, what is the cost? Dividend. That's why DPS1. Comfortable? In order to get this dividend, only equity shareholders are investing in the company. Correct? That's what capital. What capital they will be investing? MPS0. MPS, my dear lovable students, in future, as per financial management, if you are going to get a cash flow, you are going to get a, and if that cash flow is perpetual, if that cash flow is, what do you mean by perpetual? Every year, same cash flow you are going to get for an infinite period. This is what it is called as, sir, then present value of that cash flow is equal to cash flow divided by R. Cash flow divided by, here that R is what? KE. That R is what? So I have to find out that R or that KE. Are you all really with me? Yes, sir. That means that R or that KE is equal to cash flow divided by present value. What is present value? MPS0. Are you all really with me? That is why KE is equal to DPS1 divided by MPS0 into 100. This is the derivation of this formula. Comfortable? That's it. That's it. So D stands for expected dividend, also written as D1. That's what DPS1. and P stands for market price of the equity. That is what, sir, market price of the equity means ex dividend, excluding dividend. Excluding dividend in the sense means MPS 0, current market price. That's what P0. Can I proceed, sir? That's it. I'm moving to the second approach. Why this much approach? Why this much approach are there only for the equity? Because for preference, for the debtor, the providers of the fund specifically, explicitly said that I want 10-12%. But this equity people will not open their mouth. But we cannot assume that they don't want anything. They need something, right? So this approach, the next approach, earnings price approach, correlate the dash of the company with the market price of its share. I am assuming that the expectation of the shareholder is not the dividend. The expectation of the shareholder is the earnings. Expectation of the shareholder is the, for example, a company like Tata. Sir, for Tata, one shareholders are there, million trillion shareholders are there. Million trillion. If you are a shareholder in that company, you will be worried about the dividend, not the EPS. How much company is earning, shareholder doesn't bother. How much he is getting, bother. Are you really with me? In that case, my dear lovable students, we will value the KE at dividend price approach. Comfortable? But with regard to A&M classes, only 1 or 2 or 3 shareholders are there just to have that private limited company. Or I may be a 1% company also. Are you really with me? So I am not worried about dividend. I am worried about the earnings. Because if A&M classes earns, I earns. Are you really with me? Then I will not go with the dividend price approach. I will go with the earnings price approach. So here the cost to the company is the earnings and it is not the dividend. That means KE is equal to EPS 1 divided by MPS 0 into 100. Right, sir? K is equal to EPS 1 divided by, sir, EPS 1 means current earnings per share. Why, sir? Current. Current is equal to future. There is no growth. Both under the dividend price approach and also under the earnings price approach, there is no growth. There is no super, sir. And what is P stands for? Market price per share. That means in order to enjoy the EPS 1, the equity shareholders are investing MPS 0 in the company. Comfortable? Sir, the same derivation will be there. If the cash flow is a perpetual cash flow, the present value of that cash flow is equal to cash flow divided by R. Here, cash flow is equal to EPS 1, not DPS 1. Can I proceed? Divided by R. R means what? KE. Are you really with me? That means I want the KE. So, KE is equal to EPS 1 divided by present value. Present value is nothing but MPS 0. Are you really with me? Into 100 is the cost of equity. That is, which is nothing but cost divided by capital. That is called as what of capital? According to the company, if the approach is the dash approach, earnings price approach, sir, EPS 1 is the cost. And what is the capital, man? MPS 0 is the capital. Are you all really with me? That's it. The second one, second method also done. What is the first approach? Dividend price approach. Second approach, under both this approach, lifelong DPS and EPS will be constant. Will be constant. Sir, this is the biggest defect of this approach. How, sir? Every year you will give 2 rupees dividend. There should be some growth for the dividend. That is called as growth approach or Gordon's model. Growth approach or Gordon's model. So Gordon came up with an idea that how every year DPS 1 can be same. How every year, sir, EPS 1 can be same. Right, sir? So my dear lovable students, rate of dividend growth remain constant. This is another super brilliant logic of the Gordon. Gordon is saying that there will be growth. There will be, if I get 2 rupees, next year I will get 2.1 rupees. Next year I will get, calculator, next year I will get 2.31 rupees. Are you really with me? Next year I will get 2.541 rupees. Look at here. Sir, calculator. 2.1 minus 2 divided by 2 into 100. You tell me what is that? 2.1 minus 2. Okay, 5% you are getting, huh? Okay, man. I'm changing this to 2.2, man. 2.2, sir. And I'm giving you data of 2.42. 2 point what? 42. Sorry, sir. Then, sir, 2.662. With this, we have to calculate, man. 2.2 minus 2 divided by 2 into 100 comes to 10%. Next year, sir. 2.42 minus 2.2 divided by 2.2 into 100 comes to 10%. Sir, 2.662 minus 2.42 divided by 2.2 into 100 comes to 10%. This is what Gordon is saying. There will be growth, but that growth rate will be same. This is the basic assumption of Gordon. Basic assumption of Gordon. Look at here. Rate of dividend growth remain constant. Sir, the dividend price approach, earnings price approach, you said that there won't be dash at all, growth at all. But Gordon is coming and saying that there will be growth, but the rate of growth will be constant. Look at here. And so this 10% will be the growth rate. This is the first assumption of the Gordon. Sir, if you are asking that, how, sir, practically this will work every year, lifelong, growth rate of how much percent? 10%. Sir, these all are ideology, sir. These all are ideology. One person is coming and saying that, sir, you don't know how to find out KE. ஒன்னால தான் கண்டுபிடிக்க முடியல. நான் சொல்ற ஒரு வழி. டிவிடெண்ட் பிரைஸ் அப்ரோச் ஃபாலோ பண்ணிக்கோ. உடனே இன்னொருத்தர் வந்து கருத்து சொல்றாரு. சி டிவிடெண்ட் பிரைஸ் எல்லாம் எல்லா கம்பெனிக்கு என்ன ஆகாது? அப்ளை ஆகாது. என்ன ஃபாலோ பண்ணிக்கோ? earnings price approach ஃபாலோ பண்ணிக்கோ. புரியுதா இல்லையா? உடனே Gordon is criticizing both dividend price and earnings price approach. என்னடா லூஸ் மாதிரி பேசுற? எல்லா வருஷம் 2 ரூபாய் டிவிடெண்ட் கிடைக்கும், எல்லா வருஷம் 3 ரூபாய் EPS கிடைக்கும்னா 100 வருஷத்துக்கு அப்புறம் இன்ஃப்ளேஷன் என்ன ஆகும்? கரெக்டா இல்லையா? 100 வருஷத்துக்கு அப்புறம் 2 ரூபாய்ங்கிற வேல்யூ காயின் இருக்குமானே தெரியாது. அப்போ நீ இன்ஃபினிட்டா பர்பெக்சுவலா, சார், you will be paying the same 2 rupees means who will accept? So there is a big defect there. So there should be growth. There should be growth. And if you are going for growth, since the shares are equity shares and the cash flow will be perpetual, correct? Gordon cannot say that for the first 5 years 5% growth, for the next 10 years 10% growth, for the after 100 years, sir, 25% growth. Then how you will be valuing? There is no such mathematical tool to value that cash flows, because it is for infinite period. Then people will come and say that after 2000 years you will be having 25% growth. After 2000 years, how you will value that cash flow? We can't. So in max, sir, there is limitations. There is what? So in order to work that growth, sir, Gordon have to come up with a basic assumption that there will be growth and that growth rate will be constant. This is the assumption number 1 of Gordon. And Gordon said one more thing, sir, earnings. What is earnings? EPS. Dividend. What is dividend? DPS. And equity share price. Equity share price means MPS 0. All grow at the what rate? Same rate. 10%, 10%, 10%. Everything will grow at 10%. That means, my dear lovable students, sir, DPS, dividend per share will grow at 10%. Earnings will grow at 10%. Market price will, sir, grow at 10%. So, for the first time, sir, Gordon come up with a formula that, sir, DPS 1 is equal to DPS 0 into 1 plus G, which is the next expected dividend. Next, what Gordon is saying that if this is company, today MPS 0, an equity shareholder is investing with the intention to get not the last year dividend, is not a mental to get the last year dividend. He want the next year dividend. And that next year dividend should be a grown dividend. Are you with me? The next year dividend should be a grown dividend. That means, my dear lovable students, he want, sir, DPS 1. He want what? DPS 1. So, what is DPS 1? DPS 1 is equal to DPS 0 into 1 plus G. That is the cost the company is going to incur. Sir, this is already paid dividend, sir. This is already, sir, if an investor, if an equity shareholder invest here, sir, company will get the money here. Am I right? With that money, company will do the business during this 12 months. Am I right? And they will generate profit, and that profit will be distributed in the next year. Am I right? In the next year, my dear lovable students, sir, will the company pay DPS 0 or DPS 1? So the cost the company is going to incur is the DPS 1. DPS divided by, my dear lovable students. For that, equity shareholder will be investing today, or equity shareholder will be investing next year. Today, that's what MPS 0. That is what. From that MPS 0, company will not get the gross proceeds. Company have to incur the what cost? Flotation cost. What cost? Are you all really with me? So P0 stands for current market price per share, and G stands for constant growth rate. What growth rate? Sir, we used to say G stands for growth. As per Gordon, it is not growth. It is what growth? Constant growth. Every year it will grow at 10%. In case of newly issued equity share, where flotation cost is incurred, my dear lovable students, this is the formula. Sir, DPS 1 divided by MPS 0 minus flotation cost plus G. Are you all really with me? That means, sir, this is the cost the company have to incur. What is the cost? DPS 1. DPS divided by, my dear lovable students, MPS 0. MPS, sir, that is the gross investment. Can the company invest the entire gross investment? Can the company enjoy the entire gross investment? No. From that, company have to pay flotation cost. So that much money will be reduced, plus G. G will be constant growth rate. And F stands for what cost? I will give you a quick example to make you understand. Company has paid dividend of how much per share? 1 per share of face value of, so rupees 10 into 10% is what? Rupees 1. Am I right? So last year company paid 1 rupee. And it's expected to grow how much percent every year? 10% every year. So the next year future dividend will be DPS 1 will be 1 1.1 1.1. This is the DPS 1, right? And the market price of the share is 55. Today in market the share price is 55. That means in order to enjoy 1.1 in future, my dear lovable students, hello sir, the shareholder has to invest 55. So 1.1 divided by 55 plus G. What is the growth rate? 10%. So calculator, 1.1 divided by 55 comes to 0.02. That means 2%. Right, sir? Plus, sir, perpetual growth rate of 10%. Because this growth will not be for 1 year. This growth will be perpetually. Are you all really with me? That's why I am adding again plus G. Clarity. So it should be how much percentage, man? 12% should be the KE. 12% should be the. So basically KE is equal to DPS 1 divided by MPS 0 plus G. DPS 1 divided by MPS 0 plus G. Right, sir? DPS 1 is the cost to the company. MPS 0 is the capital. And this will grow. What will grow? Dividend will grow. What will grow? Earnings will grow. What will grow? Market price will grow. Everything will grow at the constant growth rate. That's why for everything it is plus G. Are you all really with me? Now, Gordon itself explaining that how you have to, sir, measure the growth rate, how to find out the G. There are two methods are there to find out the G. Either average method or the Gordon's growth model. Either average method or, sir, average method in the sense means you have to take the current dividend. Current dividend means DPS 0. Are you all really with me? Is equal to, my dear lovable students, sir, DPS N into 1 plus G raised to N, which is nothing but DPS N means dividend in N years ago. Dividend in, for example, 2 years back, 3 years back or last year, DPS 0, this was the dividend company have paid. That's what DN, dividend in the nth year. And you are going to see the dividend for a particular number of years. That's what into 1 plus G raised to N. If you want the growth rate, sir, root of D0. D0 means DPS 1 divided by DPS N. It's because by this way, sir, DPS N means dividend in the future. Are you really with me? Future, past. Dividend in N years ago, past. So today's NSR dividend divided by past dividend. Are you really with me? Yes, sir. Minus 1, and you have to take the nth root. Like this, you can find out the growth rate. This is one way. We have never used this way to find out the growth rate. Right, sir? But we are having other ways also. Gordon itself said that divide D0 by Dn, find out the result, then refer the present value interest factor. That is step number 1. Find out the result found at step number 1 in corresponding years row. That means he's asking you to see the present value factor table and see the interest rate for the corresponding column. This is the what rate, growth rate in step number 3. Example they are giving. Wait, I will help you. Sir, the current dividend DPS 0 is 16.10. Now currently company paying a dividend of 16. And dividend 5 years ago was 10 rupees. So 5 years before 10 rupees. Sir, today company is paying a dividend of 16.1. Sir, growth irka? Irke. Adanaal thana 10 rupa, 16 rupa, 10 paisa irke liya. Growth rate in the dividend can be found out as follows. Sir, step number 1, D0 by Dn. What is the D0? What is today's dividend? 16.1. What is the Dn? 10 rupees. That means 1.61 is the growth rate. 1 point is not the growth rate, is the compound happened. That means if you are having 1 rupees 5 years back, it become 1 rupa 61 paisa. Within how many years? 5 years. Comfortable? Sir, find out the result found at step number 1. That is 1.61 in the corresponding year row. That is what year? 5th year. 5th year. See the interest rate. Corresponding column, which is how much percent? 10%. I don't have the table. If I am having the table, but I am having calculator, am I right? So my dear lovable students, so I have to reach to 1.61. Nothing. Take the calculator. Sir, 1 rupa irukku vechko. At the end of 1 rupa, 1.1, it will become 1 rupa into 110% comes to 1 into 1.1 comes to 1.1. So how many years you took? 5 years. So 1.1 into 1.1 into 1.1 into 1.1. Put 1.61. With how many year compounding? 5 years. Are you really with me? This is what the factor you got. Yes, sir. Are you really with me? எப்படி சார் நீங்க 10% கண்டுபிடிச்சீங்க? ஆன்சர் பார்த்தா கண்டுபிடிச்சேன். Because this 10% I can't find out. Are you really with me? If to find out, I need the present value table. I don't have the present value table. What is the logic it is working? I am saying that is 5 years before I am having 1 rupee. But after how many years? 5 years. It has grown to 1 point. So the life is how many years? 5 years. So it should grow at some R rate. Correct? So I am guessing. Always I will guess with 10%. So 1 rupee at the start of the year will become 1.1 rupee. Right? Up 1.1 into 1.1 into 1.1 into 1.1 into 1.1 comes to 1.61. That's what the factor I got. Are you all with me? Sir, see the interest rate of corresponding column. Therefore, the growth rate G is equal to 10%. Can I proceed? This is one way, sir. Other way, that is instead of doing the nth root, you can do like this. Sir, Gordon is coming with more scientific way of finding out the G. G is equal to B into R. G is equal to. Sir, this model attempt to derive a future growth rate where growth rate is equal to what into R? B into R. B means retention rate. B means, that means if 10 rupees you earned EPS, every company will declare dividend. That is what? 6. So 10 minus 6, you will get what? 4. This is called as balance. or B, with the company. How much you are retaining is important, and also at what rate it is reinvesting is important. That's what R, rate of return on what invested? Fund invested. Are you really with me? So Gordon is saying that G is equal to what into what? B into R. B into super, sir. I'm coming to the next one called as realized yield approach. What approach, man? Again, an IRR, my dear lovable students. That's what realized yield approach. Realized yield approach. Sir, yes, sir. Sir, average rate of return realized in the past few years, historically regarded as what return in future? Expected return in future. That means last 5 வருஷமா 10% return earn பண்ணிருக்கேன் அப்படின்னா I am having a basic assumption that for next 5 years also I will earn the same return. Are you all really with me? Sir, computes cost of equity based on the what record of the dividend actually realized. What is the name of it? Realized what approach? Realized, that means past. Realizing yield approach kadayadu. It is realized. That means, sir, I will calculate the KE by using this approach based upon the what record? Past records. Past records. For example, I'm having a cow. Cow is giving last 5 years, sir, 5 liters of milk. Tomorrow, how much liter it will give? 5 liters. In clarity, yeah. Sir, example, sir. Mr. X has purchased the shares of ABC Limited for how much? 1000. That means he has paid 1000 rupees. Right, sir? So the present value of cash outflow from his pocket is 1000 and received dividend for 5 years at the rate of 10%. He got dividend for the 5 years at 10%. At the end of the what year? 5th year, he sold the share at 1128. Surely the share price would have been increased. Correct? The cost of equity as per the realized what approach? Yield approach would be as follows. It would be the discount rate which equates the value of the dividend received in the past how many years? Plus present value of the sale price 1128 to the purchase price of what? 1000. That means have you purchased 1000? So the value of an asset is 1000 rupees. Are you really with me? Sir, do you have any future cash flows? Yes, sir. For the past 5 years, how much you got? 10%. That means 1000 into 10 comes to 100. 100. 100. 100. 100. 5 years, you would have got 100. Correct? Plus, my dear lovable students, you will be getting the redemption value. That is, which is nothing but the selling price of 11. Sir, if I discount this cash flow, I should get 1000. I should get that rate is called as realized yield approach. This discount rate which equals this 2 is 12% approx. I will tell you how to find out. Are you really with me? Sir, I am having 1000 rupees today. Yes, sir. 1000 rupees is growing to, sir, dividend of 100, 100, 100, 100, 100. And in this year, 6th year beginning or 5th year ending, you are getting sale proceeds of 1128. They are taking discounting factor of how much percent? 12%. Calculator. 1 divided by 1.12 comes to 0.893. Sir, again equal to 0.797. Again equal to 0.712. Again equal to 0.636. Again equal to 0.567. And again 0.567. Right, sir? If I multiply the cash flow with the what factor? Discounting factor, I will get 89.3. Which is nothing but at the end of the first year, I am going to get 89.3. What is it, sir? At the end of the first year, I am going to get 100. What is the present value of it today? 89.3. At how much percent? 12%. That means my objective is I am going to buy an asset today. Yes, sir. By paying how much? 1000. But for that, I am going to get 100, 100, 100, 100, 100. Plus, at the end of the 5th year, I will be getting 1128. Are you really with me? All these are what value? Future value. If I discount the what value? Future value with some rate, I should exactly get 1000. Sir, that rate is called as realized yield approach. Realized, which is nothing IRR, which is nothing but, because IRR is the what at which, rate at which the discounted cash inflow will be equal to discounted But in order to get the IRR, I need cash flow. I need that cash flow I will take from history. That's it. That cash flow, I will not take the grown cash flow. I will not, sir, consider the growth rate in the realized what approach? Yield approach. I will not say that dividend will grow at 10%. Dividend will grow at 20%. Like that and all, I will not take. Are you all really with me? Sir, I will use the past data to find out the future KE. That is called as realized yield approach. Because this is more or less like the real KE. Because last 5 years, the company have issued dividend of 100 per share. Are you all really with me? That means for next 5 years also, if nothing extraordinary happen, company has to issue 100 per share only. Yes, sir. Yes, sir. Sir, when 5 years back, 1,000 rupees share has been grown to 1128. Are you all really with me? Yes, sir. That means present value of the future cash flow should be equal to present value of the cash outflow. That means how much is the cash outflow? 1,000. Future cash flow 100, 100, 100, 100, 100. And in beginning 1128 at the end of the 5th year. Am I right? This I have to discount at some percentage. When I discount, it is also coming to how much? At எத்தனை percent? That means I can say that KE is equal to 12%. This is called as realized. So it is the average rate of return realized. This average rate of return realized. In the past, how many years? Few years. Historically regarded as what return in future? அப்ப லாஸ்ட் 5 வருஷம் எனக்கு 100 ரூபாய் வந்திருக்கு. ஐ எம் எதிர்பார்க்கிறேன் என்னன்னா அடுத்த ஃபியூச்சர் இயரும் இதே ரிட்டர்ன் தான் வரும். So you have to compute the cost of equity based on the what record? Dividend actually realized. That is called as realized yield approach. So first approach, dividend price approach. Formula, DPS 1 divided by MPS 0 into 100. Second approach, earnings price approach. Formula, EPS 1 divided by MPS 0 into 100. Next approach, growth approach. Correct? Dividend price plus growth approach. What is the formula? DPS 1 divided by MPS 0 plus G into 100. Plus G into 100. Comfortable? Next one, earnings price plus growth approach comes to EPS 1 divided by MPS 0 plus G into 100. Can I proceed? Now, realized what approach? Yield approach, which is nothing but IRR. Same like YTM. Are you really with me? It is a rate at which the discounted cash inflow will be equal to discounted. But the cash flow, I will not take the future cash flow. I will take the historical cash flow as the future cash flow. Are you really with me? That's it, man. I'm moving into the last approach called as CAPM, capital asset. There, I am going much more technical and saying that there are two types of risk are there, diversifiable or unsystematic risk. What or what? Diversifiable. It is related with whose performance? It can be eliminated by an investor through what? Diversification. For example, instead of investing in only one company, if I am investing in multiple companies, this risk can be eliminated. Are you really with me? Sir, for example, if you are investing only in government security, there is no risk at all. Hello, sir. If you are investing in a company which are mobile industry, technological company, it is having high risk. Tomorrow, AI may replace the technology. So, if you are diversifying your investment, if you are putting investment in various portfolio, then the diversifiable risk can be reduced. But non-diversifiable or what risk? Which is macroeconomic or what specific risk? Whatever you do, it cannot be eliminated. Thus, a business should be concerned about what method? Solely with the what diversifiable risk? Non-diversifiable risk. That means if a security, if a share is having both diversifiable risk and non-diversifiable risk, diversifiable risk can be eliminated by doing diversification. Correct? But non-diversifiable risk or systematic risk, even who cannot, investor cannot avoid. Investor cannot At that circumstance, if you are finding out the KE by using DPS1, EPS1, sir, DPS1 plus growth approach, that and all will be rubbishness. Are you really with me? So what this method is saying, that cost of equity under CAPM will be what rate? Risk-free rate plus what premium? Risk premium. That means, my dear lovable students, this is the RF. This is the what? If you are going and investing in FD, government securities, you will freely get the return. Are you all really with me? Yes, sir. But if you are investing in a company where, and if that company is having non-diversifiable or what risk? Systematic risk, that I can't avoid. So for that risk taking, I should get the premium. Am I right? That risk is measured by what? Beta into RM minus RF. That means RF plus beta into RM minus RF. Are you all really with me? Sir, this premium, sir, this RF is for the what risk? Diversifiable risk. Are you all with me? If you are feeling so much of risk, go and reduce your risk by putting in the risk premium. Are you all with me? But this part I cannot avoid. That is called as non-diversifiable risk. That is called as non-diversifiable risk. Sir, non-diversifiable risk means, sir, if you see, medicine industries means they are having some risk. Cloth industries means they are having some risk. As compared to, for example, cloth industry, sometimes tile industry may be less risky. Tile or marble industry may be less risky. Are you all really with me? Yes, sir. So, when you compare two industry, their risk and return will surely change. So, if you are going to put your money in a industry who are having more diversifiable risk, more non-diversifiable risk, that industry will have more risk. Then your return should be more. Because what you are calculating, the expectation of the what holder? Shareholder. If the shareholder investing in a security which comprise of more diversifiable risk, he will expect only RF. That's what RF. But if the security or shares of this particular company belongs to non-diversifiable risk, my dear lovable students, he is taking a risk. Then he expect more premium. That's why RF plus. That's why what? RF plus beta into RM minus RF. If you see, look at the graph, man. Sir, this is the RF. This is the, that means, sir, if you are investing only in the dash risk, diversifiable risk, you will be expecting only RF. But if you are investing in a company where, look at here, sir, if you are investing, if you are here, you are taking risk. This is the risk part, beta. Sir, now you come here. I'll rub this, you will understand. Sir, I will come here. That means this is the first part, and you have come here. Is the risk increases? Because, sir, instead of taking this much risk, you have taken this much risk. Right? Again, you have what? Reached here. That means when you increase your risk, automate what risk? SML means systematic risk. Systematic risk means non-diversifiable risk. Right? If you increase your SML, automatically your what will increase? Risk premium will increase. Sir, if you go beyond inga poga enna unna, automatic what will increase? Risk premium will increase. Are you really with me? That's why they have come up with a formula that KE is equal to RF. What is RF? Risk-free return. That means I don't have any risk, then you will get RF as return. No, sir. I am taking risk. Sir, I took only this much of risk. The first, this 10% category of risk. Hello, sir. Yes, sir. That means simple. If you inject more and more and more risk into the capital structure, automatically the beta increases. Once the beta increases, return also should increases. Right, sir? So RF plus RF means what return? Risk-free return. Beta measures the risk into RM minus RF. RM means market return. Minus RF is the risk-free return. Market represent the business. Market represent the, because lot of business put together called as market. Minus what, man? Risk-free return means FD. This is called as premium. What, man? Premium. Correct? Assume market as issue price and sir, risk-free as face value. Always issue price minus face value is the premium. Are you all ready with me? The same way, market return. Market return means, sir, all the business put together called as market. Correct? Market will be having risk. Market will be having risk. That's what RM. What is RM? Risk of the market minus RF. That means inside RM, you are having risk. Inside RF, you don't have the risk. That means RM minus RF, you will get the risk. For that, if you multiply with beta, you will get the premium. Are you really with me? That's why they are one line in saying, they are saying that KE means cost of equity. RF means risk-free return. Beta stands for beta coefficient. It represents what risk? Systematic risk. Systematic or non-diversifiable or unavoidable risk. Are you all really with me? Which I can't do anything. Which I can't do anything. Are you all really with me? Yes, sir. RM means, sir, rate of return on what portfolio? So RM minus RF is the market risk premium. Comfortable? Are you all really with me? You look at here, man, risk return relationship of various securities. Sir, if you are investing in government bond, sometimes I may have only this much risk. If I am investing in corporate debt, sir, I am having little more risk, but not up to equity. If you are investing in what share? Preference shares, I am having this much risk. But if you are investing in equity shares, I am having this much risk. Right, sir? If the risk increases, my dear lovable students, automatically return should also. You are studying CA, that is a high risky course. After you become CA, if every month if you get 10,000, will you be okay? No, sir, because your risk is higher. So you want return also should be a risk increase and a risk return increase. Aida. After studying BCom, sir, will you expect anyone 1.5 lakh salary? No risk, because who and all are joining or passing. To fail, some sort of skill is required. Are you all really with me? Come on. The risk-free return equal to RF is equal to how much percent? Company's beta 1.75. Sir, beta represent risk. Enna risk? Systematic risk, which are unavoidable risk. This is company specific, not market specific. Are you all really with me? So beta is 1.75, and the return on market portfolio equal to 15%. So if you are investing in market, you will get 15, but the RF is what? 10. What is the risk premium? 5%. So for every 1 beta, I want 5%. But the company's beta is 1.75%. So into 5. So that's the cost of equity capital would be 1.75 into 5. 8.75 plus 10 RF. Total 18.75% is the KE. Comfortable? Sir, actually, I'm coming to the last one, man. Cost of what earning? Retained earning, which will be represented as KR. Sir, actually, if a company earns CPS, that has to be distributed as dividend to the equity shareholders. Correct? But the company is not distributing it as dividend. Companies, they themselves holding it. Correct? Yes, sir. So there is an opportunity cost to the equity shareholders. That opportunity cost is measured by what R? It is the opportunity cost of dividend foregone by the what holder? Sir, formulas used for calculation of cost of retained earnings are same as formula used for calculation of cost of equity. Because, my dear lovable students, what is equal to what? KE is equal to KR. Because KE means cost of equity, KR, retained earnings, also belongs to the, if you are following dividend price approach, my dear lovable students, KR is equal to DPS 1 divided by MPS 0 into 100. Earnings price approach, sir, KR is equal to EPS 1 divided by MPS 0 into 100. Sir, growth method, sir. KR is equal to DPS 1 divided by MPS 0 plus G, which is mutatis mutandis same. Correct? Sir, for KE, for when you are calculating what? Net proceeds realized, that is issue price less what cost will be taking. But for KR, sir, P means what market price. However, sometimes issue price may also be used, ignoring the what cost? Flotation. That means if you are calculating, this is the difference they are saying. If you are calculating KE and if you are calculating KR, if you are calculating KE, DPS 1 divided by MPS 0. MPS 0 is equal to gross proceeds minus flotation cost. But if you are calculating KR, sir, DPS 1 divided by MPS 0. MPS 0 is equal to gross proceeds. I will ignore the what cost? Flotation cost. Are you really with me? Yes, sir. That's it, man. We are individually done with the KD, KE, KP, and KR, and we are moving into the weighted average cost of capital, that is WACC. What is WACC? Sir, company one makes a mix of various sources of finance, correct? Like debt, preference, equity, or return. Cost of what capital? Total capital will be equal to WACC of individual source of finance. How, sir, I have to find out the WACC? Calculate the dash capital from all the source of capital. Can you say what are all the source of capital? Like long-term debt capital, preference share capital, equity share capital, and retained earnings. Right, sir? Then calculate the proportion of each source of capital to the what capital? Total capital. That means, sir, if I am having debt, equity, preference, everything, how much proportion which comes everything? Multiply the proportion in step number 2 above with the respective what of capital. So individual cost of capital into proportion will be the weighted average cost of capital. This proportion is the weight. Proportion is the, so aggregate of the what of capital. This is called as WACC. That means, sir, KE plus KD plus, sir, KP plus KP plus, correct? Yes, sir, KR will be KO. Or rather, correct technical word, weighted KE plus, weighted KD plus, weighted KP plus, weighted KR is equal to weighted KO. Purida? When I take the weight, I am having two options. Number one, certain people will calculate the weight based on book value. Certain people will calculate the weight based on market value. Sir, why you are going with book value? It is very easy and convenient because every data is available with me. Every data is available. That means if I am going the data based on historical price. Historical price means I issued one equity share at 100. I issued one debenture at 100. I issued one preference share at 100. That is called as book value weight. Sir, anneki 100 sir. Inneki market price 100 sir irukku. Adu 103 aichile sir. Hello sir. Then why are you doing post-mortem analysis? Because you are calculating the what of capital, cost of capital. Today, then use today's data. Don't 5-year past data. That is called as market value. What value? So reserves such as share premium and retained profit are included in the book value of equity. This is a super brilliant point. If you are calculating KO by using what value weight? Book value weight, you will take, sir, debt, preference, equity, reserves and surplus also. But in market value weight, reserves and surplus will not be. Sir, actually the market value weight are more correct. And it represents a firm's what structure? Preferable to use what value weight? Market value weight for the what? Equity. Because it shows the correct and clear picture. Correct. Reserves such as share premium and retained profit are ignored as they are in effect incorporated into the what of equity. Sir, if the book value of the one share is 10, I will say that market value is 50. That market value includes reserves and surplus. Are you really with me? Yes, sir. No separate market value for the what earning? Retained earnings. I will give you one example, man. This is one example, beautiful example. Capital structure of company, 10% debenture with how much maturity? The book value is 100 per debenture, total 5 lakh. 5% preference shares with 10-year maturity, total 5 lakh, but the book value is 100. Equity share face value of 10 each, today 10 lakh. What is the total capital employed? Market price of these security are debenture today 105, preference share today 110, equity share today after tax cost of capital. After tax they said, so KE 10%, KD 6.89%, and KP, and they want to calculate the KO. Can we calculate the KO? First I am calculating the KO, use the what value weight. Already given 5 lakh, 5 lakh, 10 lakh, 20 lakh. So 5 lakh, 5 lakh, 10 lakh, 20 lakh. Right? Out of 20 lakh, the weight of 5 lakh is 25%. Can I proceed? Out of 20 lakh, 5 lakh is 25%. Can I proceed? Out of 20 lakh, the weight of 10 lakh is 50%. Right, sir? The individual cost of capital already given in the question. They said that KD is equal to 6.89% and KP is equal to 4.08% and KE is equal to 10%. Are you all really with me? So this is called as weighted KD. What KD? This is called as weighted KP. What KP? This is called as weighted KE. What KE? Are you all really with me? Yes, my dear lovable students. So weighted KD into, sir, this is individual cost of capital. Yes, sir. Evlo point 0.0689. This into 25%. This is called as weighted KD. Weighted KP. Weighted KE will give you the weighted average cost of capital. By using what weight? Book value weight. The same can be calculated in market value weight. That is more realistic than book value weight. Right up. Yes, sir. For example, sir, come on. How much is the debenture capital? 5 lakhs. What is the face value per debenture? So 5 lakhs divided by 100. How much debenture you are having? 5,000. What is the market value per debenture? 105. So 5,000 into 105. 5 lakh 25,000. Comfortable? Here the same story. 5 lakhs divided by 100. How much preference share? 5,000. What is the market price per 110. 5,000 into 110. 5 lakh 50,000. Are you all really with me? I'm coming to equity shares, man. 10 lakhs divided by 10 comes to 1 lakh. Into market price 24 comes to 24 lakhs is the market value. That's what 5 lakh 25, 5 lakh 50, 24 lakhs. Right, sir? Can I find out the proportion? That means out of 34 lakhs 75,000, how much is debentures? Out of 34 lakhs 75,000, how much is preference shares? Out of 34 lakhs 75,000, how much is equity? This is what weight. Are you really with me? Actually, the individual cost of capital already given in the question. Then I will be doing the weighted KE, weighted KP, weighted KE. I will get the overall cost of capital as 8 point. If you use the book value, it is just 7.74%. Right, sir? But if you are using the market value weight, it is 8 point, which is more realistic than book value weight. That means if you go with the book value weight, sir, you will discount the capital budgeting problem only with 7.74%. Since the discount rate is less, sometimes NPV may be more, and you will say that dash the project, accept the project. Blunder. Are you really with me? Because the KO of the company is not 7.74%. KO of the company is 8.59%. My dear lovable students. Comfortable? Are you all really with me? That's it. This is the quick summary of the individual cost of capital. Can we quickly say the just 1 or 2 minutes main formulas? You also take your notebook and write along with me. You have to write along with me. We are just going to make a 1-page revision before the day of examination. Sir, when you see that 1 page, every discussion should come to your mind. Sir, we are going to talk about cost of capital. Cost of capital. You just make like this, sir, just a table for the cost of capital. Number means number 1. Number 2 is the source. And number 3 is the formula. That's it, game over. That's it, game over. Sir, tell me, what is the first one we studied? Irredeemable debt. You can write it as irredeemable debt. For irredeemable debt, you have to participate, man. I already having resources. For you only, I'm writing another 5-10 minutes. You participate and one time write. Tell me. KD is equal to I into 1 minus T divided by NP into 100. That's it. What is the second source of finance? Redeemable debt. Then KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Comfortable? Yes, sir. Next one. Third one. amortization of bond. Amortization of bond is the third concept we have discussed in this. That is VB is equal to, VB means value of a bond today is equal to, yes, cash flow at Y1 divided by 1 plus KD raised to 1 plus cash flow at Y2 divided by 1 plus KD raised to 2. Are you able to appreciate? This will go on, and cash flow at nth year divided by 1 plus KD raised to n. Sir, when you see this, our discussion will come to your brain. Sir, is there anything regarding the debt you are supposed to revise before exam? Yes, convertible debentures. Right? Convertible debentures. In case of convertible debentures, RV is higher of cash redemption value or kind redemption value. Are you able to appreciate? Yes, sir. Cash redemption value or kind redemption value. Tell me. Yes, sir. Sir, next formula. That is, sir, redeemable debentures with tax effect. With tax effect for capital expenditure also. Such formula, one thing we have discussed. KD is equal to I plus RV minus NP divided by N whole into 1 minus T divided by RV plus NP divided by 2 into 100. Divided by 2 into 100. I think all the debt related formula we have summarized. Yes, sir? Yes, sir. I have to continue the same thing, man. The next one. What is the next one, man? Irredeemable preference shares. Tell me, what is the formula? KP is equal to PD divided by NP into 100. PD divided by NP into 100. Pakka? I'm continuing, man. What is the next type of security? Redeemable preference shares. Right, sir? Formula. KP is equal to PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Comfortable? Super, sir. Then, next one. Equity. Correct, sir? KE. I'm writing KE in the center. Various approaches are there. First approach, dividend price approach. Tell me formula. DPS 1 divided by MPS 0 into 100. The second approach, earnings price approach, comes to EPS 1 divided by MPS 0 into 100. The third one, dividend price plus growth approach, which is DPS 1 divided by MPS 0 plus G into 100. The next one, man, earnings price plus growth approach, which is equal to EPS 1 divided by MPS 0 plus G into 100. The next one, that's for growth model. That's okay. That's how to find out the G. Correct? Where you can mark here that, sir, note. You can write a note that G is equal to B into R. Hello? Or that nth root formula also you can use to find out the growth. Right. Next one, realized what approach? Yield approach. Realized yield approach means use historic cash flows. Use what? Historic cash flows. Use historic cash flows. Are you all really with me? Then capital asset pricing model. RF plus beta into RM minus RF. Where beta is equal to what risk? Market risk. Systematic risk. Beta is equal to systematic risk. Because why I am sometimes one exam they gave that systematic risk is equal to 1.25 or something. Purida. So there, what is the systematic risk? My system is not working. Okay, fine. Sir, KE. That's it. Done. All the formulas. Yes, sir. That formula also you can use. That is without time value of money. That is, sir, for realized yield approach, one of the another formula is DPS 1 plus MPS 1 minus MPS 0 divided by MPS 0 into 100. In this, we are not considering the time value of money. Correct? That's why we are finding out the IRR. Are you all really with me? That's it. That's it. I think that next one, 9, KR. First one, KR. KE is equal to KR. Right, sir? But note, what is the important note? Use current market price without flotation cost. Without what loss? That means don't reduce flotation cost for KR. This is the one line summary. Correct? We are not supposed to reduce flotation cost. Then the last one, 10th formula, which is what, man? WACC. WACC. That is KO. KO classified into two categories: book value weight, market value weight. Correct? Less realistic, more realistic. Which one? Market value weight. Are you able to appreciate? Whatever it may be, the table approach will be number, then what? Source, then what? Amount, then what? Proportion, then what? Individual cost of capital, weighted average cost of capital. Then you will get the KO as the weighted average cost of capital. You will get the KO as the weighted average cost of capital. This is the formula or format in which we are going to proceed with this chapter. That is called as what of capital. Our objective of this chapter is to find out the KO. Sorry, sir, I understood. Sir, if you do certain question, that will be fantastic, sir. Sir, we will be solving question number A. This is a RTP November 2022 question. Super fantastic, outstanding question. Sir, then we will be solving, sir, question number N, which is, sir, RTP May 2022 latest question. After that, we will be solving, my dear lovable students, sir, question number M, which is a, sir, RTP November 2020 question. The reason, very good hand-picked 3 questions we are going to do. From every topic, question A, question N and question M we will solve. If you solve these 3 questions itself, you will get a fantastic application idea of this chapter. And in addition to that, what I'm expecting from you is solve all the ICA illustration and solve all the ICA illustration book back more than enough for examination. Comfortable? So in the coming slot, we'll be doing the 3 questions. Before that, have a 5 minutes go through. I will never say that by heart the formula. We have discussed very logically. This is like the formula adjustment before the day of examination. Tuck, tuck, you can complete. I am waiting for your quick revision of the formula and come back. We'll be solving 3 questions, my dear lovable students. Sir, very, very, very happy afternoon to all. Sir, we are going to start the next chapter called as financing decision in that capital structure. Basically, this chapter is called as capital structure theories. Capital structure theories. So we are going to take capital structure decision, my dear lovable students. In this chapter, actually, 3 things we have to discuss. If we discuss 3 things, this capital structure theories chapter comes to an end. Number 1, various theories we are supposed to discuss. Number 2, arbitrage process we are supposed to discuss. And EBIT and EPS analysis we have to discuss. These are the 3 areas which the ICA will test you. Number 1, theories, my dear lovable students. This is the background of the theories. We are going to have a big fight, my dear lovable students. If 2 firms are alike in all aspects, except capital structure, will the value of the firm change or not is the question. So what we are going to talk is there are 2 company man. One is A Limited and other is B Limited. Both A Limited and B Limited are doing same business. Both A Limited and B Limited business is one and the same. Capital employed are one and the same. And the risk of the business are one and the same. Sir, EBIT generated by both the business are also one and the same. That means if 2 firms are alike in all aspects, except capital structure. Except, will the value of the firm change or not is the question. Sir, because of the capital structure, will the value of the firm change? Sir, some theories are saying that yes, if the capital structure changes, value of the firm changes. Some theories are saying that no. How, sir, if two firms are alike in all aspects except capital structure alone, how the value of the firm change? So theories classified into two categories. There are two types of theories are there. One is theory of relevance and theory of irrelevance. Theory of relevance is saying that even though if two firms are alike in all aspects except capital structure, the value will change. There are two theories supporting the theory of relevance, that is net income approach. Number one is what? And number two is traditional approach. Number two is theory of irrelevance is, sir, net operating income approach and the Modigliani-Miller approach. Modigliani. So what is the reason why these two theories are saying if two firms are alike in all aspects, for example, A Limited is there and B Limited is there, if they are doing the same business, for example, cloth business, if they are having same capital employed, 50 lakhs and 50 lakh, sir, since both are in the same business, the beta, the diversifiable risk, non-diversifiable risk of the company will be one and the same, and the EBIT generated by both the company are also same, then how the value of the firm changes is what the primary understanding. Because everything should be same, the value of the firm should also be same. It's like two cows are there. Cow number 1 will give you 5 liters of milk and cow number 2 also will give you 5 liters of milk. Are you really with me? Yes, sir. If you are going and purchasing the cows in market, if someone is saying that for cow number 1 it is 10,000 and cow number 2 it is 15,000, will you accept it? No. Sir, there should be some basic reason. Sir, the basic reason is the relationship of the cost of capital. Basic reason for the difference is the relationship of the which is nothing but, man, KD and the KE. Relationship of KD and the, my dear lovable students, KD is the cheaper source of finance. KD is the, whereas KE is the costlier source of finance. KE is the, sir, KD is a approximation of the profit or the charge against the profit. Charge against the profit. That means debt will be debited to the P&L account. Are you all really with me? Yes, sir. And KE is a, sir, after paying the PAT from the profit after tax, I am paying the equity dividend. Are you all really with me? Which cannot be debited to the what account? P&L account. Which cannot be debited to the, that means, sir, always KE is a costlier source of finance than the KD. Always KE is a costlier source of finance than the, so the primary, sir, base of this chapter is, even though two firms are alike in all aspects except capital structure, that means, sir, one firm is having debt inside the capital structure. Another firm is a all equity firm. They does not have debt in the capital structure. That means if the KD is equal to 10% and KE is equal to 15%, my dear lovable students, if a firm is a all equity firm, their 100% of the capital comprises of KE is equal to KO. That means which is equal to how much percentage? 15%. But, sir, in the same place, there is another firm. In their capital structure, they are having both, sir, debt and what? Equity. If you inject debt into the what structure? Capital structure, my dear lovable students, automatically, because of the cheaper source of finance which is present inside the what structure? Capital structure. We know that KO means weighted KO, that is weighted average cost of. So KO is equal to weight of the equity into KE. Are you really with me? Plus the weight of, sir, debt into KD. That is KD into weight of the debt. This is what our KO is all about, right? So this is the basic understanding or knowledge which is saying that if, even though if two firms are alike in all aspects except capital structure, yes, the value of the firm will change. Yes, the value of the firm will. My dear lovable students, there are two people who are saying that yes, the value of the firm will change. That is called as net income approach and the traditional approach. So we are going to start. These are the learning objective of this chapter. Number one, capital structure theories. Number one. Number two, net income approach, shortly called as NI approach, shortly called as then traditional approach. What approach? Both this theory are theory of relevance. Both this theory are theory of. Then we are having NOI approach. We are having. Then we are having Modigliani Miller approach. Modigliani. Then we are having trade-off theory and we are having pecking order theory. What order theory? This is just a theory only. There is no numerical part from the trade-off theory and the pecking order theory. Just we have to understand for 1 or 2 mark in examination what is trade-off theory and what is pecking order theory. Are you really with me? Then we have to take a decision, capital structure decision through EBIT EPS analysis. EBIT EPS. In capital budgeting, we will use, sir, NPV as a tool to take a decision, right, sir? Sir, the same way, sir, which capital structure I want is based upon my EBIT EPS analysis. What analysis? So first of all, so we are going to take a decision. First, the decision is the, sir, financing decision. What decision? Financing decision will lead to capital structure decision. Financing decision will lead to. So capital structure decision refer to designing the form of financing. That is which source to be tapped. So if you are going to raise a fund of 50 lakh, whether you have to raise by equity, whether you have to raise by debt, or whether you have to raise by mix of both, such a decision is called as capital structure decision. That is a chapter, capital structure decision. But it is not capital structure theories. That is different. Capital structure decision means in my capital structure, how much percentage should be the equity? How much percentage should be the debt? How much percentage should be the preference? Are you really with me? Their actual capital requirement, amount to be funded, and their relative proportion mix in the total capitalization. For example, if I am going to raise 100 lakh rupees fund, my dear lovable students. Sir, my question is, out of this 100 lakhs, how much should be debt? How much should be equity? How much should be preference? How much should be retained earnings? This decision is called as capital structure decision. This I will decide based upon the tool called as EBIT EPS analysis. Are you really with me? So, first of all, I have to take capital budgeting decision. Capital budgeting decision means if I am having money, I will purchase plant and machinery. Correct, sir? There I will take replacement decision. There I will take modernization decision. There I will take expansion decision. There I will take diversification decision. These are the major capital budgeting decision we will take. In order to take a dash budgeting decision, capital budgeting decision, we have to raise the fund. Are you already with me? There are various sources are there for raising the fund. Either you can raise the fund internally, that means through internal fund, or you can raise the fund through debt, or you can raise the fund through external equity. Are you really with me? Internal fund are called as reserves and surplus. Correct? Debt means debt. That means debentures. Yes, sir. And external equity means you are raising equity shareholders, sir, or preference shareholders. This is what need to raise the fund. So, I am going to do a capital budgeting decision. In order to take a capital budgeting decision, I have to raise the fund, right, sir? These are the various sources of fund. Then only I can take a capital structure decision. Sir, if there is no project, I don't want fund at all. Are you really with me? It is like business, how it will work like, okay, I am having 100 crores in my hand. I have to do something. Let me do this business. No, the business work cover. First of all, there should be a good project. If there is good project, in order to do that project, I need fund. என் கையில சும்மா கொஞ்சம் காசு இருக்கு அதுக்காக நான் என்ன ஒன்று பண்றேன் கிடையாது பிசினஸ்ங்கிறது. Are you really with me? So the business should start with the capital budgeting decisions. That's what they are saying. Sir, through capital budgeting decision means a replacement decision or modernization decision or expansion decision or diversification decision. So I have to take one of these decisions. For example, sir, I am A&M classes. I have to put another branch. That means I am going for expansion decision. All right, sir. Sir, now I'm doing only CA. I'm going to start ACCA. It's diversification. Are you really with me? Or I am going to increase the, sir, modernize the classrooms. That is called as modernization. Or I am going to replace the existing camera with the new camera. That is called as replacement decision. To do any of this, I need what? Fund. I have to raise the fund. There are various options available to me as an owner. Either I can raise the fund through internally, or I can borrow the money, or I can go for equity. These are the main three options available with me. Are you all really with me? Sir, if out of these three options, how much should be the internal fund? How much should be the debt? How much should be the external equity? That percentage, that mix is called as capital structure decision. Capital. Okay, right. That means, sir, existing what structure? Capital structure. Then I will check that am I, sir, existing company or a new company? If I am an existing company, what is the existing capital structure? Currently, how much equity I am having? Currently, how much debt I am having? Currently, how much internal funds are available? Right, sir? And the payout policy, this is called as dividend decision. Are you all really with me? Yes, sir. Payout policy, because if I am having 100% payout policy, there is no internal fund at all, because there will be zero retained earnings, right? That means to do the project, I won't have the dash at all, internal funds at all. So my payout policy is also one of the factor which will affect the, which will determine the what structure decision? Capital structure decision. All right, sir? So what is my existing capital structure will decide, and my payout policy will decide. Based on that, I will make desired debt equity mix. Desired debt equity mix. Sir, when I make the desired debt equity mix, I have to see how much, what will be the effect on the return, and what will be the effect on the risk, and what will be the effect of what of capital? Cost of capital. Because of injecting more equity into the what structure? Capital structure. If KO increases or KO decreases or KO remaining constant, anything happen, my dear lovable students, sir, it will affect my value of firm. It will affect my. So I should take a decision where after I taking that optimum capital structure decision, my KO should be minimum. My KO should be, if the KO reduces, value of the firm increases. If KO reduces, so my dear lovable students, all these decisions I am going to take. So in my capital structure, how much should be the percentage of debt? How much should be the percentage of equity? How much should be the percentage of reserves and surplus? This is called as what structure decision. Fine. We are going to take the capital structure decisions that we will be making using a tool called as EBIT EPS analysis. What analysis? Before we talk about EBIT EPS analysis, first we will be talking about capital structure theories. Capital, as I already introduced, that if two firms are alike in all aspects except capital structure, will the value of the firm change or not is the question. Right, sir? The following approaches explain the relationship between what of capital, cost of capital, and what structure and the value of the firm. That comparison, that study is called as capital structure theories. That means what will happen to my KO? Sir, if the capital structure changes, now you should have the understanding that what is capital structure. That is the mix, the percentage of debt and equity in my capital structure is called as capital structure, and the VF, what of the firm? There are two theories are there, sir. Theory of relevance and theory of irrelevance. Tell me, theory of relevance and theory of relevance is saying that if two firms are alike in all aspects except capital structure, yes, the value of the firm will change. That is called as net income approach. What approach? And traditional approach. And what approach? No, sir. If two firms are alike in all aspects except what structure? Capital structure, how the value of the firm will change, that is called as theory of irrelevance, sir. Net operating income approach and Modigliani and Miller approach. Modigliani and, so set your mind, there are two theories are there, theory of relevance, theory of What is the argument of theory of relevance that you understand? If two firms are alike in all aspects, except capital structure, yes, the value of the firm change. First of all, you should understand the basis of the argument, because one of the firms are only having equity, other firm is having equity and debt. That means KD and KE is there. KD is the cheaper source of finance, whereas KE is a costlier source of finance. Correct? So if any company injecting debt into the what structure? Capital structure. Since KD is a what source of finance? Cheaper source of finance. Surely KO reduces. If KO reduces, value of the firm increases. This is what NI approach. What approach? Sir, according to this approach means what approach? NI approach. Capital structure decision is relevant to the what of the firm. So what NI approach is saying that if two firms are alike in all aspects except what structure, if one firm is a all equity firm and other firm is a levered firm, other firm is a, that means in the capital structure of the levered firm, what and what is there? Debt and equity there. This represent the debt represent the KD and the equity represent the KE. This will be their KO. Are you all really with me? Whereas for all equity firm, in their capital structure, only who will be there? Equity will be there. So KE will be equal to, ennappa comfortable appa? That means, my dear lovable students, we know that KE will be cheaper source of finance and KE will be costlier source of finance and KD will be cheaper source of finance. So since the first guy is having only equity in their what structure? Capital structure, automatically their KE will be higher, automatically their KO will be higher. Comfortable. Whereas the second person, since we are going to take the WACC, that is weighted average cost of capital. Hello, sir. Since inside their capital structure, what and what is there? Debt and equity is there. In that, debt is a cheaper source of finance. Because of that, KD pulls down KO. KD pulls down KO. Because of KD pulls down KO, once the KO reduces, value of the firm increases. Value of the firm. So that's what they are saying, sir. According to this approach means NI approach. Capital structure decision is relevant to the what of the firm, value of the firm. An increase in financial leverage. Financial leverage in the sense means use of debt in the capital structure. That is called as financial leverage. If you are using debt in the what structure? Capital structure, you will say that such a situation is called as financial leverage. What leverage? Will lead to decline in the weighted average cost of capital. Yes, if I inject debt into the capital structure, sir, I am injecting KD into the capital structure, right? If the proportion of the debt increases, proportion of the cheaper source of finance increases. Understanding? If proportion of the cheaper source of finance increases, it pulls down the KO. If KO reduces, value of the firm increases. If KO reduces, that means while the value of the firm as well as market price of the ordinary share will increase. So what NI approach is saying that let the two company be there. Adha namakula sanda. Let the two company be there. Sir, this A Limited is doing only business of cloth, and even B Limited is also only doing business of what? Cloth. And 50 lakhs is the capital employed and 50 lakhs is the what employed? Capital employed. Are you really with me? Assume the beta of this business is also 1.5 and beta of that business is also 1.5, right, sir? And EBIT generated by both the business are 40 lakhs and EBIT generated by both the business are 12 lakhs and 12 lakhs. Let it be same. Still, value of the firm will change. What is the basis of such a statement by NI approach? Because NI is saying that what is the nature of A Limited? You are saying that it is a all equity company. If it is a what equity company? All equity company, its KO is equal to KE. Am I right? Yes, sir. KE does not have any tax benefit. Am I right? Yes, sir. It is the costlier source of finance. Are you really with me? the expectation of the equity shareholders will always be higher than KD, correct? So automatically their KO will be higher. Their KO will be. But NI is asking a logical question that what is the nature of this firm? This firm is a levered firm. Levered firm means in their capital structure, who is there? Debt is there. That means KD is there and KE is there, right, sir? KD is a what source of finance? Cheaper source of finance. So if you inject debt into the what structure? Capital structure, my dear lovable students, automatically KO reduces. So KO reduces, value of the firm increases. Value of the firm, this is what the theory of the NI. Conversely, a decrease in the leverage. Decrease in the leverage means if you are reducing the component of debt in the what structure? Capital structure will cause an increase in the overall cost of capital and consequence decline in the value as well as market price of the equity share. So what this approach is saying that if you are injecting more and more and more debt into the capital structure, sir, automatically the proportion of the debt in the capital structure increases, then it is a cheaper source of finance. Because of that, KO reduces and its value of the firm increases. Are you all with me? So the value of the firm on the basis of net income approach can be ascertained as follows. Sir, value of a firm is equal to value of equity plus market value of debt. So market value of equity plus market value of the debt. So according to the what approach? NI approach. They are saying that, sir, market value of the firm is equal to market value of equity and market value of debt. Market value of equity and market value of debt. Why are they saying, sir? Sir, if it is NI approach, if it is what approach, man? This is the basic understanding of the NI approach, my dear lovable students. Sir, always this capital structure is a comparison of the cost of capital, correct? Sir, KE and KD are there. KE and, sir, this KE will always constant. KE will always, and KD will always constant. KD will, that means if you inject more and more and more debt into the what structure also, capital structure also, KD will be constant. KD will be, and KE will be constant. KE will be, sir, since both are constant, look at here, man. This is the cost of capital percentage and this is the leverage. Leverage means percentage of debt. Leverage means what? Percentage of debt. Sir, if there is no debt, you are saying that zero debt you are having, then KE is equal to KO. It will be a dash equity firm, all equity firm. Are you really with me? But if you are introducing debt up to this, man, if you are introducing up to this level, have you introduced debt? Yes, sir. Then KD will not change. KD will be what? Constant. And KE will be what? Constant. Because of both the people constant, my dear lovable students, KO reduces. KO, look at the KO. This is what KO. Sir, this was the KO earlier. Because if there is no what at all, debt at all, KE is equal to KO. So this line represent earlier what? KO. KE is equal to KO. Correct? But I inject this much debt into the what structure? Now the capital structure comprises of KD and what? KE. In that, KD is a dash source of finance. Cheaper source of finance. Since it is a cheaper source of finance, it pulls down KO, which is nothing but KE. Are you all really with me? That's why the KO starts falling. Look at here. The KO starts falling. Now I again injected what into the capital structure? Debt into the capital structure. Then again KO starts falling. Are you all really with me? When I inject more and more and more debt into the what structure? Capital structure. Sir, my KO will start falling. If my KO reduces, my value of the firm increases. Are you all really with me? How to deal this, sir, in the examination? Sir, this is a 5-step approach. This is a 5-step approach. This is a, so if question is coming from NI approach, deal it with 5-step approach. Always try to calculate EBIT and interest. Always try to calculate EBIT and interest. EBIT means earnings before interest and tax. Right, sir? And interest means whatever interest applicable to the firm. Then calculate the market value of equity. Market value of equity. And calculate the market value of debt. Market value of if you calculate market value of equity, and if you calculate market value of debt, and if you add value of equity plus value of debt, you will get the total value of the firm. You will get the total value of the firm. This line only they are saying that, sir, value of the firm is equal to market value of equity plus market value of debt. Comfortable? Market value of equity plus market value of, yes sir, why sir, under NI approach I am calculating market value of equity and market value of, because equity means KE and debt means KD, correct? As per NI approach, both KE and KD are constant. So constant means it will not change. So I am finding out the item which will not change. Then I can find out the item which will change. That is KO. KO will change. Are you really with me? But this is a logic way. As per NI approach, my dear lovable students, market value of the firm is equal to market value of equity plus market value of debt. Market value of, sir, once I find out the fixed item, I can find out the variable item. Are you really with me? The variable item is the overall cost of capital. That is what? KO. KO is the overall cost of capital. Is it fixed or constant? Is it, sir, constant or variable? Variable. It should be variable. Then only the NI approach will be theory of relevance. Because in order to be theory of relevance, the value of the firm should change. In order to value of the firm should change, my dear lovable students, KO should change. Are you really with me? So EBIT divided by value of the firm. Tell me, EBIT divided by. So my dear lovable students, if it is NI approach, what NI? Sir, net income approach is saying that these are our basic assumption. You will be having KD in your what structure? Capital structure. You will be having KE in your, sir, the combination of these two is only what? KO. This will be treated as constant. This will be treated as constant, and this will be treated as variable. Are you really with me? Now, sir, what is the value of the firm? Value of the, sir, value of the firm as per NI approach is saying that value of the firm is nothing but value of equity plus value of the debt. Are you really with me? Now, everyone is asking a doubt that what is value of equity? Value of equity is nothing, sir. Value of equity is equal to NIT, EBIT, minus interest. EBIT, because if a company earns EBIT, they have to pay interest to the debt holders. Are you really with me? Sir, balance only will be available to the equity shareholders. Are you really with me? That is the return the equity shareholders will be getting. Sir, divided by KE. Divided by, just let me ask you a question. You are an equity shareholder in a company, and in that company debt is there. Is company liable to pay interest? Yes, sir. Sir, the entire EBIT can be consumed by the equity shareholders, or EBIT minus interest can be consumed. EBIT minus interest can be consumed. Are you really with me? Since the equity shareholders will get only EBIT minus interest, that is called as earnings available to equity shareholders. Earnings available to the equity shareholders. You tell me, man, once you become an equity shareholder, will you get earnings available to the equity shareholder for 1 year or 10 year or infinite years? Infinite years. That means the cash flow is a perpetual cash flow. Cash flow is a, sir, if cash flow is a perpetual cash flow, then value of an asset today is called as the value of equity. Are you really with me? Is equal to cash flow divided by R. What is cash flow? EBIT minus interest. What is R? KE is the R. That is the rate. Are you really with me? Sir, now you are the owner of the what also? Debt also of the company. Are you really with me? That means, will you get EBIT, EBIT minus interest, or veru interest? Veru interest. That means if you are debt holder, sir, you can enjoy only interest. Are you really with me? This will be the future cash flow. Are you really with me? Since this is a what cash flow? Future cash flow. The expected return will be KD. Expected return will be. That means, my dear lovable students, sir, value of equity plus value of debt is equal to value of firm. So I can say that value of firm is equal to value of equity plus value of debt. Value of equity is equal to, if you are equity shareholder, can you enjoy EBIT? EBIT minus interest. So EBIT minus interest, correct? Divided by NI. KE, are you all really with me? plus the value of the debt means I can enjoy what? Interest divided by KD. Let me ask you a question. If you are holding 100% of the debt and 100% of the equity in a company, will you enjoy interest EBIT minus interest? I will enjoy EBIT. Are you really with me? That means if I am 100% shareholder and 100% debt holder, I will be enjoying EBIT. Yes, sir. That means minus interest and plus interest, not mathematically, logically, I am cancelling. Are you really with me? That means if I am holding 100% of the company, I can enjoy what IT? EBIT. Now I am the equity shareholder. I am the debt holder. That means KE plus KD is equal to KO. That's why the value of the firm is equal to, sir, EBIT divided by value of the firm will give you the KO. Are you really with me? That's the derivation of the formula they are saying. Simply they are saying that, sir, value of the firm is equal to EBIT divided by KO. But as per what approach? NI approach, I have to calculate the KO. KO is equal to EBIT divided by value of the firm. EBIT divided by, in other words, KO means cost of overall cost of the capital. This can be written as return on investment. Return on investment is equal to return divided by investment. Am I right? Sir, what is a return? EBIT is a return. Are you all really with me? In order to enjoy EBIT, whether you have to invest value of equity, value of debt, value of firm. That's why value of the firm. So KO is equal to EBIT divided by value of the firm. Comfortable? That's it with regard to the first theory called as NI approach. NI is saying that try to inject more and more and more debt into the, if you are injecting more and more and more debt into the capital structure, because of the presence of the cheaper source of finance, that is KD, KD pulls down KO. Once a KO reduces, value of the firm increases. It's a 5-step approach, my dear lovable students. Step number 1, find out EBIT and interest. Step number 2, find out the market value of the equity. Aduk munnadi, sir, you have to EBIT minus interest. You are supposed to do, right? EBIT minus interest. Sir, first you have to calculate EBIT and interest. Then market value of the equity. Market value of the debt. Then you will get the market value of the firm. Are you really with me? Now you are having EBIT in your hand. You are having market value of firm in your hand. The expected rate is called as KO. Comfortable? I'm coming to the next one, sir. Next theory I'm going to explain called as net operating income approach. What approach? Sir, what NI said that, this is how you have to understand. NI, net income approach, said that 3 characters will be there. Are you really with me? One is called as KE, other is called as KD, and other is called as what? According to NI approach, if you are having 10% debt or 90% debt, whatever may be the proportion of debt in the what structure, capital structure, your KE will be constant. Am I right? Sir, if you are having 0 debt or you borrow 100% debt, still the KD will be what? Constant. Sir, because of these two people, constant. Sir, because of injecting cheaper source of finance into the what structure? Capital structure, automatically KO reduces. Right, sir? Now, NOI approach is having a criticism over the NI. NOI is asking that if you inject more and more and more debt into the capital structure, how the fear of the equity shareholders will be one and the same. Because earlier, if this is the capital structure, for example, 10 crore is the capital structure, you can have various options. Option number 1, this is debt and this is equity and this is total. Always the total will be how much crore? 10 crore. You can have 0 debt and you can have 10 crore as equity. Am I right? My dear lovable students, in option number 2, you can have 1 crore as debt and 9 crore as equity. You can have option number 3, you can have 2 crore as debt and 8 crore as equity. Total comes to 10 crore. Able to appreciate. In option number 4, you can have 3 crore and 7 crore and the total will be 10 crore. What NOI is asking that if you are asking me to inject more and more and more debt into the what structure? Capital structure, your analysis is correct. You are saying that KD will be constant. Are you all really with me? But NOI is asking a basic critical doubt to the NI that how KE will be constant, man. Because if you inject more and more and more debt into the what structure, capital structure, automatically the buy-in of the equity shareholders increases. So your basic assumption of KE constant is useless. Are you really with me? It is unacceptable. I can't accept that at any point of time, because this is the KO, my dear lovable students. Sir, KO. Sir, this is KO. If you inject debt into the what structure? Capital structure. KD pulls down KO. KD pulls down KO. But sir, automatically the fear of the equity shareholders increases. They pulls up the KO and KO remain constant. And KO remain. If KO remain constant, value of the firm will not change. Value of the firm. Appa what NOI is saying that, Tambi, we are having three sources of items. Number one, KD and KE and KO. I am saying that KD will be constant. I am saying that KD will be constant. Are you really with me? And number two, sir, KE will be not constant, will be variable, and KO will be constant. KO will be, sir, how the NOI will work na? This is the KO. This is the, when you inject debt into the what structure? Capital structure. KD is the cheaper source of finance. Because of that, KD pulls down KO. Now KO reduces, value of the firm increases. Idoda NI mudiju poichu. But NOI is saying that, illappa, if you inject debt into the capital structure, the buy-in of the equity shareholders increases and KE increases and it pulls up KO and KO remain constant. That means KO will not change. If KO will not change, KO does not change, my dear lovable students, my value of the firm will not change. That's why NOI approach is a theory of irrelevance. Is a theory of, come on man, any change in the leverage will not lead to any change in the total value of the firm. NOI is asking that if first guy is doing serupu business and second guy is doing tuni business, then they can have different value of the firm. Are you really with me? If both the people are doing same business with the same capital employed, with the same return, with the same risk, how the value of the firm will change? Simply because of the reason that one is a all equity company, other is a debt and equity company. Question arises. And the market price of the share and the overall cost of capital is independent of the degree of leverage. Whether you are injecting 10% debt into the capital structure or 20% debt into the capital structure or 30% debt into the capital structure does not matter at all. Whether you are having debt, not having debt, because of that, the value of the firm will not change. This is the ideology of the NOI approach. Are you really with me? As a result, the division between the debt and equity is what? Irrelevant for me. For the net operating income approach, as per this approach, increase in the use of debt, which is apparently cheaper, is also accepting that KD is cheaper. There is no doubt about it. Is exactly offset. Is what? Exactly offset by an increase in the KE. That's what he is simply saying. Loose super dance. I don't really with me. Yes, sir. This is what? What? Oh, KO. Sir, when you inject debt into the capital structure, KD pulls down KO. Yes, and the KE pulls up KO. KO remain unchanged. This happens because equity investors seek higher compensation as they are opposed to greater risk due to existence of fixed return securities in the what structure. If you inject more debt into the capital structure, automatically the risk of the equity shareholders increases. Risk of the, because the fixed interest bearing securities or the fixed amount increases. Are you really with me? Then automatically, my dear lovable students, what will happen? You know, the expectation of the equity shareholders increases. When the expectation of the equity shareholders increases, KE increases. Are you really with me? When KE increases, it pulls up KO and the KO remain constant. Actually, this is what the position of the KO. It goes down. Are you really with me? Because of KD. And it comes up because of KE. And now KO is constant. Comfortable? What NOI is saying that as per my approach, whose approach? NOI approach. KD will be constant. KD will be. and KO will be constant. KO will be, and you have to calculate the KE. KE will be variable. KE will be. Now, NOI is an ulta. NOI is an ulta of the NI approach. He said that step number 1, first calculate the EBIT and interest. First calculate the EBIT and for every company, you have to see how much is the EBIT and how much is the interest. Hello, sir. And according to the NOI, will the KO changes? Will not changes. Will not changes. If KO does not change, value of the firm changes, will not changes. So calculate the value of the firm. Calculate that should be the step number 2. Sir, should not be like market value of equity plus market value of debt. Anyway, the what of the firm will not change. Value of the firm will not change. So first find out the value of the firm. Inside this value of the firm, 2 people are there. One is value of debt and value of equity. Is KD constant or variable? Constant. That means anyway value of the debt will not change. Right, sir? From the value of the firm, reduce the what of the debt? Value of the debt. Then automatically value of the firm minus value of the debt, you will get the value of equity. Value of yes, my dear lovable students, can you find out EBIT minus interest in step number 1? Yes, sir. This is the earnings available to the equity shareholders. Sir, can you get the value of the equity? Yes, sir. So automatically their expectation will be KE. So step number 5, KE is equal to EBIT minus interest divided by value of the equity. Comfortable? So think like this. NI is saying that KD is constant, KE is constant, KO is variable. So first find out EBIT and interest. Comfortable? Then find out market value of the equity. Then find out market value of the debt. You add market value of equity plus market value of debt. You will get the market value of the firm. You are having EBIT in your hand. You are having market value of firm in your hand. Find out the KO. Are you really with me? Because, sir, NI approach is a theory of relevance. So, there, in order to be theory of relevance, we have to calculate the KO. Comfortable? Whereas NOI approach is a theory of irrelevance. Their KO should not be the balancing figure. Either KD or KE should be the balancing figure. Comfortable? What is saying that KD is constant and KO as mandatorily to be constant. Are you really with me? Then the only balancing figure is what? KE. So, under NOI approach, we have to calculate the KE. Comfortable? So, how he is designing the problem? First, calculate the EBIT and interest. Then, straight away calculate the known figures such as market value of the firm. Inside the market value of the firm, market value of debt is there. Market value of equity is there. Are you really with me? My dear lovable students, remove the market value of the debt. You will get the market value of equity. You are having EBIT minus interest. You will be getting earnings available to the equity shareholders. Divided by market value of the equity, you will get the, that means NOI is saying that is a how many step approach? 5-step approach. Are you really with me? So the value of the firm is equal to EBIT divided by KO. EBIT divided by KO. Sir, V means what of the firm? Value of the firm. Sir, NOI means net operating income. KO means what of capital? Cost of capital. As per NOI, I am not liable to calculate the KO or value of the firm. I have to calculate the KE. KE is equal to EBIT minus interest divided by value of the equity. Value of the, that means as per NI approach, I have to calculate the KO. Correct? KO is equal to EBIT divided by value of the firm. EBIT will be given in the value of the firm will be value of equity plus value of debt. Comfortable? Whereas here KE is equal to EBIT minus interest divided by value of EBIT and interest will be given in the question. Value of equity means value of the firm minus value of the debt. Can I proceed? Now I'm moving or entering into the next theory called as traditional approach. What approach? Traditional approach is asking one basic question with the same example. Look at here, man. NI, you said that KD will be constant. KE will be constant, right? But NOI said that KE will not be constant, KE will be variable. KE will be variable. Am I right? NOI said that KD will be constant. Are you really with me? And here he said that KO will be constant. I am writing as per what approach? NOI approach. Right? Traditional approach is asking a basic question or doubt to both NI and NOI, saying that என்னப்பா நீ சொல்ற, because you are asking me to inject more and more and more debt into the person who are giving debt to you, sir, they won't have any என்னவா risk. They won't have any risk. Even the KD should also increase. Sir, if you inject more and more and more debt into the what structure? Capital structure, the expectation, the risk of the debt holders will also increases. Then automatically KD increases and KE will also increases. My dear lovable students, if KE also increases, KD also increases, automatically KO increases. If the KO changes, not increases, KO, if the KO changes, then automatically value of the firm will change. Automatically. That's why, sir, traditional approach is called as theory of relevance. Because in order to be theory of relevance, my dear lovable students, who should change? KO should change. If KO changes, value of the firm changes. If value of the firm changes, it will be theory of relevance. Are you really with me? So what traditional approach is saying? That this approach favors that as a result of what leverage? Up to some point, cost of capital comes down. That means initially this traditional approach is supporting NI approach. Initially, traditional approach is saying that if you are injecting 10% debt into the what structure, what NOI said that KD pulls down KO and KE pulls up and KO remain constant. Traditional approach is saying that it is not like that. Once you inject 5 or 10% debt into the what structure, actually equity shareholders will enjoy that position. Are you really with me? Because financial leverage will work favorably. Are you really with me? Actually, trading on equity will happen. Actually, the equity shareholders will be having more EPS if you are having minimum debt. So initially, what will work? NI approach will work initially, and value of the firm increases. But இதே ஒரு பழப்புன்னு சொல்லி beyond that point, reverse trend emerges. Beyond that point, reverse trend emerges means once you keep on injecting debt into the what structure? Capital structure, who will start react? Equity shareholders will start react. Once they start react, and who will also start react? KD will also start react. That means who will increase? KD increases and also KE also increases. But NOI, you said that it will be exactly offset. It will be, but the change will not be exactly offset. Sir, if KD increases by 5%, the KE will increase by 15%. It will be a steep increase. It will be a steep increase. That means KE will not be exactly offset, my dear lovable students. The principal implication of this approach is that cost of capital is dependent on the what structure. And there is an optimal what structure? Capital structure, which minimizes the cost of capital. This is the super point in the traditional approach, my dear lovable students. Sir, what NI is saying that KD is constant, KE is constant, and KO is variable. Correct, sir? Yes, sir. KO is variable. Whereas NOI is saying that KD constant, KO constant, and KE is variable. Able to appreciate? What traditional approach is saying that when you inject debt into the what structure? Capital structure, initially KO reduces. Initially. But if you inject more and more and more debt into the what structure? KD increases, even KE also increases. But the proportion of increase in KE will be much, much higher than that of KD. Are you really with me? Because of that, KO increases. Because of that, if KO increases, value of the firm decreases. Am I right? So up to a level, KE will not react. Up to a level KE will not react. Up to a level KD will not change. Are you really with me? ஒரு லெவல் தாண்டினதுக்கு அப்புறம் ரெண்டு பேர் என்ன ஆக ஆரம்பிப்பாங்க, இன்க்ரீஸ் ஆகும். அந்த இன்க்ரீஸ்ல யாரோட இன்க்ரீஸ் ரொம்ப அதிகமா இருக்கும், கேயோட இன்க்ரீஸ். அப்ப அந்த இன்க்ரீஸ் ஆவர் அந்த பாயிண்ட் இருக்கு பாத்தியா, that is called as optimum capital structure. What capital structure? Under NI approach you won't have optimum capital structure. Under NOI approach you won't have optimum capital structure. Logic. Because sir, when you inject more and more and more debt into the what structure, capital structure, automatically KO reduces. 10% na I injected debt, then KO reduces by 10%. Correct? I inject more debt, 20%, then KO reduces by 20%. Are you understanding? If I inject 50% debt, then KO reduces by 50%. Are you all really with me? That means what is the optimum capital structure as per NI? There is no such concept. If possible, try to inject 100% debt. Practically, is it possible? No, sir. But NOI is saying that nee debt inject pannamiru. Sir, KO is not going to change. If KO is not going to change, there is no question of optimum what structure at all. Capital structure at all. Are you able to appreciate? But traditional approach is saying that initially when you inject debt into the what structure, capital structure, KO reduces. So when the KO reduces, value of the firm increases. Are you really with me? Are you able to appreciate? That means, my dear lovable students, after a particular point of time only KO start increasing. Correct? So in the point like KO romba least arko, that point is the optimum what structure. Only under traditional approach you will be having optimum capital structure. Under NI and under NOI you won't have optimum capital structure. Can I proceed, sir? So what traditional approach is saying that KD will change, KE will change. If both the people changes, automatically KO will change. So KD will change. So according to this approach, KD will change, KE will change, automatically KO will change. KO will also change. This is what the theory called as traditional approach. Are you really with me? So NI is a theory of relevance. NOI is a theory of irrelevance. And the traditional is a theory of relevance. Coming to the last one, the hero called as Modigliani-Miller approach. Modigliani, sir, the NOI approach, that is net operating income, is definitional or conceptual. It is correct only if you inject debt into the what structure? Capital structure. KO reduces because of KD. And KE pulls up KO. Are you really with me? And it will exactly offset. This is what the theory of the NOI. But it lacks behavioral significance. எல்லாரும் கேக்குறாங்க, how it will exactly offset? Sir, NOI was speechless. He was not able to explain why it is exactly offset. So it does not provide operational justification. How it will operate, NOI was not able to say, for irrelevance of what structure? Capital structure. That's why who came as hero? Modigliani. However, Modigliani-Miller approach provides behavioral justification for constant overall cost of capital and therefore total value of the firm. Then, sir, there is a defect in the NOI approach, my dear lovable students. NOI approach said that, sir, net operating income, there is a defect. Conceptually, that is right. But operational justification, it failed. I will give you the operational justification. I will explain you how it will be exactly offset. That means Modigliani-Miller approach is an extension of the NOI approach. Are you really with me? Sir, this approach indicates that capital structure is irrelevant. If two firms are alike in all aspects except capital structure, sir, the value of the firm will not change because of the arbitrage process. Because of the, which will correct any imbalance. If there is any imbalance between the levered firm and the unlevered firm, then also it will correct, my dear lovable students, that expectation will change and at a stage will be reached where arbitrage is not possible. So there were defect with the NOI approach. Conceptually, NOI approach was correct. Whereas, Sir, operational justification, it has failed. Who gave the operational justification? Modigliani and Miller approach. So Modigliani and Miller said that. Modigliani and Miller said that, sir, if two firms are alike in all aspects except capital structure, the value of the firm will not. He has explained one without tax and he has explained one with the tax. Sir, we are moving with this background. We are moving into the three questions what we are supposed to be solved. Sir, illustration number A, illustration number N, and illustration number M. Shall we apply our discussion into the question, sir? This is a RTP May 2022 question. Following data relating to two companies belonging to the same risk class. Yes, when two companies are alike in all aspects except what structure? Capital structure. Will the value of the firm change or not is the question. Correct, sir? Sir, they are of same what class? Risk class. Same risk class. Hello, sir. Sir, when two firms are alike in what aspect only? All aspects only. I will do this chapter at all. Correct? Sir, this is B limited and this is C limited. B limited is having debt. That means B limited is a levered firm. Whereas C limited does not have debt. They are unlevered firm. What firm, man? Equity capitalization rate. My dear lovable students, 18% is the KE of the C limited. KE is equal to KO. Correct? And the expected net operating income, EBIT, is how much lakh? 9 lakh. Why both the company are having same EBIT? Because if two companies are alike in all aspects except will the value of the firm change or not is our discussion. Right, sir? You have to determine the total market value. Total market value means value of the and equity capitalization rate. Equity capitalization rate means and weighted average cost of capital. That means KO for each company. Sir, assuming no taxes as per MM approach. No taxes as per? Because there was defect in the NOI approach. That's why who came? MM approach came. Are you really with me? MM said that I will prove to you with the tax and without tax. And the second part of the question, determine the same total market value, determine the equity capitalization rate and weighted average cost of capital for each company assuming 40% tax as per the MM approach. Right, sir? So same question, the MM is going to prove that when two companies are alike in all aspects except capital structure, just because of the reason that one person are having debt and another person are having does not have debt, that because of that the value of the firm will not change. Are you really with me? If you critically analyze B limited and C limited two company, my dear lovable students, inga paru, sir, this is with regard to company number 1 and this is with regard to company number 2. Right, sir? What is the EBIT of the first company? 9 lakhs. Okay, what is the EBIT of the second company? Same 9 lakhs. Because, sir, risk and return should be one and the less what man interest. Sir, what is the interest paid by the first company? What is the interest paid by? Which is 27 lakhs into 12%. Am I right? 3 lakh 24,000. Yes, sir. So 3,24,000 is the amount of interest. Right, sir? But the second company does not have what at all? Debt at all. Hence, there is no interest at all. Are you all really with me? Yes, sir. So, my dear lovable students, 9 lakh minus 3,24,000 comes to 5,76,000 is the profit before tax. Can I proceed? Whereas in the second company, 9 lakh rupees is a profit before tax. Why are you staring? Sir, there is no tax. Then why are you writing profit before tax? My dear lovable students, less tax, dash, dash. Okay, wow. So, my dear lovable students, what is a PAT? Profit after tax. The profit after tax in company number 1 is 5,76,000. Right? And profit after tax of the second company is how much lakh? 9 lakh. Now, MM is asking a very logical question. If you are holding 100% of the company as a whole, will you enjoy interest, EBIT minus interest, EBIT? EBIT. That means if you are holding 100% of the company, you will get both interest and PAT. Am I right? What is the interest you will get? 3,24,000. What is the PAT you will get? 5,76,000. So 3,24,000 plus 5,76,000 comes to. That means if you are holding 100% of the first company, you will get 9 lakh. Right, sir? But if you are holding 100% of the second company, you won't have interest. The interest will be 0, but you will be having PAT of 9 lakhs. So then also you will be having 9 lakhs. That means, my dear lovable students, if there is no tax, if there is, according to approach, according to what? If there is no tax, value of the levered firm is equal to value of the unlevered firm. Value of the levered firm is equal to value of the. This is what the logic. This is what the logic. Are you really with me? Value of the levered firm will be equal to value of the unlevered firm. So always is asking that whether you are having tax, not having tax, start your calculation with the unlevered firm. Start your calculation with the. So I'm going to calculate, man, assuming there is no tax as per what approach? So calculation of value of firms, that is B limited and C limited according to hypothesis. Hello, sir. So the market value of the C limited, who's the second company? C limited. What is their specialty? Unlevered firm. is asking that always first value the unlevered firm because they don't have debt in their what structure? Capital structure. For them, KE is equal to KO. So KE already given as 18%. That means KO of that company will be also 18%. So I am going to value the market value of the firm, unlevered firm. Right, sir? Sir, value of a unlevered firm is equal to EBIT divided by KE or KO, whatever it may be. Hello, sir. Is the EBIT given in the question? If you are 100% owner of that company, you can enjoy EBIT of 9 lakh and your expectation is how much percent? 18%. So 9 lakhs divided by 18% comes to 50 lakhs. Sir, tax there are, tax not there are. The proposition of the Modigliani and Miller is if there is no tax, value of the levered firm is equal to value of the. If value of the levered firm is equal to value of the unlevered firm, technically means KO of the unlevered firm is equal to KO of the levered firm. Comfortable? So value KE of an unlevered firm given is equal to KO of unlevered firm is equal to 18%. Are you all really with me? Now, sir, I have completed the value of the dash firm, unlevered firm. If there is no tax, value of the unlevered firm is equal to value of the. Now I am going to calculate the market value of the B limited. That is the first firm. That is what firm? Levered firm. Sir, actually, if there is tax, sir, value of the what firm is equal to? Levered firm is equal to value of the unlevered firm plus DT plus what? DT plus what? Sir, what is the value of the unlevered firm? 50 lakhs. Just now we calculated. Are you really with me? Plus you are having debt, but you does not have the T. T stands for what rate? Tax rate. Ennappa? That means 27 lakhs into 0. So 50 lakhs will be the what of the firm. That means, sir, what MM's hypothesis is saying that Modigliani and Miller can be classified into how many categories? 2 categories. Without tax and with the tax. Are you all really with me? If it is without tax means value of the unlevered firm is equal to value of the levered firm. Because whatever income you are getting from the levered firm, the same income you will be getting from the unlevered firm. Enapa clarity? Are you all really with me? Whereas, my dear lovable students, if there is tax, the value of the levered firm is equal to value of the unlevered firm plus DT. Plus what? DT. D means debt. D means tax rate. Can I proceed, sir? So here debt is there, but tax is not there. Are you all really with me? That means 27 lakhs into 0 comes to 0. So 50 lakhs plus 0 comes to 50 lakhs will be the what of the firm. So are you all settled? The settled in the sense means if there is no tax, value of the levered firm is equal to value of the. Now I am calculating the equity rate. That is equity rate. Are you really with me? And the back. You tell me what is the B limited? B. B means what firm? Levered firm. Sir, why are you not calculating for C limited? They are already given in the question, which is KE is equal to KO. Sir, whose KE is not given? B limited's KE is not given. Are you really with me? Yes, sir. So I have to calculate the KE of the whose limited? Levered firm. Can we calculate KE? What is the EBIT of the company? 9 lakh. On that, the first company is liable to pay interest of 3 lakh 24,000. Comfortable. From the 9 lakh, if you reduce 3 lakh 24, earnings available to the equity shareholders are 5 lakh 76,000. Comfortable? Yes, sir. As per NOI, first you have to calculate the value of the firm. Am I right? Sir, I already said that approach is an extension of NOI approach. NOI fails to give operational clarification. Correct? Now is coming and saying that I will explain to you how exactly it will offset. So even the is also traveling the same route of the NOI approach only. NOI 5-step. Calculate the EBIT and interest. Then you have to calculate the value of the firm. Sir, in order to calculate the value of the firm is equal to EBIT divided by KO. But the KO of the levered firm is not given in the immediately. is asking that there is tax, there is no tax. There is no tax. If there is no tax, value of the levered firm is equal to value of the, that means KO of a unlevered firm is equal to KO of a levered firm. Accepting. Are you all really with me? That means, my dear lovable students, I have to adopt the KE as the KO of a unlevered firm. I have to adopt the KO of a unlevered firm as the KO of the levered firm. Puruncha? That means, my dear lovable students, 18% is the KO of the levered firm or unlevered firm, because there is no tax. If there is no tax, my dear lovable students, value of the levered firm is equal to value of the, so calculator man, sir, 5,76,000 divided by 18% comes to, sorry, 5 lakh, 9 lakh, sorry, 9 lakhs divided by 18% comes to 50 lakhs is the value of the levered firm, which is equal to value of the unlevered firm. Why? Because there is no tax. If there is no tax, value of the levered firm is equal to value of the KO of a unlevered firm is equal to KO of the, sir, inside this how much lakh? 50 lakhs. For an unlevered firm, only equity will be there. Am I right? But for a levered firm, both debt and equity will be there. In that, KD will be constant as per NOI. The same assumption is there for Modigliani and Miller approach also. Are you all really with me? That means out of this 50 lakh, how much is the debt included? 27 lakhs. So 50 lakhs minus 27 lakhs comes to 23 lakhs will be the market value of the equity. Market value of, that means, my dear lovable students, sir, in the levered firm, is debt is there or debt is not there? Debt is there. If what is there, debt is there, then automatically the fear of equity shareholders increases. Then it will not be 18%, it will be more than 18%. Correct? So I am going to calculate the KE. Sir, KE means expectation of the what shareholder? Equity shareholder, which is nothing but earnings available to the equity shareholders divided by value of equity. What is the earnings available? 5,76,000 divided by what is the value of equity? 23 lakhs. So calculator man, 5,76,000 divided by 23 lakhs into 100 comes to 25.04% is the KE. Let me ask you a question. What is the KE of an unlevered firm? 18%. What is the KO of an unlevered firm? 18%. Because there is no debt in the what structure? That means the equity shareholders of an unlevered firm does not have bayam. But the equity shareholders of the levered firm are having bayam. Since they are having bayam, automatically the return expected by the equity shareholders will also be more. Will also be That's why it is not 18%. That's why it is 25.04%. But my dear lovable students, the KO of both unlevered form and KO of both levered form will be one and the same. How to calculate the KO, my dear lovable students? You can calculate the KO by, sir, what by what? EBIT divided by value of the firm. What is EBIT? 9 lakhs. What is the value of the firm? 50 lakhs. So 9 lakhs divided by 50 lakhs into 100 comes to 18% is the KO. 18% is the, sir, the same KO we can find out by using WACC table. In the levered form, equity and debt is there. What is the market value of equity? 23 lakhs. Just now you find out, right? What is the market value of debt? 27 lakhs. What is the total value of the firm? 50 lakhs. That means here I am not putting the book value weight. I am putting market value weight. Are you all really with me? I can calculate the WACC using book value weight and what is my weight? What is my weight? That is 23 lakhs divided by 50 lakhs into 100 comes to 46%. 27 lakhs divided by 50 lakhs into 100 comes to 54%. Can I calculate the individual cost of capital? This is KE and this is KD, correct? My dear lovable students, KD already given in the question as how much percent? 12%. You tell me KO, sir. KO of a levered firm will be equal to KO of an unlevered firm if there is no tax. Conceptual clear? So it should be how much percent? 18%. Calculator 12% into 54% comes to 6.48%. Am I right? So calculator man, 18% minus 6.48% comes to 11.52% is the weighted KE. Is the what KE? So this should be 46%. Am I right? So calculator 11.52 divided by 46% comes to 25.04% should be the full KE. Sir, here 25.04%. Are you able to appreciate? That means one line summary of the entire discussion is approach can be classified into two categories. Without taxes and with the taxes. Are you really with me? If it is without taxes, man, value of the unlevered firm is equal to value of the, hence KO of an unlevered firm will be equal to KO of the. Fine, fantastic to the core. I'm moving into the next one, man. Assuming 40% tax as per approach. Are you really with me? Can I proceed as per 40%? Sir, with the tax, without tax? With the tax. If there is tax, value of the levered firm will be equal to value of unlevered firm. Or value of the levered firm will be more than the value of unlevered firm. More than the value of unlevered firm. I will prove you, man. The same question I can prove you, man. There are two companies are there, right, sir? Company number 1 and company number 2. Please help me. What is the EBIT? 9 lakhs. What is the EBIT of the second company? 9 lakhs. Sir, is the first company liable to pay interest? Yes, sir. What is the interest? 3 lakh 24,000. Second company put a dash. So earnings before tax of the first company 5 lakh 20 5 lakh 76,000. Are you really with me? 5 lakh 76,000. And here it will be 9 lakh. Sir, less tax at the rate of 40%, which is given in the question. So calculator man, 5 lakh 76,000 into 40% comes to 2 lakh 30,400 is the tax to be paid by the levered firm. Are you all really with me? Whereas 9 lakhs into 40% comes to 3 lakh 60,000 is the tax to be paid by the unlevered firm. That means the PAT, profit after tax, 5 lakh 76,000 into 60% comes to 3 lakh 45,600 will be the PAT of the levered firm. Am I right with my calculation? 9 lakh into 60% comes to 5 lakh 40,000 will be the PAT for the what firm? Unlevered firm. Now Modigliani and Miller is asking a basic question. My dear lovable students, if you, sir, have tax, if you are holding 100% of the debt and equity, will you get interest from the first company? You would have got interest of 3,24,000, and from the second company you would have got 0. Am I right? Sir, equity, sir, you would have got 3,45,600, and here you would have got 5 lakh and 40,000. So calculator man, sir, total return from the company 3,24,000 plus 3,45,600 comes to 6,69,600 from company number 1 and 5,40,000 rupees from company number 2. Am I right? That means if there is tax, automatically the return generated from a levered firm should be more than the return generated from a unlevered firm. Then if there are two cow, one cow is giving a milk worth rupees 6,69,600 and another cow worth rupees 5,40,000, will you buy both the cow at the same rate? That's why is saying that if there is tax, value of levered firm is equal to value of unlevered firm plus dt. Plus what? Dt. Plus what? Dt. Are you all really with me? That means nothing but, my dear lovable students, look at here, man. Value. So calculation of value of firms, that is B limited and C limited according to hypothesis. Market value of C limited always as per First value the dash firm, unlevered firm. First value the unlevered firm. So for unlevered firm, look at here, man. Simple, man. You have to be with me. Sir, in order to value the levered firm, first I have to value the unlevered firm. Correct? Sir, value of unlevered firm is equal to basically EBIT divided by KE. This was the earlier formula if there is no tax. Correct? But if there is tax, sir, the equity shareholders cannot enjoy what? EBIT. Equity shareholders can only enjoy PAT. Are you all really with me? That means the value of NF firm is equal to unlevered firm is equal to EBIT into 1 minus T. EBIT into 1 minus T divided by KE. Divided by what? Tell me, what is the EBIT of the second company? 9 lakhs. 9 lakhs is the EBIT into 1 minus T. What is tax rate? 40%. So into 0.14 divided by what is KE? 18%. So calculator, 9 lakh into, sir, 0.6 comes to 5,40,000 is what? Look at here. 5,40,000 is the PAT. Are you really with me? That's what I've reached. If there is no tax, value of unlevered firm is equal to EBIT divided by KE. But if there is tax, value of unlevered firm is equal to EBIT into 1 minus T divided by KE. Puri the difference. That means 5,40,000 divided by 80%. So 5,40,000 divided by 80% comes to 30 lakhs is the dash of the firm. Value of the firm. If there is tax. If there is, let me ask you a question, sir, to ensure that you are with me for the calculation. My dear lovable students, have you calculated value of the unlevered firm? Yes, sir. Without tax? Yes, sir. What was the value? 50 lakhs. How much lakh? 50 lakhs. What is the tax rate? 40%. That means from 100 rupees, 40 will go. Remaining 60 will be there. So 50 lakhs into 60% comes to that 30 lakh only you have achieved or arrived here. Are you all really with me? So without tax, if the value is 50 lakh, and if I am paying a tax rate of 40%, with the tax, the value of the firm will be 30 lakhs. Are you all really with me? Now I have completed the valuation of the unlevered firm. Now I am going to calculate the value of the levered firm is equal to value of the unlevered firm plus DT plus what? Tell me, my dear lovable students, value of unlevered firm, if there is tax, will be how much lakh? 30 lakhs. Is debt is there for levered firm? அதனால தான் அது levered firm கூப்பிடுறோம். கரெக்டா? What is the debt? 27 lakhs is the debt. 27 lakhs is the debt. What is the tax rate, my dear lovable student? 40%. That means how much lakhs plus 30 lakhs plus 27 lakhs into 40% comes to 10,80,000 will be the DT. Right, sir? Abdina 30 lakhs plus 10,80,000 comes to 40,80,000 will be the value of the levered firm if there is tax. If there is, appreciating? That means, my dear lovable students, 40,80,000 is the value of the levered firm if there is tax. Correct? But value of the unlevered firm is equal to how much lakh? 30 lakhs. That means 10,80,000 is the difference between value of the what into what? Levered firm and the unlevered firm. Right, sir? If you see, sir, if there is tax, if you are holding 100% of the levered firm, you can have 6,69,600. But if you are holding 100% of the unlevered firm, you are having only 5,40,000. Appa 6,69,600 minus 5,40,000 comes to, you will be having 1,29,600 extra if you are holding 100% of the what firm? Levered firm. Can I proceed? Yes, sir. 1,29,600. Sir, why I am having extra 1,29,600? Because the levered firm have paid a tax of 2,30,400. Can I proceed? But the unlevered firm had paid a tax of 3,60,000. Correct? So 2,30,400 minus 3,60,000 comes to 1,29,600. This 1,29,600 extra is available with the levered firm. Comfortable? Why, sir, this guy has paid less tax? Why, sir, this guy has paid more tax? Because of interest. Because interest is a tax deductible item. Interest is a tax deductible item. Are you really with me? If you see the interest, if you see the question, they are saying that, my dear lovable students, 12% is the KD. 12% is the, sir, the second company is having 1,29,600. Is this for 1 year? Lifelong. Every year, this 1,29,600 will come. Every year, 1,29,600 will come. Right? That means the cash flow is a perpetual cash flow. What cash flow? The value of an asset today is equal to cash flow divided by R. The R is how much percent? 12%. So 1,29,600 divided by how much percent? 12% comes to 10 lakh. That is the difference between the first company and the second company, 10,80,000. That's what we are finding out as DT. That is a logic of debt into tax rate. Are you all really with me? Are you all really with me? So 40,80,000 is the value of the firm. Can I continue with the second part of the answer? So you tell me, sir, total value of unlevered firm, how much lakh? 30 lakh. Because if there is tax, the value of the unlevered firm reduces. Correct? What was the value of the firm if there is no tax? 50 lakh. From that, they would have paid tax of 40%. So 50 lakhs and the 40 lakh, 40% pochina 30 lakhs. Abdi calculate panna kudadu. Are you really with me? You have to calculate as EBIT into N minus C, 1 minus T divided by KE. Can I proceed? Yes, sir. So KE of an unlevered firm is equal to KO of an unlevered firm is equal to how much percent? 18%. Are you settled? Now I am going to calculate the market value of the B limited. That is what firm? Levered firm. Ipa na yara value panna poren? Levered firm. If there is tax, value of levered firm will not be equal to the value of the unlevered firm. If there is tax, value of levered firm will be more than the value of the unlevered firm. Comfortable? Yes, sir. So value of levered firm is equal to value of the unlevered firm plus DT. Plus what? DT. What is the value of the unlevered firm? 30 lakhs. Plus what is the debt in the levered firm? 27 lakh. What is the tax rate? 40%. So 27 lakh into 40% comes to 10,80,000 plus how much lakh? 30 lakhs comes to 40,80,000 is the value of the levered firm if there is tax. Comfortable? Now, sir, the WACC, weighted average cost of capital of C limited. Who C? Unlevered firm. For them, the WACC is how much percent? 18%. Because KE is equal to, now I am going to calculate the KE and I am going to calculate the KO. Are you all really with me? Yes, sir. What is the EBIT of the levered firm? 9 lakhs. Less interest. Is there any debt in the capital structure? Yes, sir. Debt value of 27 lakhs. And the 27 lakhs interest 12% comes to interest of 3,24,000. Are you able to appreciate, sir? From the EBIT 9 lakh, if you reduce 3,24,000, what is the earnings before tax? 5,76,000. Is the levered firm liable to pay more tax or less tax? Less tax because of charging interest. Am I right? So less tax at the rate of how much percent? So 5,76,000 into 40% comes to 2,30,400 is the tax. Comfortable? So you will be getting a PAT, profit after tax, of 5,76,000 minus 2,30,400 comes to 3,45,600. Right? Already we calculated the what value of the firm. Always is saying that take the total value of the firm. In case yaar irkangana, tax irkangana, value of the levered firm will be higher than the value of the unlevered firm. Purida? That means already we calculated 40,80,000, which is much more than 30 lakhs. 30 lakhs was the value of the unlevered firm, plus DT will be there for value of the levered firm. Sir, inside this 40,80,000, sir, debt value will be there and also equity value will be there. Can you reduce the market value of debtor? Yes, sir. How much lakh? 27 lakh. That means, my dear lovable students, market value of equity will be 13,80,000. Can I proceed? That means, sir, to the equity shareholders, 3,45,600 is the earnings available to equity shareholders. In order to enjoy 3,45,600, they have to invest 13,80,000. So calculator man, 3,45,600 divided by 13,80,000 into 100 comes to 25.0% is the KE. Is the what? And can we calculate the KO, my dear lovable students? Yes, sir. What is the formula for KO? KO is equal to EBIT divided by value of the firm. What is EBIT? 9 lakhs. So 9 lakhs divided by what is the value of the firm? 40,80,000 into 100 comes to 22.05. Yeah? It's the KO. Sir, what is the EBIT? 9 lakhs divided by 40,80,000 into 100 comes to 22 point. But sir, is this, sir, weighted average N of capital, cost of capital? Is this NI approach? No. This is Modiglian Miller. So KO is equal to, I have to use the WACC table, correct? Can we calculate the WACC table? Tax bottom. Yes, sir. Tax bottom. Tax bottom tally. Wait. Sir, can I use the WACC table? Yes, sir. Sir, we are having equity and what? Debt. What is the market value of equity? We just find out 13,80,000. What is the market value of debt? 27 lakh. So total value of the firm 40,80,000. Can I calculate the weight? Yes, sir. Can I calculate the, sir, K individual cost of capital? Already I find out KE as 25.04%. I will not take KD as 12% because tax is there. Correct? If tax is there, cost of capital should be after tax. Hello, sir. So 12 into 60% comes to 7.2%. Comfortable? If I calculate, I will get 13.23%. If you want, by using formula method, don't take the KO as EBIT divided by value of the firm. This will work out only if there is no tax. Correct? If there is tax, EBIT will not be available to the what shareholder? To the all shareholders. Are you really with me? Actually, the KO means the total return. Correct? So don't use this formula because this formula will be applicable only if there is no comfortable. Yes, sir. So the WACC will be 13.23%. Sir, but the WACC of unlevered firm was how much percent? 18%. Correct? But the WACC of, sir, levered firm is how much percent? 13.23%. அப்ப ரெண்டு பேரோட WACC என்ன ஆவல? Match ஆவல. Match ஆவலனா WACC is changing. KO is changing. That means MM should be theory of relevance. MM cannot be theory of. That's why from there arbitrage process is starting. What MM is saying that if there is tax, surely initially value of the levered firm will be more than the value of the unlevered firm. And slowly people will start fry from the levered firm to the unlevered firm, called as primary arbitrage. Correct, sir? So we are having basically 4 theories are there. NI approach, NOI approach, traditional approach, and the Modigliani Miller approach. Right, sir? If you ask me to tabulate the 5 theories, my dear lovable students, sir, number 1, NI, number 2, NOI, number 3, traditional, number 4, without tax, and with tax. Are you really with me? What NI 3 characters are there? KD, KE, and KO. Are you really with me? What NI is saying that KD will be constant, KE will be constant, and KO will be variable. Hello, sir. What is the rule? What is the rule of NI? NI is saying that try to inject. Try to inject more, and more debt into the capital structure. Into the capital structure. Since KD is the cheaper source of finance, KD is the cheaper source of finance, KD pulls down KO. KD pulls down KO. When KO reduces, value of the firm increases. When KO reduces, value of the firm increases. Are you all really with me? Yes, sir. Now coming to NOI, man, KD is constant, KE is variable, and KO is constant. KO is constant. The rule of NOI approach is saying that what the theorem or the rule is saying that if you inject debt into the capital structure, since KD is cheaper source of finance, KD reduces KO. But this but is the theory, correct? But fear of equity shareholders increases, and automatically KE increases, and it exactly offset. Hence, KO remain unchanged. Right, sir? Hence, KO remain unchanged. Come on, man. Traditional approach. What tradition is saying that KD is variable, KE is variable, hence KO is variable. Everyone is variable. Traditional approach is saying that when you inject more debt, when you inject debt into the capital structure, debt into the capital structure, initially equity shareholders enjoy financial leverage. And equity shareholders enjoy financial leverage. And initially KO reduces. Such point is called as optimum capital structure. Optimal capital structure. Comfortable? With regard to without tax, if there is no tax, value of unlevered firm is equal to value of the levered firm. Value of unlevered firm is equal to value of the levered firm. Value of unlevered firm is equal to value of levered firm. Comfortable? Hence, KO of unlevered firm is equal to KO of levered firm. Hence, KO of unlevered firm is equal to KO of unlevered firm. Here, KO is equal to EBIT divided by value of the firm. EBIT divided by value of the firm. EBIT divided by value of the firm. Here, if there is tax, value of unlevered firm will not be equal to value of the levered firm. Value of unlevered firm will not be equal to the value of the levered firm. Hence, value of levered firm is equal to value of unlevered firm plus DT. Value of levered firm is equal to value of unlevered firm plus DT. Value of unlevered firm plus DT. Okay, sir? Yes, sir. And if tax is there, value of the unlevered firm is equal to EBIT into 1 minus T divided by K. K or KO, whatever it may be. EBIT into 1 minus T divided by K. EBIT into 1 minus T divided by K. Comfortable? With this, my dear lovable students, the concept revision of the first chapter, that is capital structure theories, comes to an end. And we have done with question number 1, which is question number A. In the coming slot, we'll be solving again MM. You have to revise the theory, whatever we have done. The 2 questions we'll be solving, which we will be feeling it as very cakewalk to proceed, my dear lovable students. We will be, discussing a superb 2 question, past examination and RTP question. Have a full revision of theory, NI, NOI, traditional, MM without tax and MM with tax. Are you all clear? Yes, sir. Sir, very, very, very happy afternoon to all. So we are doing capital structure theories. We have done. Actually, the relationship is first cost of capital. We calculated KD. We calculated KP. We calculated KE. We calculated KR. We calculated KO. Sir, because of Alzheimer's, I'm asking you a question, sir. Can we recall what is the formula for KD? Redeemable debt. I into 1 minus T plus RV minus NP divided by whole divided by RV plus NP divided by 2 into 100. Right, sir? If the debt is a redeemable debt, this formula will come. If it is irredeemable debt, I into 1 minus T divided by NP into 100. If it is PD, that is, sir, KP, sir, irredeemable KP na PD divided by NP into 100. Redeemable na PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Then we are having KE 5 formulas or 6 formulas. Dividend price approach, earnings price approach, dividend price plus growth approach, earnings price plus growth approach, realized yield approach, and the capital asset pricing model. Generally, KR is equal to KE if there is no flotation cost. If there is flotation cost, we have to rework the KR by using the KE formula. But the denominator, sir, we have to take the gross and not the net. Are you remembering? Simple. That's it with regard to that. So if you work out the weighted average cost of capital, the answer, what we will be calling it as KO, that KO can be worked out either using the book value weight or the market value weight. Now, after we studied the cost of capital, we have entered into the capital structure theories. NI approach, NOI approach, traditional approach, Modigle and Miller without tax, and Modigle and Miller with the tax. Now, the last line we said in the MM with the tax is, if there is tax, value of the levered firm will be higher than the value of the. Now, how MM approach theory will be a theory of irrelevance, it will be a theory of relevance is what we have stopped. Correct? Now, MM itself are saying that, illappa, there is a process will be happening called as arbitrage process. What process? Sir, what is arbitrage? Sir, this is propounded by Modigliani and Miller. It is proposition capital structure irrelevant to the what valuation. Because according to MM, if 2 firms are alike in all aspects except capital structure, value of the firm will not change. This is what the story of the MM approach. Right? Explanation. If 2 firms are alike in all aspects, example, return are same, that is EBIT same, sir, beta same, size of the firm same, except what structure? Capital structure cannot have 2 different values. Even if they have Initially, because of tax, sometimes value of the levered firm may have more value than the value of the unlevered firm. Purida? Their value will be made automatically equal due to operation of a process called as what process? Arbitrage process. So, what is arbitrage, sir? It is a process of buying in cheaper market. You will go and buy the things from the cheaper market and sell in the what market? Costlier market to make a arbitrage gain. That means if there is tax, what MM is saying that two firms will be there, levered firm and unlevered firm. If there is tax, this will be the position. This means value of the levered firm will be higher than the value of the unlevered firm. You tell me whether you are shareholder in this firm or this firm, your risk is same, your return is same, your size is. Then by investing huge amount in levered firm, why are you holding that, sir, 100%? Sir, if you are holding 100% of the what firm also, unlevered firm also, this firm also earning same EBIT, correct? So let you sell the shares in levered firm and go to the, this is called as arbitrage. This is called as, sir, இவ்வளோ பெரிய இன்வெஸ்ட்மெண்ட் பண்ணி இங்க இவ்வளோ இபிஐடி என்ஜாய் பண்றதை விட இதை விட கம்மியான இன்வெஸ்ட்மெண்ட் எங்க பண்ணாலே அன்லிவர்ட் ஃபார்ம்ல பண்ணாலே எனக்கு என்ன கிடைக்கும்னா same EBIT கிடைக்கும். So due to this process, demand of the product in the cheaper market increase. So every people will start sell the shares of the levered firm and they will start investing in the unlevered firm. Are you really with me? So everyone will start selling the shares of the levered firm and they will start buying the shares of the, then automatically the demand of the unlevered firm increases and demand of the levered firm decreases. That's what they are saying. Due to this process, demand for the product in the cheaper market increases, thereby decreasing its price. After some time, equilibrium price will be achieved. That means the value of the levered firm reduces and value of the unlevered firm increases. It will reach a price called as what? Equilibrium price, and the arbitrage process will then stop. Till that, a process will be happening. So what is arbitrage, sir? Arbitrage process means selling of all securities of what firm? According to MM, if there is tax, which firm is overvalued? Levered firm. So you will sell the shares of the and purchasing securities of the what valued firm? Who is undervalued firm? Unlevered firm. Equals to the percentage of equity holding in the overvalued firm. Hello, sir. So there are two situations you will be having. Number one, sir, where the levered firm is what valued? Overvalued. Sometimes levered firm will be, if levered firm is overvalued, people will start sell the shares of the levered firm and start buy the shares of the unlevered firm. This is called as primary arbitrage. What arbitrage? Sometimes unlevered firm is overvalued. What, man? Unlevered firm is overvalued. If unlevered firm is what valued? Overvalued. My dear lovable students, hello, sir. Then this is the unlevered firm and this is levered firm. People will start sell the shares of the unlevered and people will start buy the shares of the, sir, what if the levered firm is overvalued? What the investor should do? Number one, investor sells his present equity holding of the what firm? In levered firm, investor is having equity. Yeah, ada modalla vitru. Number two, investor borrows proportionate to his share of debt in the what firm? எந்த அளவுக்கு நீ இங்க equity வச்சிருக்கியோ அந்த அளவுக்கு you have to borrow. Number three, investor purchase security of the what firm? Unlevered firm equals to his percentage equity holding in the what firm? Sir, for example, earlier you were holding 10% in the levered firm. The same 10% of the equity you purchase in the unlevered firm. Are you agree with me? But here, sir, investor sell his present equity holding of the what firm? Unlevered firm equity model. And investor purchase security of the levered firm equal to his percentage. Here there is no need to borrow. Hello, sir. So because of shifting from the overvalued firm to the undervalued firm, investor will be having some excess money in his hand. Are you really with me? That is called as gain by investing in the what valued firm. So an investor will gain by investing in the what valued firm. Since the same amount of present income can be earned by investment amount, which is less than the what investment. So by investing a more amount, I was enjoying, sir, 2,40,000 EBIT in this company. But by reducing a less amount in a unlevered firm itself, I can enjoy 2,40,000, right? So that is called as arbitrage gain. That is called as, sir, when this arbitrage process will comes to an end, when both the company reaches the equilibrium value, then arbitrage process will comes to an end. So according to Modigliani and Miller, arbitrage process will comes to an end when the value of both the company become identical. Value of both the company become. So there are two types of arbitrage are there. Number one, primary arbitrage, and if the value of the levered firm is more than the value of the unlevered firm, that is called as what arbitrage. If there is primary arbitrage, people will shift from levered firm to the, sir, if the value of the unlevered firm is more than the value of the unlevered firm, then it is called as, in case of secondary arbitrage, people will move from unlevered firm to the levered firm, right, sir? Sir, for what purpose? Like monkey, they are shifting from levered to unlevered, or sir, unlevered to levered, to obtain one of the objective. To obtain what? இது ரெண்டுல ஏதாவது ஒரு objective அவங்க achieve பண்ணணும். Number one, increased profit with the what investment? Same investment. Sir, if I am investing X amount in levered firm, I am getting 2,40,000 only, no? Yes, sir. But if I am investing the same in another company, I will be getting more. Are you really with me? That means I want to increase my profit with the, or same profit with what investment? Why I have to invest this much amount in it to get 2,40,000? If I invest lesser than this amount itself, I can get 2,40,000. Correct? Yes, sir. Sir, how arbitrage process when levered firm is what valued? First, this is the 5-step approach. How many step approach? Now think, practically think. There are two firms are there. Levered firm, and now in the levered firm's value is higher. You are a equity shareholder in the levered firm. First sell, my dear lovable students. Sell. First you sell the equity of the what firm? Levered firm. Sir, you are not holding 10% of the levered firm. You are holding only the 10% of the equity of the what firm? Levered firm. But you are going to invest the 10% equity of the unlevered firm. Correct? Yes, sir. So, like this, you have to analyze and understand, my dear lovable students. One is levered firm is there, other is unlevered firm is there. Our situation is value of the levered firm is higher than the value of the, then only primary arbitrage will work. In this levered firm, equity is there and also debt is there. Correct? In equity, you are holding 10%, and in debt, you are holding 0%. Correct? Now, you have to sell the equity in the what firm? Levered firm. Sir, once you sell the equity in the what firm, you will be having money. And now you are moving into the unlevered firm. There you will go and invest, sir, the 10% in the equity of the unlevered firm. Correct? But risk changed. Because earlier you were holding only equity of the levered firm. Correct? But now you are holding 10% of the equity of the unlevered firm. So, sir, 10% holding equity of the levered firm is not equal to 10% equity of the what firm? Levered firm is not equal to 10% equity of the what firm? Unlevered firm. Why, sir? Why, sir? Logic. The reason very simple. If I am holding 10% equity of the unlevered firm, I can say that I am holding 10% of the company. But if I am holding 10% equity of the levered firm, I am holding only 5% of the company. Because if I hold the same, how much percent? 10% in debt, purida, then I can say that I am holding 10% in equity and 10% in debt, total 10% I am holding. But now I am holding 0% in debt. Yes, sir. I am holding only 10% in the equity of the levered firm. By selling that, I can't move into the unlevered firm. ஏன்னா இங்க levered firm ஓட equityல மட்டும்தான் 10% வச்சிருந்தேன் நானு. பட் அன்லீவர்ட் ஃபர்மோட ஈக்விட்டியில 10% வச்சா அன்லீவர்ட் ஃபர்மோட 10% வைக்கிறதுக்கு ஈக்குவல். அப்ப என்னோட இன்வெஸ்ட்மெண்ட் என்ன ஆகணும்னா மேட்ச் ஆகணும்னா எங்கிட்ட காசு பத்தாது. தட்ஸ் வை தே ஆர் சேயிங் தட் போரோ. தட்ஸ் வை தே ஆர் சேயிங் that's why you have to borrow. But if you borrow, my dear lovable students, some excess money will be there with you. That excess money is called as arbitrage gain, and that amount has to be invested in the unlevered form, 10% of the equity. Then if you calculate the net income before arbitrage and after arbitrage, it will be exactly one and the same, and that comparison will give you extra money with you. எப்படி சார் இது ஒர்க் அவுட் ஆகுது? that I will be solving by illustration number 1. Can we? There are two companies, man. One is N Limited and M Limited, having same earnings before interest and tax of how much rupees? 20,000. Sorry, two companies are alike in all aspects. Then only this chapter will be applicable. So M Limited and N Limited, man, EBIT of 20,000 and 20,000. Can I proceed? M Limited is a what company? Levered company, having debt of how much lakh? 1 lakh. At how much % rate of interest? The cost of equity of N Limited is 10 and M Limited is 11.5. Compute how arbitrage process will be carried out. Understand very clearly, man. You have to answer to me. You have to shout along with me. What is the EBIT of M Limited? 20,000. EBIT of N Limited. Sir, M Limited is a dash firm, levered firm, whereas N Limited is a, my dear lovable students, M Limited debt how much lakh? 1 lakh. 1 lakh. What is the KE of the M Limited given in the question? 11.5%. And here it is only because this is an unlevered firm. There is no debt at all. Equity shareholders does not have buy-in. Whereas M Limited is having debt in its what structure? Capital structure. Equity shareholders will feel buy-in. So the expectation of the equity shareholders will be higher than the N Limited, right? That's why they are having 11.5%. And the KD, cost of debt, comes to 7%. Now I am going to calculate the value of equity. What of equity? Value of equity means market value of equity is equal to earnings available to the equity shareholders divided by K. Comfortable? Sir, I am going to calculate, man, the value of the equity of the company M Limited. Can I? Yes, sir. What is the EBIT? 20,000. Sir, if the debt is how much lakh? 1 lakh. And KD is 7%. So 1 lakh into 7% come to 7,000. They are supposed to pay to the debt holders. Can I proceed? Appa 20,000 evlo pochuna? 7,000 pochuna. 13,000 rupees will be the earnings available to the equity shareholders. Are you all participating? So 13,000 divided by 11.5% is their expectation. So 1,13,043 is the market value of equity of levered firm. Enna எல்லாரும் participate பண்றீங்களா? Coming to the, sir, value of equity of the unlevered firm. Correct? What is the EBIT? 20,000. Are they liable to pay any interest? No, sir. That means 20,000 rupees is the EBIT. Yes, sir. What is the expectation? 10%. So what is the value of market value of equity? Sir, enna sir, idu 1,13,000 da irukku, idu 2,00,000 da irukku. Sir, there only equity I have considered. Sir, here equity plus dash has to be added. Debt has to be added. So the value of firm is equal to market value of equity plus market value of data. Just now you calculated for a levered firm, value of equity is 1,13,043 plus 1 lakh is the debt. So 1,13,043 plus 1 lakh comes to 2,13,043 is the value of the, I am going to, sir, picturize that in my table. Two firms are there. One is what limited? What limited? M Limited and N Limited. M Limited is having equity and N Limited is having debt. Enna pothukriya? Sir, for equity, what is the value of equity? 1,13,043. Are you all really with me? 1,13,043. What is the value of debt? 1 lakh. So the value of the firm is equal to 2,13,043. But in N Limited, value of debt is 0. And value of equity comes to 2 lakhs. So 2 lakh plus 0 comes to 2 lakhs is the what of the firm? Value of the firm. So as exactly MM said that value of the levered firm is higher than the value of the unlevered form. Correct? So people will start flying from the levered form to the unlevered form, right? Now I will tell you how the arbitrage process will work. If you have 10% shares of M Limited, you have to answer to me. Is M, my dear lovable students, levered, unlevered? So in levered, equity 10% you are holding. Your value of investment in equity shares is 10% of 1,13,043. That means 11,304.3 you are holding. That means in this 1,13,043 you are holding how much percent? Up 1,13,043 into 10% comes to 11,304.30 is your present investment. Correct? And return will be how much percent? 10%. Actually, now this company, levered firm, is having EBIT of 20,000. Yes, sir. Out of that, 7,000 they paid us interest. So 13,000 is the earnings available to the equity shareholder. If you are holding 100%, they will give 13,000 rupees, right? But if you are holding only 10%, so the present return you are enjoying is 1,300. Can I proceed, sir? Now, what is the alternate strategy? You will jump from the levered firm to the, sir, sell your 10% shares of the what firm? Levered firm at how much rupees? 11,304.3. So first step number 1, sell it. So you will get 11,304.30. Getting it? Yes, sir. And borrow 10% of the levered firm's debt. Correct, sir? Tell me, man, sir, is a levered firm is having debt? How much? 1 lakh. 1 lakh into how much percent? So second step should be what? Borrow. How much borrow? 10%. So my dear lovable students, sir, 11,304 plus 10,000 comes to 21,304. 3 rupees will be there in your pocket. And invest the money, that is 10% in the unlevered firm stock. What is the value of the unlevered firm? 2 lakh. So out of this money available, you have to invest. You are going to invest 2 lakh into how much percent? That means from your pocket, how much money will go? That means, sir, 21,304.3 minus 21,000 means 1,304.30 will be there still in your pocket. This is called as arbitrage gain. Comfortable? So the total resource or money we have will be totally 21,304.3 will be there in your pocket. Picturizing? Yes, sir. Sir, solle. And invest 10% of 2 lakhs comes to how much? So out of the money available of 21,304.3, if you invest 20,000, still you are having 1,304.3. Yes, sir. Now I am going to find out the net income, my dear lovable students. Earlier, I was 10% equity shareholder in levered firm. Earlier, I enjoyed 1,300. I already find out, man. Now, I am a 10% equity shareholder in the unlevered firm. What is the EBIT of the unlevered firm? 20,000. There, how much I am, sir, holding? 10%. So, 20,000 into 10% comes to, I will get dividend of 2,000. But I am having personal borrowing. What borrowing? Because I have borrowed. How much I borrowed? 10,000 I borrowed. For that I have to pay KD. What is the KD available in the question? 7%. So tell me, 10,000 into 7% comes to 700. So from 2,000, if how much goes? I will be getting 1,300. Exactly the same. Are you all really with me? That means because of the what process also, arbitrage process also, my income has not been. So your return will be 10% EBIT of the what form? Minus interest to be paid on the borrowed fund. Correct? Up 20,000 or 10%. Will we get 2,000? And we borrowed 10,000. For that, are we liable to pay 7%? So 700. So 2,000 minus 700, 1,300 will be the net income. Even after you moving from levered firm to the unlevered firm, still in your pocket 1,304 excess money will be there. For that 1,304, can you eat ice cream? Now your returns remain the same 1,300, which you can getting from what limited? Before investing in M Limited, but still you have 1,304. excess money available with you. Hence, you are better off by doing the arbitrage. Comfortable? If you see the key moments in this match, in the above example, you have not invested the entire amount received from sale of shares of levered plus amount borrowed. Correct? Because the total money available with you was 21,304. You invested only 20,000. Number two, you maintain same level of earnings and reduced investments. Correct, sir? Alternatively, you could have invested entire amount in the what company also. Sir, instead of keeping this 1,304.3 as idle in your hand, if there is no good projects with you as an investor, you can park even this money also in the unlevered firm and you can enjoy KE there. Then automatically you will be having higher return. Correct? In that case, annual earnings would have been. I'm moving into illustration number 2. And can we finish off the second question from the leverage? We are having two type of leverage are there. One is arbitrage are there, primary arbitrage and the secondary arbitrage. Comfortable? The same question. Following data is available in respect of two company having same business risk. Capital employed how much? 2 lakh. EBIT how much? 30,000. KE how much? 12.5. Look at here, man. This is levered company and this is what? Unlevered. They take 10%, my dear lovable students. How much lakh? 1 lakh. Equity 1 lakh. 1 lakh plus 1 lakh. That's why here it is 2 lakh because capital employed should be same. If two companies are alike in, an investor is holding 15% shares in what company? Calculate the increase in annual earnings of investor. If he switches his holding from lever to the, if you want to know increase in what earning? Annual earnings, 100% of the money should be invested in the unlevered form. Can we do? Yes, sir. Sir, everything actually they have given. Sir, tell me. I'm going to value of the firms. Tell me, this is levered firm and this is unlevered firm. What is the EBIT? 30,000, 30,000. Will both the company have same? Yes, sir. Less interest. Only levered firm is liable to pay interest. Correct? Yes, sir. What is the debt? 1 lakh. 1 lakh or 10% comes to 30,000, 10,000 levered firm மட்டும் தான் less பண்ணணும். யாருக்கு less பண்ணக்கூடாது. So earnings available to equity shareholder is 20,000 and 30,000. Can I proceed, sir? You tell me what is a KE, sir. KE is how much percent? 12.5%. Right, sir? So 12.5 is the KE of the levered firm and also KE of the unlevered firm. Because specifically they have not bifurcated what is a KE. Last question they have given separately. Hello, sir. So calculator man, sir, inga 30,000. I'm first calculating unlevered firm and 30,000 divided by 12.5% comes to 2,40,000 is the value of the, whereas my dear lovable students, value of equity, correct? What is the earnings available to the equity shareholder? 20,000 because after 30,000 you are liable to pay 10,000. About 20,000 divided by 12.5% comes to 1 lakh and sir, to this I have to add n of debt, value of debt. How much value of debt? 1 lakh. But here value of debt will be 0. So the value of firm will be value of equity plus value of debt comes to 2 lakh and, but here 2 lakh 40 plus 0 comes to 2 lakh 40. Correct? In this situation also, the value of the what firm? Levered firm is higher than the value of the unlevered firm. That means here also what arbitrage will work? But last question, 10% was the holding. Here you are holding 15%. So come on, man. So in this 1 lakh 60, you are holding 15. 1 lakh 60,000 into 15% comes to 24,000 is what the amount you are holding. Correct? You sell it, you borrow it, you will be having sufficient money with you. You invest 100% in the unlevered firm. Correct? Then your net income will increase. Same? Increase. Come on, man. Analysis. Now the value of levered company is more than that of the Purida. Therefore, investor will sell his shares in what company? Levered company. And buy shares in the unlevered company. To maintain the level of risk, he will borrow proportionate amount and invest that also in the shares of the what company. Because question 1, how much is the increase in income? That means in order to enjoy more income, my dear lovable students, you should not keep anything in your hand. Can I proceed? So investment and borrowing. Come on. Sir, what is the current equity share capital of the levered firm? 1,60,000. Adod evlo percent? 15%. That means now you are holding 24. What is the debt of the levered firm? 1 lakh. அதோட எவ்வளோ percent borrow பண்ணிடு? 15%. 1 lakh into 15% come to 15,000. So what is the total money available with you? 39,000. Sir, actually, ideally, what is the value of unlevered firm? 2,40,000. On that also you are going to invest, sir, 15%. So 2,40,000 into 15% comes to 36,000. But in place of 36,000, I am going to invest 30. That means 3,000 extra I am going to invest. For this 3,000 extra, I will get additional return. Are you all really with me? Now, my dear lovable students, I totally invested 39,000 where? Unlevered firm. Unlevered firm, I should get KE. What is the KE of unlevered firm? That means I will totally get 4,875. Enapa clarity, Sir, on that, can I enjoy entire 4,875? Or I have to pay my interest on personal borrowing? What is my borrowing? 15,000. What is the KD? 10%. 15,000 into 10%. Out of 4,875, 1,500 I should pay as interest. Purida? So the net income in my pocket will be 3,375. When I was in levered firm, their earnings available to the equity shareholders was total எவ்வளோ ருபீஸ் அவங்களோட இபிஐடி 30. அதுலேருந்து 10,000 போச்சுன்னா இந்த 20,000 15% எனக்கு கொடுத்துருந்தாங்களா? அப்போ சார் எவ்வளோ இன்ட்டு எவ்வளோ? 20,000 into 15% comes to 3,000. Are you able to appreciate? So the incremental income, extra income, what I am enjoying because of shifting from levered firm to unlevered firm is 375 rupees. Right? Sir, the ideal investment what I am supposed to be make is only 36,000. But I have made extra investment of, for this 3,000, can I enjoy KE in unlevered firm? KE is 12 point. So 3,000 into 12.5% comes to 375. By that way itself, this answer can be find out shortcut. Comfortable. Instead of going this much NSR around, sir, நம்ம அங்கே நம்ம answer போடலாம். Last shortcut, have you understood? I'm moving to the last question, man. Illustration number 8. When the value of unlevered firm is more than the value of what firm? This is our secondary arbitrage. What arbitrage? So if the arbitrage is a primary arbitrage, value of the levered firm will be more than the value of the முதல்ல sell பண்ணு, அப்புறம் borrow பண்ணு, அப்புறம் invest பண்ணு, அப்புறம் net income calculate பண்ணு, compare பண்ணு. Are you really with me? Yes, sir. Sir, if the value of the unlevered firm is higher than the value of the levered firm, please don't borrow. What man? Please don't. What you are supposed to do is, sir, first one, sell it. என்ன பண்ணு? Sell பண்ணு. Hello, sir. Sell பண்ணதுக்கு அப்புறம், sir, don't borrow. What man? Don't borrow. Are you really with me? Because already you are having higher investment. Because you are having 10% equity in the unlevered firm. Hello, sir. And you want to invest only 10% in the levered firm. So you are having sufficient money with you. Yes, sir. Then you have to invest. You have to what? In both debt and equity. In both what and what? Debt and equity. In both what and what? In debt equity ratio. In what ratio? Then calculate the net income and compare. And calculate the net income and, hey, are you all really with me what I am talking to you? My dear lovable students, I am moving into the next question and make you understand the secondary arbitrage. There are two companies, U Limited and L Limited. Hello, sir. Yes, sir. Sir, having same EBIT of 20,000 each. That L Limited is a what firm? Having debt of how much lakh? At 7%. And cost of equity of U Limited are 10% and 18%. Compute how arbitrage process will work. Hello, sir. Yes, sir. First one, unlevered firm. Who's unlevered? U and L. They are unlevered. U Limited unlevered. Abdina, who's levered? L. Are you all really with me? Okay, man. Come on. What is the EBIT for both the company? 20,000, 20,000. Sir, always it will be Same. Sir, who is having debt? L. L is levered. How much lakh? 1 lakh. KD, 7%. But KE they have given different. Correct? Here it is 10 and here it is 18. Yes, Nyayam. Because in a levered form, what is there? Debt is there. They will be expecting more return. That's why it is how much percent? 18%. Come on, man. Value of what share? Equity share. Which is nothing but, man, sir, earnings available to the equity shareholders divided by KE. Here EBIT will be the earnings available to equity shareholders. 20,000 divided by 10% comes to here out of 20,000, debt 1 lakh into 7%, 7,000 they have to give it as interest. Up 20,000, 7,000 pochana will be the earnings available to the calculator, sir. 13,000 divided by 18% comes to 72,222 is the value of equity. Hello, sir. Can I calculate the value of firm? For an unlevered firm, sir, value of firm is equal to value of equity. Can I proceed? For a levered firm, value of equity plus value of debt, which is 1 lakh plus 72,222 comes to 1 lakh 72,222. Look at the situation. Here the value of the unlevered firm is higher than the value of the, that means people will start fly from the unlevered firm to the levered firm. Sir, this is how arbitrage process will happen. If you have 10% shares of what firm? Unlevered firm. That means 2 lakh oda evlo percent? 10%. உன் கையில உனக்கு எவ்வளவு கிடைக்கும்? That is an investment of 20,000 is with you. Comfortable. And you are getting 10% return. On this 20,000 EBIT, you can enjoy 10% up. Up 20,000 into 10% comes to 2,000. Investment will be 10% of the earnings available to equity 1,000. How much? 2,000. That means in the present company, in the unlevered firm, you are having 20,000 equity. You are enjoying 2,000 rupees. Now you can, sir, jump from the unlevered firm to the levered firm. Sell your share. First you have to unlevered firm. How much you will get? 20,000. And buy 10% shares of levered firm. Equity plus what? Debt. Because in unlevered firm, only what was there? Equity was there. Now you are shifting from unlevered to in levered. What and what is there? Equity and debt is there. So in the debt equity ratio, you have to go and invest. Can I? Come on, man. Sir, what is the total market value of equity? 72,222. Adoda 10% invest panniko, which come to 7,222. Comfortable? What is the market value of the debt? 1 lakh. Adoda 10% invest panniko. Total 10,000. So the total investment in the levered firm is required is only 17,222. 17,222. Are you really with me? But you are having how much rupees in your hand? 20,000. Wow. Are you really with me? But in order to shift from dash firm to dash firm, unlevered firm to levered firm, I need only 17,222. So I will be having surplus money available. So 20,000 minus 17,222 comes to 2,778. Extra money will be with you. Now I am checking what will be my return before arbitrage process and after arbitrage process. Correct? What, man? Ippo, you are in levered firm. 10,000 rupees, 1 lakh rupees is the market value of debt. On that you are holding 10%. Abdina, 10,000 you are holding. For that you will get KD of 7%. 700 rupees will come to you. Ennapa? And you are holding 10% of equity. What is the market value of equity? 7,222. Adoda 10% comes to 7,222. Correct? Adoda KE you will get. What is the KE of the levered firm? 18%. Up 7,222 into 18% comes to 1,300. Look at here, 1,300. That means total return will be how much? 2,000. This will be the return from the levered firm now. Correct? When you are in a firm, unlevered firm, you were holding 10%. Correct? What was the EBIT of that company? 20,000. Idoda 10%. Now also you are getting 2,000. That means your income has not been changed. But still in your pocket 2,778 is there. This is called as what gain. So in both the case, the return received is how much? 2,000. And still you have excess cash of 2,778. Hence you are better off by doing what? Arbitrage. That means you will start selling the what company share? and buy dash company share, thereby pushing down the value of shares of unlevered firm and increasing the value of levered firm till what is reached. So in the above example, sir, have you invested 100%? No, sir, because you are having still money. Yes, sir. Sir, we have not invested entire amount received from sale of shares of what company? Sir, we have the same level of earnings along with the reduced investment. Am I right? Yes, sir. Alternatively, we could have invested entire amount in the what company? If we have invested entire amount in the levered company, we would have got extra interest and we would have got extra dividend and our earnings would have been increased. Comfortable? That means if you want, you can invest this extra 2,778 also. எங்க levered company debt இல்லையா equity இல்லையா both mix என்ன mixல debt equity mixல அப்ப ஆட்டோமேட்டிக்கா முன்னாடி இருந்த இன்கம் விட இப்ப இருக்கிற இன்கம் என்ன ஆகும் அதிகமாகும் அப்படின்னா உனக்கு ஆர்பிட்ரேஜ் கெயின் இருக்காது அந்த ஆர்பிட்ரேஜ் கெயினை நீ வந்து ஃபுல்லா கொண்டு போய் என்ன பண்ண போறேன்னா இன்வெஸ்ட் பண்ண போற ஹலோ with this primary arbitrage and secondary arbitrage comes to one. Sir, in order to work primary arbitrage, value of the levered firm should be higher than the value of the unlevered. Then people will start sell the shares of the levered firm and they will borrow if required. Then they'll be having lot of money will be with them. The entire money they will not be investing in the levered firm, but even after the arbitrage process, they will be having same income and extra money will be with them. That extra money is called as arbitrage gain. Alaga purida? Appreciate pandriya? But at any chance, if the value of the unlevered firm is higher than the value of the levered firm, such a situation is called as secondary arbitrage. People will start selling the shares of the unlevered firm and they will start investing the shares of the levered firm. Automatically, it will, sir, the shareholder will be having the same income with extra money in his hand. That extra money is called as arbitrage gain. With this, we can say that we are through with the revision of cost of capital. We are with the revision of capital structure theories. And the third one, arbitrage process. Are you all really with me? We are moving into the coming slot of discussion is EBIT and EPS analysis, my dear lovable students. That is also a part of this chapter where, sir, you have to find out the indifference point. Such a question may come in examination. We will discuss the concept of EBIT, EPS analysis and will be doing past 3 examination question from EPS, EBIT analysis. Comfortable? Have a revision up to this, redo the questions and come back. We will continue with the discussion of EBIT and EPS analysis. Sir, very happy evening to all. So we are doing capital structure decisions. In that, we have already completed the cost of capital. Cost of capital in the sense means how to find out the KD, how to find out the KE, how to find out the KP, how to find out the KR and how to find out the KO. Sir, the purpose of finding out the overall cost of capital is to use for the capital budgeting decisions. Right, sir? So, my dear lovable students, then we have talked about the capital structure theories. If two firms are alike in all aspects, except capital structure, will the value of firm change or not is the discussion. Yes, the value of the firm change is what theory of relevance. No, the value of the firm will not change is what theory of irrelevance. Then, after that, we have talked about the arbitrage process. That is a process introduced by Modigliani and Ian Miller. Two type of arbitrage, primary arbitrage and secondary arbitrage. That is, two firms will be there, levered firm and unlevered firm. Sir, because of tax, if the value of the levered firm is higher, people will start selling the securities of the levered firm and they will shift to the unlevered firm. This is called as primary arbitrage. Sir, if the, because of, sir, any reason, if the value of the unlevered firm is higher than the value of the levered firm, then the secondary arbitrage will work. Now, we are pending with one topic called as, sir, EBIT EPS analysis. EBIT EPS analysis. This is an expected area for examination. I will tell you, man, actually in the whole chapter, we have not discussed in a capital structure how much should be the percentage of equity, how much should be the percentage of debt, how much should be the percentage of preference share capital, and how much should be the percentage of reserves and surplus. Actually, in the world, there is no concrete formula that 70% equity, 30% debt, 10% preference. Such a percentage, no one can propagate. No one can bring that such a percentage. So, my dear lovable students, we have to choose a percentage which will suit us well. For example, if I am wearing white color shirt, it's not suiting for me. If I wear blue color, if it's good for me, I have to wear the blue color. The same way, under what option company's EPS is higher, that option is the perfect capital mix. That should be adopted by the company. That is called as capital structure decisions. So we are going to take the decision. In my capital structure, how much percent should be equity, how much percent should be debt, how much should be preference. Sir, taking such a decision is called as capital structure decisions. First question we are going to do from that area. This is a May 2022 past examination question. Look at the length of the question. So if you are preparing for your examination, we can't have an assumption that like this question and all will not come. This is a very past examination question. So that respect we have to give to this area. The particulars relating to Raj Limited for the year ended 31st March are given as follows. Output units at normal capacity 1 lakh unit. That means this company or the firm is having the capacity to produce 1 lakh unit. Selling price per unit 40. 1 unit can be sold for 40 rupees. Variable cost is 20. So 40 minus 20 will be 20 will be the contribution per unit. Fixed cost already given as 10 lakh. Capital structure of the company as at 31st March. That means already existing company man. Equity share capital total 10 lakh with equity shares of 10 each at the rate of 1 lakh at the rate of 10 each. They are having reserves and surplus of 5 lakh. They are having current liabilities of 5 lakh. Total comes to 20 lakhs. So 20 lakh is the existing capital employed. Raj Limited has decided to undertake an expansion project to use the market potential that will involve another 20 lakh. That means company is going to do a project. To do new project, company need fund. So how much is the capital required? 20 lakh. Company expects an increase in output by 50%. Currently, number of units is 1 lakh. But if the company doing this project, instead of 1 lakh, they can sell 1 lakh 50,000 units. Fixed cost will be increased by rupees 5 lakh. Already existing fixed cost of 10 lakh. If I do the new project, it will increase for another 5 lakh. And variable cost per unit will decrease by 15% because of economies of scale. That means if I am producing less number of unit, automatically per unit cost will be higher. If I am going to manufacture more number of unit, to my supplier, I can bargain for discount. This much units I am purchasing. No, please provide me what? Discount. So automatically raw material cost per unit will reduce. The additional output can be sold at the existing selling price without any adverse impact on the market. Still demand is there in the market. If we increase the number of units also, there are so many customers are ready to buy the product. Following alternative scheme for financing the proposal expansion program are planned. Alternative number 1, alternative number 2, alternative number 3. How much lakhs we need? 20 lakhs. Debt 5 lakh, that means balance equity 15 lakhs. Debt 10 lakh, that means balance equity 10 lakhs. 14 lakh debt, balance equity. Current market price per share is 200 rupees. In market, now the shares is going at 200. Slab-wise interest rate, sir, for fund borrowed is as follows. If you are borrowing debt up to an amount of 5 lakh, interest rate applicable will be 10%. Over 5 lakh, up to 10 lakh, KD will be 15%. Over 10 lakh, KD will be 20%. Find out which of the above mentioned alternative would you recommend for Raj with reference to EPS, assuming a corporate tax rate is 40%. So, company is an existing company. Company will be having already EBAT. Company is going to do a new project with an additional capital of 20 lakh. When they put 20 lakh, they will get additional EBAT. Once they get additional EBAT, sir, in which option out of the three proposal, under which proposal my EPS will be higher is what the decision I have to take. So I am having how many alternative? Three alternative. Alternative number 1, alternative number 2, alternative number 3. What is alternative number 1? Raising debt of 5 lakh and equity of, because 5 plus 15 total 20 lakhs. Alternate number 2, raising debt of 10 lakh and equity of, which comes to 10 plus 10 comes to 20 lakhs. Alternate number 3, raising debt of 14 lakh, balance equity of, so 14 plus 6 comes to 20 lakhs. Are you all really with me? So what I am going to calculate the earnings per share. Earnings per share. Because I have to choose an option where my EPS is higher. My EPS is higher. So can I calculate the expected EBIT? Yes, sir. Sir, I am going to calculate the expected EBIT. By seeing the question, you say, how much number of units currently we are selling? 1 lakh. 1 lakh units. If I pump additional 20 lakh into my business, I can increase the production. And my output will increase by 50%. So my new number of units will be 1,50,000. 1,50,000 units. And they said that even though the number of units increases, sale price will not get affected. So what is the selling price per unit? 40. 40. Sir, what is the old variable cost? 20. Because of increase in the production, we can enjoy the economies of scale. Sir, because of economies of scale, variable cost per unit reduces by 15%. That means new variable cost will be 85% of the existing. Correct? So 20 into 85% comes to 17 rupees. Comfortable? So the new contribution will be how much lakh? 23 lakhs. 23 rupees. 23 rupees per unit. Per unit. How many unit you are going to sell? 1,50,000. So 1,50,000 into 23 comes to 34,50,000 is the total contribution. Total contribution. Right, sir? You know marginal costing, sales minus variable cost, contribution, minus fixed cost, profit. Now I reach the contribution. I have to reduce the fixed cost. Already I am incurring fixed cost of 10 lakh. When I do the new project, I have to incur additional fixed cost of 5 lakh. Total fixed cost I have to incur will be 15 lakh. So from 34,50,000 minus 15 lakh, 19,50,000 will be my new EBIT. Let me ask you a question. Whether you are doing the project by all equity or fully debt or equity and debt, will the EBIT change? No. The EBIT is not a financing decision. It is an operating decision. Right, sir? So, my dear lovable students, 19,50,000, 19,50,000, 19,50,000 is the EBIT, earnings before interest and tax. Sir, am I going to employ same debt in all option or different debt in different option? Different debt in different option. So, if the debt changes, automatically interest changes. And the debt, here it is performing as per traditional approach. Because traditional approach said that if you inject more and more debt into the capital structure, even the KD increases. So the KD, as per the question, is a traditional approach question. Right? In option number 1, I am going to borrow to the extent of only 5 lakh. And they said that if I borrow only 5 lakh, so the interest rate will be 10%. So 5 lakh into 10%, 50,000 will be the interest for option or alternate number 1. Can I proceed? But they specifically said that if I am borrowing over and above how much lakh? 5 lakh up to 10 lakh, my interest will raise to 15%. It's slab system. It is what? Slab wise. Sir, if you are traveling through optional tax regime up to 2.5 lakhs nil. Sir, 2.5 lakhs to 5 lakh at 5%, 5 lakh to 10 lakh at 20%, more than 10 lakh at 30%. Right, sir? Let me ask you a basic question. My income is 5 lakh. My income is If my income is 5 lakh or above 5 lakh, will the entire 5 lakh will be taxed at 20%, or I can still enjoy the basic exemption limit? The same what the slab wise meaning is all about. If it is more than 5 lakh up to 10 lakh, you have to calculate slab wise. That means for alternative number 2, for the first 5 lakh into 10%, 50,000. For the next 5 lakh into 15%, come to 75,000. Students will do a mistake here. They may apply entire 15% on the 10 lakh because they said that slab wise. So 50,000 plus 75,000 comes to lakh and 25,000 is the total interest under option number 2. Coming to alternate number 3, my dear lovable students. Sir, I am going to employ 14 lakhs debt, correct? If you employ 14 lakhs debt over and above 10 lakh, how much percent? 3 slabs will come. First slab up to how much lakh? 5 lakh at the rate of 10% comes to 50,000. Next 5 lakh at the rate of 15% comes to 75,000. Comfortable? And 4 lakhs into 20% comes to 80,000. Are you all really with me? So 50 plus 75,000 plus 80,000 comes to 2,05,000 will be the interest in third option, alternate number 3. Sir, have I finalized EBIT? Same EBIT under all the option or different EBIT? Now I have to reduce the interest. Same interest, different interest. Why different interest? Different debt. So different interest. Right, sir? In option number 1, 50,000, comfortable. Option number 2, 1,25,000. And option number 3, 2,05,000. So you'll be getting earnings before tax. From 19 lakh 50, if you reduce 50,000, you will get 19 lakh. From 19 lakh 50, if you reduce 1,25,000, 18 lakh 25,000. From 19 lakh 50, if you reduce 2 lakh 5,000, you will get 17 lakh 45,000. Pay the tax at the rate of, sir, I am not calculating 40, I am straight away calculating 60. Can I? So my dear lovable students, 19 lakhs into 60% comes to 11 lakh 40,000. Sir, 18 lakh 25,000 into 60% comes to 10 lakh 95,000. 17 lakh 45,000 into 60% comes to 10 lakh 47,000. Are you all really with me? Now, if one part of the capital required if I raise by debt, the other part has to be raised by equity. Already I am having number of equity. Yes, sir. Already I am having number of equity shares are there. And now I am going to raise fund by issuing additional equity. Right, sir? So what is the number of equity share to be issued? My dear lovable students, what is the total capital employed? 20 lakhs. Out of that, in alternate number 1, debt, 5 lakhs. Up at 20 lakhs minus 5 lakh, 15 lakhs. So 15 lakhs has to be raised by way of equity. And for every equity share, 200 rupees is the market price. So 15 lakhs divided by 200. 7,500 additional shares I have to issue. Comfortable? Are you really with me? Already you are having existing number of shares. Can you say how much is the existing number of share? 1 lakh. Whether it is alternate number 1, alternate number 2, alternate number 3, the existing number of share will not change. Clarity? In alternate number 1, I have to raise additional equity share of 7,500. So the total number of equity share will be 1,07,500. Why are you calculating? Then only I can calculate EPS. Because EPS means residual earnings divided by number of equity share. But if I am traveling through alternate number 2, sir, there the debt increases. Out of 20 lakh, 10 lakh, I am raising by way of debt. That means balance 10 lakh, I have to raise by way of equity. And for every equity share, the current market price is 200. So 10 lakh divided by 200 means 5,000 number of equity share I am supposed to issue. Comfortable? Already I am having 1 lakh share, additional share 5,000, and the total number of equity share will be 1,05,000. In alternate number 3, even I am injecting more debt. That means out of 20 lakh, if I inject 14 lakh debt, balance 7 lakh, 6 lakhs will be the equity to be raised. Are you all really with me? And every share in the market is 200. So 6 lakhs divided by 200 comes to 3000 shares is what I'm supposed to issue. That means if debt increases, equity reduces. If equity reduces, automatically number of equity shares also reduces. So existing 1 lakh plus 3000 comes to lakh and 3000. Sir, I already have PAT. Now number of equity shares. First case 1 lakh 7500. Second case 1 lakh 5000. Third case 1 lakh 3000. So in first case, sir, 10.6 is the EPS. In second case, 10.43 is the EPS. And in third case, 10.17 is the EPS. You tell me which is the option having highest EPS. That's what you have to write as conclusion, man. Alternate number 1. Raising debt of 5 lakh and equity of 15 lakh is recommended, which maximizes the EPS. If your goal is to increase the EPS, please follow alternate number 1. That will give you the best EPS. Automatically, the wealth of the equity shareholders will be increasing. So in examination, such type of question will be asked, my dear lovable students, where you have to take a decision where under which option your EPS is the highest. Such decision taking chapter is called as capital structure decisions. Capital structure decision. By this question, you know what decision I have taken? I have taken a decision where in my capital structure, 5 lakh should be the debt and 15 lakh should be the equity. I am talking about the new one. Out of 20 lakh, 5 lakh should be the debt and 15 lakh should be the equity. That means till now we were worrying that there is no law in the FM saying that this much should be the percentage of equity, this much should be the percentage of debt, this much should be the preference, and this much should be the preference reserves and surplus. Taking such a decision is called as capital structure decisions. Comfortable. From this question number 1, we have completed, my dear lovable students. I am moving into the second question, which is illustration number N from this area. Can we? Sir, the management of RT Limited wants to raise its fund from market to meet out the financial demand of its long-term project. So this company need fund. Company has various combination of proposal to raise its fund. Yes. Proposal P, proposal Q, proposal R. Proposal P 100% from equity shares. That means it's an all equity option. All equity option. All equity option. Because I don't know whether they are having currently debt or not. The option is called as all equity option. Whereas with regard to Q, if you are traveling through option Q, 50% equity, 50% debt. It's 1:1 debt equity ratio. Are you really with me? If you are traveling through R, 50% equity share and 50% preference shares. These are the other information. Cost of debt, KD, and preference shares is how much percentage? 12% each. KD is equal to 12% and even KP is equal to 12%. Generally, like this will not come. Because KD will be having tax benefit, whereas KP will not have tax benefit. KD should be cheaper than KP. Correct? Question if they said that both are 12, I can't change it and all. Tax rate is 40%. Equity shares of the face value of 10 each will be issued at a premium of how much per share? That means issue price will be 10 plus 10 comes to 20. Total investment to be raised is 80 lakh. How much lakh? 80 crore. 8 crores. 8 kodi. 8 kodi. So 8 crores I have to raise. Expected earnings before interest and tax, which is EBIT, is equal to 3 crores 60 lakhs. Right, sir? From the above proposal, management want to take advice from you for appropriate plan after computing the following, which is EPS. As an advisor, you have to choose a plan which is having the highest EPS and financial break-even point. What break-even point? What is the financial break-even point of the company in costing? Sir, you are calculating the operational break-even point. It can be calculated in number of units, fixed cost divided by CPU, or in value, fixed cost divided by PVR. Are you all with me? Yes, sir. Compute the EBIT range among the plan for the indifference. This is the third requirement of the question. So there are three requirements are there, and this is an RTP November 19 question, very good question, where you are hearing about the financial what even point and indifference. This is the maximum variety from this chapter you can get is capital, sir, in a sir, structure decisions. Can we? My first question to you, sir, whether you are adopting the plan PQR based on that, will the EBIT change? Will not change. Because EBIT is not a financing decision, it's an operating decision. Can I proceed? So 3 crore 60 lakh, 3 crore 60 lakh, 3 crore 60 lakhs. Are you really with me? What is plan number 1? It's all equity plan. It is what? All equity plan. What is the total capital required? 8 crores. Sir, so equity is equal to 8 crore. In plan number 2, equity 4 crores and debt 4 crores. Are you really with me? And with regard to R, my dear lovable students, sir, equity 4 crores and preference shares 4 crores. Always right at the Monday. Then it will be very easy for you to calculate the interest and workings and all. You will never go wrong. After writing this, you start even the EBIT also. You tell me less interest charge. In situation number 1, sir, in alternate number 1, will interest come? No, because it's a all equity option. In second, sir, second one, will interest come? Yes. My dear lovable students, what is the debt? 4 crores, 2, 4, 6, into what is the 12% comes to 48 lakhs is the interest. In the third option, there is no debt at all. Then how interest will come? So the earnings before tax will be 3 crore and 60 lakh. 3 crore 60 lakh minus 48 lakh comes to 3 crore 12 lakh and 3 crore and 60 lakhs. Comfortable? Less tax at the rate of 40%. Sir, 3 crore 60 lakhs into 40% comes to 1 crore 44 lakhs. Getting it? 3 crore 12 lakhs into 40% comes to 1 crore 24 lakh 80,000. 3 crore 60 lakhs into 40% comes to 1 crore 44. What is a PAT? Profit after tax at the rate of 60%. Balance only. 3 crore 60 minus 1 crore 44, 2 crore 16, 1 crore 87, 20,000, 2 crore 16 lakh. Less what dividend? In option number 1, there is no preference share capital at all. In option number 2, there is no preference share capital at all. But in option number 3, for this 4 crore, you are liable to pay the same 48 lakhs will be the preference dividend. Right? Mathematically should be same. So you will be getting earnings available to the equity shareholders. 2 crore, 16 lakhs. 1 crore, 87 lakh 20,000. 1 crore, 68 lakhs. Comfortable? Now, I have to calculate the number of equity shares. Can I calculate the number of equity share? Already number of equity shares there are, not there are. Have they said anything about the existing? No, sir. No, sir. So the entire 8 crores you are going to raise by way of equity means 8 crores divided by 20. Calculator. 8 crores divided by 20 means 40 lakhs is the number of equity share. In the second case, 4 crore divided by 20 comes to 20 lakhs is the number of equity shares. Getting it? In third case, for again same 20 lakh because the remaining was preference shares. Can I proceed? So the EPS earnings per share 2 crore 16 lakhs divided by 40 lakhs comes to 5.4 per share if you are going with all equity. Always all equity will not give the best option because financial leverage will not work. Trading on equity will not work. So better to go with debt. So 1 crore 87 lakh 20,000 divided by 20 lakhs comes to 9.36. Are you really with me? Sir, 1 crore 68 lakhs divided by 20 lakhs comes to 8.4. So the best option is option 2. Option Q. I am taking this opportunity to explain one small concept. Sir, I introduced 4 crore debt. I introduced 4 crore preference. Correct. Both are having same KD, same KP. Still, under the debt option, we are having the highest EPS? Because for debt, we are having tax benefit. But for preference shares, we don't have. That tax savings will be, sir, go to the equity shareholders. Go to the, if you see, my dear lovable students, since I have adopted debt in my what structure? Capital structure, I have paid interest to the extent of 48 lakhs. 48 lakhs. Since I have debited 48 lakhs to my what account? P&L account. Sir, this 48 lakhs would have saved tax at the rate of 40%. At the rate of. So 48 lakhs into 40% comes to 19 lakh 20,000 would have been the tax saved, which is nothing. 1 crore 87 lakh 20,000 and 2 crore 16 lakh. Look at the difference. 2 crore 16 lakh minus 1 crore 87 lakh 20,000 comes to, sorry, tax. I wrongly took. 1 crore 44 lakh minus 1 crore 24 lakh 80,000. 1 crore 44 lakh minus 1 crore 24 lakh 80,000 comes to 19 lakh 20,000. 19 lakh. So this extra money will be there with financial plan Q. But this extra money won't be there with financial plan R. Right? This 19 lakh 20,000 will be enjoyed by the 20 lakh equity shareholders. Correct? So divided by 20 lakhs means 0.96 extra EPS the equity shareholders can enjoy. What is 8.4 plus 96 comes to? This is what 9.36. Look at here the exact EPS we have derived. Are you already with me? This is what happening inside in the financial structure. That's it. First part of the question done. The second part, financial break-even point. First understand what is the concept financial break-even point. It is a level of EBIT where your EPS should be 0. Your EPS should be 0. That means I am having some level of EBIT. With that I will pay interest. With that I will pay preference dividend. I won't have anything to the equity shareholders. Equity shareholders is saying that you paid interest, you paid preference dividend, and you paid tax on preference dividend. Are you totally with me? So in proposal number 1, there is no what at all? Debt at all. If there is no debt, if there is no preference, there is no question of financial break-even point at all. That's why it is 0. Comfortable. In second situation, second scenario, how much is the interest you are going to pay? 48 lakhs. That means if my EBIT is 48 lakh, I will pay that 48 lakhs as interest. Then my EBT will be 0. If there is no EBT, there is no tax. Then PAT will be 0. If 0 is the PAT, automatically EPS will be 0. Comfortable? So in the situation number 2, 48 lakhs will be the financial break-even point. That means if I am having an EBIT of 48 lakhs, my EPS will be 0. In situation number 3, I don't have interest. I have to pay preference. But in order to pay preference dividend, I have to pay tax on preference dividend. That is called as tax on preference dividend. Clarity? That means how much preference dividend I am going to pay? 48 lakhs. This will be, my dear lovable students, sir, 60%. Am I right? 60%. So calculator. 48 lakhs divided by 60% comes to, if I earn 80 lakhs of EBIT. Look at here. EBIT is how much lakh? 80 lakh. What is the interest I am supposed to pay? 0. Because in that option there is no debt at all. So the earnings before tax will be 80 lakhs. Right, sir? Less tax at the rate of 40%. So 80 lakh into 40% comes to 32 lakhs. Are you really with me? So 80 lakhs minus 32 lakhs comes to 48 lakhs is the profit after tax. That I will pay as preference dividend 48 lakhs. Then automatically my residual earnings will become 0. If residual earnings is 0, EPS will be 0. Such a level of EBIT is called as financial break-even point. So 80 lakhs. Second part of the question also done. So through this question, we have explained one concept called as financial. Then I'm moving into the computation of indifference point between the proposal. How many proposal? 3 proposal. Understand the concept of indifference point. Sir, I'm having 3 alternatives, sir. Alternatives classified into 3 category. Alternate number 1, alternate number 2, and alternate number 3. My dear lovable students, if I am traveling through alternate number 1, sir, I should have an EPS. I should have a EPS. The same EPS I should get in alternate number 2. The same EPS I should get in alternate number 3. So, there is a level of EBIT. There is a level of EBIT where EPS under these 2 options will be one and the same. EPS under these 2 options will be one and the same. EPS under these 2 options will be one and the same. That means at that level of EBIT, if you are choosing option number 1 or option number 2, you will be having same EPS. You will be having same EPS. That is called as indifference point. Now, I am calculating indifference point. What point? Indifference point for alternate number 1, alternate number 2, and alternate number 3. Right, sir? But you can compare only 2 alternatives at one time. You cannot compare all the 3 alternatives at the same time. Sir, if they ask indifference point in question, nothing, just write the EBIT minus interest. Minus what? Interest. You will get earnings before tax. Less tax at the rate of 40%. You will get what? PAT. Profit after tax. Profit after tax. Pay the preference dividend. You will get the residual earnings. Residual earnings. Divided by number of equity shares. Number of equity shares. You will get the EPS. Earnings per share. Earnings per share. Comfortable? My dear lovable students, sir, you know the EBIT, you don't know the EBIT. Because indifference point is a level of EBIT where the EPS is same. If the EPS is 0, that is financial break-even point. If the EPS is same, that is indifference point. That is the only difference between 2 concepts. Comfortable? Sir, in case number 1, it's a all equity option. There is no interest. But in case number 2, you are paying an interest of 48 lakhs. Yes, sir. In case number 3, there is no what at all. That means earnings before tax will be EBIT. Here EBIT minus 48 lakh. Here again EBIT. Right, sir? Sir, 0.4 EBIT I have to pay as tax. Sir, here 0.4 EBIT minus 48 lakhs into 0.4 comes to 19 lakh 20,000 I should pay as tax. Here 0.4 EBIT I should pay as tax. Right? From 1 EBIT, if I pay 0.4 EBIT, 0.6 EBIT will be with me. Here from 1 EBIT, if I pay 0.4 EBIT, 0.6 EBIT will be with me. Minus 48 lakh minus 19 lakh 20,000 comes to 28 lakh 80,000. Comfortable? Here from 1 EBIT, if I pay 0.4 EBIT, then 0.6 EBIT will be with me. There is no preference dividend for first 2 case. But you are going to pay a preference dividend of 48 lakhs for the last case. Correct? So here 0.6 EBIT will be the residual earnings. Here 0.6 EBIT minus 28 lakh 80,000 will be the residual earnings. Here man, 0.6 EBIT minus 48 lakh will be the residual earnings. Comfortable? Under option number 1, how much is the number of equity share? 40 lakhs. We already calculated. Correct? Under option number 2, how much is the number of equity share? And in option number 3, how much is the number of equity share? So my EPS, earnings per share is equal to 0.6 EPS divided by 40 lakhs. Basically residual earnings divided by number of equity shares. and residual earnings divided by number of equity shares. Now I am going to calculate the indifference point for financial plan 1 and financial plan 2. Are you all really with me? That means 0.6 EBIT divided by 40 lakhs should be equal to 0.6 EBIT minus 28 lakh 80,000 divided by 20 lakhs. Are you all really with me? Straight away this 40 lakhs and 20 lakhs. Straight away cut. This is 2 and this is 1. Pakka? So rewritten as 0.6 EBIT divided by 2 is equal to 0.6 EBIT minus 28 lakh 80,000 divided by 1. Comfortable? That means, sir, 0.6 EBIT is equal to 1.2 EBIT minus 28 lakh 80,000 into 2. Come to 57 lakh 60,000. Can I proceed? That means 1.2 EBIT minus 0.6 EBIT is equal to 57 lakh 60,000. Comfortable? That means 0.6 EBIT is equal to 57 lakh 60,000. So EBIT is equal to 57 lakh 60,000 divided by 0.6 comes to 96 lakh. That means if you are having an EBIT of 96 lakhs, whether you do the project with full equity or debt and equity, you will have the same EPS. Right? Immediately apply into the table. Don't write and all. If the EBIT is 96 lakh, residual earnings is 60% of 96 lakhs. So 96 lakh into 60%. 57 lakh 60,000. Following up. Divided by number of equity share 40 lakh. So 1.44 is the EPS. In situation number 2. Take 60% of EBIT, which is 57 lakh 60,000 minus 28 lakh 80,000. Balance will be 28 lakh 80,000 divided by 20 lakhs comes to 1.44. Sir, magic, sir. Are you really with me? It's not magic, it is logic. Are you really with me? My dear lovable students, at the EBIT of 96 lakhs, whether you are doing the project with all equity or whether you are doing the project with equity and debt, you will be having EPS, same EPS of 1.44. Same EPS of. Now, for what purpose this topic I am studying? Chumma putting table, chumma finding answer. Is there any application? Yes. I will tell you what is the application. My dear lovable students, if the project, the new project, what you are going to do is actually having an EBIT of 96 lakh, I am indifferent. I am indifferent. Whether I go with the first option or second option, I will be having the same EPS. If my actual EBIT is less than 96 lakh, the finance manager is saying that if we do this project, we will be having an EBIT of less than 96 lakhs. I will only go with option number 1. I will not take the risk. I will always go with all equity option. Always go with all equity option. Sir, if the actual EBIT is more than 96 lakh, I will never choose all equity option. I will choose the equity and debt option because I am having more EBIT. That means I can bear the interest. I can bear the interest. Then my trading on equity will work. So this is very important for examination, for your perspective. If they ask one more step forward, you will be in big trouble. Finding out the indifference point, okay, fine. Edu calculate pandra? Some table I put E. So my dear lovable students, you have to compare with the actual what? EBIT. Actual EBIT. Your actual EBIT may be equal to the indifference EBIT. Pakka? Then your decision is indifference. That is. Whether I choose the equity option or whether I choose the debt option, I will get the same EPS. But if the actual EBIT is more than the indifference EBIT, then I will go with the debt option. Are you all really with me? If the actual EBIT is less than the indifference EBIT, then I will go with the all equity option. All equity option. This is the decision you are supposed to take. That's it. So we have calculated the indifference point between P and Q. We got the answer as 96 lakhs. The same thing only I have done, but I used to do using table approach. They used to do using formula approach. Better if you are feeling table, go with table. If you are a sir CV Raman, go with the sir mathematics. I don't have any problem. Are you all really with me? Yes, sir. Now the doubt is, who is CV Raman? Go and Google it. Come on. Coming to the next one, man. Sir, I have to still perform 2 more projects between dash and dash. A2 and A3. That's what smartly I have done for all the project one table. Otherwise, every time you have to repeat. 3 hours will be swaha. So tell me, sir, 0.6E minus 28 lakh 80,000 divided by 20 lakh equity share should be equal to 0.6E minus 48 lakhs divided by 20 lakhs. Here, my dear lovable students, 0 cancel 1 right, sir? That means 0.6E minus 28 lakh 20,000 should be equal to 0.6E minus 48 lakh. 48 lakh. Are you really with me? If I solve this, sir, I can bring 0.6E minus 0.6E is equal to minus 48 lakh plus 28 lakh 80,000. Mathematically right. So this will be equal to 0, and this you will be getting some figure 19 lakh 20,000. So 0 is equal to 19 lakh 20,000. That means between these two options there is no concept of what at all, indifference point at all. There is no level of EBIT where for plan 2 and plan 3 your EPS will be same. அது எங்கேயுமே என்ன ஆகாதுன்னா மேட்ச் ஆகாது. Okay, அப்ப A2 and A3 there is no indifference point. That's what the next one, man. Between proposal P and proposal Q, proposal Q and proposal R, sir, EBIT will be cancelled and become 0. So combination of proposal Q and R is not possible. But I have to calculate the 1 and 3 now. 1 2 பார்த்தாச்சு, 2 3 பார்த்தாச்சு, 1 3 பார்க்கணும், which is 0.6E divided by 40 lakhs should be equal to 0.6E minus 48 lakh. 0.6E minus 48 lakhs divided by 20 lakhs. Can I cancel? Yes, sir. 2 1. Hello, sir. Yes, my dear lovable students. 0.6E divided by 2 is equal to 0.6E minus 48 lakhs divided by 1. That means 0.6E is equal to 1.E minus 96 lakhs. Can I proceed? So 1.2E minus 0.6E is equal to 96 lakhs. Can I proceed? 0.6E is equal to 96 lakhs. So E is equal to 96 lakhs divided by 0.6 comes to 160 lakhs is the EBIT. So at 160 lakhs EBIT, whether you are doing project with option 1 or option 3, you will be having the same EPS. Comfortable? Brilliant question. This question should be LDR for your examination. Last day before the exam, try this question. Because, sir, EPS, IS EPS decision, financial break-even point concept, and also EBIT EPS analysis. Are you really with me? Indifference point. What point? Indifference point. So this is a beautiful question, man. A brilliant. This question should be tried before the day of examination. Can we try one more question from this area? With that, this slot will comes to an end. Current capital structure of XYZ Limited is as follows. Equity share capital of how much lakh? 7 lakh. Of face value of how much each? 20 each. Reserves and surplus of 10 lakh. 9% bonds of 3 crore. 11% preference shares of 3 lakh. Of face value of 5 each. Additional fund required for XYZ Limited are 5 crore. Totally 5 crore additionally we need. XYZ Limited is evaluating the following alternatives. Proposed alternative number 1, raise the fund via 25% equity capital and 75% debt. Appa 5 crore oda 25%, 1.25 crores. 75%, 3.75 crores at 10% KD. PE ratio in such scenario will be 12. That means if I do this, market will react. Correct? I can't do whatever I want in my company because equity shareholders will be seeing like this. If I inject more debt into the capital structure, they will say that because you increase the risk. Proposed alternative number 2, raise the fund via 50% equity and rest from 12% preference shares. PE in such scenario will be what? 11. Any new equity share would be raised at a face value of, and any new preference share will be issued at a face value of 20 each. Tax rate is 34%. Determine the indifference point under both the alternatives. Indifference point. So, before I prepare the indifference point, let me calculate the basic data. Basic data. You tell me, today in market, what is the current market price of an equity share? 20 rupees because 20 each. How much number of equity shares are there? 7 lakhs. So 7 lakhs into 20 comes to 1 crore 40 lakhs is the equity share capital. Can I? Already company having reserves of 10 lakhs. Sir, already company having 9% bonds of 3 crore. Already having company having 11% preference shares of 3 lakh at the rate of 5 comes to 1 crore 50 lakhs. Yellati add pannina 6 crore is the total capital employed. That means presently the company is having a value of 6 crore. It's a 6 crore company. Now we are going to additionally raise 5 more crores with 2 options with proposal number 1 and proposal number 2. Right, sir? So capital to be raised under both the proportion is 5 crores and 5 crores. Clarity? My dear lovable students, what is the proportion? In situation number 1, 5 crore into 25%, 1.25 crore and 5 crore into, sir, 50%. Angas, rendavudile. No man, debt. No, 25 and 75 and 50 and 50. Right? Sir, in proposal number 1, 25% equity means remaining 75% should be debt. Debt. Are you really with me? That means if 1.25 crores is equity means 3.75 crores should be debt. Debt. Total 5 crore. 5 or 6? 5 crores. 5 crores. Sir, here in proposal number 2, 50-50. 2.5 crores and 2.5 crores. Are you really with me? Yes, sir. Sir, so now what is a combined capital? Combined capital. Already you are having an equity of 1.4 plus reserves of 10 comes to 1.5, correct? Plus you are raising 1.25. So 1.5 plus 1.25 comes to 1.5 plus 1.25 comes to 2.75. But they have written 2.65, which is nothing. Reserves they have not clubbed. Yes, sir. So nothing. Old equity share capital 1.4 crores. Sir, new 1.25 crores. Total 2.65 crores. Able to follow? Anga. Already equity 1.4 crores. New 2.5 crores. Total 3.9 crores. This is the combined. Reserves anyway not going to change. All reserves will continue 10 lakh, 10 lakh. 9% bond will not change 3 crore, 3 crore. 10% debt will change. Sir, 10% debt, sir, proposal 1, 3.75 crores and there 2.5 crores. Sir, that's what? 3.75 crores. Right, sir? Debt. Pakka? In proposal number 2, inga vande debt ku badala yaru varuva? Preference with 12% preference share capital. So 12% preference dash and 2.5 crores, which is new part, second part, 50%. And 11% preference shares, you are already having 1.5 crores and the total capital employed will be 11 crore because already you are having capital of 6 crore plus additional capital, total 11 crore. This is a proposition of the 11 crore. Clarity? What is the interest for proposal number 1? I am supposed to pay. Sir, interest means, sir, 3 crore into 9% and 3.75 crore into 10%. So 3 crore into 9 plus 3.75 crore into 10. Total comes to 27 lakh and 37 lakh 50,000 come to 64 lakh 50,000. I should pay as interest if I am traveling through the proposal number 1. But in proposal number 1, do you have any preference share capital? Yes, sir. What is the preference share capital? 1 crore 50 lakhs into preference dividend of 11%, 16 lakh 50,000 should be the preference dividend. That's it. Proposal 1 calculations done. Interest for proposal number 2, simple. Sir, 3 crore into 9%. That's it. 27 lakhs. Comfortable. Preference dividend for proposal 2. Already I am having preference shares of 1 crore 50 lakhs. This into 11%. 2 crore 50 lakhs. This into 12%. Correct? So 1 crore 50 lakhs into 11% comes to 16 lakh 50,000 plus 2 crore 50 lakhs into 12% comes to 30 lakhs. Total comes to 46 lakh 50,000. Comfortable? That's it. Now all the basic data has been done. This I will not solve. I will be doing the table approach. How many options? 2 options. Only 2 options. So 1 indifference point. I have to write that EBIT minus interest. I will be getting earnings before tax less tax at the rate of 34%. Are you really with me? Yes, sir. You will be getting PAT, profit after tax, less preference dividend. You will be getting residual earnings divided by number of equity shares. You will be getting the EPS, earnings per share. Can we? I don't know EBIT. That is the suspense. Sir, interest under option number 1. 64 lakh 50,000. Under option number 2, 27 lakh. Up in 64 lakh 50,000 and 27 lakh. So it is E minus 64 lakh 50,000. E minus 27 lakhs. Can I? So 0.34 E minus 64 lakh 50,000 into 34%. 21 lakh 93,000. Following. Again 0.34 E minus 27 lakhs into 34% comes to 9 lakh 18,000. Can I proceed? That means, sir, 101 minus 0.34 comes to 0.66 E minus 64 lakh 50 minus 21 lakh 93,000 comes to 42 lakh 57,000. Again 0.66 E minus 27 lakhs minus 9 lakh 18,000 comes to 17 lakh 82,000. Comfortable? Under option number 1, there is preference dividend. Please note the preference dividend properly. Under option number 1, preference dividend is 16 lakh 50. And option number 2, preference dividend is 46 lakh 50. Please help me. What is the option number 1? 16 lakh 50,000. 46 lakh 50,000. Comfortable? My residual earnings will be 0.66 E minus 42 lakh 57,000 plus 16 lakh 50,000. 59 lakh 7,000. Is my calculation right? 0.66 E minus 17 lakh 82,000 plus 46 lakh 50,000, which comes to 64 lakh 32,000. What is the number of equity shares under option number 1? We have to calculate. 2,65,000 divided by 20. Correct then? So 2 crore 65 lakhs divided by 20 means 13 lakh 25,000 is the number of equity share for option number 1. Whereas for option number 2, 3 crore 90 lakhs divided by 20 comes to 19 lakh 50,000 should be the equity for option number 2. Sir, if we have added the 10 lakhs to this, our number of equity shares will be Swaha. Correct? That's why they have showed it separately. You are not calculating WACC using market value weight. If that is the case, we could have included there. Fine. So I got the formula, which is residual earnings divided by number. Residual earnings divided by number. You should help me to solve this. Sir, 0.66E minus 59,07,000 divided by 13,25,000 should be equal to 0.66E minus 64,32,000 divided by 19,50,000. Right? First 3030 cancel. So 0.66E minus 59,07,000 divided by 1325 should be equal to 0.66E minus 64,32,000 divided by 1950. Ella zero cancel பண்ணிட்டு 3 0 தான் cancel ஆகும். By mistake, if you put 195, that's it, gone. John, you are gone. So 1325 divided by 5. Can I write this as 265? 1950 divided by 5. Sir, can I write it as 390? Still 5 la povulya. 365 divided by 5 comes to 53 or 73. Sorry, 265 divided by 5 comes to 53. That's the max I can do, correct? 53. And 390 divided by 5 comes to 78. I can cross multiply straight away. Is there any common number 53, 78 and all? No, sir. Better cross multiply. LCM. Alright, sir. So 78 into 0.66 comes to 51.48E minus 59,07,000 into 78 comes to 46 or 4 crore. 4 crore 60,74,000. I know. 46 crores 7,46,000. Number padikku theriyudilla. Yes sir. Yes sir. Yes sir. Leave it. So we have done it. No, should be equal to, sir, 0.66 into 53 comes to 34.98E minus 64,36,000 into 53 comes to 64,32,000 into 53 comes to 34 crore 8,96,000. 96,000. Hello sir. Is denominator comma illa over? Avladhan sir. Even now can I bring all the E? 51.48E minus 34.98E should be equal to, sir, 46 crore 7,46,000 minus 34 crore 8,96,000. Fine. So 51.48 minus 34.98 comes to 16.5E should be equal to 11 crore 98 lakh 50,000. Example on the doubt or answer correct. E is equal to 11 crore 98 lakh 50,000 divided by 16 point E 72 lakh 63,636 point. At this EBIT, EPS of both the option will be one and the same. 72 lakh 63,636.36. Are you all really with me? Appreciating, huh? Sir, you know, this is a RTP May 23 question. May. Same question may be picked for examination. If you are having the courage to say that, that's your choice, your life. My dear lovable students, sir, like these questions will be coming. You have to practice this type of question by your own. Surely you will ask one question. If you yourself are solving all that, how I will practice? Redo those questions. Don't worry, you are having another 3 questions for your practice. Sir, the same type of question, Akash Limited. This is a RTP May 2019. Try by yourself and check the answer. I have attached the answer for you. Then number 2, Alpha Limited question. My dear lovable students, this is ICI study material question only. Book back. ICI book back only. You can try by yourself and you yourself can put the EBIT. You try everything if you hear when you will try. You try by your own. I have arranged the questions to you. And question number M, the financial advisor of Sun Limited. Even this question is also a ICI book back question. Are you all really with me? Then you check yourself where you are going wrong. And these two questions are ICI book back question. The same can be lifted for examination also. So don't take a risk. With this, officially we can declare that we are through with capital structure decisions, my dear lovable students. Are you all really with me? First do the 3 questions which I have solved. Then do the next 3 questions which I ask you to try. We'll meet at the appropriate time with a different chapter. Till that, thank you. Bye-bye from A&M. Sir, very happy evening to all. Sir, we are doing the revision of the financial management. In that, my dear lovable students, we understood that subject FM means taking 3 decisions. Number 1 is investment decision. Number 2 is financing decision. And number 3 is dividend decisions. In that, actually, we have taken care of the financing decision. Number 1, cost of capital. Number 2, capital structure theories. Number 3, arbitrage process. Number 4, EBIT, EPS analysis with indifference point. This many topic we have done. So to that same, we are going to do the leverage analysis. What analysis? Sir, this is the analysis of leverage, my dear lovable students. Sir, sales minus variable cost contribution minus fixed cost, we will be having EBIT. From the EBIT, if you reduce interest, we will be getting EBT, earnings before tax. Less tax at the rate of some percentage, you will get the PAT, profit after tax. From the profit after tax, we have to pay the preference dividend, we will get the residual earnings. Divided by number of equity shares, you will get the EPS, earnings per share. So actually, this is the income statement of any organization. If you analyze the income statement, from sales to the EBIT is what the operating leverage. From EBIT to EPS is what the financial leverage. So, from sales to EBIT, we are having operating leverage. From EBIT to EPS, we are having financial leverage. Sir, this minus EBIT and plus EBIT will get cancelled. Sales to EPS, we are having combined leverage. That means combined leverage is equal to operating leverage into financial leverage. Right, sir? Why, sir, we are having operating leverage? My dear lovable students, if sales is 100 rupees, this is what the revision of the operating leverage. Sir, if the sales minus variable cost, contribution minus fixed cost, EBIT. Sir, this is less and this is more. My dear lovable students, if the sales is 1 lakh and variable cost is 50,000, automatically contribution should be 50,000. Assume fixed cost to be 25,000, your EBIT will be 25,000. Sir, this is the cost structure of the company, present cost structure of the company. Assume there is a increase of 10% in sales, then automatically 1 lakh will become 1,10,000. 1 lakh will become 1,10,000. If the sales increases, variable cost should also increases. That means 50,000 also will become 110%, comes to 55,000 will be the variable cost. So 1,10,000 minus 55,000 comes to 55,000 will be the contribution. Look at the change. New sales 1,10,000. Old sales 1 lakh. So 1,10,000 minus 1 lakh, 10,000. Divided by 1 lakh into 100 means there is a 10% increase in sales. My dear lovable students, 55,000 is the new variable cost, right, sir? Minus. So there is an increase of variable cost also 10%. So if the sales increases by 10%, variable cost also increases by 10%. That means contribution also increases by 10%. Right up. But since fixed costs are fixed in nature, fixed cost will not change. That's what 25,000. So from 55,000, if you reduce 25,000, you will be getting an EBIT of 30,000. Correct? You just think, man, there is no change in the fixed cost at all. Because if 10% increase in sale will change the variable cost, will change the contribution, but will not change the fixed cost. You look at the EBIT. What is the change in EBIT? 5,000 is the change in EBIT. Divided by how much? 25,000 into 100. So 5,000 divided by 25,000 into 100 comes to 20%. 20%. That means if sales increases by 10%, EBIT increases by 20%. EBIT increases by. So actually the rule is if sales increases by 1%, EBIT should also increase by 1%. But if EBIT, if the sales is increasing by 1%, EBIT is increasing more than 1%. Such a benefit, such a favorable situation is called as leverage. Such a favorable situation is called as leverage. Assume a situation where there is a 10% reduction in the sales. 1 lakh rupees sales has become how much? 90,000. And 50,000 rupees variable cost will become 45,000. So 90 minus 45 come to 45,000 will be the contribution. Again, contribution also will come down by 10%. That means if sales decreases, contribution reducing. If sales increases, contribution also increasing. Whereas whether sales increases or reducing, fixed cost will be fixed. Fixed cost will be fixed. So 45,000 minus 25,000 comes to 20,000 is the EBIT. Find out the percentage change in EBIT. Percentage change in EBIT is equal to 20,000 minus 25,000 divided by 25,000 into 100. That means 5,000 divided by 25,000 into 100 comes to 20%. So look at here. Look at here. My dear lovable students. Here if the sales are increased by 10%, EBIT are increasing by 20%. Right, sir? Here, if the sales are decreased by 10%, EBIT decreasing by 20%. Are you able to appreciate the reason or the logic? If sales increases, variable cost increasing or decreasing. That means variable cost is traveling in line with sales. Whereas fixed cost is not traveling in line with sales. That means whether fixed cost, sir, whether the sales increasing or not, what cost is same? Fixed cost is same. So why I am incurring fixed cost? Since I am operating my business, I am incurring fixed cost. So my dear lovable students, I am having what leverage? Operating leverage between sales and what? EBIT. Because of the person called as. That's why I'm going to discuss, man, formula in short. My operating leverage is because of the presence of the fixed cost. Because of the presence of the fixed cost. So sales minus variable cost minus you will get contribution. Minus fixed cost is what? EBIT. Sir, because of variable cost, I don't have leverage. Because if sales increases, variable cost increases. If sales decreases, variable cost decreases. But because of the presence of fixed cost in my cost structure, I am having what leverage? Operating leverage. That's why fixed cost ku mela yaru? Contribution. Fixed cost keela yaru? That's why operating leverage is equal to contribution divided by EBIT, which is mele divided by keela. Yarku mele? Fixed cost ku mele. Yarku keela? Because of the presence of the fixed cost only, I am having the operating leverage. Are you really with me? Next, coming to the financial leverage, my dear lovable students. Look at the situation, the same scenario. This is the present scenario and this is a reduction and this is increase. Sir, I am continuing from EBIT. From the earnings before interest and tax, I am liable to pay what? Interest. So if I pay interest, I will be getting earnings before tax. From that, I have to pay tax at the rate of 30%. Right, sir? So I will be getting PAT, profit after tax. Profit after tax. From that PAT, my dear lovable students, I have to pay the, sir, preference dividend, if any. If any, I will get the residual earnings divided by number of equity shares. I will get the EPS, which is earnings per share. Are you all really with me? So what they are saying, you are having EBIT of 25,000. This EBIT I am continuing. From that EBIT, you are liable to pay interest of 5,000. Right? You will be getting earnings before tax of 20,000. From that EBT of 20,000, pay 6,000 rupees tax. You will get PAT of 14,000. Assume there is no preference dividend, because there is no mandatory that in your capital structure preferential capital should be there. Right? So your residual earnings will be 14,000. Assume 10,000 is the number of equity share. So 1.4 per share will be the earnings per share. This is the current capital structure. Assume, my dear lovable students, since the sales increases, variable cost increases. Since the variable cost increases, contribution increases. Even though sales increases, fixed cost will not increase. So if sales increases, EBIT will increase. So because of change in sales, assume EBIT has become 30,000. EBIT has become, that means there is a 20% increase in EBIT. Generally, if there is 20% increase in EBIT, there should be 20% increase in EPS. This should be the normal. If things are happening like that, we can say that there is no magnitude effect. We can say that there is no additional advantage. We can say that there is no benefit. Are you really with me? Sir, even the EBIT has been increased from 25,000 to 30,000. Will the interest change or will not change? Will not change. Why the interest has to change, my dear lovable students? Because interest I am paying for the debt in the balance sheet. Interest I am paying for the debt in the balance sheet. So my earnings before tax will be 25,000. On that 25,000, I am liable to pay tax at the rate of 30%. Comes to 7,500. So from 25,000, if I reduce 7,500, I will get 18,000. 17,500 is the profit after tax. Are you really with me? Assume there is no preference dividend in the question at all, because there is not, it is not mandatory that in the capital structure who should be there, preference dividend should be there. I will be getting residual earnings of 17,500 divided by equity share 10,000, 17.5 per share. That means percentage change in EPS is equal to 1.75. Yes. Percentage change in EPS is equal to 1.75 minus 1.4 divided by 1.4 into 100. Paka. Which comes to 25%. But the EBIT has been raised only by 20%. But the EPS has been raised by 25%. This is called as leverage. This is called as leverage. Leverage means less effort, more return. Less effort. For example, in road, ஒரு பெரிய கல்லு இருக்குன்னு வெச்சுக்கோ. அந்த கல்லை நீ ஒரு ஓரமா போடணும்னா தூக்கி போட்டேனா முதுகு பிடிக்கும். அதனால நீ என்ன பண்றேன்னா ஒரு குச்சி எடுத்து கோல் எடுத்து இப்படி குத்துற இப்படி திருப்புற. Are you really with me? Less effort, more return. That is called as lever, called as leverage. If I put 1% effect, my return will be more than 1%. More than? I am going to reduce the EBIT by 20%, my dear lovable students. If I reduce the EBIT by 20%, 2,500 into 20%, 5,000. So the revised EBIT will be, sir, because of the reason that EBIT has been reduced, will the debt holders claim less interest, same interest? Same interest. That means I have to pay 5,000. So 20 minus 5,000 comes to 15,000 is the earnings before tax. Adik mela 4,500 will be the tax at the rate of 30%. So 10,500 will be the PAT. So there is no what dividend? Preference dividend. So my residual earnings will be 10,500 divided by number of equity share comes to 1.05 per share. 1.05 per share is the EPS. Can I calculate the percentage change in EPS? Percentage change in EPS is equal to, sir, 1.4 minus 1.05 divided by 1.4 into 100. 1.4 minus 1.05 comes to 0.35 divided by 1.4 into 100 comes to 25%. The same story is happening. That means, my dear lovable students, if EBIT decreases by 20%, my EPS is decreasing by 25%. Are you all really with me? 25%. That means there is some person inside the capital structure. That person is nothing but what? Interest. Interest. Sir, whether the EBIT change or not, who will not change? Interest will not change. Whether EBIT increases also, same interest. Whether EBIT decreases also, same interest. Appo, the reason for the financial leverage is equal to interest. Is equal to what? Interest. You tell me, from the EBIT, I will be paying the interest. Sir, from EBIT, if I pay interest, I will get the EBT. Correct? Who's the reason for the financial leverage? Interest. Appa mele divided by kide. Interest mele yaru? EBIT. Kide yaru? EBT. That is the formula. So operating leverage is equal to contribution divided by EBIT. And financial leverage is equal to EBIT divided by EBT. Are you all really with me? Now I am coming to the combined leverage. Coming to the combined leverage in the sense means, sir, in your capital structure, in any firm's capital structure, sales minus variable cost, you will get minus fixed cost. You will get earnings before interest and tax. From that, if you reduce interest, you will get earnings before tax. Right, sir? Minus tax at the rate of 30%. You will be getting profit after tax called as PAT. From the PAT, reduce preference dividend, you will get the residual earnings divided by number of equity shares will give you EPS, earnings per share. Comfortable? So my dear lovable students, sir, assume the present sales is 1 lakh and present variable cost is 50,000. Present contribution will be 50,000. Present fixed cost will be 25,000. Right? Present EBIT will be 25,000. Minus interest 5,000 and EBT will be 20,000 at the rate of 30% comes to 6,000. Sir, 14,000 will be the PAT. Assume there is no preference dividend. It is not mandatory in nature. So what is the residual earnings? 14,000 divided by 10,000 equity shares, 1.40 per share. Right? Now, my sales is going to increase 10%. By, so there is going to be an increase in 10% in sales. If sales increases by 10%, 1 lakh become 1 lakh and 10,000. Right? Sir, if the sales increases, will the variable cost increases? 50,000 will become 55,000. So 1 lakh 10,000 minus 55,000 comes to 55,000. If the sales increases, will the fixed cost increases? No. Fixed cost will be same, 25,000. So 55,000 minus 25,000 comes to 30,000 is the EBIT. Sir, because of increase in EBIT from 25,000 to 30,000, will the interest increase or decreases? No, sir. The same interest of what? 5,000. So 30,000 minus, sir, 5,000 comes to 25,000 is the EBT. Pay tax at the rate of 30% comes to, what is the PAT? 17,500. There is no preference dividend. Residual earnings 17,500 divided by 10,000 comes to 1.57 per share. Comfortable? Sir, sales has been increased by 10%. Nyayama pata. My EPS should also increase by 10%. But that is not what happened. That is not what happened, right, sir? Now my EPS is increased by 1.75 minus 1.4 divided by 1.4 into 100. New EPS minus old EPS divided by old EPS into 100. 1.75 minus 1.4. 0.35 divided by 1.4 into 100 comes to 25% is the increase in EPS. This is wow, because sir, if 1% change in sales should only lead to 1% change in EPS, but 1% change in sales is leading to 25% change in EPS. The reason or the logic, sir, when sales increases, everyone should increase, but fixed cost has not increased, right, sir? When sales increases, everyone should increase, but interest has not increases, right, sir? But the reason for the combined leverage is because of fixed cost and interest, right, sir? Fixed cost ku mele yaar iruka? Contribution. Interest kீழ யார் இருக்கா? That's why contribution divided by EBT is the reason for the combined leverage. No need to by heart any formula. My dear lovable students, operating leverage is because of the fixed cost. மேலே by கீழ contribution divided by EBT. Financial leverage is because of the interest. மேலே by கீழ EBT divided by EBT. Combined leverage is because of both fixed cost and interest. Fixed cost மேலே contribution, interest கீழ EBT. Are you really with me? EBT. Are you really with me? The same can be expressed in different formula. Sir, we know that sales minus variable cost contribution minus fixed cost is the EBIT. Comfortable? Sir, what is contribution? Sales minus variable cost. What is EBIT? Contribution minus fixed cost. This is called as full formula. Either you say operating leverage is equal to contribution divided by EBIT, or sales minus variable cost divided by contribution minus fixed cost. Can I proceed? Sir, financial leverage will start from EBIT. From EBIT, if you reduce interest, you will get EBT. From the EBT, if you pay tax, you will get something blah 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 blah. Sir, the main reason for the financial leverage is the presence of the interest. So you can say either EBIT divided by EBT. Sir, how to find out EBIT? Contribution minus fixed cost. Right, sir? Divided by, sir, what is EBT? EBIT minus interest. Right, sir? Sir, operating leverage is equal to combined leverage is equal to what leverage? Combined leverage is equal to operating leverage into financial leverage. Operating leverage into, that means contribution divided by EBIT into EBIT divided by EBT. Hello, sir. This EBIT will get, that means contribution divided by EBT. That's what the another formula, contribution divided by EBT. Or look at here, my dear lovable students, in denominator of the operating leverage we are having contribution minus fixed cost. In numerator of the financial leverage we are having contribution minus fixed cost. Cancel. Numerator remaining sales minus variable cost. Denominator EBIT minus interest. That's what sales minus variable cost is equal to contribution. And EBIT minus interest is equal to EBT. That's what the discussion, contribution divided by EBT. So we are having three leverage, my dear lovable students. Operating leverage, financial leverage, combined leverage. Operating leverage is because of the interest, fixed cost. And financial leverage is because of the interest. And combined leverage is because of the fixed cost and interest. That means, sir, we are having, romba simple, sir, this is the income statement. This is called as the, sir, in our income statement, my dear lovable students, sales minus, sir, from sales to EBIT, we are having operating leverage. From EBIT to EPS, we are having financial leverage. From sales to EPS, we are having combined leverage. Combined. So, in operating leverage, we are having fixed cost as the fixed component. In financial leverage, we are having interest as the fixed component. In combined leverage, we are having fixed cost and interest as the fixed component. That means, my dear lovable students, if you see fixed cost classified into two categories. In an organization, there are two types of fixed costs are there. Fixed operating cost and fixed financial cost. Tell me, fixed operating cost and fixed financial cost. Fixed operating cost is what? Fixed cost. Fixed financial cost is what? Interest. So in your operating structure, cost structure, if you are having fixed cost, if the sales increases, fixed cost will not increases. That is called as favorable leverage. That is called as. But if you are having fixed costs in your what structure? Capital structure. And if your sales reduces, my dear lovable students, that is called as unfavorable leverage. So leverage represents the risk. Risk may be either favorable or unfavorable. Are you really with me? So because of including fixed cost in your what structure? Not capital structure, cost structure. You may have what leverage? Operating leverage. Because of including interest in the capital structure, that is debt in the capital structure, you are having financial leverage. Are you really with me? Sir, if you are having both fixed cost and interest, this will count to combined leverage. That means this is another formula called as percentage formula. Called as what? Percentage formula. Sir, operating leverage is a comparison between sales and EBIT. Are you really with me? 1% sales மாறினா எவ்வளோ percent EBIT மாறுங்கிறத operating leverage. Financial leverage is a comparison between EBIT and EPS. 1% EBIT மாறினா எவ்வளோ percent EPS மாறுங்கிறத financial leverage. Combined leverage is a comparison between sales and EPS. 1% sales மாறினா எவ்வளோ percent EPS மாறுங்கிறத combined leverage. Right, sir? My dear lovable students, operating leverage means percentage change in EBIT divided by percentage change in sales. What it means? If 1% change in sales will lead to how much percent change in EBIT? Comfortable? Sir, what is financial leverage? Sir, percentage change in EPS divided by percentage change in EBIT. 1% EBIT மாறினா எவ்வளோ percent EPS மாறுங்கிறதா financial leverage. What is combined leverage, man? Percentage change in EPS divided by percentage change in sales. 1% sales மாறினா எவ்வளோ percent EPS மாறுங்கிறதா. You just have a reconfirmation of the relationship. Operating leverage is the relationship between sales and EBIT. Financial leverage is the, sir, relationship between EBIT and EPS. Comfortable? And combined leverage is the relationship between sales and EPS. அப்போ 1% சேல்ஸ் மாறினா எவ்வளோ percent EBIT மாறும்? அப்ப யார் மாறணும் ஃபர்ஸ்ட்? அப்ப சேல்ஸ் should be the denominator. That's why percentage change in sales is the denominator. Its reflection will be on the numerator. That is percentage change in what? EBIT. So what I am looking is, if 1% change in sales will lead to how much percent change in EBIT? If 1% change in EBIT will lead to how much percent change in EPS? If 1% change in sales will lead to how much percent change in EPS? Are you really with me? So the reason for the operating leverage itself is what cost? Fixed cost. The reason for the financial leverage itself is interest. The reason for the combined leverage itself is fixed cost and interest. So my dear lovable students, sir, this is called as what element formula? Fixed. So from the main item, remove the fixed elements. Remove the, what is the operating leverage? Sir, which is nothing but sales minus variable cost contribution minus fixed cost EBIT. Yarnale fixed cost. Mele by kide. What by what? Sir, take the numerator as contribution. There is no doubt about it. Whatever numerator you have taken, take the denominator. Contribution divided by contribution. Contribution, you will get 1. But from the contribution, remove the fixed element. Who is the fixed element? Fixed cost. Sir, with regard to EBIT, sir, I will take EBIT minus interest. I will take the numerator as denominator also EBIT. From that, I will remove the fixed element called as what? Interest. What is EBIT minus interest? EBT, basically EBIT divided by EBT. Sir, combined leverage is because of who and who? Fixed cost and interest. Fixed cost, mele contribution. In denominator also I will take contribution. From the contribution, I will reduce fixed cost. Contribution minus fixed cost, EBIT. From the EBIT, I will reduce interest. I will get, which is contribution divided by EBIT. This is another way of expressing the formula. Are you all really with me? So we are having three leverage are there. Operating leverage, financial leverage, combined leverage. Operating leverage is because of the fixed operating cost. Tell me, fixed operating cost, which is present in our cost structure. Whereas financial leverage is because of the fixed finance cost, which is there in the capital structure. Capital structure. Sir, the combined leverage is because of the fixed operating cost present in the cost structure plus fixed financing cost present in the capital structure. Clarity? Sir, how the combined leverage will work? Sir, operating leverage into financial leverage is equal to combined leverage. Sir, they have given, sir, with the financial leverage and combined leverage, you have to calculate the operating leverage. Appo enna available na, sir, you have to calculate the operating leverage with the combined leverage. So what and all given? Financial leverage is given under. Appo what leverage is equal to? Operating leverage is equal to combined leverage divided by financial leverage. Right, sir? Sir, I want to calculate the what leverage? Financial leverage. That means what and what will be given in the question? Operating leverage and the, so financial leverage is equal to combined leverage divided by operating leverage. Comfortable? Sir, I want to calculate the combined leverage. Easy. Combined leverage is the product of operating leverage into financial leverage. Operating leverage, financial leverage kuduthu combined leverage kekalam. Sir, combined leverage, financial leverage kuduthu operating leverage kekalam. Combined leverage, operating leverage kuduthu financial leverage kekalam. Are you all with me? So there are three types of leverage are there. Number one, operating leverage, financial leverage. Operating leverage is between sales and EBIT. Financial leverage is between EBIT and EPS. And combined leverage is between sales and EPS. Comfortable. Now, till now, we talked about the financial leverage with only interest. But in our capital structure, we may inject preference shares also. Even preference dividend is also fixed percentage. Am I right, sir? If, sir, preference dividend is also how much percent? Fixed percentage. That is also a fixed financial charge. Fixed. So that will also create some benefit to the equity shareholders. That is called as trading on equity. That is called as, because of injecting debt into the what structure? Capital structure. Equity shareholders will get some extra benefit. They will get more than their expectation. They will get more than their KE. Are you really with me? But my dear lovable students, sir, the only difference between KD and KP is KD is tax deductible, whereas KP is not tax deductible, right? So in your capital structure, if you inject preference shares, that is also a fixed financial cost. Fixed financial cost. Up a financial leverage may be without preference share capital or with the preference share capital. If it is with the preference share capital, you have to start with EBIT. Okay. What is there in your hand? EBIT. From that EBIT, pay the interest. Pay the interest. What you are having? EBT. First, I have to pay the tax. Then the balance is called as PAT. From PAT only, I have to pay the preference dividend. But in order to pay the what dividend? Preference dividend, I have to pay the tax. So is the preference dividend pre-tax or post-tax? Post-tax. If you look at here, sir, after paying tax only I can pay preference dividend. So preference dividend is a what tax item? So if I pay, if earnings before tax is 100, I will pay 30 rupees as tax. Only balance how much will be there? 70 will be there. Only balance 70 will be there. So my dear lovable students, in order to pay the PAT, I have to pay the tax. Without paying tax, I can't pay the preference dividend. So preference dividend is a before tax item or after tax item? After tax item. You just tell me. EBIT is a before tax item or after tax item? Before tax. Sir, EBIT is a before tax item or after tax item? Before tax. Is interest is before tax item or after tax item? Before tax. If everything in the formula is before tax, automatically preference dividend should also be before tax. But now preference dividend is post tax, after tax. So I have to convert the post tax item into pre-tax, right? Which is nothing but divided by 1 minus t. Divided by 1 minus t, which is nothing, man. For example, I will just give you a simple example, man. This is your profit before tax, 1 lakh. Profit before tax, 1 lakh. And tax rate is equal to 30%. The tax rate is equal to. So I want the PAT, profit after tax, sir, which is equal to profit before tax into 1 minus t. What is the profit before tax? 1 lakh. Into what is 1? 1 minus 0.3, right, sir? So 1 lakh into 0.7, am I right? 1 lakh into 0.7 comes to 70,000 is the PAT. Nothing. Sir, what is the profit before tax? 1 lakh. Less tax at the rate of 30% comes to, so from 1 lakh, if you reduce 30,000, 70,000 is the PAT. This I have derived by way of this formula. Are you all really with me? Assume from 70,000, I have to go to 1 lakh. Okay, va? So from PAT, I have to reach to profit before tax. Okay. What is the PAT? 70,000. Sir, from 100 rupees, you would have paid 30 and this will be, so this will be 70%. Right? Right? Sir, that is equal to 70,000 divided by 1 minus t. T is 0.3. So 100 minus 0.3 comes to 0.7. So 70,000 divided by 0.7 comes to 1 lakh. That is called as profit before tax. From, sir, simple, from profit before tax, if you want to reach to the profit after tax, do PBT into 1 minus t. Correct? From the profit after tax, if you have to come to the profit before tax, sir, profit after tax divided by 1 minus t. Clarity? Is preference dividend, you tell me, profit before tax or profit after tax? Profit after tax. I have to convert that into before tax. So PD divided by 1 minus t. That's why formula PD divided by 1 minus t. Comfortable? So simple. Now, combine leverage. That means in the capital structure, who is also there? Fixed cost is there, interest is there, preference dividends is there. So, what is the numerator? EBIT. From the EBIT, reduce interest. You take contribution. Numerator should be contribution. Contribution divided by contribution minus first fixed element, fixed cost. Second fixed element, interest. Third fixed element, preference dividend. But that preference dividend alone is a post-tax item. Convert that into by putting 1 minus t. Are you able to appreciate, sir? That's a game over. And we are moving into the last formula before we start solving the question. MOS formula. What formula? MOS means margin of safety. Margin of over and above the break-even point is called as what even safety? Margin of safety. So, sales minus variable cost, contribution minus fixed cost is what? EBIT. If my sales is up to fixed cost, that is called as break-even point. If my sales is more than fixed cost, that is called as margin of safety. Am I right? So, my dear lovable students, the margin of safety will have implication only with the operating leverage. Nothing to do with the financial leverage and the combined leverage. So, combined leverage ko margin of safety ko enna illa. Sir, financial leverage ko margin of safety ko enna illa. But operating leverage and margin of safety is having relationship. Sir, operating leverage is equal to 1 divided by margin of safety. 1 divided by. Sir, this in regular class I will, sir, derive this 1 divided by margin of safety. But now if I start, it will take 20-30 minutes. Unnecessary. So operating leverage and margin of safety will have relationship. This is a maximum formula you have to carry from the, sir, leverage analysis. Can we tuck revise? Come on, operating leverage in short, contribution divided by EBIT. Financial leverage in short, EBIT divided by EBT. Combined leverage, contribution divided by EBT. Pakka. Full formula, focus and say, Operating leverage. Sales minus variable cost divided by contribution minus fixed cost. Financial leverage. Contribution minus fixed cost divided by EBIT minus interest. Combined leverage. Sales minus variable cost divided by EBIT minus interest. Right, sir? Percentage formula for operating leverage. Percentage change in EBIT divided by percentage change in sales. Financial leverage. Percentage change in EPS divided by percentage change in combined leverage. Percentage change in EPS divided by percentage change in sales. Are you able to recall it? Fixed element formula. Fixed item minus paniru. Okay va? Operating leverage. Contribution divided by contribution minus fixed cost. Financial leverage. EBIT divided by EBIT minus interest. Combined leverage. Contribution divided by contribution minus fixed cost minus interest. Comfortable? Combined leverage formula has been given. With that, I need operating leverage. Operating leverage is equal to combined leverage divided by, with the operating leverage and the combined leverage, I need financial leverage. Combined leverage divided by operating leverage. Sir, operating leverage given, financial leverage given, I want combined leverage. Operating leverage into financial leverage. Comfortable? Sometimes in the capital structure, what dividend will be there? Preference dividend will be there. Then financial leverage is equal to EBIT divided by EBIT minus interest minus preference dividend divided by 1 minus T. So if preference dividend is there in the capital structure, who will also get affected? Combined leverage will also get affected. So combined leverage is equal to contribution divided by contribution minus fixed cost minus interest minus preference dividend divided by 1 minus T. Can I proceed? MOS is having relationship only with the operating leverage is equal to 1 divided by margin of safety. Can we start doing the question from the leverage analysis? The first question is a RTP November 2022 question. Debut Limited currently has an equity share capital of 1 crore 30 lakh consisting of 13 lakh equity shares. Company is going through a major expansion plan requiring to raise fund to the extent of 78 lakh. That means additional capital required is to finance the expansion. The management has the following plan. Plan 1, 2, 3, 4. Already EBIT, EPS analysis we have taken care of such things. Correct? Issue 7,80,000 equity shares of 10 each. So 7,80,000 into 10, 78 lakh. Or issue 5 lakh equity shares of 10 each, that is 52 lakh. And balance through long-term borrowing at 12% interest per annum. So balance na 78 lakh minus 52, 26 lakh at the rate of 12%. Issue 3,90,000 equity shares of 10 each. So 39 lakhs plus 39 lakhs, that is, sir, 39 lakhs at the rate of 9% debt. 39 plus 39, 78 lakhs. Issue 3,90,000 equity shares of 10 each comes to 39 lakh and balance through 6% preference shares. Again 39 lakh at the rate of 6%. EBIT of the company is expected to be how much lakh? So because of the financing decision, will EBIT affected? No, sir. Considering corporate tax rate at the rate of 40%, you are required to calculate the EPS in each of the above plans. Easy. Ascertain financial leverage in each plan and comment is what the question is all about. Can we? Sir, first we will analyze what is the present equity. Whatever may be the plan, the present equity remains at how much lakh? 13 lakhs. Can I proceed? 1 crore. Number of equity shares? 13 lakhs. Because, sir, 1 crore 13 lakhs, they themselves given 13 lakh equity shares. Right, sir? Yes, sir. New issue, my dear lovable students. Sir, plan number 1, we decided to issue new issue how much, man? 7,80,000. Right, sir? Plan number 2, 5,20,000. Plan number 3, 3,90,000 and 3,90,000. So, existing plus new issue will be the total equity share capital. So, already 1 crore 30 lakhs is there. Plus 78 lakh you are going to issue. So, 1 crore 30 lakhs plus 78 lakhs comes to 2 crore 8 lakhs will be the new equity. And a plan number 2, sir, 1 crore 30 lakhs is there. Plus 52 lakhs you are going to raise by way of equity na 1 crore 82 lakhs. If I go with plan number 3, sir, 1 crore 30 lakhs plus 39 lakhs of equity means 1 crore 69 lakhs. Sir, here 1 crore 30 lakhs plus 39 lakhs comes to 1 crore 69 lakhs. Are you comfortable up to this? Yes, sir. That means once I go with plan number 1, the total number of equity share with me will be 2 crore 8 lakhs divided by 10. What is the face value? So 20 lakh 80,000 equity shares will be there. Yes, sir. அது இங்கே add பண்ணிருக்கலாம். Because 13 lakh plus 7 lakh 80,000 comes to, yes sir, 13 lakhs plus 5 lakh 20,000 comes to 18 lakh 20. 13 lakhs plus 3 lakh 90 comes to 16 lakh 90. 13 lakhs plus 3 lakh 90, 16 lakh 90. Sir, if I am going with second plan alone, I am going to raise debt with 12% long-term debt to the extent of 26 lakhs. If I am going with third plan alone, I will be raising 9% debenture of 39 lakh. If I am going with fourth plan alone, I can raise the preference shares by 39 lakhs. Appreciate Pandrani. So I am going to calculate the EPS and the financial leverage. You tell me, if the plan change, will the EBIT change? So whatever may be the plan, EBIT 52 lakh, 52 lakh, 52 lakh, 52 lakh. Less interest at the rate of 12%. That will be only there for plan number 2. 26 lakh into 12% comes to 3 lakh 12,000 is the interest you are supposed to be paid. Less interest at the rate of 9%. That will be available only for plan number 3, which is 39 lakh into 9% comes to 3 lakh 51,000. You will be getting earnings before tax, right, sir? From the EBT, pay tax at the rate of 40%. So EAT at the rate of 60% will be there. Straight away put EAT. 52 lakhs into 60 comes to 31 lakh 20. 48 lakh 88,000 into 60% comes to 29 lakh 32,800. 48 lakh 49,000 into 60% comes to 29 lakh 9,400. And 52 lakhs into 60% comes to 31 lakh 20,000. Comfortable. Sir, if I am traveling through plan number 4, I am having preference dividend of 6%. So 39 lakhs into 6% comes to 2 lakh 34,000. Comfortable. So my earnings available for the equity shareholders will be 31 lakh 20, 29 lakh 32,800, 29 lakh 9,400, 31 lakh 20 minus 2 lakh 34 comes to 28 lakh 86,000. Ennappa comfortable? Divided by number of equity shares, already find out just now. So 20 lakh 80, 18 lakh 20, 16 lakh 90, 16 lakh 90,000. Can I proceed? Sir, I can easily find out EPS, which is nothing but earnings available to the equity shareholders, which is residual divided by number of equity shares. 1.5, 1.61, 1.72, 1.71. First requirement of the question comes to an end. Hello. Now I am going to calculate the financial leverage, because of whom you will be having financial leverage, interest and preference dividend. In option number 1, I don't have what at all? Interest and preference dividend. So there is no what at all? Financial leverage. That means my EBIT will be equal to EBT. Then 1 rupees will be the financial leverage. That means if you are getting 1 as the financial leverage, there is no interest, there is no preference dividend. Hello. In second case, I am having interest, but I don't have preference dividend. So, only orala mattu paatha podulya. Calculator, what is EBIT? 52 lakhs divided by 48 lakh 88,000 comes to 1.06. Is the what leverage? Financial leverage. Who is there? Interest is there. Who is not there? But in situation number 3, same. Who is there? Who is not there? Interest is there. Preference dividend is not there. What is the EBIT in case number 3? 52 lakh. What is the EBT? 48 lakh 49,000. So 52 lakhs divided by 48 lakh 49,000 comes to 1.07. But in situation number 4, you are having both. Yaru irka. Interest is not there. Yes, sir. Only who is there? Preference dividend is there. But still we have to give effect to preference dividend. That's why logic I have discussed for this formula. What is the formula? EBIT divided by EBIT minus interest. 0 to go. Preference dividend divided by 1 minus 3. Comfortable. What is the EBIT of case number 4? 52 lakh. Divided by EBIT, 52 lakhs. Interest 0 divided by preference dividend 2 lakh 30. This will be 70%, right? Sorry, 40%, 60% after tax, correct? So 1 minus 0.4 comes to 0.6. So 3 lakh 90,000. 52 lakh minus 3 lakh 90. 48 lakh 10,000. 52 lakhs divided by 48 lakh 10,000 comes to 1.08 is the financial leverage if there is preference dividend. Are you all really with me? And they want comment also, but comment is missing. What comment? You should say that, sir, under 1.72 is the best option. This is the option where you are having highest EPS. Correct, sir? Whereas this is the option where you are having highest financial leverage. Highest financial leverage. Are you really with me? So it's better to go with option number 3, plan number 3, because under that plan you are having highest EPS. Are you able to appreciate? I'm moving into a beautiful question from question number N. It's a November 2021 past examination question. Don't think that like this and all question will not come. A student, what I'm expecting from you is, if you are just simply listening to the video and understand that if there is a chapter called as leverage, you will not understand anything. After the video, do this 3 question and try to solve ICI illustrations and book back, especially book back. Then your preparation for the examination will be done. Information of A Limited is given below. Earnings after tax, which is PAT, 5% on sales. Sir, is question sales expressed, not expressed? So can I take X as sale? X into 5%, 0.05x. So the PAT will be point. Income tax rate will be degree of operating leverage. Operating leverage is equal to 4. What is operating leverage formula? Contribution divided by EB8. 10% debenture in capital structure, 3 lakh. So 3 lakh into 10%, 30,000 will be the interest. Variable cost, how much lakhs required? 6 lakhs. So can I take here 0.05x? Income tax at the rate of 50%. So this will also be 0.5x. Correct? Sir, because 50-50 man? Yes, sir. So if inga 100 rupees and 50 rupees tax katti 50 rupees micham irukum. Appo this 50 is equal to this 50, right? Then my dear lovable students, 0.1x, 0.10x is the EBT. Interest expense already we calculated 30,000, right, sir? Then EBIT will be another 30,000 plus 0.1x or 0.1x plus 30,000. Technically correct. Is fixed cost given in the question? No. But they have given operating leverage as how much time? 4 times. Now I am having EBIT in my hand, right, sir? They said that variable cost is 6 lakhs. 6 lakh. And I know that sales I have taken as, so automatically contribution will be X minus 6 lakhs. Now I am having contribution. Now I am having EBIT. I can easily find out the fixed cost. Able to appreciate? Simple, man. So operating leverage is equal to contribution divided by EBIT. 4 is equal to X minus how much lakhs? 6 lakhs divided by 0.1x. 0.1x plus 30,000. Can I put by 1? Yes, sir. Can I cross multiply? 4 into 0.1. 0.4x plus 30,000 into 4. 1,20,000 should be equal to X minus 6 lakh. Cross multiplication. Correct? So my dear lovable students, I'm bringing every X and all here. So X minus 0.4x is equal to 6 lakhs minus 1,20,000. Correct? This is like minus 1 6. Plus 1,20,000. Right, sir? Yes, sir. So my dear lovable students, 1x minus 0.4x, 0.6x is equal to 7,20,000. Comfortable? So x is equal to 7,20,000 divided by 0.6. 12 lakhs is the x. What is x? I can say the sales as 12 lakhs, right? Okay, man. Again writing 12 lakh. Already given, sir, variable cost of 6 lakhs. From 12 lakh, 6 lakh gone. 6 lakh. Fixed cost Sir, just now I can calculate. EBIT I have calculated. Illa 0.1x, that is 12 lakhs into 0.1 comes to 1,20,000 plus 30,000 comes to 1,50,000. Enapa clarity? Appa 6 lakh minus 1,50,000, 4,50,000 is the fixed cost. Comfortable. Less interest will be same 30. So EBT 1,20,000. Sir, 60,000 will be the income tax. 60,000 will be the PAT. That's it, game over. What they want? Calculate financial leverage. Do you know what is financial leverage formula? Financial leverage is equal to EBIT divided by EBT. Hello, sir. What is EBIT? 1,50,000 divided by EBT 1,20,000. Hello, sir. So 1,50,000 divided by 1,20,000 comes to 1.25 times is the financial leverage. What is the interpretation of this? If 1% change in EBIT will lead to 1.25% change in EPS. Can I come to combined leverage? Sir, combined leverage is equal to operating leverage into financial leverage, because operating leverage is given in the question. 4 into 1.25 comes to 5 times. What is the meaning? If there is a change in sales of 1% will lead to 5% change in EPS. You can apply formula also for combined leverage. Contribution divided by EBT. What is the contribution? 6 lakh. EBT 1,20,000. So 6 lakhs divided by 1,20,000 comes to 5 times. Same 5 I am getting here. Right, sir? Calculate the percentage change in EPS. If sales increase by 5%. It's a relationship between sales and EPS is what combined leverage. We are having combined leverages how much time? அப்போ 1% sales மாறினா 5 times யார் மாறுவா? அவங்க என்ன சொல்றாங்கன்னா 5% மாறினா அப்போ 5 into 5 is equal to 25% will be the new change in EPS. If there is 5% increase in sales, that means if sales increase by EPS will increase by 25% because the combined leverage is 5 times. Check the answer, man. Income statement of A Limited. Sir, they also got the answer. Component of X sales is 12 lakh. Have you got? Yes, sir. Sir, computation of leverage, operating leverage 4 times. Have you got operating leverage 4 times? Given in the question. They have just cross-checked. That means the figures computed whether it is cross-tallying with 4 times or not. Yes, sir. Financial leverage, sir, have we got a 1.25 times? Yes, 1.25 times. Getting it. And combined leverage, have we got as 5 times? Yes, sir. 5 times is the combined leverage. Clarity. That's it. What is the percentage change in EPS? Sir, 25%. FD, sir, because 1% change in sales will lead to 5% change in EPS. Up 5% change in sales will lead to 5 into 5. 25% change in EPS. That's it. Hence, if sales increase by 5%, EPS will increase by 25%. Clarity. I'm moving to the last question from this area. Super fantastic to the core. This is a May 2022 past examination question. Details of company for the year ended 31st March are given below. Sales, how much lakh? 86 lakhs. This is the sale. Sir, profit volume ratio, that means contribution, 35%. Right, sir? Sir, fixed cost excluding interest expenses 10 lakh. 10% at 55 lakh. So 55 lakhs into 10%, 5 lakh 50,000 is the interest. 75 lakhs is the equity. Divided by 10 comes to 7 lakh 50,000 is the number of. Income tax rate is everything as basically given in the question. So basically sales minus variable cost contribution minus fixed cost EBIT. What is the sale? 86 lakh. What is the variable cost? Directly we will go to contribution. 25 lakh 80,000. 30 lakh 10,000. 30 lakh 10,000. Comfortable? Sir, fixed cost given in the question as 10 lakh. Up 30 lakh 10,000 minus 10 lakh. 20 lakh 10,000 is the EBIT. Can I reduce interest? 5 lakh 50,000 as the interest. Getting it? So I will be getting EBT of 14 lakh 60,000. Correct, sir? less tax at the rate of 40% comes to 5,84,000. Comfortable? Can I get the PAT? 8,76,000. Right, sir? Super, super. Fantastic, sir. There is no preference dividend, all, nothing. Determine, sir, divided by number of equity shares. So, PAT divided by number of equity shares comes to 7,50,000. Sir, 1.168 per share is the EPS. Can I proceed? Determine company's return on what employed? Capital employed. Pre-tax and EPS. We just calculated the EPS 1.168. So the EPS is 1.168. Now I have to calculate the return on capital employed. Do you know the formula return on capital employed? EBIT divided by capital employed. What is the EBIT? 20,10,000. Capital employed means debt plus equity. Correct? Yes, sir. Equity 75 lakh, debt 55 lakh, 75 plus 55. So 1 crore 30 lakhs. We invested 1 crore 30 lakh. We received 20 lakh 10,000. Comes to 15.46%. This is the return on capital employed. Right. First part of the question done. Second part. Does the company has a favorable what leverage? Financial leverage. What is the financial leverage? We have to find out. Clear? So financial leverage is equal to EBIT divided by EBT. Correct? Yes, sir. What is the EBIT? 20 lakh 10,000 divided by EBT 14 lakh 60,000 comes to 1.38 times. What is the meaning of this? If 1% change in EBIT will lead to 1.38% change in EPS. Good only. This is called as favorable, right, sir? Sir, return on capital employed is 15.46 and KD is only, that means my business is generating 15.46% return, whereas the KD is only 10%. Hence, it is having a favorable financial leverage. Right, sir? Third part of the question. Does operating and combine, sir, calculate operating and combined leverage. Easy. Operating leverage contribution divided by EBIT, which is 30 lakh 10,000 divided by 20 lakh 10,000 comes to 1.497 approx. Can I? Combined leverage is equal to contribution divided by EBT. 30 lakh 10,000 divided by 14 lakh 60,000 comes to 2.06 times 06, 2.06 approx. Financial leverage is equal to already given, already calculated 1.377. Hello, sir. What's the next part of the question? Calculate percentage change in EBIT. If sales increase by, the relevant data is operating leverage. What is the current operating leverage we got? 1.497. Meaning, 1% sales marna 1.497 EBIT marma. Up 10% enna marna? Sales marna 14.97% will be the change in EBIT. Clarity? At what level of sales the EBT of the company will be equal to what? 0. They want EBT to be 0. Correct? So this is the earnings before tax. What? 0. But still we have to pay 5,50,000. So we have to earn EBIT of 5,50,000. Fixed cost will be there 10 lakh. So 10 plus 5,50,000, 15,50,000. Sir, contribution percentage 35%. That means this 15,50,000 will be 35%. Right? So 15,50,000 divided by 35% comes to 44,28,571. So if the company is having a sale of 44,29,000 approx, round off. Are you really with me? That's what they have calculated, man. Sir, that's it with regard to this question. So you know, if you see where we are standing in the FM, sir, the first chapter you have to prepare for your exam is the cost of capital. You know, from this chapter, cost of capital, sure shot 7 mark question is expected. Sure shot 7 mark. Cost of capital. This is the first requirement for the exam. Don't take, sir, selective study. After the cost of capital, capital structure theories like NI approach, NOI approach, traditional approach, and Modigliani and Miller give more importance to Modigliani and Miller. Another, sir, sure shot 5 to 7 mark in examination. The third topic is the EBIT EPS analysis. EBIT EPS analysis. A sure shot 5-mark question from exam. The first compulsory you'll be having. This topic ensure that you are prepared. In these areas and all, I have done the revision now. The number 4, after EBIT EPS, sir, in this Modigliani Miller, sir, arbitrage process is a very important part. Arbitrage process, right, sir? Then after this, sir, EBIT EPS, you can get an indifference point 5-mark question. Indifference point 5-mark question. These are the maximum you will get from the cost of capital. Sir, the 5th one is the leverage analysis. You will surely get, sir, leverage analysis 5-mark question. So this itself covering nearly, man, sir, your 50 to 60% of your exam. Look here, 7 plus 5, 12. 12 plus 5, 17 plus 5, 23 plus 5, 20. So nearly 25 to 30 marks, minimum to max, will be covering from this area. And if you are ready to prepare ratio analysis, dividend decision, sir, capital budgeting, and working capital management, that's it. You are 100% prepared with your FM. So my dear lovable students, in your preparation, do the question which I have chosen, plus try max ICI illustration and book back. That's it. More than enough for examination. Conceptually be very clear. Do the same question again and again. Rather than trying 100 new question, one question you do for 100 times, that will give you a sure shot success. I believe that. It was a wonderful and a fantastic revision of the leverage analysis. In the coming slot, we'll be talking about ratio analysis. Another 6 to 7 mark in your pocket, we will be getting it. We'll meet at the appropriate time. Thank you. Bye-bye from me. Sir, very, very, very happy afternoon to all. So we are doing financial management. In that FM, financial management, we have completed the revision of first one, cost of capital, capital structure theories, arbitrage process, then EBIT EPS analysis. The next one, sir, after the EBIT EPS analysis, indifference point, then leverage analysis. We are pending with, sir, ratio analysis, dividend decision, capital budgeting, and working capital management. In today's session, we are going to knock off ratio analysis. Yes. So the chapter ratio analysis classified into 5 categories. Number 1, liquidity ratio. Number 2, leverage ratio. Number 3, profitability ratio. Number 4, overall profitability ratio. Number 5, TAP ratio, which is turnover ratio, activity ratio, performance ratio. So chapter ratio analysis classified into 5 categories. Number 1, liquidity ratio, leverage ratio, profitability ratio, overall profitability ratio, TAP ratio. Sir, the leverage ratio again classified into 2 categories, capital structure ratio and coverage ratios. Sir, first we are going to talk about liquidity ratio. What are the types of liquidity ratio a firm has to check? Number 1, current ratio. Number 2, quick ratio, liquid ratio or acid test ratio, absolute cash ratio, basic defense interval, working capital ratio. The first one is the current ratio. You know, the purpose or the objective of the liquidity ratio is to check the liquidity of the business. Liquidity of the business. For example, suddenly sundry creditors is coming and asking money. At that time, we can't say that, sir, the money is in fixed deposit. The fixed deposit will mature after 1 month or 6 months or 1 year. You come at that point of time, that will not be applicable. So, how much, sir, current assets I am having to meet the current liability is what the current ratio. So, how much current assets I am having to meet the current liability is what the current ratio. So, current ratio is equal to current asset divided by current liabilities. Next one, inside this current asset, there are 2 types of current asset will be there. Soft current asset and hard current asset. Hard current asset in the sense means it will take more time to convert into cash. Soft current asset in the sense means it will only take less time to convert into cash. So how much current, sir, quick asset I am having to meet the current liability is what the quick ratio or the liquid ratio or the acid test ratio. So quick ratio, liquid ratio or acid test ratio. How much quick asset I am having to meet the current liabilities. How much quick asset I am having. So how much current asset I am having to meet the current liabilities is what? Current ratio. Sir, how much quick asset I am having to meet the current liability is what? Either quick ratio or liquid ratio or acid test ratio. Come to absolute cash ratio. Even in this quick asset, sir, hard quick assets are there and soft quick assets are there. Hard quick assets are, still it will take even more time to convert into cash. So absolute cash ratio means I will see only cash. That's what cash plus marketable securities divided by current liabilities. Cash plus marketable securities divided by current liabilities. So absolute cash ratio is equal to cash plus marketable securities divided by current liabilities. So what is, sir, three ratios? Basically three ratios are there: current ratio, quick ratio, absolute cash ratio. Every ratio is checking only one criteria: to meet my current liability, to meet my current liability, to meet my current liability. How much current assets I am having, how much quick assets I am having, how much cash plus marketable securities I am having. That's what the liquidity ratio. Basic defense interval. Simple. If you are having 5,000 rupees in your hand, daily you are spending 500 rupees for next 10 days, nee tension aga vendi avasiyam illa. That's what basic defense interval. How much quick asset I am having. For example, 5,000 rupees is my quick asset and 500 rupees is the cash expenses per day. I can say that my basic defense interval is 10 days. Sir, what is working capital? After the, sir, once we discuss the working capital management, we can say that, sir, working capital is equal to current asset minus current liabilities. That is the amount which I am going to in my business in various short-term assets are called as current asset. Sir, the amount the outsiders are going to invest in my business are called as current liability. So my investment minus outsiders investment is called as working capital. Are you really with me? These are the main ratios. So logically understand, current ratio. Current ratio is equal to current assets divided by current liabilities. What is its interpretation? How much current assets I am having to meet the current liabilities. What is quick ratio? How much quick assets I am having to meet the current liabilities. What is absolute cash ratio? How much cash and marketable securities I am having to meet the current liabilities. Basic defense interval means, sir, I am having this much of quick asset. How many days it will run without disturbance divided by cash expenses per day. Working capital means current asset minus current liabilities. I am coming to the leverage ratios. There are two types of leverage ratios are there: capital structure ratios and coverage ratios. Because leverage, as we already discussed in the last session, that sales minus variable cost contribution minus fixed cost EBIT. Actually, the analysis from EBIT, sales to EBIT, is the costing subject. Are you really with me? From the EBIT, I have to pay the interest. Sir, from EBIT minus interest, I will get the EBT. From the EBT, I will get the tax. I will pay the tax. Then I will get the PAT, profit after tax. From the profit after tax, if I reduce the preference dividend, I will get the residual earnings divided by number of equity shares. I will get the EPS, which is earnings per share, which is earnings per share. Sir, in the balance sheet, liability side, I will be having equity share capital. For this equity share capital only KE, I will be having reserves and surplus. This is what KR. I will be having debt. This is called as KD. Sir, if I inject debt into the capital structure, sir, my status itself will change. From all equity company, I will become a levered firm. So because of that, my capital structure got affected. That's what capital structure ratio. Sir, if I inject debt into the capital structure, if I inject preference shares into the capital structure, automatically fixed financial cost, sir, will come into the picture. Then I have to take care of the coverage ratio. So that's what I'm going to do. First one is debt ratio. That means my dear lovable students, debt plus equity, I am totally having 100. Out of 100, 30 rupees is my debt means, sir, the debt ratio can be said it as 30%. Simple. Out of the total fund, how much is the debt? How much portion is the debt? That's what debt ratio. Debt divided by total fund. That means out of 100, if 30 is debt, automatically 70 will be equity. That's called as equity ratio. So equity ratio means equity divided by total fund. That is 70 divided by 100. Out of my 100 rupees total fund, 70 rupees is my equity. That is called as equity ratio. My dear lovable students, debt equity ratio means debt divided by equity. Debt equity ratio means debt divided by equity. That means 30 rupees is the debt and 70 rupees is the equity, means 3:7 is what my debt equity ratio. That means if I am having 7 rupees equity in my capital structure, 3 rupees is the debt. That's what debt equity ratio. Because I am talking about capital structure. I am talking about capital structure. Mainly in my capital structure, I will classify the capital structure into debt and equity. Right, sir? So out of the debt plus equity is the total fund. Out of my total fund, how much is the debt is what the debt ratio. Out of the total fund, how much is the equity is the equity ratio. What is the relationship between debt and equity is what the debt by equity. Right, sir? I am coming to the capital gearing ratio. Sir, because of injecting debt into the capital structure, because of injecting preference shares into the capital structure, automatically, my dear lovable students, automatically, sir, the equity shareholders will be having some benefit. Automatically, equity shareholders will be having some benefit. Yes, sir, because for the debt, I have to pay only fixed KD. For the preference, I have to pay only fixed KP. So, since I have to pay fixed KD and fixed KP, sir, equity shareholders will have trading on equity. Equity shareholders will have favorable financial leverage. Are you agree with me? Sir, because of including preference shares and debt in the what structure? Capital structure. Equity shareholders is having benefit. So, what is the gearing portion? Preference share capital plus what? Debt. So, because of including these two guys in the what structure? Capital structure, equity shareholders are getting benefit. So, that's what? Preference share capital plus debt divided by equity shareholders fund. This is called as capital gearing ratio. Proprietary ratio, proprietor, sole proprietor means owner. Out of the total asset, how much is the owner's fund? That's what proprietary fund divided by total asset. Sir, if proprietary fund is 30%, remaining 70% should be debt. That's what debt to what asset ratio? Total asset ratio, which is nothing but debt fund divided by total assets. So, out of total asset, how much is proprietary fund is what? Proprietary ratio. Out of total asset, how much is the debt fund is what? Debt to total asset ratio. Coming to fixed asset to long-term fund ratio. Because generally, we will not pay immediately money and buy the fixed asset. Generally, we will take term loan to buy the fixed asset. That's why such a ratio we are calculating. How much fixed asset we are having and, sir, how much long-term fund. For example, I am having long-term fund of 100 crores and I am having fixed asset of 500 crores. Sir, I am having higher fixed asset. Higher fixed asset. Are you really with me? These are the main capital structure ratio. That means don't say the ratio, say the relationship. Out of the total capital employed, how much debt is there? That is called as debt ratio. How much capital employed? How much equity is there? That is called as the equity ratio. Sir, what is the relationship between debt and equity is what? The debt equity ratio. Sir, because of the presence of the preference share capital and debt in the capital structure, what is the equity? How much is the equity shareholders fund? That's what the capital gearing ratio. That means preference share capital plus debt divided by equity shareholders fund is what the capital gearing ratio. Out of my total asset, sir, how much fund belongs to the proprietor is what the proprietary ratio. Out of the total asset, how much fund belongs to the debt holders is what the debt to total asset ratio. Sir, always, sir, fixed asset, I will be buying by taking loan. So what is the relationship between fixed asset to long-term fund is what? Fixed asset to long-term fund ratio. That's it. Sir, if you inject debt and if you inject preference shares into the what structure? Capital structure. My dear lovable students, or sir, surely, sir, I am liable to pay interest. Surely, I am liable to pay preference dividend. These are fixed commitments. What commitment? Sir, if you are having fixed commitment, you should ensure that the organization will never face difficulty to pay the interest and the preference dividend. That's why I'm very concerned about the coverage ratio. First one is debt service coverage ratio. Debt service. My dear lovable students, the return on investment is the EBIT, earnings before interest and tax. But this EBIT is not only available to the debt holders, this will be available to the debt holders, this will be available to the government, this will be available to the preference shareholders, and this will be available to the equity shareholders. I'm talking about debt service coverage ratio. So out of EBIT, how much money I can use to serve the debt is what I should take as numerator. That's why earnings for what service? Debt service. I cannot take EBIT because I am not, sir, going to consider the equity and preference. I'm going to consider only the debt. So the earnings available for debt service divided by interest because this is what I'm going to pay, plus installment. Generally, I will pay the installment from my PAT, profit after tax, because it's a principal repayment, right, sir? So it will be after tax item. Sir, earnings for debt service is a before tax item. Interest is a before tax item. Installment divided by 1 minus T is also a before tax item. It's a after tax item. I should convert into before tax item. That's why divided by 1 minus T. So the debt service coverage ratio is equal to earnings available for debt service divided by interest plus installment divided by 1 minus T. Right, sir? Then coming to the interest coverage ratio. You know, sir, EBIT minus interest, you will get earnings before tax. One thing is very sure, I will pay the interest from EBIT. Are you really with me? For example, if I am having EBIT of 1 lakh and I am liable to pay interest of how much? 5,000. That means 1 lakh divided by 5,000 is equal to 20 times is what my interest coverage ratio. Sir, if I am having interest coverage ratio of 20 times, no need to worry at all. Because my company is in very safe position. Because, sir, if EBIT comes down by 1 or 2 times, no need to get tense. Because my coverage is 20 times, my dear lovable students. Coming to preference dividend coverage ratio. Sir, from the EBIT, we will pay interest. We will get earnings before tax. From that, we will pay the tax. We will get the PAT. From the PAT only, we will pay the preference dividend. So, how much PAT I am having to pay the preference dividend is what the preference dividend coverage ratio. For example, my PAT example is 1 lakh and PAT, sir, preference dividend is 10,000, my dear lovable students. 1 lakh divided by 10,000, 10 times coverage I am having. So, if 1 or 2 times, if the PAT falls, sir, no need to worry at all because my coverage is 10 times. That's why PAT divided by preference dividend. Fixed charges coverage ratio. Fixed charges. That means I will consider, sir, what is the money available to meet the, sir, fixed charges. If you see, my current ratio is equal to current asset divided by how much current assets I am having to meet the current liability. So my current liability with regard to debt is interest and installment. But installment is a post-tax item. So I'm converting that into pre-tax item. Now the interest also become pre-tax item. This also become pre-tax item. Right, sir? Sir, basically in the numerator, how much money available with me? That means sales minus variable cost, contribution minus fixed cost is EBIT. Am I right, sir? This EBIT is after fixed cost. This fixed cost consider cash fixed cost and non-cash fixed cost. Non-cash fixed cost like depreciation. Depreciation is a non-cash item. So, EBIT would have been reduced, but cash component would not have been reduced. That's why to this EBIT, I am adding back the depreciation. Are you really with me? Then I will get EBIT plus depreciation, which is nothing but cash flow from operating activity. Cash flow from operating activity divided by basically, sir, this is cash flow from financing activity. Cash flow from operating activity divided by cash flow from financing activity is what the fixed charges coverage ratio. Is what the fixed charges coverage ratio. Right, sir? So, my dear lovable students, the first coverage ratio, debt service coverage ratio. That means in order to serve the debt, how much, sir, resource I am having. Sir, not cash I am having. How much earnings I am having. Earnings means after depreciation. Correct? So, earnings available for debt service divided by interest plus installment divided by 1 minus T. Interest coverage ratio, from where I will pay the interest, EBIT. That's why EBIT divided by interest. Sir, preference dividend coverage ratio means in order to pay the preference dividend, how much PAT I am having is what preference dividend coverage ratio. This is fixed charges what ratio. This I am analyzing from the cash angle, not from the earnings angle. That's why how much cash I am having, that is EBIT plus depreciation, to meet the interest plus installment divided by 1 minus T. Are you really with me? So fixed charges coverage ratio we are analyzing from cash, and debt service coverage ratio we are analyzing from profit or earnings. Are you really with me? I'm coming to the profitability ratio, my dear lovable students. Everyone knows that GP ratio is equal to GP divided by sales into 100. Sir, the opposite of GP, because sales can be classified into two categories, GP and cost of goods sold. Sir, if the GP is GP divided by sales into 100, cost of goods sold means cost of goods sold divided by sales into 100. Right, sir? That means if GP is 100, sales is 100% and GP is 30%, 70% will be the cost of goods sold. So the formula for cost of goods sold is cost of goods sold divided by sales into 100. Right, sir? These both are, sir, dealing with the trading account. Are you really with me? Coming to the profitability of the P&L account, we are having net profit. In P&L account, we will consider the tax. Are you really with me? So the net profit will be considered before tax and also after tax. Are you really with me? Sir, it's like before food and after food sugar checking, my dear lovable students. So net profit before tax divided by sales into 100 and net profit after tax divided by sales into 100. Generally, net profit before tax will always be higher than the net profit after tax. Right, sir? The difference between net profit before tax and net profit after tax, the difference will be tax. Comfortable? Financial expenses ratio. Sir, as a concern, we are supposed to incur so much of financial expenses, like, sir, I have to pay interest, I have to pay discount on sir, debt, I have to pay premium on redemption of debentures. So many financial expenses I have to incur, the expense relating to finance. So how much percentage I am incurring? So financial expenses divided by sales into 100. It does not include loss due to theft, goods destroyed by fire and all, because these all are abnormal item. Include only the normal item. Are you really with me? Now, very important, man, operating profit ratio. My dear lovable students, sales minus variable cost, contribution minus fixed cost, NIT. EBIT, sir, from sales to EBIT is what? Operating leverage. And EBIT is otherwise called as operating profit. EBIT is otherwise called as operating profit. What profit? So that's why, so operating profit ratio means operating profit divided by sales into 100, or rather technically EBIT divided by sales into 100. Comfortable? So we are having one income ratio and expenses ratio. Sir, gross profit ratio bar cost of goods sold ratio. GP ratio, GP divided by sales into 100. Cost of goods sold ratio, cost of goods sold divided by sales into 100. Net profit ratio. Sir, net profit is there in the P&L account and financial expenses are also there in the P&L account. So net profit ratio, net profit divided by sales into 100. Financial expense ratio, financial expense divided by sales into 100. Operating profit ratio, sir, operating profit or EBIT divided by sales into 100. The opposite of operating profit is the operating cost. Operating cost. You should understand one thing. Operating cost is equal to cost of goods sold plus, because this cost of goods sold will be there in the trading account, right? In your P&L account, two expenses will be there. Number one, operating expenses and non-operating expenses. So cost of goods sold plus operating expenses is called as operating cost. Operating cost. So operating cost ratio is equal to operating cost divided by sales into 100. So operating profit or the opposite the operating cost. Coming to the PV ratio, marginal costing, we are specialized in that. Sir, contribution divided by sales into 100. Sir, sales minus variable cost contribution. Sir, contribution divided by sales into 100 is called as profit volume ratio. Coming to variable cost ratio, variable cost divided by sales into 100. Variable cost divided by sales into 100. Comfortable? I'm coming to the overall profitability ratio. Overall profitability ratio. Sir, till now I was simply talking about the normal profitability ratio. GP ratio, gross profit divided by sales into 100. Meaning, out of sales, how much percent is gross profit? How much percent is gross profit? Sir, what is cost of goods sold ratio? Out of sales, how much percent is the cost of goods sold? Net profit ratio, how much out of sales, how much percent is the net profit? Sir, financial expense ratio, out of sales, how much percent is the financial expenses? Operating profit ratio, out of sales, how much is the operating profit? Operating cost ratio, out of sales, how much is the operating cost? Sir, profit volume ratio, out of sales, how much is the contribution? Sir, variable cost ratio, out of sales, how much is the... That means every profitability ratio is attached with sales. Every profitability ratio is attached with. I'm moving into a very important calculation called as, sir, overall profitability ratio. What ratio? Overall profitability ratio means, sir, I am going to check the return on investment. I am going to check the return on equity and I am going to check the return on asset. So basically return divided by investment, return divided by equity and return divided by asset. Sir, if you check the profitability ratio, I took GP, I took cost of goods sold, I took NP, I took financial expenses, I took operating profit, I took operating cost, I took contribution, I took variable costs, everything from the P&L account. That is both numerator and denominator are from the P&L account. So the comparison between two P&L item, but in overall profitability, I will consider P&L and balance sheet. For example, return will be P&L item and investment will be balance sheet item. Are you really with me? So basically this is going to be a P&L divided by balance sheet. Sir, return on investment. Sir, simple sir. Sir, sales minus variable cost, contribution minus fixed cost, EBIT. Right sir? This EBIT is the return before tax. Before you are paying tax, this is the return of a business. So pre-tax return on capital employed. What tax? Pre-tax. Before you are paying tax, company is earning EBIT. Sir, in order to enjoy this EBIT, company have invested what and what? Equity. So EBIT divided by equity plus debt. So which is nothing but, man, sir, return on investment is equal to return divided by investment. What is the return before tax? EBIT. Sir, what is your investment? Debt plus equity. That's it, game over. Sir, if it is post-tax return on investment, sir, post-tax is equal to return divided by investment. Investment will not change. What and what? Equity plus debt. After paying tax, sir, interest we will get. Right? Debt holders will get interest and equity shareholders will get PAT. So basically the return will be PAT plus interest divided by equity plus debt. Divided by equity plus debt. I am coming to return on equity. Sir, look at here, man. We know we are having EBIT. From the EBIT, if you reduce interest, you will get EBT. Minus tax, you will get the PAT. From the PAT, if you reduce preference dividend, you will get the residual earnings. Divided by number of equity shares is what? EPS. Are you all really with me? So, my dear lovable students, sir, my question is, what is the return on equity? Residual earnings, sir. Preference dividend, sir, or PAT. What is the return? For equity shareholders, residual earnings is the return. Right, sir? Sir, what is pre-tax return on equity? Sir, which is return divided by equity. Denominator will be equity. Sir, profit before tax. Profit before tax. Look at here. Profit before tax. Because from profit before tax, I am only paying what? Tax. Then I am paying only preference dividend. Correct. So, post-tax means after payment of tax. PAT is the return, I can say, for NSR after paying tax divided by equity. So, two things we done. Number one, return on investment and return on equity. Sir, like this we can consolidate. Sir, you try to say return on investment classified into two categories. Number one, pre-tax and post-tax. What is the return pre-tax? EBIT divided by investment, debt plus equity. What is the post-tax? Interest plus PAT divided by debt plus equity. That's it, game over. Sir, return on equity classified into two categories. Number one, pre-tax and post-tax. Comfortable? Sir, for a equity shareholder, pre-tax is the profit before tax divided by equity. And post-tax is PAT divided by equity. Comfortable? Yes. A return on asset, sir. Sir, assets will generate EBIT. Assets will generate EBIT. So the pre-tax return is EBIT divided by average total asset. Comfortable? Post-tax, sir, assets will generate what? PAT divided by average total assets. Are you able to appreciate, sir? That's it. So the next one also done. The third one also done. The third one is a return on asset. A return on asset classified into two category, pre-tax and post-tax. What is with regard to pre-tax? EBIT divided by average total assets. What is with regard to post-tax? PAT divided by average total assets. PAT divided by average total assets. Comfortable? Sir, what is sir, based on EPS and dividend? Super, sir. Sir, as we all know that sales minus variable cost contribution minus fixed cost EBIT. From that EBIT, pay the interest. You will get the earnings before tax. Pay the tax. You will get the PAT. From the PAT, we will pay the preference dividend. Right, sir? Then you will get the residual earnings. This is the earnings available to the equity shareholders. Divided by number of equity shares is what this portion is what they are asking. EPS means residual earnings divided by number of equity shares. Sir, if EPS is 10 rupees, my dear lovable students, company will not give the entire 10 rupees to the equity shareholders. Out of this 10 rupees, if company gives only 6 rupees as dividend, total equity dividend 6, sir, sorry, total dividend, for example, they have given 60,000 rupees total dividend. Total dividend declared during the year is 60,000. And company is having 10,000 equity shares. 60,000 divided by 10,000 comes to 6 per share is the DPS. Is the DPS, dividend. So what is the EPS? EPS is equal to 10. What is the DPS? That means out of how much rupees earned? 10 rupees earned. Company give a 6 rupees dividend. So 6 divided by 10 into 100 comes to 60% is the dividend payout ratio. That's what DPS divided by EPS into 100. Comfortable? Sir, as a shareholder is investing in any company for return. Yes, sir. So for a shareholder, the yield means return. Yield means what? So from the angle of the shareholder, the return what you are getting is DPS. DPS. In order to enjoy this DPS, he has to invest today's MPS. So this is called as yield. Yield means what? Return. Are you with me? Return means return by investment. Right, sir? A return divided by investment. This is from the angle of the shareholder. So this is the yield of the shareholder. Yield of the shareholder is equal to cost of the company. That's what K. K is equal to DPS 1 divided by MPS 0 into 100. Exactly tallying. Are you with me? Sir, earnings yield means, sir, the shareholder is not looking for dividend. Shareholder is looking for earnings. Earnings. So according to him, EPS is the return. In order to enjoy the EPS, he has to invest MPS. So EPS divided by MPS into 100. That means this is nothing but KE under the earnings price approach. This is under dividend price approach. So you know you are able to appreciate. Right, sir? That's it. Coming to the based upon market ratios. Price earning ratio. Sir, price earning ratio means price divided by earnings. Price earning ratio. Price divided by earnings. What price? Market price. Divided by what? Earnings. For example, sir, my share is having an EPS of 10. Sir, and market price is 100. That means 10 times. A share who are generating an EPS of 10 is having a value of 10 times in the market. That's what price earning ratio. Book value per share accounting formula, which is nothing but net worth divided by number of equity shares. Are you really with me? Yes, sir. Sir, how much the company is having what? Net worth. Net worth in the sense means company's asset, which is nothing but assets minus liabilities is equal to net worth. For example, if you take balance sheet, here you will be having total asset. Here you will be having liabilities. Right, sir? Total liabilities. I am talking about liabilities. Sir, from the total asset, if I reduce the liability, I will get the net worth. Net worth is nothing but the equity share capital plus preference share capital plus reserves and surplus something, etc. So this net worth divided by number of equity shares will give you book value per share. It will give you book value per share. Comfortable? Then, my dear lovable students, market value to book value means, sir, book value is, for example, 10, but market value is 50. The reflection, the market reflection is 5 times. Are you together with me? If I am seeing the reflection based on EPS, then it is price earning ratio. If I am seeing the reflection based on my book value, it is market value to book value. That's it. That's it with regard to that area also. Comfortable, sir? I'm coming to the, sir, tap ratio, which is nothing but working capital management, which is nothing but working capital management. Because in working capital management, sir, there will be raw material. That raw material will be converted into WIP. That WIP will be converted into finished goods. That finished goods will be converted into debtors. And that debtors, sir, I have to pay off, right? This raw material would have been supplied by creditors. And from this debtors, I will get cash. And this cash will be repaid to the creditors. This is called as working capital cycle. This is called as working capital cycle, right? For example, my dear lovable students, what is working capital cycle? Sir, in capital budgeting, I can say that I have to go and purchase a plant and machinery by investing 50 lakh. How I am going to invest in a 50 lakh rupees plant and machinery? The same way, in order to run my business, I have to invest in raw material. I have to invest in WIP. I have to invest in finished goods. I have to invest in debtor. I have to invest in cash. And certain investment will be bared by outsiders, called as creditors, called as, sir, expenses, employees, called as, sir, expenses outstanding. So I am going to look raw material turnover ratio. Raw material. I am going to check the performance of the raw material. You just tell me, my dear lovable students, after I invest in raw material, this is what actually happening. The factory can be classified into 3 categories. Inside the factory, you will be having 3 places. Number 1, stores. Number 2, work area. And number 3 is the warehouse. Number 3 is the warehouse. Sir, after you invest money in raw material, if the raw material are there inside the stores itself, that means it's bad. Very bad. What is the performance of the stores is what the raw material turnover ratio. What is the performance of the work area is what the WIP turnover ratio. What is the performance of the warehouse is what the finished goods turnover ratio or stock turnover ratio. Right, sir? So how to check the performance of the raw material, that is stores, by checking raw material turnover ratio? Basically, generally, I will tell you, any turnover ratio, what man? Any turnover ratio is equal to turnover divided by that particular item. Are you really with me? That means with this available resources, how much turnover I generate. That's what turnover ratio. With this available resources, how much turnover I generate. That's what my performance. My performance means turnover. Alright, sir. Sir, if my business is having turnover of 500 crores means, wow, that shows your performance. I am saying only but there is no turnover. That means you don't have performance at all. Are you really with me? So, generally, sir, any turnover ratio means turnover divided by that particular resource. With this available resource, how much turnover I generate? For example, I will show you. Look at here, man. Capital turnover ratio. Capital, which is nothing but turnover divided by capital employed. For example, I made capital employed of 100. I made turnover of 500. Means, wow. That means my turnover is 5 times of my capital employed. It's showing good. I invested only 100. Sir, next one. Fixed asset turnover ratio. Fixed asset turnover ratio is equal to turnover divided by fixed asset. Are you totally with me? That means, or that shows that with the resources of fixed asset, how much turnover I made. Are you really with me? That shows my performance. Sir, I'm having 100 rupees of, sir, fixed asset. I made 1000 rupees turnover. Wow. I made turnover of 10 times of my fixed asset. Generally, turnover ratio means turnover divided by resources. With this much of resources, how much turnover I made. Right, sir? Yes, sir. Working capital turnover ratio, which is nothing but turnover divided by net working capital, which is nothing but, sir, I have invested this much net working capital. With this much working capital, how much turnover I made? For example, 100 rupees is the working capital I have invested. Sir, why you have invested 100? That's what working capital management chapter, right, sir? Which is nothing but current asset minus current liabilities. There we will be talking about estimation of working capital. Am I right? With this, if I make 2000 rupees as turnover, that means 20 times. Wow. That means with the available resources of 100, I made, sir, 20 times as turnover. Brilliant. Now, sir, raw material, sir, I will not sell the raw material. I will consume the raw material. I will, sir, WIP, I will not sell the WIP. I will incur the cost for WIP. Finished goods, I will sell the finished goods, but my dear lovable students, the sales include profit also, right, sir? Debtor means, sir, it is connected with the credit sales. It is connected with the creditors means it is connected with the credit purchases. அப்ப எப்படி சார் நீங்க பார்க்க போறீங்க? What raw material turnover ratio. So here I am seeing that this is the analysis I am going to make. What is the performance of the stores? Performance of the stores. For example, sir, working capital turnover ratio is equal to sales divided by இதோட interpretation. With this much of working capital, I made this much of sale. So my resource available is the working capital. So I am comparing my sales with the working capital. Clarity. For example, fixed asset turnover is equal to fixed asset divided by, turnover divided by fixed asset. Are you really with me? Turnover divided, sales divided by fixed asset. So with this much amount of fixed asset, how much turnover I made? So the resource available is what? Fixed asset. Inga raw material turnover ratio means I can't take sales divided by raw material because I will not sell the raw material. I will consume the raw material. That's why raw material consume divided by stock of raw material. But I will be having opening stock of raw material and closing stock of raw material. That may be different. I am not interested to take either the opening stock nor the closing stock. I will take the average stock of raw material. That means this average stock of raw material is the resources. Yes, sir. With this resource, how much times I have consumed the raw material. It shows if it is, sir, if the performance is good, it will be showing multiples like 5 times, 10 times, 12 times, 13 times. Are you really with me? Coming to WIP turnover ratio. WIP is related to my factory work area. There, I will not sell the raw material. I will not consume the raw material. I will be incurring all the elements of cost, such as, sir, material, labor, overhead, everything, right, sir? So, my dear lovable students, factory cost divided by average stock of WIP. Average stock of, sir, with this much of resources, average stock of WIP, how much, sir, factory cost I have incurred? That shows the performance of the WIP because this is TAP ratio, either turnover ratio or activity ratio or performance ratio. With regard to, sir, finished goods turnover ratio or stock turnover ratio, what I have to take generally is the sales divided by average stock of finished goods, right up. Sir, actually finished goods is for sales only, but sales include profits. Profit, sir, profit is an extra amount which I am getting as a return. That will not mark my performance, right up. So I will not take sales, instead I will take the cost of goods sold. That's why cost of goods sold divided by average stock of finished goods. Average stock of finished goods. Comfortable? So tell me, what is raw material turnover ratio? Cost of raw material consumed divided by average stock of raw material. WIP turnover ratio, factory cost divided by average stock of WIP. Finished goods turnover ratio, cost of goods sold divided by average stock of finished goods. Coming to debtors turnover ratio. Coming to, my dear lovable students, sir, when debtor will come? When I make the credit sales. When I make the, so credit sales divided by average accounts receivable. This is my resources. This is my resources. For example, if the credit sales I made is 10 lakh and average accounts receivable is 1 lakh, I can say that 10 times is the debtors turnover ratio. 10 times is the 10 times debtors turnover ratio means, sir, in an year, 10 times debtors has rotated. 10 times debtors has abdina. Sir, for example, on 1st of April, I start selling. Sir, 10 times, 360 days in a year. For example, 360 divided by 10 comes to 36 days. Correct? If I make credit sales today, I will get payment from debtors after how many days? 36 days. One round over. Then again, I will make credit sales. I will get money after 36 days. Second round over. Are you really with me? If I make credit sales today, I will get the payment after 36 days. Like that in a year. How much time I made credit sale? 10 times. 10 times. If the turnover is more means I'm getting quickly money. Tuck, tuck, tuck. I'm realizing the money. Are you really with me? So debtors turnover ratio is equal to credit sales divided by average accounts receivable. Average accounts receivable. Comfortable? And if I make credit purchases, my dear lovable students, sir, creditors will come. Correct? Creditors turnover ratio means after goods supplied by the creditor, sir, within how much time I have paid. That is creditors, sir, payment period. Creditors, in an year, how much creditors has been rotated? That's what credit purchases divided by average accounts payable. Average accounts payable. For example, I have made total credit purchase of 1 crore and 10 lakhs, sir, for example, 5 lakhs is the average accounts payable. 1 crore divided by 5 lakhs comes to 20 times is the creditors turnover ratio. That means, hello sir, sir, if today creditors supply the goods to me, correct? 360 divided by 20 comes to 18. Within 18 days, I made the payment. Then again is supplied. 18 days, I made the payment. Again is supplied. 18 days, I made the payment. Again is supplied. 18 days, I made the payment. Like that, I have done this activity for 20 times. That is called as creditors turnover ratio. Creditors turnover ratio. Right, sir? If the same turnover ratio, if you express in days, it is called as, sir, holding period. What period? So the same thing can be ulta. You can say in the holding period. It is way of expression. நான் என்ன சொல்றேன்னா, in an year, sir, 8 times is my raw material turnover ratio. 8 times. Or I can say that, sir, 360 divided by 8 comes to 45 days. That means once I purchase what material? Raw material. It is there in my store for 45 days. After 45 days only I will consume. So there is a blockage. There is a lockage of the raw material for next 45 days. Purida. So either I can say in times or I can say in days. If I am saying times is called as turnover ratio. If I am saying days is called as holding period. So raw material turnover ratio is equal to raw material consumed divided by average stock of raw material. Comfortable? Sir, I can say the same thing. I can say the same thing. For example, sir, what is give one example for raw material consumed, which is 10 lakh. What is a raw material consumed? That means 2 lakh is the average stock of raw material. So my example. So 10 lakhs divided by 2 lakh comes to 5 times is the raw material turnover ratio. This means, my dear lovable students, 360 divided by 5 comes to 72 days is the raw material holding period. That means if I purchase raw material today, I will keep the raw material in the stores. In the stores, it will be there for 72 days. So, inga paru, ingirundhu ஆரம்பிக்கும் 1st of April இருந்து. First once it over 72 days, we will issue to the factory. Then calculator 72 plus 72, 144. On the next 144th day, again second issue will happen. 144 plus 72, 216. On the next, sir, 216th day, we will third issue will happen. Sir, next one, sir, 216 plus 72, 288. On the 288th day, fourth issue will happen. 288 plus 72, 360. That's it. Year comes to an end. So 1, 2, 3, 4, 5. That's what 5 times is the raw material turnover ratio. Both are same. So if you are saying in the rotation turnover, that is called as raw material turnover ratio. If you want in days, you can say it as raw material holding period. Raw material holding period. Right, sir? The same abulta, திருப்பி போட்டா என்ன வந்துரும்? Holding period வந்துரும், which is nothing but average inventory of raw material. So you say the original formula. You say the raw material turnover ratio is equal to raw material consumed divided by average stock of raw material. Right, sir? Sir, let me ask you a very simple question. You are having 1 lakh rupees cash with you. 1 lakh rupees cash with you. Daily you are spending 5,000 rupees for your tea, coffee, rubber, this, that, etc., etc., etc. Hello, sir? 1 lakh divided by 5,000 means 20 days. No need to worry for anything. So you are having next 20 days money with you. Sir, எப்படி நான் போட்டேன்? Sir, the money available with me divided by cash expenses per day. Cash expenses? The same. What is the stock available with me? That's what average inventory of raw material. That's what average inventory of. That means I'm having average stock of, for example, 3 lakh rupees average stock is with me. I don't want raw material consumed because this raw material consumed will be for 1 year. Yes, sir. I don't want raw material consumed. I want raw material consumed per day. For example, here, if I take the cash expenses, it's for 1 year means 360 into 5,000 will come. Correct? I don't want the total expense for a year. I want the per day. That means, sir, raw material consumed divided by 360. Divided by 360. Correct? Dane? Raw material consumed divided by 360. Then I will get the raw material consumed per day. Sir, can I bring the denominator 360 to mele? Yes, sir. எப்படி எடுத்துட்டு வரலாம்? 3 lakh into 360 divided by raw material consumed. Divided by raw material. Sir, like this also I can say, are you really with me? Yes, sir. So, I will get the raw material in a period, holding period. So, listen, once you understand one thing, all the remaining will be a cakewalk. Okay, don't by heart the formulas. Don't by heart the formulas. Getting the logic. Sir, with regard to raw material, I am going to find out the performance of the stores. I am going to find out the performance of the stores. Sir, if I want to say the performance in times, I will call it as raw material turnover ratio. If I want to say the performance in days, I will call it as raw material holding period. Correct? How I will see the performance? Raw material turnover ratio. Raw material turnover ratio is equal to raw material consumed divided by average stock of raw material. Comfortable? Sir, raw material, what period? Holding period is equal to, sir, average stock of raw material divided by raw material consumed per day. Raw material consumed per day. Raw material. For the entire question, assume 360 days, my dear lovable students. Hello, sir. Tell me, sir, can I assume that raw material consumed as 10 lakh? Can I assume that average stock is equal to 2 lakh? Like that, can I go? Okay, man. Sir, can I calculate the turnover? What is the raw material consumed? 10 lakhs. What is the average stock of raw material? 2 lakhs. So, 10 lakhs divided by 2 lakh comes to 5 times. What is the meaning of 5 times? In every year, sir, 5 times I rotated the raw material. I rotated the raw material for 5 times. Ennachana, I purchased raw material, kept in stores. Hello, sir. Get out. Get out. In the sense means it went to the factory. Again, I purchased the raw material, kept in stores. Second time, get out. Third time, purchase the raw material, kept in stores. Get out. Fourth time, purchase the raw material, kept in stores. Get out. Fifth time, I purchased the raw material, kept in stores. Get out. Year over. That means this activity I performed for 5 times. That's what raw material turnover ratio. The same thing. So, let me ask you a question. Between one time, how many days the stock was there in the source? That's what raw material holding period. So, between two legs of activity, நீங்க வாங்குனீங்க, get out பண்ணீங்க. இதுக்கு இடையில எத்தனை நாள் அது அதுக்குள்ள இருந்துச்சு? எதுக்குள்ள? Source-குள்ள. That's what raw material holding period. So, raw material holding period is equal to average stock of raw material comes to 2 lakhs, sir, divided by, sir, what is the raw material consumed? 10 lakh. So, 10 lakhs divided by 360 means every day I have consumed 1,000, 2,000, 777.77, right? So, calculator, man. 2 lakhs divided by, please put the full figures, then only you will get the full answer. 2 lakhs divided by 2,777.7 comes to 72 days. So, between one activity, one round of activity, raw material was there in the stores for 72 days. 72 days. The same can be found out by way of or. Sir, do you know raw material turnover ratio? How many time? 5 times. How many number of days? Number of days as per my example, 360 days. Right, sir? That means, my dear lovable students, sir, raw material in a period, holding period is equal to 360 divided by raw material turnover ratio is equal to 360 divided by 5. Then also you will get 76 days, 72 days. Right? Which is nothing but, my dear lovable students, inga vaanga, sir, raw material turnover ratio is there. Raw material turnover ratio is equal to raw material consumed divided by average stock of raw material. Right up. Sir, raw material holding period is equal to average stock of raw material divided by raw material consumed per day. Raw material, or rather average stock of raw material consumed per day. Average stock of raw material, sir, average stock of raw material consumed per day. Clarity? Since the numerator is average, denominator also should be average. Right? So you tell me, very simple man, how to find out the average stock of raw material? How to find out the average stock of raw material? Raw material consumed divided by 360 days. Right? So this formula I can rewrite as, hello sir, sir, raw material holding period is equal to average stock of raw material divided by raw material consumed divided by 360. Comfortable? This can be rewritten as raw material holding period is equal to average stock of raw material into 360 divided by raw material consumed. Right, sir? Are you really with me, sir? Sir, let me ask you a question. Is there any rewrite? Sir, average stock of raw material divided by raw material consumed into 360. Sir, pakka? Otherwise, it will apply only for the numerator. Ipu numerator da neliya. Ipu numerator da. But presentation is like this. Sir, my dear lovable students, come on, sir. What, sir? If I am having raw material, what ratio? Turnover ratio. Can I find out the raw material holding period by indirect formula? If this is how much time? 5 times, which is nothing but 360 divided by raw material turnover ratio, which is nothing but 360 divided by, what is raw material turnover ratio? Raw material consumed divided by average stock of raw material. Are you really with me? If I reverse this, 360 into average stock of raw material divided by raw material consumed, 360 into average stock of raw material divided by raw material consumed. Hence proved. Are you really with me? This is how it is working. Derivation of the formula. Are you really with me? So, in an year, my dear lovable students, how much time you have rotated the activity is called as raw material turnover ratio. Appreciate Pandriya. In between two rotations, how much time the stock was there in the stores is what? Raw material holding period. Comfortable? Yes sir, yes sir. That's it. Sir, coming to raw material holding period in months, Chi, instead of 360 divided by 12 divided by raw material turnover ratio. Raw material holding period in weeks, 52 weeks divided by raw material turnover ratio. Raw material holding period in days, 365 divided by raw material turnover ratio. Average cost of raw material consumed per day. Sir, raw material consumed divided by number of working days in a year. Are you all really with me? Comfortable? That's it. Come to WIP holding period, my dear lovable students. That means what I am going to check is, I am having 3 places in the factory, right? In that 3 places, my dear lovable students, place number 1 is the stores. Place number 2 is the work area. Place number 3 is the godown. Sir, I will purchase the raw material and keep in the stores. After I keep in the stores, I will issue this raw material to the work area. Am I right? Yes, sir. So, raw material comes to the work area. Sir, labor comes to the work area. Overhead comes to the work area. Right? Now is the work completed or work going on? Work going on. That is called as WIP. Once the work is completed from the work area, I will transfer to the godown as finished goods. Right? Sir, from stores, every elements of production came to where? Work area. After completing the work, time, it gone out of the work area. How much time came in, gone out? Came in, gone out. Came in, gone out. This is called as WIP turnover ratio. Comfortable? Sir, the distance between the came in and gone out, that means how much days that item was there inside the work area is called as WIP holding period. எத்தனை நாள் அது ஃபேக்டரிக்குள்ள ஹோல்ட் ஆச்சு? புரியுதா? Simple, the same thing you can do the formulas. Sir, I'm not deriving all that. So WIP holding period, tell me average stock of WIP divided by average factory cost per day. Sir, it can be expressed even in what also? Months also. What is the formula? 12 months divided by WIP turnover ratio. Indirect formula. Yeah. WIP period in weeks na 52 weeks divided by WIP turnover ratio. WIP holding period 365 days divided by WIP turnover ratio if it is in days. Correct? What is the average cost of WIP? Factory cost divided by number of working days in a year. Right, sir. Next one, inventory velocity. I will use the word velocity. What, man? Velocity means the period for which the revenue from operation can be generated with the help of என்ன inventory maintain and expressed in terms of period. That means என்னன்னா inventory velocity na sir average inventory என்னது divided by sir cost of what per operation? Cost of goods sold per day. Cost of goods sold per day. Cost of per day. What does this indicate? What do you mean by inventory velocity? How much days the inventory finished goods was there in the godown? So from the work area, what will come? Finished goods will come to the godown. From the godown, it will go out to the customer. To the customer. வந்துச்சு போயிச்சு ரிப்பீட் வந்துச்சு போயிச்சு ரிப்பீட் வந்துச்சு போயிச்சு ரிப்பீட் how much time வந்துச்சு போச்சுங்கிறதா ஸ்டாக் டர்ன்ஓவர் ரேஷியோ சார் வந்து போறதுக்கு ஒரு டைம் எடுத்துருக்குல்ல எத்தனை டைம் அது கோடவுனுக்குள்ள இருந்துச்சுங்கிறதா inventory holding period. Sir, this can be find out. Inventory velocity can be find out by average inventory divided by average cost of goods sold per day. Or inventory velocity in months means 12 months divided by inventory turnover ratio. In weeks means 52 weeks divided by inventory turnover ratio. Right, sir? Inventory velocity in days means 365 days divided by inventory turnover ratio. Average cost of NSR inventory means COGS divided by 360 days or number of working days in a year. Are you all really with me? Now, debtors collection period or trade receivables velocity. Right. Raw material you convert into WIP. WIP you convert into finished goods. Finished goods you will convert into debtors. Once I sell debtors today, within how many days my debtors are paying me cash? That's what debtors collection period. Debtors. Sir, debt collection period shows the average period for which credit revenue from operation remain outstanding. Hello, sir? It indicates rapidly or slowness within which the money is collected from the trade receivable. So, every debtors collection period, how you will calculate? Debtors collection period is equal to average trade receivable divided by average credit sales per day. Average. So, debtors collection period months la venuna 12 divided by debtors turnover ratio. Weeks la venuna 52 weeks divided by debtors turnover ratio. Days la venuna 365 days divided by debtors turnover ratio. எப்படி சார் average credit sales per day calculate பண்ணுவேன்? Total credit sales divided by number of working days in a year. Right, sir? Sir, creditor. What is creditors analysis? No, I am purchasing raw material from creditor. After a certain point of time, I am repaying. So, how much time purchase repaid? This is called as creditors turnover ratio. After purchase to repay, I would have taken certain time. How much time I have taken? That is called as creditors payment period. Creditors payment period, which is nothing but average debt payment period is equal to average trade creditors divided by average credit purchases per day. அதே உனக்கு மந்த்ஸ்ல வேணும்னா சிம்பிள் டோட்டல் எவ்வளவு மாசம் 12 divided by creditors turnover ratio. Right, sir? Weeksல வேணும்னா 52 weeks divided by creditors turnover ratio. If you want in days 365 days divided by creditors turnover ratio. Sir, average credit revenue from operation means credit purchases per day means sir total credit purchases divided by number of working days in a year. Are you all really with me? Pakka, sir. That's it with regard to all the ratio. Within 5 minutes. I don't want the ratio. I want its analysis. 5 to 7 minutes. Can we quickly do it? Come on, man. Sir, I will say a ratio. I don't want current asset. Current ratio means current asset divided by current liability. Such by heart, I don't want. You say it is what on what? Current ratio. How much current assets I am having to meet the current liabilities? Quick ratio. How much quick asset I am having to meet the current liabilities? Absolute cash ratio. How much cash and marketable securities I am having to meet the current liabilities? Basic defense interval. Any ratio? Sir, quick asset divided by cash expenses per day. That means how many days I can survive. Even not even 1 rupee come into my business. அப்பா அம்மா வீட்டுல இருந்து காசு அனுப்பலனா கூட அடுத்த 10 நாளைக்கு டீ குடிக்க பிச்சை எடுக்க வேண்டிய அவசியம் இல்லை. Are you really with me? What is working capital? Current assets minus current liabilities. Current assets is my investment. Current liabilities is the Urkara investment. Are you really with me? So my investment minus Urkara investment is what the working capital which I am net ready to invest. Are you really with me? Yes, sir. Coming to the leverage ratio. Sir, in your capital structure, liability side of the balance sheet, out of your total fund, how much debt is what the debt ratio? Out of your total fund, how much equity is what the equity ratio? Right, sir? The relationship between debt and equity is what the debt equity ratio. That's why debt divided by, sir, because of injecting preference share capital and debt into the what structure? Capital structure. The earnings of the equity shareholders increases. That's what gearing, gear, gear mati poite irukano. Are you totally with me? Preference share capital plus debt divided by equity shareholders fund. Comfortable, sir? Proprietary ratio. Out of my total asset, how much money is of proprietors? That's what proprietary ratio. Out of my total asset, how much is the debt fund? Is what the debt to the total asset ratio. Always fixed assets is connected with the long-term loan. So, sir, this out of NSR long-term fund, how much fixed assets I am having is what the fixed asset divided by long-term fund ratio, right, sir? Sir, I am going to serve the debt. In order to serve the debt means I have to pay the interest, I have to pay the principal. Sir, in order to pay interest and installment, how much earnings available to debt holders are there is what the debt service coverage ratio. In order to pay the interest, how much EBIT is there with me is what the, sir, in order to pay the preference dividend, how much PAT I am having is what the, in order to pay the interest and installment in cash, how much cash available with me is what the fixed charges coverage ratio. Are you totally with me? Sir, out of sales, how much is the gross profit is what the gross profit ratio. Out of sales, how much is the cost of goods sold is what the, out of sales, how much is the net profit is the net profit ratio. If it is taking profit before tax, it is net profit ratio before tax. If it is after tax, net profit ratio after tax. Right, sir? Out of sales, how much percentage is the financial expense is what the financial expense ratio. Out of sales, how much EBIT is what the operating profit ratio. Right, sir? That's it, sir. This I don't want. This I don't want. Sir, return on investment. Abdinale ratio return divided by investment. Right, sir? This return always we will express before tax and after tax, because on return we are liable to pay tax. Before tax means before food sugar test we are taking. After tax means after food, sir, test you are taking. Sir, what is the profit before tax? EBIT. So EBIT divided by capital employed. What is the profit after tax? PAT plus interest divided by capital employed. Comfortable? Return on equity means I am analyzing only from the angle of the equity shareholders. Equity means equity plus preference, right? Yes, sir. My dear lovable students, return on equity means what is the profit? Profit before tax? PBT. PBT. Profit before tax divided by equity. What is the profit after tax? PAT. PAT divided by equity. Comfortable? My dear lovable students, return on asset. Sir, asset will generate EBIT. Are you really with me? Yes, sir. So the profit before tax is EBIT divided by average total assets. Whereas, sir, profit after tax divided by average total assets. Right, sir? Now I am coming to the performance. Okay, sir, companies having residual earnings. Hello, sir. For every shareholder, every share earned how much is what the EPS. Right, sir? Sir, this much I gave it as dividend. For this much number of shares, that means every share earned, how much dividend is what the DPS. What is the relationship between out of 10 rupees earned, if I distribute 6 rupees means companies having a dividend payout ratio of 60%. Sir, dividend yield and earnings yield from the angle of the investor. What is a return to the investor? A return is, sir, dividend. In order to enjoy the DPS, they have to invest the MPS. Sir, earnings yield means the return is EPS. In order to get the EPS, sir, they have to invest the MPS. Right, sir? Yes, sir. Sir, one share is having 10 rupees. Sir, yes, sir. What is a reflection in the market? That is what? Price earning ratio. Price divided by earnings. Sir, book value per share. Sir, asset minus liabilities is what? Net worth. That net worth divided by number of equity shares is what? The intrinsic value per share or book value per share. Right, sir? Sir, market value to book value means what is a reflection of the book value to the market is called as response ratio. What ratio? Response ratio. Response ratio means, sir, what is a response in the market to the book value is what the market value by book value, right, sir? Now our turnover ratios. We can express turnover ratio in two ways, either in times or in days. If it is in times, turnover ratios. If it is in days, holding period. That's it. Sir, can I ask the raw material turnover ratio? Yes, sir. What does it mean? How much raw material consumed with the average stock of raw material, right, sir? Sir, sir, WIP. What WIP meaning? Sir, with this much of average stock of WIP, how much factory cost I incurred, right, sir? Finished goods turnover ratio. With this much average stock of finished goods, how much cost of goods sold I generated? Are you really with me? Debtors turnover ratio. With this much of average accounts receivable, what is my credit sales? With this much of average accounts payable, what is my credit purchase? Now here onwards, romba easy. Working capital turnover ratio, nothing. Turnover divided by working capital. Fixed asset turnover ratio, simple. Fixed asset divided by, sorry, turnover divided by fixed asset. Capital turnover ratio, which is nothing but turnover divided by, comfortable. The same can be expressed in what period? Holding period. Simple. Holding period is equal to days la venuma, days la irukku. Sir, months la venuma, months la irukku. Sir, weeks la venuma, weeks la irukku. Part venuma, part irukku. Fight venuma, fight irukku. Hello, sir. That means raw material holding period is equal to, sir, unmayana formula, average stock of raw material divided by average raw material consumed per day. Average. Right, sir? The next one, sir. Sir, WIP holding period is equal to average stock of WIP divided by average factory cost per day. Right, sir? The next one, sir. Finished goods, sir, holding period is equal to average stock of finished goods divided by average cost per day. That's it. Next one. Debtors turnover ratio is equal to debtors holding period. Holding period, collection period. We can't hold the debtor. Alright. Debtors collection period is equal to average accounts receivable divided by average credit sales per day. Basically, you want in days, average by average. That's it. Simple. Okay, wow. Sir, next one, sir. Creditors payment period is equal to average accounts payable divided by average credit purchases per day. Next one. That's it. Chapter, ratio, analysis, revision. All the ratios we have done. Are you all really with me? For the next 10-15 minutes, go through, my dear lovable students, all the, sir, ratio. Then we will start a superb pass examination. RTP May 22 question number A. Then, sir, I will be solving that. After that, I will be solving RTP May 2021 question number N. And also, in the coming slot, we will be solving M question number M, A, N, M, RTP November 2022. I am waiting. Take 15-20 minutes time. Settle and come back. We will complete this revision. I hope that you are comfortable and enjoying. Sir, very happy evening to all. So we are doing the revision of financial management. In that, my dear lovable students, these are the topics we have completed. Number one is the cost of capital. If you see this topic, cost of capital, standalone, we will get a 6 to 7 mark question. Basically, you will be getting a computation of WAC question, that is KO. Then after the cost of capital, capital structure theories like NI approach, NOI approach, traditional approach and MM approach, that is Modigliani Miller approach. In that, generally everyone will give weight to the MM approach, but there is a huge chance that you may get even traditional approach also. Are you agree with me? Whenever they are asking a question from traditional approach, just keep in mind that under traditional approach, only optimum capital structure will be there. So that capital structure may be a 5-mark question for examination. Then arbitrage process. It's a very beautiful concept in FM itself, but it's not regularly asking area. But when they ask how to find out the arbitrage gain will be a question. So not a regular area, but still very important area. Once it's asked, once in a while they will be asking, but we can't say that when they will ask. That's a problem. Coming to the fourth topic, my dear lovable students, after the arbitrage process, we are having the EBIT and EPS analysis. This is a expected question for examination for 5 mark. If you see every question paper, this question, EBIT, EPS analysis is a regular area, my dear lovable students. Once we pass EBIT, EPS analysis, then the next point is the indifference point. Indifference point. This is also not that much regular area, but in 3 attempts they are asking once, or sir, one attempt left they are asking. So this topic has to be prepared. I will never say that leave this topic, indifference point. Then coming to the next one called as dividend decision munadi, ratio analysis, leverage analysis and ratio analysis, a very important 2 analysis. Mandatory area for examination, 10 to 12 mark, maybe 5 mark or 6-5 or 6-7, like that putting. Don't put. So if you see the entire FM, we are left with 3 topics. One is dividend decision. Number 2 is the capital budgeting. Number 3 is the working capital management. In that, we are going to knock dividend decision. Then we will be pending with the capital budgeting and working capital management decision. What is this dividend decision is all about? I will tell you, man. There was a big fight going on. What the fight was, if 2 firms are alike in all aspects, sir, except capital structure, will the value of the firm change or not is the question. That's what capital structure theory is. In that NI, NOI, traditional MM, everyone said that if 2 firms are alike in all aspects, except capital structure, no, the value of the firm will not change. Or some people said that, yes, the value of the firm will change. Either of the answer they said. My dear lovable students, sir, with regard to the dividend decision, the same discussion we are going to make. If 2 firms are alike in all aspects, except dividend policy, dividend decision, will the value of the firm change or not is the question. That means one firm is giving dividend, another firm is not giving dividend. Remaining everything is one and the same. A limited, B limited. Capital employed 50 lakh, 50 lakh. Risk, sir, same. EBIT, same. Only thing, one firm is declaring dividend, another firm is not declaring dividend. Because of declaring dividend, will the value of the firm change or not is the question. Some people are saying that yes. If 2 firms are alike in all aspects, except dividend decision, value of the firm will change, because how they are proving is value of the firm is equal to number of equity shares into market price per share. Number of equity share into market price per share. They are saying that we are going to value the value of the firm based upon the liability side of the balance sheet. For example, we know that, sir, if you add the entire asset, you will get the total asset. From the total asset, my dear lovable students, if you reduce the liability, sir, assets minus liability, you will get the capital employed. Right, sir? If 2 firms are having same capital employed, then value of the firm will not change. But if the capital employed changes, value of the firm changes. Generally, we will go for this valuation, that is asset minus liability valuation, in case of merger, in case of acquisition, in case of amalgamation, like that circumstances. But in case of FM, we will never go through with the asset valuation. Majority cases, we will go with the liability valuation. That's why even under the capital structure approach also, value of the firm is equal to value of equity plus value of debt. Value of equity plus value of debt. So we always prefer, sir, liability side valuation than the asset side valuation. The logic is very simple. It's very tough to find out the fair market value for each and every asset. For example, you are going to value, sir, Saravana Bhavan. Have you heard about Hotel Saravana Bhavan? Yes, sir. Like this one cup and saucer they'll be having. Sir, in one cup and saucer they'll be having 25 spoons. Like that, 3000 set of 25 spoons will be there. 3000 set. Will you value each and every spoon? Is it possible? No, sir. So it's always very headache to value the asset side of the balance sheet in reality. And it's very easy to value the liability side of the balance sheet, because just we have to know number of shares. Anyway, that will be available in the balance sheet. It's a book value only. And we will never, sir, respect the book value. We will go for the market value valuation. So our subject itself is market value. So what one ideologists are saying that, yes, if 2 firms are alike in all aspects, except capital structure, except dividend decision, yes, the value of the firm will change. The first person come up with such a thought is the Walter. Walter. Walter said that he only started everything. Sir, generally someone should start and MM should close. That's what the MM's job. Here also it's like that only. NI has to start. Yes, NI started. Net income started. Then NOI criticized NI. Then traditional approach criticized both NI and NOI. Then MM came and closed all the three. Are you really with me? Technically, sir, MM is an extension of NOI. That story you know because NOI operationally failed. Whereas MM were able to explain how it is exactly offset. For that, he given formula. He come up with the sir ideology. Are you agree with me? This is what happened, my dear lovable students. So the same way, sir, now I am going to start with a Walter. Walter is saying that what I have to find out to you, number of shares into market price per share. So I am going to find out the P0 because we need two data. One is total number of share and other is the market price per share. Anyway, everyone knows the total number of shares. It is available in the books of accounts itself. So we have to calculate the market price. That is what the discussion. Right, sir? The relationship between dividend and share price based on Walter formula is shown below. Generally, Walter has asked a basic question to the, sir, everyone. For example, if there is a MAD in the market, you are going to buy that MAD, what you will pay? What you will pay is based upon what the MAD will give you. If the MAD will give more milk, you will pay more price. If one MAD gives, sir, less milk, it will give only Sani. That means you will give less price. Are you really with me? So what the MAD, sir, gives is what? The value of the MAD. Are you really with me? Are you really with me? So my dear lovable students, market price per share. Sir, today a shareholder will pay. Today a shareholder will pay, sir, based upon the future value of the, sir, present value of its future cash flows. Present value of its what? Present value of its future cash flows. Are you really with me? What I am going to get in future? What I am going to get in future? How much liters of milk I am going to get from get in future? Adode today's present value. Adode today's present value is the price which I am ready to pay today. Correct? For example, you are going to purchase a, sir, residential house property in Nungambakam. Someone is saying that 5 crore. Sir, will you simply invest 5 crore? No. Sir, a financial manager, financial management person should think that what I will get from that money because I am investing today. So, value of any asset today is the present value of its future cash flow. So, Walter is saying that according to a shareholder, he will be expecting dividend in future. He will be expecting dividend in future. Right, sir? Yes, sir. Plus, sir, every shareholder of the company will not be expecting dividend. One more element he will be expecting. Walter is explaining that the second expectation for a shareholder, for example, if the EPS of the company is 10 and if the DPS of that particular company is 6, that means out of 10 rupees, 6 rupees has been declared as dividend. The remaining 4 rupees company itself is holding, retaining. Now, the Walter is asking one question that, sir, if the company distributed 10 rupees as dividend, that 10 rupees would have been invested in, that 10 rupees would have been invested by the shareholder in some investment and would have got the return. But out of 10 rupees, hello sir, the company declared dividend of only 6 rupees and company holded. Then in the next year, my dear lovable students, my expectation is I want dividend on my original investment because I already invested the current market price, right sir? If I invest today current market price, at the end of the first year, I want DPS 1 plus that only I am not sufficient. I want one more return. The one more return is nothing but, sir, this 4 rupees has been reinvested by myself in the company. That means I want return on investment on investment. Investment on. So, what Walter is saying that 10 rupees is the EPS and, sir, 6 rupees is the dividend. So, E minus D comes to the retention, my dear lovable students. E minus D is the retention. So earnings minus dividend. This is the money available with the company. Right, sir? My dear lovable students, this money will be invested by the company in their project. That project will earn IRR. That project will generate IRR. That means this money will give you a return at the rate of R. Are you really with me? So listen to me, man. So what Walter is saying, that Walter classifying the return into two categories. Every year, the Walter is saying that you are entitled to get DPS1. You are entitled to get DPS1. Plus, sir, the shareholder will be expecting E minus D. What is E? EPS. What is D? DPS. The balance is the money available with the company. This will be invested by the company in a, sir, project. And that project will give you a return called as R. That is a rate of return. That is a... Sir, will this happen? Will all the story happen for 1 year or perpetual? Perpetual. You tell me if the cash flow is a perpetual cash flow. If the cash flow is a perpetual cash flow, the present value of the perpetual cash flow is equal to cash flow divided by R. Cash flow divided by... This will be the cash flow. What is the cash flow? E minus D into R is the cash flow. Right up. This I am going to get at the end of year number 1. End of year number 1. Sir, what is the value of asset today? Present value of the future cash flow. So from year number 1, Y1, I have to bring to Y0. For that, I will be doing divided by K. For that, I will be doing divided by K. Are you really with me? Sir, will this story happen? This DPS1 and R into E minus D divided by K will be happen only for Y1 or Y2, Y3, Y4 for infinite period. Infinite period. Whole divided by K. That means the present value of a perpetual cash flow is equal to cash flow divided by R. Are you really with me? Sir, if I write like this, my dear lovable students, can I say that, sir, Walter is equal to D by KE plus? Is this KE applicable like this? Yes, sir. D by KE plus. Sir, R by KE into E minus D whole divided by K. Right, sir? What Walter is saying that you are going to get, sir, DPS1. You are going to get DPS1. You discount that DPS1 today. That's why D by K. You are going to get R into E minus D. Hello, sir. Sir, that you have to bring today from Y1, you have to bring today to Y0. That's why divided by K. Correct? Sir, this cash flow is for perpetual. Are you really with me? Sir, the present value of a perpetual cash flow is equal to cash flow divided by R. That's what? Divided by K. So this is cut short, and Walter come up with a formula that D plus R by K into E minus D whole divided by K. Can I proceed, sir? D plus R by K into E minus D whole divided by K. What is P? Market price of the share. What is E? Earnings per share. What is D? Dividend per share. What is KE? Cost of equity or rate of capitalization or discount rate. What is R? IRR. The above formula is given by Professor James E. Walter, which shows how dividend can be used to maximize the wealth of the equity shareholder. He argues that in the long run, share price reflect only the present value of the expected dividend. Sir, if a share is not at all giving dividend, no one will be ready to pay price for that particular share. If a share is giving higher dividend, the shareholder will be ready to invest higher price. This is the ideology of the Walter. Yes, sir. Retention influence stock price only through their effect on the what dividend, future dividend. So this is what the conclusion given by the Walter. What Walter said that Walter's approach consider only two factors. Walter is saying that I will consider only R and K. R is the rate of return earned by the company. KE is the expectation of the shareholders. Are you with me? For example, if KE is equal to 16%, and R is equal to 20%, what Walter is saying that, sir, company is able to generate more return than the expectation of the equity shareholder. Yes, sir. Such a company don't give what at all? Dividend at all. That means if the R is greater than what? KE. R is greater than KE, then the optimum dividend policy should be 0%. Don't give what at all? Dividend at all. Only at that point of time, the company's share price will be maximum. If that is the case, number of shares into market price per share, you will get a higher value. That's what our discussion is all about, right, sir? If the R is equal to KE, man, it is indifference point. Every payout ratio is optimum payout. Whether you give the dividend, whether you don't give the dividend, that does not matter at all. If the R is less than KE, that means R means return earned by the company is less than what? KE, my dear lovable students, 100% better to pay the dividend. Don't keep the company by the what? Company. Don't keep the dividend by the company. Have 100% payout ratio. This is what the story given by the Walter. So Walter is saying that, my dear lovable students, the price, market price of today, that is P0 is equal to D plus R by KE into E minus D, whole divided by K. That is, a equity shareholder will be expecting two things. Number one, D, dividend. Number two, retained earnings. That is, sir, return on retained earnings. Return on. So company will, sir, earn EPS. They will give DPS. So E minus D is the retained earnings. Company will invest R provided if the R is higher than K. R is higher than K. If the R is equal to K, sir, it is indifference. You give the dividend, don't give the dividend. And if the R is less than K, numerator will become less. If numerator less, it's a degrowth. If the numerator R is greater than K means, sir, it's better to hold 100% and, sir, invest in the new project. Are you agree with me? Yes, sir. This is what the story of the Walter. So, we'll be seeing what Walter is thinking through his formula. Can I solve question? One question. Okay, man. Second question, one part is there, we will solve. Following information is taken from ABC Limited because I want to apply that into numbers, that's why. Net profit of the year, how much lakh? 30 lakhs. Company earned a profit of 30 lakhs. Okay, sir. 12% preference share capital, 1 crore. So 1 crore into 12% comes to 12 lakhs. So 12 lakhs is the preference dividend. Equity share capital, 60 lakhs. Let it be there. IRR, R is equal to how much percent? 22%. That means if company hold the money, company can generate a return of 22%. But KE, the expectation of the shareholder is only, that means if I give dividend to the equity shareholder, they will invest somewhere and they will get a return of only 18%. What is higher? R is higher or KE is higher? According to the Walter's model, 0% should be the DPOR and 100% should be the retention. Right, sir? But this guy is holding, sir, only 75%. That means this guy is against Walter. This guy is against the principle of the Walter. That means company right? Calculate the market price of the share using the Gordon's model. I'll come to it at the appropriate time. And Walter's model. It's a Jan 21 question. My dear lovable students, be with me. What is the net profit, my dear? Net profit is equal to 30 lakh. Generally, net profit means PAT. Profit after tax. So, PAT is equal to 30 lakhs. From that PAT, I have to pay the preference dividend. What is the preference share capital? 1 crore. What is the PD? 12%. That means from the 30 lakhs, I am supposed to pay 12 lakhs as the preference dividend. Are you all traveling along with me? So, from 30 lakhs, if 12 lakhs goes means 18 lakhs is the retained earnings. So, company is having 18 lakhs. Divided by number of equity shares, my dear lovable students. 6 lakhs. 6 lakhs is the number of equity shares. So 8 lakhs divided by 6 lakhs comes to 3 per share. That means EPS, earnings per share, is 3. Company earned 3 rupees as the EPS. Right, sir? Less DPS, dividend payout ratio, at the rate of 25%, because retention is equal to 75%, means dividend payout ratio is equal to 25%. Can I proceed? So 3 into 25% comes to 0.75 per share. That means company declared 0.75 per share. So 3 minus 0.75 comes to 2.25 per share is what the company retained. This is what the retained earnings of the company. Am I right? According to Walter, what is the rate of return? 22%. This is the IRR of the company. But what is the KE? 18%. Right, sir? According to Walter, sir, the dividend payout ratio in such a situation should be 0%. Company should not give what at all? Dividend at all. Clarity? Sir, I am going as per the original share price of the Walter. This is unnecessary in the question. According to me, what 0 is equal to? P0 is equal to D plus R by KE into E minus D whole divided by K. This will be the market price of the share. What is the dividend? 0.75, because 25%. Right? Plus what is R? 0.22. What is KE? 0.18. Is the numerator higher or denominator higher? Numerator higher. What Walter is saying that if numerator is higher, don't pay dividend at all. What is the E? 3 minus what is D? 0.75. Right? Whole divided by what is KE? 0.18. My dear lovable students, sir, calculator. Sir, 0.22 divided by 0.18. 1.22 into 2.25. Right? 2.75. So 2.75 plus 0.75 comes to 3.5 divided by 0.18 comes to 19.44 per share will be the current market price. Current market price. If you followed Walter 100%. But this company has not followed Walter. This company actually worked against Walter. If they worked against Walter, then the share price will be less. Yes, sir. Then the share price will be less. My dear lovable students, now the real answer for the question. P0 is equal to D plus R by KE into E minus D whole divided by KE. What is D? 0.75 dividend. Following Walter na 0. Correct? Yes, sir. Sir, 100% Walter I am going to do. So they won't give what at all? Dividend at all. So P0 is equal to 0 plus. What is the R? 0.22. Divided by KE? 0.18. Can I proceed? What is E? 3 minus dividend 0. Whole divided by 0.22 or 18? 18. 0.18. Can I proceed, sir? So P0 is equal to 0 plus, calculator man, 0.22 divided by 0.18 into 3 comes to 3.66 divided by 0.18. Right? Comes to 20.37. So what Walter is saying that this is a firm. Correct? Yes, sir. If this company has not given what at all? Dividend at all, and assume they are having 10,000 equity share for assumption purpose. So 10,000 into 20.27 will be the value of the firm. Comes to 2,03,703 is the value of the firm. Whereas if the same firm, my dear lovable students, 10,000 into 19.44 comes to 1,94,400. 1,94,400. Getting it? Sir, for our exam answer, this is not at all required. I just prove you that according to Walter, if you give dividend, one share price will come. If you don't give a dividend, another share price will come. That is why I am saying that Walter is a theory of relevance. That's why Walter is saying that my theory is a theory of relevance. So what is the answer as per the Walter's model? Sir, Walter's model 19.44. Our first answer 19.44. Right, sir? That's it. The theory of Walter. So what Walter is saying that, sir, simple. Shareholder will pay price of a share today. Price of any asset today is based upon the present value of the future cash flows. From a shareholder will get D as the future cash flows. Right, sir? Plus R divided by K into E minus D. Whole divided by K. This is what the formulas are given by Walter. What now Gordon is saying that, how Walter, what you are saying is correct. What you are saying is correct. The present value of any asset today is the, sir, present value of its future cash flow. Correct? But how the dividend every year will be same? Sir, 2, 2, 2, 2, 2. It will never be every year 2, 2, 2, 2, 2. There should be some growth in dividend. There should be some growth in dividend. According to Walter, sir, DPS 1 is equal to DPS 0. Everything is same. DPS 5 is equal to DPS 0 because you won't have what at all? Growth at all. But Gordon is asking to Walter that how that will work. So your formula is baseless. Conclusion is same, whereas formula is baseless. Tell me, conclusion is same, whereas formula is baseless. What Gordon is saying that following formula is used by Gordon to find out the price per share, which is MPS 0. MPS 0 means current market price should be equal to EPS 1. EPS 1 means the company earns at the end of the year 1. Correct? Into 1 minus B. 1 minus B. B stands for retention. B stands for retention ratio. So 1 minus B means, sir, dividend payout ratio. Sir, if you multiply EPS 1 into dividend payout ratio, you will get basically DPS 1. DPS 1. According to Walter, there is no classification of DPS 1 or DPS 0 and all. That's why we just said that D plus. There you should never use the word DPS 1 because according to Walter, every year you will be having same dividend. But Gordon is saying that how that is possible. So it should not be same. It should not be same. It should be different, including growth. So what Gordon is saying that, come on, at the end of year number 1, my dear lovable students, you will be earning EPS 1. On that EPS 1, you will be declaring dividend. That means out of the EPS, you will keep something with the company. That is called as B. That is called as retention. So from 100%, if you are retaining 60%, 40% is the dividend payout ratio. Up EPS 1 into sir, dividend payout ratio will give you DPS 1. So what, sir, Gordon is saying that every shareholder will be expecting DPS 1. Every shareholder will be expecting. And sir, this DPS 1 is a future cash flow, which is, sir, at Y1. I have to bring that to the Y0. So I have to discount. I have to discount using a discounting factor called as R. According to Gordon, that R is equal to KE minus BR. What Gordon is saying that this is the expectation of the equity shareholders. This is the expectation of the equity shareholders. Minus B into R stands for G. Growth. Basically, what Gordon is saying that we already discussed that KE is equal to. When I write KE is equal to, I am going back to the cost of capital chapter. KE is equal to DPS 1 divided by MPS 0 plus G. Are you remembering? This plus G I am bringing here, which is nothing but KE minus G. Can I say like that? Is equal to DPS 1 divided by MPS 0. Can I say? My dear lovable students, KE minus G is equal to EPS 1 into 1 minus B. That will also give me DPS 1 divided by MPS 0. If I calculate this KE, the chapter is cost of capital. If I calculate MPS 0, the chapter is dividend decision. That's it, game over. So what, sir? MPS 0 is equal to EPS 1 into 1 minus B whole divided by KE minus G. Enapa comfortable? Are you able to appreciate? Are you all really with me? This is what the formula propagated by Gordon. So Gordon MPS 0 price per share, today's price is equal to, it's based upon how much earnings the company is making. Not only earnings, sir, retention, that is 1 minus B, that is dividend what ratio? Payout ratio. K is the what of equity? Cost of equity. R means the IRR, internal rate of return, and BR is equal to growth rate. So G is equal to what into R? B means the amount of retention made by the company. R means at what rate that amount is going to be invested by the company. That's called as B into R. So according to Gordon's model, where IRR is greater than the what of capital. That means if the R is greater than KE, price per share increases and dividend payout ratio decreases. Same conclusion of the Walter. I will tell you, conclusion of Gordon is equal to conclusion of Walter. Whereas the approach of Gordon is not equal to approach of the Walter. What? Sir, Walter is saying that share price today P0 is equal to D plus R by KE into E minus T whole divided by KE. You will get one share price as per Walter. But the same share price you will never get as per Gordon. Because the valuation method as per the Walter and the valuation method as per the Gordon are not one and the same. But the conclusion, the basic principles of the dividend decisions are one and the same. Even Walter also saying that compare R and KE. Even Gordon also saying that compare R and. On the other hand, when IRR is lower than the what of capital, price per share decreases and dividend payout ratio increases. So my dear lovable students, this is the conclusion of Gordon. Engyo paatha mari irukum. Sir, if the company is a growth company, that means if the R is greater than KE, don't give what at all? Dividend at all. If the company is a constant company, R is equal to KE, every payout ratio is a optimum payout ratio. If the company is a decline company, that means if the R is less than KE, declare dividend at the rate of 100%. Right, sir? Now, a relationship between dividend and share price on the basis of Gordon formula is shown as follows. Sir, according to Gordon, sir, MPS 0, what is MPS 0? Current market price is equal to DPS 0 into 1 plus G. What is DPS 0 into 1 plus G? DPS 1 whole divided by KE minus G. Both are one and the same. Both are one and the. Whereas MPS 0, current market price, correct, sir? DPS 0, current dividend, G, growth rate, KE, cost of equity. So what? The formula given by Gordon shows that when the R is greater than KE, price per share increases as the dividend ratio decreases and vice versa. So what Gordon is saying that compare R with KE. Compare. If the R is greater than KE, please don't give what at all. Then what will happen, you know, MPS 0 will increases. But you when start declaring what, dividend, then automatically MPS 0 will reduces. Clarity. Are you able to appreciate? The same question will be solving using the what model, man? Gordon's model. The same question, question number 2. Yes, come on. So what Gordon is saying that, sir, we have to value the price as per Gordon. So MPS 0 is equal to EPS 1 into 1 minus B divided by KE minus G. So what is EPS 1? 3. Just now we find out 3 into 1 minus retention ratio. Retention ratio B is 0.75. Right up. 0.75. According to the Gordon, you are not supposed to give what at all? Dividend at all. You are not supposed to give dividend at all. Right? But still you have given 25% dividend. Right, sir? Whole divided by what is KE? 0.18. What is the growth? We have to calculate the growth. Correct? B into R. What is B? 0.75. What is R? 0.22. So calculator. 0.75 into, sir, 0.22 comes to 0.165. So, minus 0.165. That means, my dear lovable students, 3 into 0.25. 0.75 divided by 0.18 minus 0.165 comes to 0.0. Sir, 0.75 divided by 0.015 comes to 50. 50 rupees is the current market price as per Gordon's valuation. Right, sir? Yes, sir. Sir, look at here, man. Sir. Here, sir. 50 rupees is answer. What is, how you will calculate, man? Market price per share by using what model? Gordon's model. What is the formula? EPS 1 into 1 minus B whole divided by K minus G or BR, whatever it may be. Are you agree with me? The same formula can be calculated by DPS 1 into 1 plus G whole divided by K minus G. Are you agree with me? Yes, sir. The figures has been given. Where, what is MPS, price per share? 50, yeah. This is 50. What is EPS 1? We have to calculate. EPS 0 is equal to 3 in the question. So, EPS 1 is equal to 3 into growth rate. Correct? What is the growth rate, man? B into R. Correct? 0.165. So, 1.165. Am I right, sir? So, 3 into 1.165 comes to 3.495. So, this is 3.495. What is the retention ratio? 75%. K already given in the question as, sir, IRR R 22%. G growth rate 16.5. Just, sir, 0.165 is equal to 16.5%. And DPS 0 0.75. Because 3 into B minus 1 minus B 0.75. Right, sir? Now computation of market price as per what model? Gordon's model. MPS 0 is equal to DPS 0. What is DPS 0? 0.75 into 1 plus G. Okay, man. Our 0.75 divided by 0.75 into 1.165 is equal to 0.87375. Correct, sir? Whole divided by 0.18 minus 0.165, which comes to 0.15. What is the share price? 58.25. Sir, inga enna kadichichu? 15 kadichichu. That is whose model? Gordon's model. Then why 58.25? Sir, is two answers are given based upon two assumption. Yes, sir. What is assumption number 1? EPS 1 as 3. Assumption number 2, EPS 0 as 3. So if your assumption changes, answer changes. Right, sir? Because question, if you look at the question, they set net profit, 12% preference shares, equity share, IRR, cost of capital, retention ratio. The following information is taken already there. Correct? So we can consider it as past. This is one interpretation. Or you can say that taken means I have gone to the company and asked what will be your future. So question is not clear whether that is EPS 0 or EPS 1. So if you treat 3 rupees as EPS 1, then 50 rupees will be the share price. Right, sir? If you treat 3 rupees as EPS 0, then the next year EPS will be more than 3. Correct? Sir, if the EPS increases, automatically share price increases. That's why 58.25. Right, sir? Sir, any assumption you can take. Sir, can I write only one answer? Yes, that's fine. No problem at all. But for this question, 2 alternate answers has been given. That's it. With regard to the first 2 approaches, Number one, Walter's model and the Gordon's model. Both are theory of relevance. Relevance. Both people's conclusions are one and the same. Right, sir? Whereas both people way of proving are different. What Walter is saying that P0 is equal to D plus R by KE into E minus D whole divided by KE. Comfortable? Whereas what Gordon is saying that, sir, P0 is equal to EPS 1 into 1 minus B whole divided by KE minus G. Now the hero coming called as Modigliani and Miller. What Modigliani and Miller is saying that if two firms are alike in all aspects except capital structure, how the value of the firm will change? Hello, sir. Is simply asking, Modigliani and Miller is simply asking, there are two firms, for example, A Limited and B Limited, or simple, rather simple. Sir, there are two sons called as Mr. A and Mr. B. Mr. A is earning 1 lakh. Mr. B is also earning 1 lakh. In home, Mr. A is giving 20,000, whereas Mr. B is only giving 10,000. Will the value of Mr. A and Mr. B to his mother will change? Will be one and the same? Will be one and the same. முன்னாடி எல்லாம் இப்போ அப்படிதானா? Well and good. So my dear lovable students, hello sir, MM is asking that if two firms are alike in all aspects except dividend decisions, how the value of the firm will change? It's absolutely blunder. He is saying that MM hypothesis is primarily based on arbitrage argument. Already we discussed primary arbitrage and through the arbitrage process, MM hypothesis discussed how the value of the firm remains same whether the firm pays what or not. What MM is saying that MPS 0, that is current market price of a share is equal to DPS 1. Nyayam. The same only have been said by the Gordon. Correct? What MM is saying that in addition to that, every shareholder will be expecting capital gain. That's what MPS 1. For example, if today a shareholder invests in a share for 100, my dear lovable students, he will be expecting 150 at the end of year number 1. So his expectation will not only be the dividend, but also the capital gain. Right up. For that only, sir, that is the future cash flow. That is a future cash flows. So if that is a future cash flow, my dear lovable students, that has to be bring to present value by using a discounting factor called as K. So first, MM comment said that, sir, Walter, you valued P0 as D plus R by KE into E minus D all divided by K. This valuation method I don't want. Hello, sir. You valued based on an assumption that this is what meant dividend, that is shareholder will be expecting dividend and he want return on what earning? Retained earnings. This is how a shareholder will be looking a share according to you. But the P0 as per Walter is, Gordon is EPS 1 into 1 minus B divided by KE minus G. What MM said that according to the Gordon, a shareholder will value the share based upon what is the DPS 1. Because EPS 1 into 1 minus B is nothing but EPS 1. First point number 1, MM said that my P0 is not only DPS 1 but also MPS 1. But also MPS 1. So this DPS 1 is a future value. MPS 1 is a future value because this dividend you will get at the end of year 1, Y1. And MPS 1, a shareholder will get at the end of year number 1, Y1. My dear lovable students, DPS 1 plus MPS 1, this has to be discounted to today. That's why divided by K. Correct? So that I am discounting divided by 1 plus K. Hello, sir. Sir, MPS 0 means price in the beginning of the period. MPS1 means price at the end of the period. DPS1 means dividend at the end of the period. And K is the cost of equity. Sir, as per MM hypothesis, value of the firm will remain unchanged due to what decision? Dividend decision. This is a formula given by MM. What MM said that value of the firm is equal to. What is the value of the firm? Value of the firm is nothing but present value of its future cash flows. Present value of its. What is its future cash flow? Number of shares into sir market price per share. So what is the existing number of shares? எவ்வளோ shares இப்போ already company கிட்ட இருக்கு. Plus delta n. Delta n. That means MM is linking dividend decisions with the investment decisions. What MM is saying that, okay pa, if the R is greater than KE, you are saying that company should hold 100%. With that 100%, will the company do pujaya? No. Company have to invest somewhere. So in order to do that investment, company need fund, additional fund. So how they will raise the additional fund? They will raise the additional fund by issuing further shares. That's what delta N. That's what delta N, additional number of shares. So at the total already existing companies having some share plus delta N means total number of shares. From this line only I started this chapter. Total number of shares into market value per share is the value of the firm. Right, sir? Minus investments, because according to MM, there should be very good what opportunity? Investment opportunity. If a company invests means money will come in or money will go out. Money will go out. That's what capital budgeting, investment decision. Right, sir? And during that year, company will earn something. That means, my dear lovable students, that earnings is a cash inflow or cash outflow? Cash inflow. So what MM is saying that, romba simple, sir, what is the existing number of shares? That what? N. Plus what N? Delta N. Delta N means additional number of shares you have issued to do the project. Yes, sir? That's what N plus delta N. That means I got the total number of shares. What is the value of the firm? Value of the firm is equal to total number of shares into market price per share. That market price is MPS1. Market price is MPS1. Hello, sir? Yes, sir. Sir, minus I, because if the firm invests means money will go out, plus E. So during the entire year, company will earn. So the total cash flow at the end of the year number 1 in the hands of the company will be N plus delta N into MPS1 minus I. This has to be discounted to today's value. That's what the N of the firm, value of the firm. That means what MM mathematically done na, instead of finding P0 like Walter, instead of find out P0 by Gordon, he directly calculated value of the firm. What is value of the firm? Number of shares into market price per share. This is the basic formula of MM. What MM is saying that you should have a very good investment decision. Right? Yes, sir. My dear lovable students, N means number of shares today existing. At the end of year number 1, you will be having a very good investment decision. You don't have money to do that. Correct? You have to raise the capital by issuing additional number of shares. That's what delta N. So N plus delta N. You will get the total number of shares. Actually, into market price per share itself will get the value of the firm. But that much capital will not be there with the company, because you would have invested something. So I would have gone out. Yes, sir. Yes, sir. And you would have earned something during the year. E would have come in. Hello, sir. Divided by 1 plus KE will be the value of the firm. Are you with me? So with this, we will be solving question number A. Rambo Limited has 1 lakh equity share outstanding for 2022. The current market price of the share is how much? 100. So, இப்போ 1 lakh into 100 is equal to 1 crore. That means the present value of the firm is 1 crore. What MM is saying that whether you give dividend, you don't give the dividend, it will be how much crore itself. Company is planning to pay dividend at the rate of how much per share? 10 per share. Let them pay dividend. Required the rate of return is how much percent? 15%. That means KE is equal to, R is equal to 15% because the rate of return. Based on MM, calculate the market price of the share of the company when the recommended dividend is number 1 declared, number 2 not declared. So two circumstances are there. Number 1 declared, dividend declared, not declared. What is MM's ideology? Whether a company declares dividend, whether a company not declaring dividend, value of the firm will be one and the same. How many new shares are to be issued by a company at the end of year on the assumption that net income of the company is how much lakh? And the investment budget is 50 lakh when the dividend is declared or dividend is not declared. Proof that market value of the company at the end of accounting year will remain the same whether the dividend are distributed or not. This is a most expected question for any examination. Simple. Always step number 1. Even ICA itself traveling through the step. Okay, sir, simple sir, calculate the price at the end of the period. Price at the end of the period means, we know the formula, my dear lovable students. MPS 0 is equal to DPS 1 plus MPS 1 whole divided by 1 plus K. You know current market price. What is the current market price? 100. 100 should be equal to, what is DPS 1? 10. Because if they are going to give the dividend, if they are going to pay the dividend, 10 plus MPS 1 we don't know, plus 1 divided by what is the KE? What is the KE given in the question? Is the KE given in the question? Required rate of return is 15%. Adan KE. Because as per MM, there is no comparison of what and what? R and KE and all. Required rate of return means the equity shareholder is expecting 15%. So 0.15. Hello sir. Can I cross multiply sir? 100 into 1, 100 plus 100 into, sir, 115 should be equal to 100 plus 10 plus MPS 1. 15, 150 above. 1 verum 15. Yes sir. 0.15. Yes sir. So 100 plus 15, 115 should be equal to 10 plus MPS 1. Right sir. That means MPS 1 is equal to 115 minus 10 should be equal to 105. That means what MM is saying that if the company gives the dividend, correct? First they are doing dividend not paid, but we have done dividend are paid. Sir, can I move to the dividend are paid? If the company gives the dividend, today's market price will be 105. Correct? This is step number 1. Step number 2, what is the fund required? Logically answer. What is the total earnings? 40 lakhs. Are the company declaring dividend? Yes sir. They are declaring dividend. How much is the dividend per share? 10. Already how much shares are there? So 1 lakh into 10, 10 lakh. So out of 40 lakh, 10 lakhs goes means balance 30 lakhs will be available with the company. What is the very good opportunity of investment opportunity available? Out of 50 lakhs, only 30 lakhs are there. Balance 20 lakh, company have to raise by way of new shares. Will the company raise the new shares today or at the end of the year? End of the year. That means they will be declaring not at MPS 0 but at MPS 1. What is MPS 1? 105. Up 20 lakh divided by 105 means company have to raise 19,047.62 share. This is the delta share, correct? So what MM is saying that, my dear lovable students, at the start of the year, company were having how much share? 1 lakh share. Sir, at the end of the year, company will be issuing 19,047.62 share. That's what N plus delta N. At the end of the year, will you value the company with 100 or 105? So this into 105 will be the total value of the firm without considering investment. Correct? In that you will be investing totally 50 lakh. So 50 lakh will go out and you will be earning totally 30 lakhs. 30 lakhs is the earnings, 40 lakhs done. 40 lakhs is the earnings inflow. So what MM is saying, that calculator man, 20 lakhs divided by 105. அப்படியே calculator வச்சுக்கோ. Plus already equity share of 1 lakh. This will be the total number of shares, right? Into 105 comes to, this will be the total value of the firm, which comes to 1 crore 25 lakhs. Plus you have earned an earnings of 40 lakh. Minus you will make an investment of 50 lakhs. That means the wealth available with the company at the end of the year will be 1 crore 15 lakhs. Right? This is at the end of the year number 1. Y1. I want MPS 0. So divided by 1 plus K. So divided by 1.15 comes to 1 crore is the what of the firm, value of the firm. That means already before starting all this drama, the value of the company was 1 crore. Sir, now situation number 1, company declared dividend. Then also the value of the firm is 1 crore. Now the MM is going to prove that, illapa, company is not declaring the, if the company is not declaring the dividend, my dear lovable students, hello sir, the value of the firm will be higher. Sorry, share price will be higher. Share price will be, whereas value of the firm will be same. Look at here. Sir, what 0? MPS 0 is equal to DPS 1 plus MPS 1 whole divided by 1 plus K. Correct? You tell me, sir, what is MPS 0? Is equal to, Terima? Yes, sir, 100. Because I am going to calculate the MPS 1. What is DPS 1? 0. I am not going to give the dividend. What is MPS 1? We have to calculate. So MPS 1 divided by 1 plus K, 0.15. That means, sir, 1 into 100, 100 plus 100 into 15, 15. Sir, 1 into 0, 0 plus MPS 1. That means 100 plus 15. 115 is equal to MPS 1. Are you all with me? Yes, sir. Simple one line summary of the entire discussion. This situation is dividend paid or dividend not paid? Not paid. Not paid na 115. Paid na 105. What is the gap? What is the DPS? அவ்வளோதான். டிவிடெண்ட் பே பண்ணலைன்னா இதுக்குள்ள அந்த 10 ரூபா சேர்ந்துருக்கும். டிவிடெண்ட் பே பண்ணியாச்சுன்னா 10 ரூபா இருக்காது. ஓ அப்படியா? அப்படிதான். Simple. Hello sir. So my dear lovable students, what MM is saying that 115 will be the share price, which is nothing but 105 plus 10 comes to 115. Step number 2, what is the fund required? I need only less fund because I have not given what at all. I have earned 40 lakh, not given dividend at all. That means in my hand 40 lakhs will be there. I am having an investment opportunity of 50 lakhs. 40 lakhs minus 50 lakhs comes to 10 lakh. 10 lakhs is the fund required. So I will be raising this 10 lakh at the year end by issuing one share 115. So I will be getting delta N 8,695.65 shares. Already company were having 1 lakh shares. That means 1 lakh 8,695 into what is the market price at the end? 115. This will be the total wealth of the company at the end of the year number 1. Correct? Plus company earned an earnings of 40 lakhs minus company made an investment of 50 lakhs. So this will be my value of the firm at the end of Y1. I want the value today divided by 1 plus K comes to 1 divided by 1.15 comes to 1 crore. Easy man. Appo inga paru present already we calculated how much crore? 1 crore. Sir, dividend not declared 1 crore. Dividend declared 1 crore. In any MM question in exam, just read one line. Rambo Limited has how much equity share? 1 lakh equity share. Outstanding. Correct? Current market price is 100. 1 lakh into 100. That's it. All the answer should be 1 crore. That's a shortcut, man. You do this much time, answer should be 1 crore. 3 models we have done. Walter model, Gordon's model, MM approach. That's it. Question number 1 and 2 done. Shall we move into the last question, my dear lovable students? Following information are given for a company. What is the EPS? Company earned 10 rupees. What is the PE ratio? 12.5. You know, price earning ratio is equal to price divided by earnings. Price divided by earnings, which is 12.5. Correct? Price earning ratio is 12.5. Correct? Rate of return on investment are 12%. Market price per share as per Walter given 130. Yes, sir. So 130 is equal to D plus R by KE into E minus D whole divided by K. Let me ask you, 1 divided by price earning ratio is equal to K. Yeah? There is one formula. Have we discussed? Yes, sir. Because EPS divided by MPS 0 is equal to K. Tiripi pota? Yes, sir. So 1 divided by 12.5 comes to 8% is what the KE. KE actually given by way of price earning ratio. So I am having KE as 8%. I am having R as 12%. My dear lovable students. Hello, sir. You are required to calculate dividend what ratio? Payout ratio. So I have to calculate dividend payout ratio. Market price of the share at the optimum dividend payout ratio. Then I have to compare R and KE. Correct? What is the PE ratio at which the dividend policy will have no effect on the what of the company? And market price of the share at this price earning ratio. Market price using the dividend what model. One by one, I will come, human. Sir, first I will calculate the, sir, Walter, P0 is equal to DPS1 plus R by KE into E minus D whole divided by K. Current market price, given or not given? Given, sir. Question 130. D, don't know. Sir, R, they themselves given as 12 and KE is equal to 8%. So, E we know 10 minus D. D means dividend. We don't know. Divided by how much percent? 8%. Just now we calculated K is equal to 8%. Correct? Appingava, sir, can we cross multiply? Yeah. 130 into 8%. 10.4 should be equal to D plus, idrandi knock off panla, 12 divided by 8. 1.5 into 10 minus D appdi vechko. D plus 10, 1.5 into 10 minus D, right? That means 10.4 is equal to D plus 10 into 1.5, 15. Sir, 1.5 into D na minus 1.5 D. Are you able to appreciate? I am bringing this plus 15 to here. Sir, minus 15 plus 10.4 should be equal to D minus 1.5 D. Am I right? So if I knock off this, minus 4.6 should be equal to 0.5 D minus 0.5 D. Basically minus sign cancel. D is equal to minus 4.6 divided by 0.5 come to 9.2 is the dividend given. What is the EPS? 10. 10 la evlo DPS? Upper 9.2 divided by 10 into 100 na. Evlo? Appa 92% is the present dividend payout ratio. Hello? What is R in the question? 12. What is the KE? 8%. Is R greater than KE? According to Walter, according to Gordon, you are not supposed to give what at all? Dividend at all. Correct? Since the rate of return of the firm R is 12% more than KE, therefore by distributing 92% of the earnings, the firm is not following an optimal dividend policy. What should be the optimum? 0. They should not give what at all? The optimal dividend policy for the firm would be to pay 0 dividend. And in such a situation, market price will be. That means if they give 0 dividend, D will be 0 and E minus D will be entire 10. This 10 will grow at the rate of 12%. So 1.2 will be the earnings. 10.2 basically. Correct? Divided by 8. Whole divided by 8 means, sir, the price, market price of the share will be 187. That means if you are following 0 dividend policy, your price will be 187. But currently it is only 130 because of your wrong dividend policy. Able to appreciate? So theoretically, market price of the share can be increased by adopting a, this is theoretically, man, market, I don't know what will happen. Okay. Sir, if the PE ratio at which dividend policy will have what effect? No effect on the value of the share is such that KE would be equal to what? R. Sir, if the KE is equal to R, whether you give dividend, whether you don't give dividend, it will not affect. Are you really with me? Sir, KE would be equal to R. The KE would be 12 at the P ratio of 8.33. Ebdina, what is the current KE? 8%. What is the R? 12%. Correct? Sir, R is equal to KE. R is equal to KE means 12%. Are you really with me? That means if my R is equal to KE, hello sir, dividend payout ratio become irrelevant. Whether you pay the dividend, don't pay the dividend. Correct, sir? That means P ratio of what is the R repo? 12%. That means 1 divided by 12 comes to 8.33. 8 point. You just answer me. You just answer me. What is the current? What is the current? Hello, sir. R. 12%. Current R is 12%. 1 second, man. Current R is 12% and current K is 8%. Current P ratio 12.5 times. Correct? I want enna venumna PE ratio at which I want a PE ratio at which my dividend policy will not have no effect. Correct? When my dividend policy will not have no effect, when R is equal to KE. That means what is my R? 12. This should be equal to KE of 12%. That means what is my KE? 1 divided by P ratio. Are you really with me? That means 12 is equal to 1 divided by P ratio. That means P ratio is equal to 1 divided by 12 comes to 8.33 times. That means if my PE is 8.33, dividend policy will not have no effect. Right? Sir, if the P is 8.33 instead of 12.5, then the KE which is inverse of P would be how much percent? 12%. In such a situation, KE will be equal to R. Am I right? Yes, sir. Because if the KE is equal to R, then only dividend will be optimal indifference. And the market price as per Walters will be. Now I have to calculate the market price of the share as per Walter. What is the formula of Walter? D plus R by KE into E minus D whole divided by K. D already we know 9.2 plus 12 divided by 12 because R is equal to KE. This is irrelevant. Sir, this is 0. 1, 1, 1. Basically 1. Correct? So you will get 1. There is no effect because 10 minus 9.2, 0.8. 0.8 plus 9.2, 10. 10 divided by 12%, you will be getting a market price of 83.33 per share. This will be the market price per share if you are following Walters model. I am coming to the same question using the Gordon's model. Do you, sir, remembering the formula of Gordon? EPS 1 into 1 minus B whole divided by KE minus G. What is EPS 1? EPS 1 is DPS 0 into 1 plus G. What is the current DPS? 9.2. Already given in the question. Can I calculate the G is equal to B into R? Yes, sir. What is B? Retention. Retention. Correct? How much, sir? Out of 192% dividend payout. So 8% is the retention. That was 8. Every 8% will grow at 12%. Correct? Up 0.96 is the G. Up this 9.2 will grow at 0.96. Comes to 9.2883 is what the DPS 1. Correct, sir? Now can I calculate the MPS 0? MPS 0 is equal to DPS 1 divided by KE minus G. What is DPS 1? 9.2883 divided by KE 8% minus G 0.96%. Am I right? Comes to 7.04%. Getting it? You will get 131.936. 936 is the share price. Alternatively, if you want, this formula also you can apply. Instead of DPS 0 into 1 plus G, EPS 1 into 1 minus B, both will give you what only? DPS 1 only. Again, sir, there will be share price of 130.68. Hello, sir. This is without applying growth on dividend. Without applying growth on dividend means I take a numerator as 9.2. That means I assume that this 9.2 is a grown dividend. That is DPS 1. Here I am assumed that 9.2 is the DPS 0 and I made it grow to DPS 1. That means basically there are 3 people are there. Number 1 Walter, number 3 Gordon and number 3 MM. Walter is a theory of relevance. Gordon is a theory of relevance. MM is a theory of irrelevance. What Walter is saying that, sir, P0 is equal to D plus R by K into E minus D whole divided by K. What Gordon is saying that P0 is equal to EPS 1 into 1 minus B whole divided by KE minus G. KE minus G. Right, sir? What MM is saying that, sir, not P0. Value of the firm is equal to N plus delta N into MPS 1 plus E minus I whole divided by 1 plus K. That's it with regard to the revision of the chapter. You go through the formula, do the 3 question, try any question of the ICA illustration book back, you will be able to answer it. We'll meet with the revision of capital budgeting. By that time, you solve the 3 models and come back. Sir, very, very, very happy evening to all. So we are going to revise the chapter capital budgeting. So what is the flow of this chapter capital budgeting? As we all know that the subject FM, we have to take mainly 3 decisions, my dear lovable students. Number 1, the primary decision is what? The investment decisions. Number 2 is the financing decision. And number 3 is the dividend decision. What investment decisions are saying that where I have to invest my money is what? The investment decisions. Actually, the FM subject itself is travel like that. First, sir, we will find out a very good investment decisions. Once the investment decision is success, we will raise the money through financing decision. That means whether I have to raise the money through equity or I have to raise the money through data or I have to raise the money through preference or I have to, for an existing company, I have to keep it reserves and surplus. Sir, by raising money through these sources of finance, my dear lovable students, company will get money and that money will be investing in the investment projects and company will generate return. Out of that return, company has to repay to the shareholders. That's what dividend decision is all about. Whether the company have to give dividend or not. If company gives dividend, what will be the value of the firm? If company does not give dividend, what is the value of the firm? In this slot is our discussion. That investment decisions can be classified into 2 categories, my dear lovable students. One is long-term investments and short-term investments. That long-term investments is called as capital budgeting in our subject and short-term investment is called as working capital management. So with this introduction note, we are stepping to capital budgeting. Sir, in investment decisions, this is what we are going to talk about. Types of investment decisions. What are the various types of investment decisions? What is replacement decision? What is expansion decision? What is diversification decision like? And basic principles for measuring the project cash flows. So I am going to choose whether a particular project has to be selected or not. So in order to select a particular project, my dear lovable students, what is the basic principles for measuring the project cash flows and capital budgeting in special cases? This main area, 3 areas we'll be talking about. Area number 1, area number 2 and area number 3. And we will enter into the capital budgeting techniques. What is payback period? What is, sir, accounting rate of return? What is net present value, profitability index, IRR, modified IRR and discounted payback period? These are capital budgeting techniques. Sir, what is capital budgeting? Capital budgeting involves identification of the investment project. First, you have to identify that, sir, project A is better than project B. Project C is better than project D. Sir, this project is better than the other project. Such identification is what the capital budgeting. That is strategic to business overall objectives. Yes, my overall objective of a business is to increase the wealth of the shareholders. So, I should choose a project where that maximize the wealth to the equity shareholders. Because of choosing a particular project, the wealth of the company should not get eroded. The wealth of the company should increase. Estimating and evaluating post-tax incremental cash flow for each of the investment proposals. That means I have to estimate. Estimate in the sense means in future how much cash flows will come, what is the life of the project, what will be the CFAT, and evaluating the post-tax incremental cash flow. Incremental means additional cash flow. If I am going with project number 1, my dear lovable students, I may get X amount of cash flow. If I am going with project number 2, what will be the cash flow I will get? What is the difference between the first project cash flow and the second project cash flow is what the incremental cash flow for each of the investment proposal, and selection of the investment proposal that maximize the return to the investor. These are the 3 activity involves capital budgeting. Sir, what you will do in capital budgeting? First of all, I will identify the investment project. Number 2, I will estimate and evaluate the post-tax incremental cash flow, and I will select an investment proposal that will maximize the return to the investor, right? So these are the capital budgeting process. First, I will plan, then I will evaluate, then I will select. Sir, after I select, I will implement, then I will control, and I will review. This is a basic thing. This type of question will never come in our FM because this is a theory area to start off with what is capital budgeting. What are the types of capital budgeting decisions, my dear lovable students? These are the types of capital budgeting. Generally, capital investments are decisions classified in 2 ways. Mainly, there are 2 types of capital budgeting decisions are there. One way is to classify them on the basis of firm's existence. Another way to classify them on the basis of decision situation. Number 1, sir, I am in continuing existing firm, sir. Already I am in existence. I am going to take a capital budgeting decision. Then I will take either replacement and modernization decision. That means already I will be having plant and machinery. I am looking that I don't want the existing plant and machinery. I want to change into new plant and machinery. So such a decision is called as replacement decision. Or I am thinking that the current technology what I am using is outdated. Now AI comes. I want to change the technology into new one. I want to modernize the plant and machinery or modernize the factory as a whole. Such a situation, I will be taking modernization decision. Number 2. Sir, for me, my business is going pakka, beautiful, fantastically going. So I just want to, increase the production level by buying another 5 more plant and machinery. I just want to extend the production capacity. That is called as expansion decision. And third one is diversification decision. Now I am manufacturing car. Let me manufacture some other product which is not at all related to car. I am going to manufacture salt. Another way, I am going to manufacture car. So that is called as diversification decisions. Sir, these 3 decisions will mainly taken by the existing firms, my dear lovable students. Replacement and modernization decision, expansion decision, and diversification decision. Are you able to live with me? Whereas on the basis of situation in the sense means, sir, I can take either mutually exclusive decision. I am having plant A before me and I am having plant B before me. If I choose plant A, I can't choose plant B. If I choose plant B, I can't choose plant A. Such a situation is called as mutually exclusive decisions in capital budgeting. Or I will be taking accept reject decision. If net present value NPV is positive, I will accept the project. Otherwise, I will reject the project. Or contingent decisions, my dear lovable students. because of taking one decision, I have to do some other things also. That is contingent decisions. So situation based, I will be taking 3 decisions. So this is all just an intro to the chapter. So mainly capital budgeting decisions classified into 2 categories. On the basis of firm's existence, either replacement and modernization decision, expansion decision, diversification decision. Right, sir? On the basis of situation, either mutually exclusive decision, accept reject decision, and contingent decisions, my dear lovable students. Estimation of the project cash flows. Whether you are going to take decision for a existing firm or in a particular situation, this chapter is dealing, the hero is the cash flow. Hero is the cash flow. Capital budgeting analysis consider only incremental cash flow. We will consider only the additional cash flow. How much extra cash flow I will get. For example, already for an existing firm, I am using a plant and machinery. I am getting, sir, cash flow of 1 lakh. But if I move to the new plant and machinery, I will get 1,20,000 means I am not interested about the 1 lakh inside that 1,20,000 because that anyway I am getting no. I am interested about that extra 20,000. That's what incremental cash flow from an investment likely to result due to acceptance of any project. If I accept any project, if I do any project, what will be my better position than the present position is what capital budgeting. Therefore, one of the most important tasks in capital budgeting is estimating future cash flow for a project. That is just estimate. If when you are estimating the cash flow, that is not the reality. That is only in paper. If you go wrong, the decision will go wrong. So you have to clearly estimating the cash flow. That is the step number 1, the major step in the capital budgeting. How to estimate the cash flows, sir? Calculating cash flows. You have to check that whether you are going to charge depreciation, no depreciation has been charged. 2 situations will be there when you are estimating the cash flows. No depreciation is charged or depreciation is charged. If no depreciation is charged, take the sales. From the sales, reduce the cost of goods sold. Reduce the cost of goods sold. Basically, you will get a gross profit. Technically, sales minus cost of goods sold will give you gross profit. Less depreciation. If no depreciation is charged, sir, I will not reduce the depreciation at all. If depreciation is charged, even I will be reducing the depreciation also. I will be getting profit before tax. I will be getting profit before tax. This is the, sir, cash flow. Sir, this is the profit before tax. From that, I will pay tax at the prescribed percentage, which may be 30% or 40% according to the company. I will pay the tax. Then I will get the profit after tax. Profit after tax. Sir, to this profit after tax, if I claim depreciation, I will add back the depreciation, my dear lovable students. Then I will get the cash flow and I will get the cash flow here. So being non-cash expenditure, depreciation has been first NSR deducted. Then we have added back while calculating the cash flow. That means what this chapter is saying that if you are calculating the operating leverage, you are following income statement. Like sales minus variable cost contribution minus fixed cost earnings before interest and tax. From the EBIT, you have to pay the interest. You will be getting earnings before tax. From the, sir, EBT, you have to pay the tax. Sir, the balance is called as PAT, profit after tax. From the PAT, you will be paying preference dividend. You will get residual earnings divided by number of equity shares. You will get the EPS, which is earnings per share. Right, sir? The same way, sir, for the capital budgeting chapter, there is a format, there is a logic. What capital budgeting is saying that start with sales. Start with sales. From the sales, reduce the cost of goods sold. You will be getting gross profit. I don't believe with me. From the gross profit, reduce the fixed cost, which is what? Depreciation. So the only thing is depreciation. All the remaining variable and the fixed cash item will go and sit in the cost of goods sold. Cost of goods sold. That's why they are segregating what? Depreciation. That too you may have two things in this chapter. Sir, sometimes no depreciation will be there, so put a dash. Sometimes you may have depreciation. If there is depreciation, reduce depreciation just for the purpose of payment of tax. Right, sir? Then you will get, sir, profit before tax. Profit before tax. In this situation, profit before tax is equal to gross profit because there is no depreciation at all. Here, sir, gross profit minus depreciation will be the profit before tax. Just pay the tax. Just pay the tax from your pocket. Generally, in situation number 1, the amount of tax will be more because you don't have the depreciation component. Right, sir? You will be getting, sir, profit after tax. Basically, cash profit after tax. Right, sir? But this profit after tax will not be the cash available in my cash box. In situation number 1, since there is no depreciation, PAT will be equal to the cash profit after tax. Am I right? Yes, sir? But in situation number 2, in my cash box, I will be having more cash, but the PAT, what is shown in the accounts, will be less. So, to this PAT, I have to add back depreciation because depreciation is a non-cash item. Here nothing to add back because I have not claimed depreciation at all. Here I have to add back, sir, non-cash item being depreciation being non-cash item. The answer what I am getting in this chapter is called as CFAT, that is called as cash flow after tax. Cash flow after tax. So the hero in this chapter is cash flow after tax. So cash flow is the hero, my dear lovable students. So what are the different types of cash flow is the next question. There are various categories of cash flows. There are initial cash flows for according to a project. For a project, there will be what cash flow? Initial cash flow. What cash flow? Initial cash flow. There will be interim cash flows. What cash flow? Cash flow during the life of the project is called as interim cash flow. And the terminal cash flow at the end is called as terminal cash flows. So these are the three varieties of cash flows. Number 1, initial cash flow, that is a cash flow at the start. Then interim cash flows, that is cash flow at the during the project. And the terminal cash flow means cash flow at the end. Come on, we'll be talking about initial cash flow. What is initial cash flow? We'll be talking about interim cash flow. What is interim cash flow? We'll be talking about terminal cash flow. What is terminal cash flow? Hello, sir. Sir, initial cash outflow, 99.99% initial cash inflows will not be there. Because initially we have to spend the money, then only we will get the money. So initially it will be cash outflows will be there. Are further into two category on the basis of fresh proposal and replacement decision. Sir, sometimes my proposal may be a fresh proposal. This is the first time I am going to buy the plant and machinery. That means my proposal is a what proposal? Fresh proposal. If the proposal is a fresh proposal, the manner of determining the initial cash outflow is in one way. Whereas my proposal is a replacement decision. That means already I am having an existing plant and machinery. Some good plant and machinery is there in the market. So I am going to exchange the plant and machinery, or I am going to sell the existing plant and machinery. I am going to buy the new plant and machinery. Then the format, the methodology of finding out the initial cash outflow will change, my dear lovable students. What they are saying is, sir, if the decision is related to an investment in a fresh proposal or an expansion decision, that means my decision is not a replacement decision. My decision is not a replacement decision. My decision is a fresh proposal. If that is the case, sir, cost of the new asset. Are you going to purchase a plant and machinery? By paying 10 lakh rupees. So 10 lakh rupees will go out of your hand, or 10 lakh rupees will come into your hand. 10 lakh rupees will go out of your hand. That will be a cash outflow. Sir, add installation or setup cost. This is a capital expenditure. Even this also, for example, you are spending 1 lakh for the purpose of installing that new plant and machinery. That is also a what outflow? Cash outflow. Add increase in working capital. Beautiful point. That means if I purchase a new plant and machinery, surely that plant and machinery need raw material to work. Surely that plant and machinery need WIP to work. So I have to surely additionally pump working capital into the system. Right? So the amount of working capital which I am going to pump into that system, for example, 3 lakh. So 10 lakh plus 1 lakh plus 3 lakhs comes to 14 lakh is the initial cash outflow, my dear lovable students. So if the proposal is a fresh proposal, what is the money you are going to spend for the new plant and machinery? Point number 1. To install that new plant and machinery, how much money you are going to spend? And also, what is the addition or increase in the working capital? That's what initial cash outflow, my dear lovable students. That means, if the proposal is a fresh proposal, there is no disturbance. There is no disturbance of the existing plant and machinery. Because existing plant and machinery is illa. Right? Whereas, if the decision is related to what decision? A replacement decision. My dear lovable students, I have to purchase the new machine and I have to sell the old machine. This will be cash outflow and this will be cash inflow. Cash outflow minus cash inflow will be the net cash outflow. Comfortable? First one, cost of the new asset. I am going to purchase the new asset for 10 lakh. So 10 lakh rupees will go out of my hand. So that new asset has to be installed. For that I have to spend money. Even that is also a cash outflow. Sir, add or less increase in the net working capital level. Sometimes when I replace the new asset, I may go with a lower capacity. Then the working capital will release. Or I may go with a higher capacity. Then I have to invest in working capital. So that working capital may be, sir, either increase in cash flow or decrease in cash flow. Right, sir? But in the fresh proposal, sir, there is no concept of release of what at all? Working capital at all. Because till now I have not deposited or invested any working capital. This is the first time I am going to do a project. So there is only question of investment in working capital. But here it may be release of working capital or there may be investment in working capital. Less. That's it. That's it. These are the cash flows associated with the new machine. Now I am coming to the old machine. Already you are having old machine, correct? You will scrap that old machine. Less net proceeds from sale of old machine. By selling the old machine, you will be having cash inflow. Right? So the cash flow associated with the new machine will surely be cash outflow. Right? But my dear lovable students, from the old machine, you will be having cash inflow. But this old machine already will be having some book value. Am I right? Now, if I sell that for scrap value, because I thought that this old machinery can be continued for next 3 or 4 years. So, based on that only, I would have planned my depreciation. Suddenly, I am coming and saying that I am going to sell the plant and machinery, existing plant and machinery, by seeing the new plant and machinery. So, I can't sell the plant and machinery by looking the book value. Right, sir? I may not be able to generate the cash flow equal to my book value. So, my sales may lead to either profit or loss. 99% loss. If it is profit on sale of fixed asset, my dear lovable students. For example, already you are having book value of 1 lakh rupees. 1 lakh rupees is the existing book value. You are going to sell this plant and machinery, existing plant and machinery for 1,50,000 rupees. Right, sir? So, there is a profit of SOFA. SOFA means sale of fixed asset to the extent of how much? 50,000. What you are supposed to do, no, this 50,000 should be treated as cash inflow. entire 1,50,000 you will treat it as cash inflow. Because of you are having profit on this 50,000, you are liable to pay tax to the department. That tax will be treated as cash outflow. That tax will be treated as, that is called as tax or expense. Tax expense due to sale of old asset. Sometimes what will happen, not sometimes, majority of the times, my dear lovable students, my book value is how much lakh? 1 lakh. I would have thought that I can use this plant and machinery for another 3 to 4 years. But suddenly a new machinery came. I am going to sell this. Sir, I am going to sell this plant and machinery. Selling price for how much? 20,000. So there is a loss on so far 80,000. Right, sir? This 80,000 I will be debiting to P&L account. Because of debiting this 80,000 to the P&L account, my expenses increases, net profit reduces, and the tax liability reduces. So this is called as tax savings. What meant tax? Or tax shield, or called as what? Tax shield. So we may have tax savings or tax shield. My dear lovable students, how we are having profit? We are taking that it's a cash outflow, profit not tax outflow. The same way this chapter is saying that treat it as tax inflow. Tax inflow. So that is the next cash flow associated with this. You will get the initial cash outflow. You will get the initial cash outflow. So simple, I am consolidating. Sir, that's it with regard to initial cash flow. Initial cash outflow may be for either for the fresh proposal or for the replacement decision. If it is for the fresh proposal, simple. How much money is the cost of the new asset? Installation and setup cost, investment in working capital, you will get the initial cash flows. Comfortable? If it is for a replacement decision, you have to take care the cash flow associated with the new asset, and also you have to take care the cash flow associated with the old asset. Knock it off, you will get the net cash outflow. I am coming to the second type of cash flow. This is the hero called as interim cash flows. What cash flow? Interim cash flows are further divided into again two categories on the basis of either fresh proposal and what decision? Replacement decision. You have to check that whether the proposals are fresh proposals or a replacement decision. Sir, if you are going to find out the interim cash flow for a fresh proposal, simple, you have to calculate the PAT. How to calculate the PAT? Just now we calculated the PAT. Just now we calculated the PAT. Look, sales minus cost of goods sold, you will get the GP. From the GP, reduce the depreciation, you will get the profit before tax. Pay the tax, you will get the profit after tax. I will start with the PAT. I will start with the PAT. Sir, to that PAT, add non-cash expenses like depreciation. Add non-cash expense like depreciation. Sometimes during the life of the project, a part of working capital may release. Or during the life of the project, a part of working capital have to be invested. In question, they will say that at the end of year number 2, there is an additional working capital of 2 lakh. So that will also be treated as interim cash flow. Comfortable? That's what add or less net decrease or increase in working capital, my dear lovable students. You will get interim net cash flow for the period. 99.99% that interim cash flow will be cash inflow. That interim cash flow will be cash. But any one of the year, because of the huge working capital required, it may go outflow also in the question. Comfortable? Sir, I am going to analyze the interim cash flow for the what decisions are? Replacement decisions are. For the replacement decisions are. Then my dear lovable students, net increase or decrease in the operating revenue. Don't see sales. See the increase in sales. That format. Don't see sales. See the increase in sales or see the decrease in sales. From the sales, we have to reduce the cost of goods sold. Don't see the cost of goods sold increase in cost of goods sold or decrease in cost of goods sold. Are you agree with me? Then you will be getting, sir, profit before tax. Sir, increase in profit before tax. or decrease in profit before tax. Right, sir? To that, sir, add or less increase in taxes. That means, sir, increase in tax or what? Decrease in tax. Then you will get what is the net change in income after tax. That is, what is the PAT? Increase in PAT or decrease in PAT. Comfortable? Then you have to add or less, sir, increase in depreciation or decrease in depreciation. You will get the incremental CFAT. What CFAT? That means if the decision is a replacement decision, sir, I will be following a technique called as incremental. What technique, man? Incremental. Comfortable? We are done with the initial cash outflow. Now we have done with the interim cash flows. I'm moving into the terminal year net cash flow. I'm in the end of the project. I'm going to close the project. If I'm going to close the project, man, whether the project is a fresh proposal or the project is a replacement decision, for both, closing is closing only. Correct? Because if it is a fresh project, sir, first time I purchased the plant and machinery, at the end of the 5th year, my dear lovable students, I am going to sell that. Then terminal cash flow. Sir, I purchased the original plant and machinery. After 2 years, I have changed into the new plant and machinery, which will be having a life of 3 years. Now that 3 years over, sir, after the end of the 3 years, I am going to disclose, sir, whether it is fresh proposal or replacement decision, the terminal cash flow calculation will not change. What they are saying, no, final salvage value. You have to sell the asset. When you sell the asset, how much you will get? That is called as final salvage value. Right? Add interim cash flows. Add interim cash flows. That is for Wi-Fi, year number 5. Year number 5, you will be having CFAT or incremental CFAT. Right? Even that is also a terminal cash flow for the year number 5. Sir, add or less what saving? Tax saving due to sale or disposal of the asset, including depreciation. At the end of the life of the project, I have to sell the asset. If I sell the asset, my dear lovable students, I will be having either profit on sale. If it is profit on sale, it's a tax outflow. Or I will be having loss on sale. If it is loss on sale, then it's a tax inflow that I have to adjust. Add release of net working capital. It will always be release of working capital. At the end of the project, I am not a loser to invest the working capital. Right, sir? So I will get the terminal cash flow. I will get the terminal cash flow. So the way of finding out the number 1, initial cash outflow for the fresh project and also for the replacement projects are different. The way of finding out the interim cash flow for the fresh project and also for the replacement project are different. Whereas the way of finding out the terminal cash flow for both the fresh project and the replacement projects are one and the same. So cash flows classified into 3 categories. Number 1, initial cash flow. Number 2, interim cash flows. Number 3, terminal cash flows. In this, interim cash flow means CFAT, cash flow after tax. Sometimes we have to calculate the CFAT in question. How to proceed for calculation of CFAT? Simple. Take the total number of units. How many units you are going to sell during a particular year? What is the selling price per unit, my dear lovable students? So number of units into selling price per unit, you will give the sales value. Right, sir? Marginal costing. From the sales value, I have to incur the what cost? Variable cost. Then I will get the contribution. From the contribution, reduce the fixed cost. Inside the fixed cost, cash fixed cost will be there and the depreciation will be there. Even if it is depreciation, reduce it. So cash fixed cost and depreciation, my dear lovable students. You will be getting earnings before tax. From that, pay the tax. Then you will be getting, sir, profit after tax. To that, add depreciation being what cash item? non-cash item, you will get the CFAT. The same only we have discussed in the start also. But how we discuss, from the sales we have to reduce the cost of goods sold. You will get the gross profit, reduce the depreciation. We will get the profit before tax. From that we have to reduce the tax. We will be getting the PAT. To that PAT we have to add back the depreciation. We will get the CFAT. But instead of having this shortcut method, we are from start number of units. Estimate the number of units you are going to sell. Estimate the selling price per unit. You will get the total sales value. Estimate the variable cost. You will get the contribution. Estimate the cash fixed cost. Estimate the depreciation. You will get the profit before tax. Pay the tax. You will get the profit after tax. Add back only depreciation. You will get CFAT. I don't believe with me. That's it. Fine. All the preliminaries are done. Okay, sir. Now take a decision, sir. Now you have to take a decision. How I have to take a decision? That is called as capital budgeting technique. For example, if you are going to doctor is saying that you are having sir fever of 103 degree. So you are not well. Sir, if you are saying that sir, then he will do some test and he will saying that you are having this problem. So there are certain technique doctor is what? Having. The same way in the capital budgeting chapter, effective investment decisions are crucial for companies' growth and sustainability, ensuring that resources are allocated to projects that maximize shareholders' value. That is a main problem. Sir, I am having lot of money, sir. Shareholders fund I am having, sir. If I put in a Mokka project, their money will go. I should invest in a project where the maximum return will be generated to such people. That should be my, sir, main agenda. So there are number of techniques available for appraisal of investment project and can be classified as presented below. So we are going to talk about capital budgeting technique. We are having either traditional or non-discounting technique. You just see, my dear lovable students, today I am going to invest in a project called as Y0. Sir, my project will run for 5 years, for example. So in Y1, Y2, Y3, Y4 and Y5, I am going to get the cash flows. Are you really with me? Yes, sir. Sir, the cash flow, what I am going to get at the end of Y5 will not be the same for today's value. I am saying that I will not consider the Trivandrum time value of money. I will not consider the time value of money. Such techniques are called as traditional technique or non-discounting technique. We are having two non-discounting technique, my dear lovable students. Number one, payback period. Number one, payback period. Number two, sir, accounting rate of return. This payback period is otherwise called a simple payback period and accounting rate of return or average rate of return. Are you really with me? Under these two technique, I will not consider the what value of money at all, time value of money at all. Coming to the next one, man, sir, time adjusted or discounted cash flows. I am going to consider the time value of money such as NPV, net present value, or PI, profitability index, or IRR, that is internal rate of return, or MIRR, modified internal rate of return, and discounted payback period. So 1, 2, 3, 4, 5. 5 major techniques are there by considering the time value of money. Number 1, net present value, profitability index, internal rate of return, modified IRR, and discounted payback period. In that, what is payback period is what our discussion is all about. What is ARR is what our discussion is all about. Discounting technique, what is NPV is what our discussion is all about. What is PI, profitability index, what is IRR, and sir, what is a summary for everything. That's it. That's it. That's what we are going to talk now. Can we, sir? Payback period. What this payback period is saying that, for example, if I am investing 10 lakh rupees in a project, if I am investing 10 lakh rupees in a project, every year the project is going to give me 2,50,000 rupees of CFAT. So this is my cash outflow. How much lakh? 10 lakh. How much I am going to get a CFAT? 2,50,000. So first year total how much I will get? 2,50,000. Second year 2,50,000. Third year, 2,50,000. Fourth year, 2,50,000. So 2,50,000 into 4 comes to 10 lakh. So by how many year? 4 years, I will recoup the money. That is called as payback. Within how much time the money what I have invested will return back is called as payback. This is simple payback. I have not considered the value what I am going to get at the end of the fourth year will not be 2,50,000, which will be less than 2,50,000. That is discounted payback. Now I am talking only about the payback. The simple payback period is of an investment is the length of the time required for a cumulative total net cash flows from the investment to equal to the total initial cash outlay. What is the initial cash outflow? 10 lakh. What is the CFAT? 2,50,000. So first year cumulative CFAT 2,50,000. Second year cumulative CFAT 5 lakh. Third year cumulative CFAT 7,50,000. Fourth year cumulative CFAT 10 lakh. That means I need 4 years to recoup the money invested. That is called as payback period. So payback period is equal to simple formula total initial capital investment. What is the initial capital investment? 10 lakh divided by annual expected after tax net cash flow, which is nothing but CFAT, which is 10 lakhs divided by 2.5 lakhs comes to 4 years. So if the project life itself is 3 years, please don't invest in that project, because sir, this project need at least 4 years to give back the money. It's like that 4 years is like your break-even period, and beyond 4 years you can enjoy the margin of safety. For example, if the life of the project is 10 years, first 4 years you will get only the principal portion back. The remaining 6 years, my dear lovable students, you are entitled to get the margin of safety. So 6 years. Next one, sir. ARR. Sir, ARR is otherwise called as accounting rate of return. What rate of return? Accounting rate of return. Sir, in capital budgeting, all the decision we will take based upon CFAT, cash flow after tax. Only one decision we will take upon PAT. That's what? Accounting rate of return. What rate of return? Accounting rate of return. So the accounting rate of return of an investment measures the average annual net income of the project, incremental income as a percentage of investment. What this ARR is calculating that I am investing, for example, totally 10 lakh. And sir, my average annual net income from the project is 2,50,000. Every year I am getting 2,50,000 from the project. That means 25% is the return of the project. 25% is the return of. So ARR, what is ARR? Average return. Profit after depreciation. Basically profit after tax, PAT, divided by investment in the beginning of the year. That means how much I invested. How much you invested? 10 lakh. If the profit after depreciation is 2.5 lakhs, you can say that 25% is the ARR of the project. Or certain people is having difference of opinion. Sir, average annual profit. Why are you taking the profit at the end? You have to take the average annual profit. In the sense means, if the life of the project is 5 years, my dear lovable students, sir, you have to take the profit after depreciation of all the 5 years. You have to total the profit divided by 5. Then you will get the average annual profit. Divided by investment in the beginning into 100. Hello, sir? Then people started criticizing that, sir, in numerator only you have applied the average. In denominator, you have not applied the average. That's why or average annual profit divided by average investment into 100. Comfortable? Sir, now question arises how to find out the average investment. Average investment is equal to opening investment plus closing investment divided by 2. Correct? Sir, average investment is equal to initial investment minus salvage value. Initial investment minus salvage value. That is initial investment cost of the asset minus salvage value. For example, 10 lakh rupees you are investing. 1 lakh rupees is going to be released. That means inside the project, how much lakhs is going to be there? 9 lakhs. Half of that 9 lakh. Plus what value? Salvage value. Because 100% of the salvage value, this one inside this 10 lakh, 1 lakh is there. Sir, inside this 1 lakh also 1 lakh is there. So 1 lakhs plus 1 lakh divided by 2. 2 lakh divided by 2, you will get 1 lakh. So add that what value? Salvage value. Are you really with me? Sometimes you may have additional working capital also. If you are having additional working capital, my dear lovable students, half of initial investment, half of, this is what initial investment, minus what value? Salvage value. That means that is the amount you are going to spend for the project, cash expenses for the project, correct? Because 10 lakhs I am going to spend, I am going to get 1 lakh rupees as salvage value. That means 9 lakh rupees is the cash investment. Take the average of that. Plus, you have to add the what value? Salvage value. Because salvage value is there in the start and salvage value is there in the end. Don't do average. Take the full value. Because if you take average also, you will get the same value only. Add additional working capital, because I will invest additional working capital before I start the project, and that additional working capital will be released at the end of the project. So same amount is there in the start, at the end. Don't take average, go with the additional working capital. Comfortable? So basically ARR is equal to average PAT divided by average investment. Average investment is equal to, sir, initial investment minus salvage value, adoda half, plus salvage value, plus additional working capital. That's it, game over. Are you already with me? With this, we have done the, sir, non-discounting technique. Two non-discounting technique. Number one, payback period and ARR. Now I am coming into the discounting technique, my dear lovable students. That means I will consider the time value of money. In that, the famous technique is the net present value. NPV is a discounted cash flow method that consider the time value of money in evaluating the capital project. This is the most hit technique. What I am doing is, sir, net present value is equal to discounted cash inflow minus discounted cash outflow. Discounted cash inflow in the sense means if the project is having life of 5 years, my dear lovable students, year number 1, year number 2, year number 3, year number 4 and year number 5. I will be getting CFAT, cash flow after tax, in year 1, year 2, year 3, year 4 and year 5. I will discount those cash flows because all these are present value. All these are present value. Sir, what is NPV? Sir, what is NPV? Net present value. Sir, discounted cash inflow minus discounted cash outflow. This cash outflow is a matter that is happening today, but cash inflow is a matter happening in future. I can't compare future value with the present value. If that is the case, man, I am comparing a future with the present. That will be wrong. Right, sir? So I have to convert the what value? Future value into the what value? Present value. For that, the technique used in our subject is called as discounting. That's why it is called as discounted cash inflow. So the CFAT, what I'm going to get in future, the terminal cash flow, what I'm going to get in future, I have to discount by using the KO. The answer is called as discounted cash inflow. Answer is called as discounted cash inflow minus discounted cash outflow. Generally, whatever I am spending at the start of the project, that is called as discounted cash outflow. That is called as discounted cash outflow. Right, sir? The difference between the discounted cash inflow minus discounted cash outflow is called as NPV, that is net present value. That is called as net present value. Comfortable? Sir, NPV is equal to present value of net cash inflow minus total net initial investment or present value of cash outflow. NPV is equal to discounted cash inflow minus discounted cash. That means C1. C1 means CFAT at the end of year number 1. So that's a future value. So y1 I have to brought to y0. That's why 1 divided by cost of capital raised to 1 plus C2. C2 in the sense means cash flow what I am going to get at the end of year number 2. First the y2 I have to bring to y1 and then I have to bring to y0. So I have to discount 2 times. That's why 1 plus k raised to 2. C3 in the sense means the CFAT what I am going to get at the end of y3. So y3 first I have to bring to y2 for that one time discounting. Then y2 have to bring to y1, that is for second time discounting, and y1 has to bring to y0 for that third time discounting. That's what C3 divided by 1 plus k raised to 3. Comfortable? Plus Cn. What is Cn? Nth year. For example, 20th year I am going to get a cash flow in future. Divided by 1 plus cost of capital raised to nth year. Hello sir. This is the present value. Present value of the future cash inflows. Future cash inflows. So C stands for cash flow for various years. K stands for discounting rate. That's your KO. N stands for life of the project. And I stands for what? Investments. Investment. Sir, investment means, I stands for investments means present value of the cash outflow. So present value of cash inflow minus I, present value of cash outflow, you will get the NPV, net present value. That's it. Sir, what is the decision rule? If the NPV is more than or equal to 0, dash the project. Accept the project. If the NPV is less than 0, reject the project. That's it, game over. Are you getting positive NPV? Accept the project. Are you getting negative NPV? Reject the project. That's it. That's it. Coming to the second technique called as profitability index or desirability factor or present value index method. 3 names are there. Either this technique is called as profitability index or desirability factor or present value index method, my dear lovable students. Sir, in comparing alternative proposal of comparing, we have to compare a number of proposals, each involving different amount of cash inflows. That's a main problem. Sir, I'm having 5 projects. Project 1, Project 2, Project 3, Project 4 and Project 5. I can choose the project which are having highest NPV. That's okay, fine. But the cash inflow and cash outflow of all the project won't be same. If the cash inflow and cash outflow of all the project is not the same, I can't decide based upon NPV. So I need another tool called as PI, that is called as profitability index. One of the method of comparing such proposal is to work out what is known as desirability factor or profitability index or present value index method, which is nothing but sum of discounted cash inflow, that means present value of cash inflow, divided by present value of cash outflows, that is discounted cash inflow divided by discounted cash outflow. Discounted cash inflow divided by discounted cash outflow. Simple. What first technique NPV is saying that discounted cash inflow minus discounted cash outflow. What PI is saying that discounted cash inflow divided by discounted cash outflow. அப்போ minus பண்ணா NPV, divide பண்ணா PI. If you minus, you will get in value. You can say that this is the value or addition in wealth. But if you divide, you will get that for every 1 rupee of outflow, I will get 1.2 rupees of inflow, 1.1 rupee of inflow, 1.3 rupees of inflow. Like that we will get. Are you really with me? So profitability index is equal to sum of discounted cash inflow, total of discounted cash inflow divided by initial cash outflow or total cash outflow, my dear lovable students. Inga paare, if discounted cash inflow is equal to 1 lakh and discounted cash outflow is equal to also 1 lakh. Okay. 1 lakh by 1 lakh? 1. That means here you have to check, is the profitability index is more than 1 lakh. If the profitability index is more than 1 lakh, then what the project? Accept the project. If the profitability index is less than 1, sir, 1 lakh rupees 1, then reject the project. That means the cutoff is whether it is more than 1 or less than 1. In case mutually exclusive project with highest PI should be selected. Coming to the next one called as IRR. So I am playing with the first one, NPV, which is discounted cash inflow minus discounted cash outflow. Right, sir? I am playing with PI, profitability index, discounted cash inflow divided by discounted cash outflow. According to NPV, if you are having positive NPV, accept the project. Negative NPV, reject the project. Comfortable? With regard to PI, more than 1, accept the project. Less than 1, reject the project. Right up. Now I am going to, sir, say that discounted cash inflow should be equal to discounted cash outflow. Minus பண்ணி பார்த்தாச்சு, divide பண்ணி பார்த்தாச்சு. இப்போ equal to போட்டு பார்க்கிறேன். Are you all with me? This is called as IRR. This is called as what? Internal rate of return. Sir, internal rate of return is a rate of return at which my discounted cash inflow will be equal to discounted cash outflow. Appo at certain rate, my cash inflow will be equal to discounted cash outflow. So IRR for an investment proposal is the what rate? Discount. That equates the present value of the expected net cash flow with the initial cash outflow. That means discounted cash inflow will be equal to discounted cash outflow. Right, sir? Sir, that can be done using this formula. This is a formula that I will be solving using, sir, interpolation method, which is the lowest rate plus NPV at the lowest rate divided by NPV at the lowest rate minus NPV at the highest rate into highest rate minus lowest rate. That, don't worry, I will come at the appropriate time. Sir, you said that if the NPV is positive, accept the project. Right? If the PI is more than 1, accept the project. This IRR, with whom I will compare, sir? You have to compare the IRR with the KO. IRR with the... If the IRR of the project is more than KO, accept the proposal. If IRR of the project is less than KO, reject the proposal. That's it, game over. If the IRR of the project is more than KO, accept the proposal. If IRR of the project is less than KO, reject the proposal. That means, what is the summary of decision? We are having non-discounted methods like payback period and ARR. For independent projects, when payback period is less than or equal to maximum acceptable payback period, then accept it. For example, for independent project means there is only one plant and machinery I'm going to buy. That plant and machinery's life is 10 years. When I'm putting payback period, it is getting 6 years. For me, 6 years is okay, then I will accept. When the payback period is more than or equal to the maximum acceptable payback, I will reject. But mutually exclusive project, 2 projects are there. One is A is there and B is there. If I choose A, I can't choose B. If I choose B, I can't choose A. If that is the case, project with least payback period should be selected. Because if I am choosing project A, I can recoup the money as quick as possible. Whereas if I am choosing project B, it will take longer time. Right, sir? So if it is a single project, independent project, you have to check with your own benchmark. Is the benchmark is more than the is the payback period more than the benchmark or less than the benchmark? You are expecting that within 5-year payback period should come, but the project is having payback period of only within 6 years. Don't accept the project. Project is having payback period of only 4 years. Accept the project. But if the project are mutually exclusive, choose the project with the least payback period. Coming to ARR, sir, you will be having some return in your mind. You want, by doing a project, 20% is the return. But the real return of the project is 22%. Accept the project. The project is giving only 18% return. Reject the project. So when ARR is more than or equal to minimum acceptable rate of return, accept the project. When ARR is less than or equal to minimum acceptable rate, reject the project. Sir, but 2 projects are there, sir, A and B. If I choose A, I can't choose B. If I choose B, I can't choose A. Then project with maximum ARR should be selected. Because if ARR increases, automatically profit increases. Right, sir? Now the discounted technique, my dear. We are having NPV. Simple. If it is a single project, is the NPV more than 0? Accept the project. NPV less than 0? Reject the project. Sir, it's a situation of mutually exclusive, sir. Then project with highest positive NPV should be selected. Highest positive NPV. Highest positive NPV should be selected. With regard to PI, sir, if it is a single project, is a PI more than 1? Accept the project. PI less than 1? Reject the project. But when the NPV is same, NPV value is same. For example, two projects are there, project A and project B. For this also NPV 50,000 and this also NPV 50,000. Then project with the highest PI should be selected. Highest PI should be selected. Because ஒரு ரூபாய் இங்க போட்டா எனக்கு அதை விட அதிகமா வருது, ரிட்டர்ன் வருது. Correct, sir? IRR, sir, for individual project, sir, if the IRR is greater than KO, accept the project. IRR is lesser than KO, reject the project. Whereas for a mutually exclusive project, project with the maximum IRR should be selected. Comfortable? That's it with regard to the overview of the revision of the capital budgeting. In the coming slot, we will be doing illustration number A, brilliant November 21 past examination question. We will be applying all the discussion there, NPV, IRR, PI, everything. And we'll be doing illustration number N, existing machine and new machine, unexpected question. Even this time, July 21, brilliant question, man. Replacement decision question we'll be talking about. Are you with me? It's a big question, man. And I will be solving illustration number M, which is an RTP May 2019 question. A reasonable question, man. With that, we have done with the revision of the capital budgeting. Are you comfortable? Have a revision. Quickly come back. We'll be solving question number 1, 2, and 3. Sir, very happy evening to all. Sir, we are going to start the revision of the last chapter, that is working capital management. Actually, we understood that our subject FM, financial management, is having mainly 3 objectives. Number 1, investment decisions. Where to invest the money is what the investment decisions. Then financing decision, from where to raise the money is what the financing decision. And dividend decision, sir, how much dividend should be distributed, as how much amount of money should be given back is called as dividend decisions. In this investment decisions, my dear lovable students, we are having long-term investments and short-term investments. Long-term investments are called as capital budgeting. We have just now completed. And short-term investment is called as working capital management. Under financing decision, we are having cost of capital. We are having capital structure theories. We are having, sir, leverage analysis, like that it goes. Under dividend decisions, my dear lovable students, we are having Walters model. We are having Gordon's model. We are having Modigliani Miller approach. Are you ready with me? Now the last slot we are going to discuss is the short-term investment called as working capital management. I'm coming to the working capital management. What do you mean by management of working capital? Sir, as a financial manager, you have to estimate the working capital. You have to estimate the, what is this working capital is all about, sir. For example, after you raise the fund, my dear lovable students, by way of equity share capital, preference share capital, debt, reserves and surplus, sir, if the entire money raised, that is after your financing decision, if 100% of the money, if you invest in the fixed asset, and you are saying that I am going to start the business from this moment, you can't start the business from this moment, because with the fixed asset, plant and machinery alone, you can't start the production. In order to make it workable, you need a capital called as working capital. That is called as working capital management. Are you really with me? So, As a finance manager, you have to estimation of the working capital. How much working capital you need. Number two, sir, what do you mean by working capital management? From where that fund I can generate, and how to handle the cash, how to handle the debtors, how to handle the inventory, how to handle the payable is what the objective of this chapter is all about. Fine. What is the accounting equation of the working capital? Working capital means current assets minus current liabilities. That's we already know. Current asset is the gross working capital, and current liability is the, sir, amount invested by outsider. Amount invested by outsider in my business. So in the gross working capital required, if the amount invested by the outsider in my business, if I reduce, means I will get the net working capital. I will get the net working capital. So management of working capital is about managing of current asset and current liabilities in a business. So you have to clearly manage each element of current asset, each element of current liabilities. If one element goes wrong, entire system, business will go wrong. In a broad classification, current asset that need management attention are receivables, debtors. For example, today if I am making a credit sale, after 9 months only I am getting money from the debtor, means 9 months my money is blocked in debtor. So that much time, sir, money should not be blocked in debtor. That means I should manage the debtors in a very, very better way. And inventory stock, sir, if I don't invest in stock at all, I may go stock out. Stock out will lead to loss. Or if I invest huge amount in stock, unnecessary stock pile up, it will lead to huge carrying costs that you would have already studied in your material chapter. And cash and advance like prepaid expenses, etc. If I am holding high amount of cash, sir, I am losing. I will be having liquidity. But if I park that extra cash in the, sir, FD or something, I will be able to earn some interest. So if I am holding more cash, I am losing that opportunity. Are you all with me? In the liability side, current liabilities are like payable, creditors and other outstanding dues. Sir, if creditors is saying that when I supply the raw material today itself, if I have to get the money, means I need money in advance, whereas my debtor is paying very late. So he will be paying late only, but to this guy I have to pay now itself. So my entire business will go wrong. So each components of working capital as classified above are managed separately. It's like, sir, in our body, 2 eyes need separate care. Sir, 2 hands need separate care. Legs need separate care. As a body as a whole need separate care. If you taken care of every organ in our human body, we can say that I am taking care of the body as well. So if you have to take care of current asset, that is cash, that is, sir, stock, raw material stock, WIP stock, finished good stock, debtors, and sir, all the elements of current liability. But the managerial approach and policies like liquidity versus profitability, conservative to aggressive investment in working capital are at the core of every decision taken by management. Abdina, sir, you are saying that there should be proper stock in the organization. For that, if I am started holding more stock, automatically my carrying cost will be high. If I don't carry stock at all, I will become stock out, and my, sir, the opportunity cost will come, correct? So I have to take, or I have to fix a working capital where my liquidity position and my profitability position will trade off. My liquidity position and my profitability position will trade off. That's what trade off between profitability and liquidity. What will happen, sir, for smooth functioning of day-to-day business? Maintaining of liquidity of fund evenly during the operating cycle is important, but unnecessary tying up of fund in idle assets is not only reduces the liquidity but also reduces the opportunity to earn better return from a productive asset. Sir, I understood that in each element of the working capital I have to invest. But if you are investing more money in each element of working capital, unnecessarily my money will be held up there. Sir, there 2 things will happen. I am losing an opportunity to earn a return. If that money, instead of investing there, if I would have invested somewhere, I would have got some return. And here also unnecessary idle fund are parking. So trade-off between the liquidity and profitability can be attained by using the following technique. First one, inventory, my dear lovable students. The first component is inventory. How you are going to manage the inventory, whether it is raw material inventory or WIP inventory or finished goods inventory. Advantages of higher side, profitability. Sir, if you are keeping, sir, so much of inventory in your premises, fewer stock out will only come. That means stock out option itself will not be there. Whoever asking goods, you can, sir, produce and give. That means increase the profitability, right? So profitability will increase. But lower inventory require, for example, advantages of lower inventory side. I am not keeping so much of inventory, sir. I am keeping only required inventory, sir. It lower inventory require less capital, so no need to invest more capital in the inventory. But sir, endangered stock out and loss of goodwill. Sometimes a very big order will come and they will say that quickly manufacture and give to me. I am saying that sorry, sir. In my stores, I don't have that much raw material, sir. Sir, you give order to me now. I will place an order with my creditor. He will supply the raw material because minimum lead time and maximum lead time is there in costing, right? He will supply within minimum lead time of or emergency purchase of, sir, 10 to 15 days. Let the raw material come. I will manufacture for you. After that, I will supply you. He will say that, poda, because my business will lose. So if I keep higher raw material, then also problem. If I keep zero raw material or lower raw material, then also problem. Then I have to keep a trade-off between profitability and what? Liquidity. My profitability should not be affected and also my liquidity should not be affected. Right, sir? For that, use technique like economic order quantity or just-in purchase called a JIT purchase to carry optimum level of inventory. Always you ensure that you are carrying optimum level of inventory. What level of inventory? That is called as, sir, business policy. That's what, while estimating the raw material, we will say that it is a policy of the company to carry raw material for 3 months. 3 months. Why that is a policy? Because the person, some listed companies and all, you know how the recipients, for example, I am person, I have to place an order with you. The first question I will ask you is, what is your inventory carrying policy? Because if you are having an inventory carrying policy of only what? 1 month, I will say that if the 1 month stock has been exhausted in the stores, within how much time your supplier will supply the goods? So after 1 month, if production stops, means, sir, you will order with your supplier. If that guy takes more time or lorry strikes comes or abnormal reasons like COVID or something happened, my dear lovable students, where you will go for raw material? So I will say to you that you should have a raw material carrying period of at least how much month? 3 months. Like this only that policy will be, sir, designed. That company will take that policy saying that how much production they are going to make in a year. Now the receivable, I am coming to receivable. Receivable means what? Debtors. After I make the cash sales, that moment itself I will get the money. That is the beauty of the cash sales. But after I make the credit sales, I am saying to the debtors that you give whenever you can, then they will never give at all. Correct? Higher credit period, I am giving 50 days, 60 days, 1 year credit period means attract customer. Everyone will come and buy product. It will increase revenue also. Yes, profitability increases in books, not in the cash box. Because if you see the net profit will be huge in the books. Correct? But sir, if you are keeping very less, okay, so this is having one advantage. Profitability increases. I am not giving so much of credit period. When I make the credit sales, I am saying to my debtor that immediately pay the cash within 10 days, 20 days, 30 days. Then cash sales provide liquidity, but fail to boost sales and what? Revenue. I can't give extensive credit period to my debtor, or I can't be very stringent saying that only cash sales is allowed. If there is no credit sale, no customer will be ready to buy from me. So I have to trade off. I have to what? Trade off. How to trade off? Evaluate the credit policy. You have to evaluate the credit policy. That is called as debtors management. Use the service of debtors management, factoring agencies. There is a concept called as factor. Sir, instead of you collecting money from the debtor, you appoint some other agency to collect the money from the debtor. That is called as factoring. That is called as what? Factoring. So engage the factoring. engage the factoring. They will ensure that they are collecting money on time. Next one, sir, prepayment of expenses. As a businessman, there are two options you are having. Sir, you can pay all the expenses in advance. Next month rent, now itself you are paying. That is called as prepayment of expense. If you are doing like that, it reduces uncertainty and profitability at inflammatory environment. Because I will tell you, now the 1 kg tomato is 100 rupees. Okay. After 1 week, 1 kg tomato is 120 rupees. To the shopkeeper, you paid now itself for the next week consumption of tomato. How much rupees you paid? 100. So next week, if the price increases to 120, will you pay that extra 20? No. Because in inflationary environment situation, this will be very, very useful for you. This will be very, very useful for you. So if you are doing like this, my dear lovable students, if your profitability will surely increase, because you will not incur so much of cost. You will be incurring less cost only. But someone is saying that no, I will be paying only at the time of incurring the cost. Sir, let the tomato price really let it come. Sir, I am asking you a question that if it become 90, what you will do? If I pay now itself 100, it will be a loss. So I will wait for the actual price. If that is the case, it improves or maintain liquidity. That means till the next month money will be there with you. But sir, liquidity increases. Here profitability increases, here liquidity increases. I don't want to increase the profitability. I don't want to increase the liquidity. I want a what? Trade-off. Then you have to make a cost benefits analysis is required. You have to do a CBA, cost benefit analysis. Are you really with me? Sir, cash and cash equivalent, sir. How much cash I should hold, sir? Capital can be used in some other investment avenues. Sir, if I am holding so much of cash, my dear lovable students, instead of holding so much of cash, if I am investing somewhere, I will get some revenue, right? So here my profitability will be increased if I invest in some other place. Okay, sir. Don't hold cash at all. If that is the case, cash can be invested in some other investment avenues. Am I right? Yes, sir. So here liquidity will reduce because you don't have what at all? Cash at all. If you invest the entire money in some other investment, your liquidity reduces. Correct? Then you have to prepare the cash budget and other cash management technique can be used to check whether you are out of cash or not, whether your liquidity is getting affecting or not. So these are the tools. That's why we are learning the tool called as data management. We will learn. Called as factoring. We will learn. Called as cash budget. We will learn. We will be learning, sir, EOQ. We will be learning. Now payables and expense management. Payables and honored in time improves goodwill and helps in getting additional discount. So if you are getting more additional discount, automatically profit will increase. Am I right? Sir, what happened to liquidity? Payables are honored in time, improve the goodwill and helps in getting what discount? Future discount. Even my liquidity also will increase. Evaluate the credit policy and the related cost. That means what this chapter is saying, that working capital management is like a body of a human being. In that body of a human being, sir, we are having some important components. We have to take care of eyes. We have to take care of legs. We have to take care of, sir, hands. We have to take care of nose. Every internal organ. One organ needs, sir, proper attention. If one organ goes, sir, wrong, then either profitability will get affected or liquidity will get affected. In a business organization, profitability should not get affected or liquidity should not get affected. Right up. Yes, sir. That's why we are having tools. How we are having tools in capital budgeting, like NPV, like IRR, like PI. The same way, these are the tools in the chapter working capital management to trade off the profitability and also the liquidity. Sir, I don't want a current assets or current liability where my profitability is higher and liquidity is lower. Where my liquidity is higher and profitability is lower. I want a trade-off position where I want to enjoy liquidity and also I should have a profitability. So to check those are, sir, I am having the tools. Come on. Now, investment and financing of working capital. Sir, investment in working capital is concerned with the level of investment in what asset? Current asset. Minus, sir, financing decision concerned with the arrangement to fund to finance to the what capital? Working capital. For example, first you have to calculate that how much is the current asset you need. Current asset comprise of how much is the raw material stock you need. How much is the WIP stock you need. How much is the finished good stock you need. how much is the debtors you need, how much is the cash you need. This, if you total, you will get the gross working capital, right, sir? From the gross working capital, my dear lovable students, sir, you have to see the sources of working capital, like financing decision concerned with the arrangement of fund. Are you going to raise the gross working capital by issuing long-term loan? Are you going to raise the fund by issuing commercial paper? Or are you going to request your creditors? Are you going to request your creditors for liability? Even they are also source of fund. Are you really with me? That's what, from the what asset? Current asset. You are reducing what liability? Current liability. You will be getting the working capital, net working capital, right, sir? Yes, sir. So what are the approaches of working capital investment? So you are a businessman. You understood one thing. What you understood? No. Whatever money I have raised by equity share capital, preference share capital, debt, and also the reserves and surplus, if the entire money has been invested in the capital budgeting by investing in plant and machinery, daily I can't do the production. So in order to do the production, I have to work the business. In order to work the business, I need a capital. That capital is called as working capital. Sir, I am going to fix a working capital as a businessman. There are three approaches I can choose to fix the working capital. Or first one, I can be very aggressive. I can be very aggressive. Or I am saying that I am very conservative. Or I can say that I am very moderate. So what is aggressive, sir? Sir, a businessman is said to be aggressive if he is investing in the working capital. That is what? Current asset is kept at minimum. Kept at what? Minimum. That means what is current asset, my dear lovable students? Current asset comprises of inventory, raw material stock, WIP stock. Inventory means raw material stock, WIP stock, and the third one, finished good stock. Right, sir? Then next one, debtors. Then next one, cash. Then next one. That's it. So my dear lovable students, sir, you are a businessman. In your stores, only 2 days consumption, you have kept it as what? Stock. If that is the case, my dear lovable students, if that is the case, let me ask you a question. If suddenly you are getting a very good order saying that I need the production for next 10 days, 20 days, 30 days, my dear lovable students, will you able to sell that? Yes. Will you? Yes. Will you able to sell that, sir? No, sir. No, sir. My dear lovable students, if that is the case, you can't honor it. That means you have invested only less amount in the what asset? Current asset. That means you are very aggressive. You are what? Very aggressive. NDT holds lower level of inventory, follows strict credit policy, keeps less cash balance. If that is the case, we are saying that your working capital policy is an aggressive policy. What policy? Picture karapaya. They are not keeping proper stock in the stores. They are not giving proper time to the debtor. They are not having proper liquid cash in the business. If someone is like that, you can say that such a businessman is an aggressive businessman. Aggressive working capital policy. Comfortable? Next one, conservative, sir. What do you mean by conservative? I have invested in working capital. There is no doubt about it. My current asset is increased. My current asset is, entity maintains higher level of inventory. Sir, follows liberal credit policy and keeps cash balance as high as to settle any current liability immediately. Generally, sir, in the same industry, everyone is keeping only 2 months stock as the holding period. But I am keeping for 6 months, loose money. Everyone is having only 1 lakh rupees cash in hand. Sir, in my table, always 10 lakh rupees cash in hand is there. My idea is, if someone is coming and asking that, you are liable to pay me this much, take it, man. That's it. Game over. So that is called as conservative approach. Sir, aggressive is very bad. Conservative is also very bad. Always you choose moderate approach. Under this approach, a balance between risk and return is maintained to gain more by using the fund in a very what manner? That means if you are following the moderate approach, my dear lovable students, then your profitability will not get affected and your liquidity will not get affected. That is called as trade-off. But aggressive means anytime you will get a big hit. Sir, conservative means unnecessary you are wasting your money. Are you agree with me? Opportunity cost will be there. Why are you holding that much of inventory? If you are holding that much of inventory, automatically your carrying cost will increase. Correct? For that much you have to pay God on rent. automatically opportunity cost will increase as lose money. So don't follow aggressive, don't follow conservative. Better to follow moderate. That subject have not said like that. Subject financial management have never said that aggressive policy is a bad policy. Hello, sir. Conservative policy is a bad policy. Moderate policy is a good policy. Like that subject have not said. Sometimes you may eat 3 idli. I may eat 7 idli. I am taking classes for 15 hours. Are you taking? No. So I may need that much of energy. You simply sitting hearing, sometimes sleeping also in between. So you may not need that much energy. So you can't say that my thing is a conservative approach and yours are a what? Aggressive or moderate. So I can't say that this is good or that is bad. Everything is good. Everything is bad. Depends upon the situation. Are you agree with me? So graphical representation of the above approach towards investment in working capital is depicted as below. Always, my dear lovable students, fixed asset will be same. Because fixed asset we will not change. Correct. Sir, if it is aggressive, my dear lovable students, the first one, aggressive. Aggressive means I will be having less current asset or more current asset. Aggressive means I will be having more current asset or less current asset. That's why I am having current asset, but not so much. So I am having conservative means, sir, conservative. This is what the level of current asset, man. Sir, average means it's between conservative and between aggressive. Sir, this may be a theory questions like that also. You may get an exam. This will be useful, right, sir? Now we are going to manage the working capital, man. Financing of NSR working capital. Financing of, from where you understood that current asset minus current liability is the working capital. This is the net amount as a business owner you are going to invest in the business. Alright, sir. So when management of an entity decide the quantum of investment to be kept in the form of what capital? If the management is thinking that this much amount to be invested in working capital after estimation of the working capital, the next question is to be answered is how the decided quantum of investment will be arranged. From where the money has to be arranged. Management explores the avenues such as sources to get the working capital financed. From where and all money can be raised. The sources can be either internal to the entities known as spontaneous sources and external sources, which is arranged by negotiating with the what institution? Financial institution or bank and other specified entities called as debt factors. Either within the organization itself, sometimes they would have raised the capital. From that excess money, they can pump the money for the working capital. That is called as spontaneous sources. Or you may have reserves and surplus also. By using the reserves and surplus, you can invest the amount for the working capital. Or the second option or the opportunity available will be, you have to borrow money from outside. How you have raised the capital? You have to go to bank and ask that I need a working capital of this much. Are you really with me? Then the tandem committee has given some norms saying that, sir, approach number 1, approach number 2, approach number 3. So what are the sources of, sir, working capital? You are having sources, spontaneous sources, trade credit. That means you can go and cry before the creditor that you supply the raw material today. Please don't ask me payment today itself. Please give me a credit of 2 months. That is a spontaneous sources. Or you can give bills payable. You can give bills payable to the creditor and saying that you can get this bills payable. You can money from this bills payable after 2 months. So my bills payable is my creditor's bills receivable. So he will go and discount with the bank. So after 2 months, I can pay to the bank. By that, I can have some relaxation. This is called as spontaneous sources or accrued expenses, my dear lovable students. I can say that, sir, please wait, some expenses like wages and all. I can say that I will pay at the end of next month. I want a time lag of what, 1.5 months. So I will be getting some delay. These are spontaneous sources. Next one, negotiated sources means I'm going outside. I'm going to the bank and inter-corporate loans and deposit. I'm taking deposit. Study very well, law chapter, deposit, which will come for 4 more. Come on. Credit from financial institution or bank. I'm going to banks and taking loan. Commercial papers and public deposit. I'm issuing CP. I am issuing debenture, bills discounting and rediscounting and factoring. These are the another options. So if I am arranging the working capital within the organization, that is called as spontaneous sources. If I am arranging the working capital from outside sources, that is called as negotiated sources. Are you really with me? What are the forms of bank credit, my dear lovable students? Now you are going and standing before bank. You can ask for cash credit, CC, or you can ask for bank overdraft, or you can bills discounting, or you can bills accepting, a line of credit, letter of credit, bank guarantee. These are the various forms of banks. So bank will give you sources of finance, are working capital in these forms and all. Are you really with me? This is the introduction for the chapter. What capital? Working capital. Sir, in this chapter, we are going to estimate the what capital, man? Working capital. Sir, in order to estimate the working capital, we are having various methods. So, amount of working capital required to keep the normal business operating without any interruption is made before the operating cycle begins. Sir, what do you mean by operating cycle? You will be having cash. From where you got this cash? From the sources of finance. By equity, by preference, by debt, by reserves and surplus, you raise the fund. That means you have already taken a decision called as financing decision. So financing decision give you cash. With this cash, you will purchase raw material and you will keep the raw material in the stores. After certain point of time, that will be issued to the work area, that is WIP, and you will invest in labor and overhead. So this raw material will become what? Work in progress. This work in progress will become finished goods. This finished goods will become debtors. This debtors will become cash. That means, for example, if you are having 1 lakh rupees cash, with this 1 lakh rupees cash, my dear lovable students, today you are going and purchasing raw material. And this raw material has to be there in the stores for how many days? 15 days. After this, from the stores, you issue to the work area. Sir, it is taking 30 days in the what area? Work area. Sir, immediately after come out of the factory, we can't sell. It has to go and sit in the godown. For example, 45 days if it is going and sitting the godown. Now it has become credit sales. Correct? Once it has become credit sales, debtor has to pay me money. Debtor is giving money only within 60 days. That means 15 days plus 30 days plus 45 days plus 60 days comes to 150 days. That means now I am having cash with me, right? Yes, sir. Now this cash will become cash within how many days? 150 days. Now how much cash is with me? 1 lakh. But after 150 days, it may become 1.2 lakhs. That is extra profit. Because to the debtor, I will sell at a profit. I am not here to talk about that 20,000. That 20,000 is my EBIT, earnings before interest and tax. With that, I will again settle to the financing decision people, such as interest, such as tax. All those things will be there. So once one cycle over, I will withdraw 20,000 from that and I will reinvest 1 lakh into that. Are you really with me? And that cycle will rotate for one more time. So operating cycle, also called as what capital cycle? It indicates the length of time between paying for material entering into stock to realization from sales of finished goods. That means how much time you are taking from the payment for the what material? Raw material, till the realization from the debtors. This length is called as what capital cycle? Working capital cycle. Working capital cycle. So before one cycle start, management has to determine how much to be invested in the working capital. There are various methods which are used by management to assess the amount of working capital required to keep operations on. What are the methods? Number one, they can find out the operating cycle. They can find out the current asset holding period. For how much period they are going to hold the raw material stock, how much period they are going to hold the WIP stock, how much period they are going to hold the finished goods stock, how much period they are going to hold the debtors, how much period they are going to hold the cash. Next one is ratio of sales. Ratio of sales. They can estimate the working capital by ratio of what? Sales. And the ratio of what? Investment, fixed investment. These are the various methods of estimation of what capital? Working capital. Comfortable? Now man, in the form of an equation, the operating cycle can be expressed as follows. Operating cycle is equal to raw material. How much period? What is the raw material holding period? plus WIP holding period plus finished goods holding period plus debtors holding period minus creditors payment period is called your net working capital. If you add all this, you will get the gross working capital. From the gross working capital, if you are reducing the creditors payment period, you will get the net working capital. Net working capital. This is what that's why we are saying that working capital is equal to current asset minus current liabilities. Working capital is equal to current asset minus current asset means what is the total amount I am going to invest in the gross working capital. Minus current liability means how much amount is going to be invested by the outsider in my business. That's what current liability. So current asset minus current liability means net working capital. That is the amount I have to invest my from pocket to the business. Net working capital is the amount I have to invest from my pocket to the business, because I will estimate how much is the raw material stock I need. I will estimate how much is the WIP stock I need. I will estimate how much is the finished good stock I need. I will estimate how much debtors I need. I will estimate how much cash I need. That is a gross working capital requirement. That is a gross working capital requirement. Look, sir, out of the gross working capital requirement, my dear lovable students, actually the entire gross working capital requirement should be invested by myself only as a businessman. But there are sources of finance. What are the sources of finance? The first source of finance is the spontaneous source of finance. What is the spontaneous source of finance? Creditor. What is the spontaneous source of finance? Creditors for expenses. So I will go and ask to my creditor. I will go and ask to my laborers, factory owner, rent payable, electricity payable. Please give me a delay of 1 month. Right? So actually, out of the gross working capital to be invested by the investor, that is businessman, some part of investment has been invested by outsider. So that money no need to be invested by myself. Right? That is why current asset minus current liability. Current asset means total working capital required. That is why it is called as gross working capital. Minus current liability in the sense means out of the total working capital required, how much money has been invested by the outsider. Correct? That means as a businessman, I have to invest only the net working capital. Can I proceed? R stands for raw material holding period. W stands for WIP holding period. F stands for finished goods storage period. D stands for debtors collection period. And C stands for creditors payment period. That means working capital cycle is equal to raw material holding period plus WIP holding period plus finished goods holding period plus debtors collection period minus creditors payment period. The various components of operating cycle may be measured. First one, raw material holding period. What you are going to find out here, holding period, always you just think. One example you keep, any formula you can derive in 2 minutes. For example, if you are having 10,000 rupees in your hand, every day you are spending 2,000 rupees. For next how many days you are having? 5 days. So what is the average money you are having? 10,000. What is the average expense? What is the average money you are having? 10,000. What is the average money? Opening money plus closing money, man. 10,000 rupees you are having, Yes, sir. Correct? What is the average expenses per day? 2,000. Correct? Up 10,000 divided by 2,000 comes to 5 days. For next 5 days, you don't worry at all. That's what holding period. That's what holding period. The same way. What is the average stock of raw material I am having? Sir, in stores, I will not sell the raw material. I will consume the raw material. What is the average consumption per day? Since in numerator I have taken average, denominator also I have to take average. That means எவ்வளோ இருக்கு ஒரு நாளைக்கு எவ்வளோ, அவ்வளவுதான் matter over. Total உங்ககிட்ட how much cash you are having? 10,000. Per day how much you are spending? 2,000. That means how much is the holding period? 5 days. That means for next 5 days I am holding cash. Yes, sir. The same logic apply. How much raw material you are having? How much consumption per day? That means you can easily find out that, sir, I am holding raw material for this much days. Comfortable? Next one, sir. What is the WIP holding period? You take the in WIP, in the work area, you will hold the WIP. What is the average stock of WIP you are having? What is the average production cost or factory cost per day? Comfortable? With regard to finished goods storage period, man, what is the average stock of finished goods divided by what is the average cost of goods sold per day. Comfortable? Sir, with regard to receivables, what is the average accounts receivable divided by what is the average credit sales per day? With regard to creditors, what is the average accounts payable divided by average credit purchases per day? That means numerator also average, denominator also average. Are you with me? If I take numerator average and denominator I have not taken average, means, my dear lovable students, it's like monkey by donkey. I want monkey by monkey, then only I will get the comparison. Am I right? That's why. என்ன இருக்கு divided by என்ன வேணும் எத்தனை நாளைக்கு ஒரு நாளைக்கு, then I will get the number of days. Am I right, sir? Yes, sir. That's it, man. So I'm going to estimate the amount of different component of current assets and current liabilities. What are the current assets? Sir, my first current asset is raw material inventory, then WIP inventory, then finished goods stock, right, sir? Then debtors, then cash and cash equivalent, then trade payable, otherwise called as creditors, then direct wages, sir, overheads other than depreciation and amortization. Can I proceed, sir? How to find out the raw material inventory? So, as a businessman, I have to keep raw material stock. I have to keep raw material in the stores. Sir, how much stock to be kept in the stores is based upon how much you are going to consume. For example, if you go to, sir, kitchen and see, Amma would have kept 5 kg of rice because Amma knows that in a month she will be maximum consuming 20-30 kgs. For example, I am saying, if she is consuming only 30 kg in a month, she will not reserve or preserve 30 kg. So what estimation of working capital? What is the estimated production? What is that? For example, in a year 60,000 units if you are going to produce, divided by 12 means every month you are going to produce 5,000 units. Right, sir? What is your policy? What is your policy? 5,000 unit is the consumption you are going to make. Every unit, for example, you are going to purchase at 3. That means 5,000 into 3 comes to 15,000. Right? Sir, as a company's policy, you want to keep the raw material stock for how much period? Do you want 2 months? Do you want 3 months? That is absolutely your policy. Absolutely your policy. Because when you are taking that policy, you should keep that whether your working capital is aggressive or what, moderate or conservative. That and all you have to keep in mind. Your profitability should not get affected. Your liquidity should not get affected. That and all you should keep. Then only you should decide a policy that if I keep 3 months stock, that will be sufficient for me. If I keep 2 months stock, that will be sufficient for me. So what I have to do now, in a year I am going to manufacture 60,000 unit. That means every month 60,000 divided by 12, I need 5,000 unit. Every unit is 3 rupees means, my dear lovable students, 15,000 is the raw material cost I am going to incur for 1 month. If my policy is I want a raw material stock of 3 months, into 3 means 45,000 rupees I have to invest in the raw material stock. Clarity? Coming to WIP, man. My dear lovable students, if it is WIP the same, how much units you are going to manufacture? 60,000. Divided by 12 means how much units? 5,000 units every month you have to go into manufacture. Correct? My dear lovable students, sir, my dear lovable students, what is the estimated WIP cost per unit? Estimated WIP cost in the sense means, sir, in order to manufacture 1 unit, I need direct material, I need direct labor, I need direct expense. I will get the prime cost. At what overhead? Factory overhead. The main problem is, my dear lovable students, sir, direct material. Generally, I will issue 100% at the start itself. Right, sir? Generally, I will issue 100% at the start itself. Correct? But the other components like labor, I will issue only 50%. Direct expense, I will issue only 50%. Factory overhead, I will issue only 50%. That means I have to first find out the estimated WIP cost per unit. It will not be equal to the full cost. It will not be equal to the full cost. Right? Assume the estimated WIP cost per unit is 7 because material itself is coming 3. For that, labor and overhead has to be applied. Assume it is 7 into average WIP holding period. What is your policy of the company? You want to hold WIP for 0.5 months, or you want to hold WIP for 1 month, or you have to hold WIP for 2 months, then you will get the cost of investment to be made in the WIP. Cost of investment to be made in the WIP. ஒரு one line சொல்றேன். Try to appreciate, my dear lovable students. 50 lakhs you are taking and you are going to buy machinery A. 20 lakhs you are taking and you are going to buy machinery B. 10 lakhs you are going to take from the capital money available and you are going to buy machinery C. Another 10 lakh you are going to take from the money available and you are going to buy machinery D. My first question, total how much machine you bought? 4 machines. First machine 50 lakhs. Second machine 20 lakhs. Third machine 10 lakhs. Fourth machine 10 lakhs. So 50 plus 20, 70 plus 10 plus 10. So from the total money available, you took 90 lakh. And you purchased how many machine? The same way, from the total money available, you will invest a part of the money in the raw material stock, part of the money in the WIP stock, part of the money in the finished goods stock, part of the money in the debtor, and part you keep it as cash. This is called as what? Capital management, working capital management. Comfortable? Able to link it? Now coming to finished goods, my dear lovable students. Sir, finished goods, how many units you are going to manufacture? 60,000 units you are going to manufacture, right? Divided by 12 means every month how many finished goods you will manufacture? Into estimated cost of production. Look, sir, this is estimated WIP cost. This is 7 per unit, but this will never be 7 per unit. This will be more than 7, because every element of cost will be 100% completed, correct? Into average storage period. You want to keep the raw material, sir, finished goods for 3 months. That means 5,000 into 10 comes to 50,000. That is for 1 month. Into 3 comes to 1,50,000. That means from the total money available, take 1,50,000 and keep that 1,50,000 in the finished goods. Comfortable? Now, debtors, my dear lovable students. Sir, estimated credit sales unit. Inga estimated production unit. Inga term changed. Not the estimated sales unit, because there are 2 types of sales are there. Cash sales and credit sales. For cash sales, I don't need to invest working capital at all, right? Yes, sir. So estimated what sale? Credit sale. For example, out of 60,000 unit, I am producing 20% is cash sale and 80% is credit sale. Purida. That means 60,000 into 80% is equal to 48,000. So totally in a year, I want to make 48,000 credit sales unit. So 48,000 divided by 12 comes to, every month I want to make a credit sales of 4,000 unit into cost of sales. There I will not include the debt, because depreciation is a non-cash item, my dear lovable students. Hello, sir. Into average collection period. You want the average collection period as 2 months, then into 2 months. Then I will get the cost of debtor. So the same way, I have to calculate the cost of raw material stock, cost of WIP stock, cost of finished good stock, cost of debtors, cash and cash equivalent, minimum desired cash and bank balance to be made. It is a policy of the company. Company can decide that I am going to keep 10,000 rupees minimum cash. I am going to keep 12,000 rupees minimum cash, like that. So if you add raw material holding period plus WIP holding period plus finished goods holding period plus debtors collection period, you will get the gross working capital. This is the amount you have to invest for the purpose of working capital. For this, you need source. There are 2 sources are there. Spontaneous source are there, and also outside source are there. The spontaneous source is what? What payable? Trade payable. Sir, you will check estimated credit purchase. One more highlight. It's not total units of purchase. It is estimated credit purchase. So my dear lovable students, for out of 60,000 units you are going to purchase, assume that 70% is credit purchase, means 60,000 into 70% comes to 42,000 units is what you are going to purchase. So 42,000 divided by 12, you will get a monthly purchase. Are you all ready with me? You will be getting 3,500 into Sir, credit period allowed by supplier. That means this into what is the purchase price you have to multiply. Then you will get a cost of 1 month purchase. You can't take a decision here. Who have to take a decision? Creditor, supplier have to take a decision. Go and ask him, what is the credit period allowed by the supplier? Are you all really with me? For example, if he's saying that I am ready to give you 2 months credit, into 2 months, that much money out of this gross working capital have been invested by the outside party. That amount, no need to invest it by myself. Comfortable? Coming to direct wages, man. That is also a spontaneous working capital. You have to go and ask your, sir, employees that, sir, don't ask me wages today. First work, let the month over, then get the wages. So estimated labor hours, how much hours they are going to work. Into wage rate per hour. For example, if they are going to work, for example, 5,000 hours they are going to work. Every hour 10 rupees you are going to pay the wage rate. So 5,000 into 10 comes to 50,000 divided by 12. Divided by 12. That means, sir, 50,000 divided by 12 means 4,100 and some numbers you are getting into average time lag in payment of wages. Is it the delay is half month? Is the delay is 1 month? Or the delay is 2 months? Generally wages and all 1 month delay will come. But in special question, they may say 0.1 month. Next one is overhead. Overhead in the sense means you would have taken factory for rent. That rent you will not pay on the first day of a month. You will ask the landlord that, please wait till the end of the 1 month. Right? So what is the estimated overhead? This is not unit based. You know in costing that variable cost will move according to the units. Whereas the rent will not move according to the units. Right? That's why it is not based on units. That's why what overhead? Estimated overhead. Divided by 12 months or 365, whatever it may be. You will get the overhead per month into average time lag in payment of what? Overheads. Then you will get the total money going to be invested by the outsider in our business. That money we no need to invest. So that can be reduced as current liabilities. So number of days in a year can be taken as either 365 or 360. This is how you have to manage your working capital, my dear lovable students. Current asset means inventory. Inside inventory, you are having raw material, WIP and finished goods. Clear? You are having debtors. In that trade, debtors will be there, bills will be there, and minimum cash balance. You will be getting gross working capital. This is the amount you have to invest in your business, provided if there is no spontaneous suppliers of finance. Who are the spontaneous suppliers of finance? Like trade payable, like bills payable, like wages payable, like payable for overhead. You will get the current assets over current liability. This is called as net working capital. Correct, sir? To this working capital, sometimes these calculations may undergo speculation. That's why every company want to safeguard themselves. So they want to keep what margin? Safety margin. At safety margin, you will get the net working capital. Comfortable, sir? This is how you have to estimate the working capital. In the coming slot, we will be start doing, my dear lovable students, estimation of working capital. Question number 1. Working capital management, RTP November 2022 question. Right, sir? This is estimation of what capital? Working capital. Till now, whatever we have discussed from here, will be solving that question. Comfortable? Are you all really with me? Have a revision up to this and come back. We'll solve that question. Sir, very, very, very happy evening to all. So we are doing working capital management. My dear lovable students, we are going to complete the entire revision of the FM. In that, the last chapter is working capital management. In that, the last topic is the cash management. Sir, actually, we have analyzed the stock by way of stock holding period, debtors by way of debtors management, under total approach, under the incremental approach, and also, my dear lovable students, we have analyzed the factor decision also. Sir, another strongest important component of the working capital management is a cash management. We will be going through the theory part first. We'll be doing one solid question from ICA study material, which is an expected question for exam. Treasury management. Sir, what is mean by treasury management? Okay, sir, debtors management we have heard. Debtors management means how much should be the debtors collection period. The same way, treasury management encompasses planning, organizing, controlling the fund. How much fund you should keep? That's what planning the fund. So from where and all we can, sir, source the fund, organizing the fund, and control the fund and working capital of an entity in order to ensure best use of the fund. Always we have to maintain liquidity, reduce the overall cost of fund, and mitigating operational and financial risk. This is what the job of group of people called as treasury management. So what are the functions of treasury management? So treasury management means it's a department inside the organization. They will be mainly doing banking. That means they will be depositing money into the bank, withdraw money from the bank, keeping the sufficient fund at the organization, and they will, sir, taking care of fund management. For example, tomorrow if I have to pass on a check to a creditor, they will ensure that the balance money is available in the bank. For example, they will ensure the proper collection from debtors on a time to time basis, and they will be taking care of the corporate finance, currency management, cash management. This taking care of all these things is what the function of one of the department in an organization called as treasury management. Okay, sir. Now management of cash. Sir, we can easily manage even debtor. We can easily manage even the creditors, but managing cash is really headache. I will tell you why. The following figure highlight the cash surplus and the cash shortage position over the period of cash budget for the pre-planning to take corrective and necessary steps. Sometimes this line is there. This line is the, sir, expected cash and bank balance with the company. Expected cash and bank balance with the company. Okay, sir, if I am keeping fund more than this, this is called as cash surplus. Unnecessarily I am holding huge money. Sir, if I am holding less than the line, that is called as cash deficit. In an organization, what should not be there? Cash surplus should not be there, and cash deficit should not be there. I have to keep the cash for my need. What are my needs, sir? Sometimes my need may be transaction need. In order to purchase the goods, pay the salary, pay the wages, I need cash. That's what transaction need. Or speculative need. So there is a good speculation of shares. Okay, I will buy the share, I can sell the share. For that, I can keep cash. And precautionary need. Sir, tomorrow, without information, some quick expense may come. For that, I have to keep some buffer cash. Are you all with me? Okay, sir. How to find out that? You said that, sir, 50,000 is the raw material stock you have to keep. Like that, debtors we have valued. How I can value the cash flow? I am having three methods, either receipts and payments method. How much cash is going to come? How much cash I have to pay? That's what receipts and payments account. Expected receipts and payments are considered. Cash inflows and cash outflows of all functional budget, including cap expenditure budget, are also considered. Then I will know that, oh my God, next month I am going to have a cash shortage. Or next month I am going to have a cash surplus. If surplus, I will deposit somewhere. If shortage, I will arrange fund in advance. So I will not be in a position of cash out. This is one method. Method number 2, adjusted income method, my dear lovable students. Adjusted income method in the sense means I will start with a net profit as per P&L account. Indirect cash flow method, that's it. Sometimes the depreciation debited to P&L account should be added back. All the non-cash item will be removed. All the impurities will be removed. Annual cash flows are calculated by adjusting the sales revenue and cost figures for delay in receipts and payments and eliminating non-cash items such as depreciation. By that way also, you can budget the cash. We have budgeted stock, raw material stock, sir, finished goods stock, WIP stock, debtors management. Generally, till now, sir, cash is given in the question. How they are giving in the question? Either they will be following the receipts and payments method, or they will be following the adjusted income method, or they will be following the adjusted balance sheet method. Adjusted balance sheet method in the sense means they will take the cash, closing cash balance from the balance sheet, and they will see share capital is there increase or decrease, reserves and surplus is there in increase or decrease, like that. Item of balance sheet are predicted by expressing what type of asset. Each except cash and bank. That means all other item in the balance sheet I am predicting. Then I am keeping the total liability side. I will drag total liability side is equal to total asset side. If I know all the asset other than cash and bank, I can take cash and bank as balancing figure. Are you all with me? And short-term liabilities as a percentage of expected sales. The profit is also calculated as a percent of sales. Adjustment to long-term liabilities is also made. So these are the three ways in which we can predict the cash. Either put the cash budget, that is called as receipts and payments method, or take the P&L, take the net profit. Sir, you treat that net profit as the cash available with you. You adjust back, sir, add back depreciation and all. you can easily find out the cash flow from operating activity. So if the cash flow from operating activity is negative, that much cash is required, you can keep that cash. Or adjusted balance sheet method means you predict all the other elements of the balance sheet except cash and keep cash as balancing figure. Coming to the cash management models, is there any particular models, any theorem like sir Gordon model, Walter model, Modigliani Miller approach, like that some theorem is there? Yes, sir. If everyone are coming up with every element of the working capital, why cash can't have? That's why William J. Baumol's economic order quantity model, which is nothing but the same EOQ, what we have studied in costing EOQ, my dear lovable students, exactly applicable to cash, which is nothing but root of 2AB divided by C. Or Miller or cash management model. So two famous models are there for cash management. Number one, William J. Baumol's economic order quantity model, or Miller or cash management model. What William J. Baumol is saying, according to this model, optimum cash level is that level of cash where carrying cost and transaction costs are the minimum. So two things are there, carrying cost should be there and transaction cost should be there. In order to carry the cost, I have to incur a cost. In order to do the transaction, I have to do the cost. I will tell you, if I keep lot of money in my office, actually anytime I can use that cash, then transaction cost will be zero, because every time whenever I need cash, no need to go to bank and withdraw money from the bank. But I can't keep the cash generally as if I'm keeping a normal paper. Someone will come and take, correct? So I have to take care very properly. I have to buy the Godrej, sir, NSR locker. I have to keep inside that. So automatically carrying cost will increase. One problem, if carrying cost increases, transaction cost decreases. If transaction cost decreases, carrying cost increases. What William Baumol economic order quantity is saying, that it is a level at which the carrying cost will be exactly equal to the transaction cost. Formula for determining optimum cash balance, root of 2AB divided by C. What is C? Optimum cash balance. That is a maximum cash balance you have to keep. Sir, U stands for annual cash disbursement. You check what is the annual demand of the cash. In a year, how much annual cash you are going to disburse. P stands for fixed cost per transaction. In order to withdraw money from bank, every time how much bank is charging, that's what fixed cost per transaction. And S stands for opportunity cost of 1 rupee per annum. That means, in the sense, means carrying cost per unit per annum. Are you all with me? Instead of keeping the money in my hand, if I deposit it somewhere, I will be getting some return. What is that opportunity cost? So this can be explained with the following diagram. Nothing. Transaction cost will come down and holding increases. There will be a total cost. That is there is a point where my transaction cost will be exactly equal to holding cost, correct? Carrying cost. Sir, it is a point at which my optimum cash balance is a point at which I should not incur highest money for the transaction cost, and also I should not incur highest money for the holding cost. That's it. What are the assumptions of William J. Baumol? When this EOQ model will be applicable, cash needs of the firm are known with certainty. I should know that this much is the cash need. This much is the, if I don't know the annual consumption of the cash, A itself is not available, then how root of 2AB divided by C I can apply? Fine. Cash is used uniformly over a period of time, and it is also known with what? Certainty. Sir, in Y0 itself, entire cash if you are going to spend means it will not be annual consumption. Correct? Cash should be spent uniformly. And the holding cost is known, and it should be what? Constant. You should know the holding cost, and throughout the year it should be constant. And transaction cost should be known, and also it should be what? Constant. Every month if the transaction cost and holding cost is changing, root of 2AB divided by C will not work, right? The second person, Miller or cash management model. Another person is saying that. Sumari pesadra. William J. Baumol. How? What is saying that? How you can exactly say that this is the cash expense in a year? Sir, according to this model, the net cash flow is completely stochastic. Stochastic in the sense means you can't predict. It will keep on changing like right, sir? Like ECG. Sir, someday cash requirement may be very high, someday cash requirement may be very low. You can't have you can limit upper control limit and return point and lower control limit. Right, sir? Yes, sir. Some days it will be at upper control limit, someday it will come to lower control limit, someday it will rise. So Miller or cash management is saying that this model is designed to determine the time and size of transfer between an investment account and cash account. What Miller is saying that keep a cash account plus the investment account. If you don't want money today, sir, swap it, sir, from the cash account to the investment account. Tomorrow, if you want money, quickly reswap it from the investment account to the cash account. Adilame, why are you holding unnecessary cash in the office? There should be one click cash will be released. There are short term, lot of investments are there. Correct? Instead of keeping that much cash idle in the office, try to invest somewhere and get some return. Hello? Yes, sir. In this model, control limits are set for what balance? Cash balance. For example, I will be having a control limit of 50,000. Once my cash balance holding above 50,000, automatically in my account, it will sweep to investment. Okay. If I pay something from my 50,000, for example, 30,000, automatically the investment will die and the money will come to this account. So always I will keep a minimum balance. These limits may be consist of H as upper limit, Z as return point, and 0 as the what limit, man? Lower limit. Sir, when it touches upper limit, when the cash balance reaches the what limit? Upper limit. Transfer of cash equal to H to Z. This much cash is there, no? Is invested in marketable securities account. This difference will go and invest. That means I won't what, man? Keep money more than return point. Okay. When it touches the lower limit, transfer from marketable security account to cash account is made. I will sell the security, money I will get, and I will refill, and I will come to return point. Are you totally with me? So, return point, this is called as return point. During the period when cash balance stays between HZ or Z0, high and low limit, no transaction between cash and marketable securities account is made. No transaction. So, this is what the idea of the Miller. It's not Modiglian in Miller or cash model, right? Sir, these are the recent developments. Now, no need to keep cash at all. You can do electronic fund transfer. You can open zero balance account. Money market operations you can do. Petty cash impress. For the small expense, you can have petty cash. You can have temporary cash surplus. Electronic cash management system. Virtual banking and all came in today. So today, sir, keeping that cash is not a big deal. They are saying, from ICA study material, we are having a very small question. We will be solving that question. Sir, it will be a very good question, my dear lovable students. With that, we can announce that we have completed the FM. Branchi Limited question. This is an ICI study material question. Branchi Limited is manufacturing company producing and selling a range of cleaning products to wholesale customers. They are selling something. Okay. It has 3 suppliers and 2 customers. Super. Abdina debtor 1, debtor 2, debtor 3, and creditor 1 and creditor 2. From debtor, they have to get the money, and to creditor, they have to pay the money. Branchi Limited relies on its cleared fund forecast to manage its cash. This is the crux of the question. There is a concept called as cleared fund forecast. I will teach you what is cleared fund forecast. You are an accounting technician for the company and have been asked to prepare a cleared fund forecast for the period Saturday 9th August to Wednesday 13th August. Abdina 9, 10, 11, 12, 13. You have to prepare 5 days cash budget. That's it. You have been provided with the following information. Okay. Sir, receipts from customer. We are having how many customer? 3 customers. 3 debtors, no. 3 suppliers. 3 suppliers and 2 customers. So, 3 suppliers na. Suppliers na creditors. And what? Customers means debtors. Correct? I am having 2 debtors and 3 suppliers. So, debtor 1, debtor 2. Creditor 1, creditor 2, creditor 3. Receive from customers. Sir, what is with regard to customer? Customer means I have to get money from the debtor. I am having W limited and X limited. Sir, what is the credit terms? 1 month, calendar month. 1 calendar month. That means if I sell today, I will get money only after 1 month. Payment, sir, BACS, that is some bankers, automated clearing services. Bracket. Okay, right. Sir, how much sales happened on 9th August? 1,50,000. 9th July, 1 lakh. Look at. 9th July na 9th August it will come. Because 1 month credit. So on this day, this 130 you will get. But this 150 you won't get. Correct? 140 you will get after 1 month. So when I prepare the next month cash budget, this 150 will come. But X Limited, none, no credit sales. Check only, my dear. Sir, today's check, sir, 1,80,000. Today itself, money will come in bank. This 160 would have came last July itself. I am not preparing for July. I am preparing for August. Am I right? So this 160 is irrelevant for the data now. Receipt of monies by banks, sir, is instantaneous. Instantaneous means IMPS. So when they made the transfer, immediately money will come to our account. That's it. அப்போ எப்போ transfer பண்ணிருப்பாங்க? 9th July I made the sale. 9th August they will transfer. 9th August itself I will get the money. அப்போ on the 9th August, look at here. On the 9th August, Saturday, hello sir, from W Limited, I would have got 1,30,000 or no other information. That's it. One data done. Comfortable? What is the status of the next one, man? X Limited checks will be paid into Branch's bank account on the same day as the sale is made and will clear on the third day following this, excluding the day of payment. Excluding the day of payment. When you deposited 9th, so leave 9th, then 10, 11, 12. So on 12th, on the third day, on 12th, will the money of 1,80,000 will be credited? Yes, sir. So come on. Sir, in your cash account, 9, 1,80,000 have not came. Sir, 10, this is 10, 10, 11 and 12. 12, 1,80,000 came. Correct? That means when you deposited that money into the bank, 9th, that means on 9th, come on 9th, uncleared fund float. Uncleared fund float means I deposited but money has not been cleared. So on this day, 1,80,000 it will show. This day also 1,80,000 it will show. This day also 1,80,000 it will show, but here it will get cleared. That means till it clear, their cash account will show that, okay, this much money has to be cleared. Easy pa. I will leave with me. Come to the next one. Payment to supplier. How many supplier? 3 supplier. A Limited, B Limited, C Limited. Correct? Sir, credit terms 1 calendar month. 1 calendar month means, sir, payment is standing order. Standing order means I said to the bank that every month you pay something. That's what standing order is all about. Right? 9th August purchases 65,000. When I made purchase, 9th August. I am preparing cash budgets for August. August 9, 10, 11, 12, 13. Comfortable? After 1 month only I will make the payment. So this will not considered at all. So what is the August Munadi month? July. Sir, July 9th I purchase. So I will make payment on 9th of August. Am I right? What is the value? 55,000. Clarity irkapa? I don't relate with me. Yes, sir. Sir, 9th June. 9th June means it would have paid on 9th July. So this is irrelevant because I am preparing cash budget for August. Come on. Branchi has set up a standing order for how much? 45,000 for a month to pay for the supplier from A Limited. This will leave Branchi's bank account on 9th August. Every few months, an adjustment is made to reflect the actual cost of supply purchase. You do not need to make this adjustment. Sir, what Branchi is doing? No, they are making payment to supplier, which is A Limited, right? Sir, 9th August, they purchase 65,000, correct? My dear lovable students, this 65,000, they will not make payment now. They will make the payment in the next month. But this 9th July, they will make the payment on 9th of September. August. Sir, how much is the payment? 55,000. So 55,000 purchase I made on 9th of July. Correct? That payment I will made exactly after 1 calendar month. That means 9th of September, I will make 45,000 rupees payment. Am I right? Yes, sir. Are you really with me? Sir, clearly understand? This is irrelevant data. This is irrelevant data for this month. It will come only the next month. Sir, last month 9th, I made a purchase of 55,000. If that is the case, means this month 9th, I have to pay 45,000. Are you really with me? So last month purchase how much? 55,000. So current month payment 45,000. 45,000. Why? Because it's standing order. Whatever may be the purchase I made, every month I will pay only 45,000. Sir, then balance 10,000. It will be adjusted in the next month. That's what they are saying. Branchi has set up a standing order for how much? 45,000. A month to pay for supplier from A Limited. From A Limited, they will pay only 45,000. This will leave Branchi's bank account on 9th of August. So from 9th of August, look here, outflow. Payment, 9th of August. This is 9th. 45 will go for the A Limited. Are you really with me? Yes, sir. Nothing more, nothing less. Sir, up 10,000 extra, sir. Every few months, sir, adjustment is made to reflect the actual cost of supplies purchase. You do not need to make this adjustment. Balance 10,000, you don't worry. That future automatically it will adjust it. Okay, wow. Next, B limited. How much calendar month? 2 months calendar. How you are making payment? Check. Check na, sir, Q you have to make in the cash. Correct? Yes, sir. Sir, this month irrelevant. This month also irrelevant because 2 months period. Correct? Only 75 is valid. Because if I purchase on 9th June, I will make payment on 9th September. July, August. Correct? 9th of August. I am preparing cash budget for August. So this 75,000 is valid. Let me ask you a question. Is this 75,000, sir, is any standing instruction? No. Branchie will send out by post check to B and what? C on 9th of August. So on 9th August only I will send the check. That day itself money will not go. But the amount will leave its bank account on the second day following this, excluding the day of posting. Leave the excluding day of posting. When they posted 9th. So leave 9th, 10, 11. 11 money will go. But till that they have to keep their bank account. That sir, payments, correct? What is the total purchase? 75,000. And this 85,000 also. Because for B and C there is no standing order. But C there is no calendar month. Correct? Sir, it is none. None means, sir, 9th August purchase made, 9th August itself they have to pay. This 95,000 they have to pay. This they would have already paid last month. This 85,000 they would have already paid last month, right? So this 75 plus 95 will be the matter. 1,70,000. And the 1,70,000 wow, where level. Comfortable? So that 1,70,000 I will show it as payable. Sir, this is uncleared fund float. In the sense means this has not gone from my bank account. But this is yet to go. Correct? When it will go, sir, 9th August over, that day only I posted, 10th August it will go. 11th August it will go, right? Yes, sir. Sir, 11th August it gone, so I have not shown it. So on 11th August, sir, I have to show it as outflow, correct? For the what limited, B limited, on 11th August, 75 gone out. And for C limited, 95 gone out. Chumma path cash budget. Are you all agree with me? The same question is an ICA question, will be repeated for this time. I am expecting this question to test. Because 10 mark cash budget, no one will prepare. And they will give you a shock. Shock laga. Easy. Easy. Wages and salary. July month and August month. You are in the month of August. We are preparing the cash budget for August 9, 10, 11, 12, 13. Weekly wages is 12,000, 13,000. Okay. Monthly salary 56,000, 59,000. What they are going to do? Factory workers are paid cash wages weekly, every week. They will be paid 1 week wage on 13th August for the last week's work done in July. They work a week in hand. Apo, you are preparing for August, yes, sir. So whatever work they done in July, this is the work done in July, weekly wages they have given. Okay. Apo, July month they will pay only in August. August Chepo. 13. August 13. So this day they will pay. This day they will pay 12,000. Sir, yedoda payment. July last week payment only 12,000. Correct? That they are going to make the payment on 13th of August. But August they are liable to pay 13,000. They will pay in maybe August end or September. I don't know because I have reached only 13. Next week will not go to September. Next week will be there in August itself. Hey, I am preparing only for 5 days, pa. Correct? So on August 13, there will be cash outflow. Correct? There will be cash outflow for wages of 12,000. Exactly matching 12,000. Comfortable? Sir, but this is monthly salary, not weekly. Monthly salary. What is the terms for monthly? All the officers, workers are paid salary monthly by BAS. You know what is BAS? BAS means immediate. When they make the payment, immediately it will reflect. Salaries for July will be paid on 9th of August. But this salary 56,000 I will pay on 9th of August. Can I make the payment? On 9th of August I have to come. 9th. Sir, salary 56,000 will go out. That's it. All other things will be dash. Simple. Coming to the next one. Other miscellaneous payments. Every Saturday morning. Okay. Every Saturday morning. Saturday. Come on, Saturday. Come on. Sir, you are accounting technician for the company and I've been asked to prepare a cleared fund forecast for the period Saturday 9th. So Saturday, starting point Saturday. Okay. Every Saturday morning, petty cashier withdraw 200 from the company's bank account for the petty cash. The month leaves branch's bank account NSR straight away. That means every Saturday they will withdraw 200. That means, my dear lovable students, 200 will come to the cash account because from bank they will withdraw. Bank balance reduces and cash balance increases. Correct? This is what petty cash 200. No other thing. Okay. What they are going to do with that? The room cleaner is paid 30 from the petty cash every Monday morning. Every Monday morning, 30 rupees I will pay to the room cleaner. How much I withdrawn? 200. That will increase the cash balance, right? Now from that, 200, I am spending 30, I am spending 50, I am rupees 10. All these will affect my cash balance. அப்போ எவ்வளோ rupees வெளியே போகும்? 30 rupees வெளியே போகும். Come on, 30 rupees. Sir, what you are preparing? Cleared fund forecast. What, man? Where is that 30 rupees? Monday. Monday is 11th August. Monday. Where is that 30 rupees? Nowhere is there. Because that will affect only your cash account, not the bank account. What I am preparing is the bank aspect. Sir, when I withdraw, bank balance reduces and it will come to the cash. Sir, I am not preparing petty cash, pa. Am I preparing petty cash account? It will affect only the bank and the petty cash. The money will go out of the petty cash. Correct? Yes, sir. Office stationery will be ordered by telephone. கூப்பிட்டு சொல்லிடுவேன் கொண்டு வாப்பா. On Sunday, 10th August, to the value of rupees 300. This is paid by company debit card. Debit card. Such payment are generally seen to leave the company account on the next day, working day. So when I make the payment of 300 on Sunday, Monday it will go. So Monday, 11th August is a Monday. Monday 300 rupees will go out. Yes, sir. So till that day, so Sunday it will be uncleared. Correct? So Sunday already 1,70,000 was there. Plus 300, 1,70,300. On Monday everything will become clear. It will become zero. Ennappa comfortable. 5 new software will be ordered over the internet on 12th August at a total cost of 6,500. On 12th of August you ordered 5 new software. A check will be sent on the same day. Amount will leave Pranchi Limited bank account on the second day following this, excluding the day of posting. What is the day of posting? 12th. Leave 12th. Then 13, 14. From 14, 16,500 will go out of bank. Correct? But 14 is there? Not there, sir. So, but here you will not show. But it will be there in the uncleared fund float. That means from 12th. But from 12th onwards, it will show 6,000. That means what is uncleared fund means we are yet to pay 6,500. So it is an alarm to the company that don't spend too much. Please keep this much money in the bank account for sure. That is called as uncleared. Balance of Pranchi's bank account will be how much lakh? 2 lakhs on 9th August. From that only we started opening cash balance given. This represents both bank balance and the what fund? Cleared fund. So that is the starting point, man. 2 lakh. Look at here, man. Sir, cleared balance brought forward 2 lakh. You are supposed to get the cleared balance carry forward 2,28,200. Ebdina, here you are having 28,200. What is the 28,200? Sir, receipts, you got 1,30,000. Total 1,30,000. From 1,30,000, come on. 45,000 is you made payment. 56,000 you made payment. 200 you made payment. 45, 56, 200 comes to 1,01,200. From 1,30,000, if you make 1,01,200, 28,800 will be cleared. Cleared means excess money with you. So already you are having 2 lakh. Now you are having 28,800. So 2,28,800 will be the balance. That's it. Sir, this part, no, uncleared fund float is just a control account, not the cash account. Correct? Coming. Next one. Prepare a cleared fund forecast. Cleared fund forecast na clear aanadha mattum podu. For the period Saturday, 7th August to Wednesday, 13th August, include using the information provided. So clearly the uncleared fund float each day. Appo inga va. That's it. 7th August illa 9th August illa 9th August. Yes, 9th August to 13th August. Sir, next day, Sunday, leave pa. No receipt, no payment. That means the same 2,28,200 will be carried forward. This will be the closing balance. Correct? This will be the opening Monday. But Monday we got a paid. We paid 75 and 95 and 300 for stationery. So 175, 300 gone. We are having 228,800. So from 228,800, 1,70,300 gone means 58,500. That will carry forward to the next day. Next day we receive money from 1,80,000 from W Limited. Correct? No payment. So 58,500 plus 1,80,000 comes to 2,38,500. Next day morning 2,38,500 was there. From that wages we made 12,000 payment. Hello sir. Total 12,000 gone out. So from 2,38,500, if 12,000 gone out, 2,26,500 is a cash balance. This is simply cash account. Coming to the uncleared fund float. Both under receipts and payments you will be having uncleared fund. Correct? Sir, receipt 1,80,000. From whom you got 1,80,000? From the debtor. But it has still not cleared. Sir, you made payment to the creditor 1,70,000. So total 10,000 gap was there. Correct? But we are having book balance of 2,28,800. Now, even on this day, our check has not been cleared. Even on this day, our check has not been cleared. So 170 was there and again 300 was there. So total net of 9,700. But on this day end, we were having 2,38,500. Every 2,38,500. Total book balance carry forward. $1,80,000. This was the fund to be cleared. 2,38,800. 300 net off. This we are supposed to get. This is supposed to be paid. Difference. நம்ம கிட்ட இருக்கு. Excessa cash இருக்கு. Correct? So last book balance was 2,38,000. Now the book balance is 2,38,500. Next month, still this has not been received. It is still receivable, but this has gone out. According to us, 1,80,000 receivable and total book balance carry forward 2,38,000. Sir, somewhere can you manage this 2,38,500? Mele. 2,28,800 is the cleared balance. Correct? 2,28,800. Right. 2,28,800. 2,38,500. $2,38,500 is the total book balance. Yes, sir. This become end, second day end. This is the balance on the second day end. Yes, sir. 58,500 opening balance. Yes, sir. Up 2,38,500 plus 58,500, 2,97,000. This is cleared balance. Minus 58,500 is a cleared balance. Correct? Carry forward. Correct, sir. 58,500 plus 1,80,000 is the total to be receivable. So total 2,38,500 should be there in our cash. This is actual cleared amount. This is yet to cleared amount. This is actual cleared amount. 2,28,800. This is yet to cleared amount. அவ்வளவுதான். இது ஆல்ரெடி கிளியர் ஆனது, இது கிளியர் ஆக வேண்டியது. ரெண்டும் சேர்த்தா எனக்கு எவ்வளவு இருக்கும் புக்ல. This is, look at here. 2,38,500 is a cleared balance. Correct? But 6,500 minus 6,500. That means 2,32,000 will be the net balance. Here what I am showing is, sir, வரவேண்டியதெல்லாம் வந்தா, கொடுக்க வேண்டியதெல்லாம் கொடுத்தா, what is the net balance? Here 2,26,500. I am liable to pay 6,500. So I can plan my fund only to the extent of 2,20,000. Comfortable. Very good question. Easy question. I say study material question. If you look at the question, everyone will feel that, wow, it's a very big question. It is not my area. But when you read it, it's a very easy question. The same question can be tested for 10 mark in exam. My dear lovable students, we can say that we are through with the revision and the workout of the EFM. Ensure that these topics you have completed in your FM. Number one, cost of capital. This will surely come for 7 mark in exam. Cost of capital. Topic number 1. Topic number 2, capital structure theories. This is coming for 5 mark in exam. Number 3, arbitrage process. If it comes coming for 5 mark in exam. Number 4, EBIT, EPS analysis, a sure shot 5 mark area. Number 5, indifference point. Sir, if it comes 5 mark area for exam. Number 6, leverage analysis, mandatory 5 to 6 mark area for exam. Number 7, ratio analysis, sure shot 6 to 7 mark area for exam. Number 8, dividend decision. Surely they are asking for 5 mark question from exam. Number 9, capital budgeting. Oh my god, 8 to 10 mark area for exam. And the last one, working capital management, a 6 to 7 mark area for exam. Sir, in this, if you are asking me, can I take, is there any irregular area? This is one of the irregular area. I will never say that this will not come in exam. But this, if time shortage, if you don't have time, arbitrage process, you can keep it at the end. Sir, the next one, you can keep it at the end. Capital structure theory is also okay. 2 topics. Other than these 2, all the topics are regular topics. You have to prepare. These are the top 10 movies of the Sir FM. If you are preparing this 10 topics out of 50, you can write for 50 in examination. It's very happy to say that we have completed the entire revision and the workout of the EFM. That's it. Sir, thank you for watching, my dear lovable students. You can update your reviews regarding the classes to this number 960-500-1043. I hope that I tried my level best to give you the conceptual clarity. You can inform me how you are feeling. I'm wishing you all the very best for the coming examination. Thank you. Bye-bye from A&M.